Alright friends, so we are actually starting with a new chapter that is called as Pgbp, that is profits or gains from business or profession. This chapter is very important. Why? Because there will be a question which will carrying around 14 to 16 marks in relation to this chapter, that is Pgbp. Without Pgbp question, there in all the attempts in the history of ICAI, they have asked a question which carries at least 14 to 16 marks in Pgbp. Alright, that is a minimum. You can expect more from this chapter. So this is the most important chapter for our syllabus. So starting with the first thing, Pgbp. So whatever we have learned till now, I've already told you that first the person should have income. If you have an income, then you should check whether it forms part of the scope. How to check whether it forms part of the scope? For that, we have residence rule and source rule. Once it is there in the scope, you can remove the exempted incomes. Once exempted incomes are removed, then all the incomes have to be bifurcated into 5 heads. Yes or no? First head is salary. All the incomes which have an employer-employee relationship will be processed in the head salary. Next is house property. Rental incomes will be processed over there. Next is Pgbp. All the incomes from your business or profession will be assessed under Pgbp, and the charging section is section 28. Then it is capital gains and thereafter IFOs. So we are about to deal with Pgbp section 28. So let's understand what all are the things that are covered under the complete head Pgbp. So friends, tell me, what do you mean by business? What do you mean by business? So business simply means an activity, maybe in the nature of a trade, commerce, manufacture, which is continuous in nature, which is recurring in nature. That is called as what? Business. Now you tell me what is profession. I've told you what is business. Now you tell me what is profession. Profession simply means by making use of your experience, skill, expertise, if you are able to generate some income, that is professional income. There is nothing that you should have a professional qualification. Say for example, my ancestors are very good in this medicinal plants. They told me some secrets in relation to this medicinal plants, this mix and all. I'm making use of that to generate income. Do I have a professional qualification? No, doesn't matter. If I'm making use of that knowledge from my ancestors to earn an income, that is also what? Professional income includes vocation also. I'm in the business of preaching. Alright. Definitely that also income generated by me can be called as a professional business. Say I am not a chartered accountant, but I know income tax and I am teaching you and I am generating some income. Professional income. Are you all here? The point is whether I am able to generate some income by making use of my profession, knowledge or experience, expertise, skill, etc. That will be definitely called as what? Profession. I hope it is also clear. So all the direct income from your business or profession will be always taxable under Pgbp. All the direct profits from your business or profession will be directly taxable under Pgbp. That is the first thing that you should know. All the direct profits. And apart from that, there are certain specific items also that are covered under Pgbp. What do you mean by specific items? The items which we are about to discuss may not be a direct income from your business or profession, but that also have to be processed under Pgbp head. We can call it what? Specific items under section 28. Are you all listening? Yes or no? So specific items. Along with the general items, there are certain specific items that are covered under section 28 that have to be processed under Pgbp. Let's understand which all are the specific items that are covered under Pgbp. Item number 1, it's very simple. Any compensation or similar payment received due to termination or modification of business or professional contracts. You are in receipt of any compensation which is on account of termination or modification of any business contract or professional contract. All those incomes have to be processed under section 28. What do you mean by this? What is this compensation or similar payment received due to termination or modification of business contract? Say for example, I have a KFC franchisee agreement. In Chennai, I am running a KFC outlet. I've signed a franchisee agreement with a Kentucky Fried Chicken. Hope you know KFC, right? Now, that contract was for 10 years. After 3 or 4 years, the KFC official came to me and they told me that they are not interested in continuing the franchisee agreement. Obviously, I will ask for what compensation? Because they told me that this agreement is valid for next 10 years. That's why I have invested in the business. Yes or no? All of a sudden, they are coming and they are saying that we are not interested in continuing our franchisee agreement. Then I will definitely ask for the compensation. If I am getting some compensation, that compensation also have to be assessed under Pgbp. Why? Because even though it is not your direct business profits. What is my direct business profit in the business? Selling of fried chickens or burgers or whatever food items. Yes or no? But this compensation, even though it is not my direct business profit, it have to be assessed under section 28. Why? Because section 28 specifically states that if you are in receipt of any compensation or similar payment due to termination or modification of a business or professional contract, you have to process it under the head Pgbp. I hope it is clear. Are you guys listening? That is the first item that are covered under Pgbp. I recommend all of you to write lecture notes, okay? I recommend all of you to write lecture notes in between. Theory is there in the material, but still I am saying you should write lecture notes. Moving on to point number 2, let's understand what is the second point covered under section 28, that is specific item. So the second item under section 28 is income in relation to earned by a trade professional or similar association. So listen, any income earned by a trade professional or similar association from specific services rendered to their members. First of all, let's understand what is this trade professional or similar association. Friends, tell me, what do you mean by trade professional or similar association? What do you mean by trade professional or similar association? What is this trade professional or similar association? You tell me. It simply means, say for example, Chamber of Commerce, Bar Association, etc. can be called as a trade professional or similar association. In Chennai, we can call that Nadigar Sangam. Have you heard about Nadigar Sangam? That actors and actresses association, film industry association, Nadigar Sangam in Tamil Nadu. That is a perfect example for what? Trade professional or similar association. We will call it as NS, Nadigar Sangam. So tell me, what is the objective of NS? What is the objective of NS? Welfare of its members. Yes or no? The main objective of Nadigar Sangam will be its welfare of its members. How do they get fund? They will have contributions from members. We will call it as contributions from members. And they will utilize it for the benefit of members itself. Yes or no? Utilize for members. They will have contributions from members and they will utilize these amounts for the welfare of members. This concept is called as principle of mutuality. This is called as what? Principle of mutuality. What is principle of mutuality? I am collecting, pooling income from you for your benefit. Are you all with me? I am pooling income from you for your own benefit. This is not a taxable activity. The principle of mutuality comes here and this is not a basic taxable activity. Say for example, I have collected 10 lakhs. I have collected 10 lakhs from the members and I have expended 8 lakhs. And what do you call this remaining 2 lakhs? There is a name for the remaining 2 lakhs. What do you call it? Surplus. It is called as what? Surplus. This surplus is not taxable. This surplus is not taxable due to the principle of mutuality. This surplus is not taxable under PGBP due to the principle of mutuality, because this is not a income generating activity. I have pooled funds and applied it for you. I pooled funds from you, applied it for you. There are some remaining balance fund to be applied in future. That to be applied in future is never your profit basically. And hence there is no taxability under section 28. But say for example, this Nadigar Sangam is selling some makeup kits. Makeup kits. What do you mean by makeup kit? Say, makeup products like lipstick, eyeliner, whatever it is. So, this Nadigar Sankam is selling this makeup products to its members for a fees. It's not free. Okay, it's for a consideration. That is a profit generating activity. There is no mutuality and all here. That is a profit generating activity. So, come back to the point. Income earned by trade professional or similar association. Normally, their surplus is not subjected to any taxes due to the principle of mutuality. But if they are earning something from specific services rendered to their members, then that is definitely accessible under section 28. Are you with me? Now, say for example, they are selling this makeup items and they are getting a revenue. Then that revenue or that profit is definitely taxable under section 28. Now friends, there is a small thing under section 44A. Section 44A, I will mix it with section 28 for a better understanding. Let's mix 44A and 28. I'll tell you what is 44A. Listen. Please be attentive here. Say for example, this Nadigar Sangam have collected 10 lakhs from members and they have expended 14 lakhs for the benefit of members. They have expended how much? 14 lakhs for the benefit of members. What is this 4 lakhs figure called? It's called as deficit. Yes or no? This 4 lakhs figure is normally called as what? Deficit. Are you with me? Now, that surplus is not taxable. That also means deficit, you cannot claim it as a loss. Are you with me? If surplus is not taxable, then deficit you cannot claim it as loss. Now listen friends, in the same year, I have some profit from selling of makeup kits. I have some profits in relation to selling of makeup kits. Say that is 6 lakhs. My profit is how much? 6 lakhs. I have some profits which are in relation to selling of makeup kits. My question is, can I set off this 4 lakh loss from the 6 lakhs profit? Can I set off this 4 lakh loss from the 6 lakhs profit? The answer is very obvious, no. But income tax department say, according to section 44A, what you can do, you can take this loss and you can claim it from your taxable profit subjected to certain ceiling limit. And the ceiling limit, what they say is, up to 50% of your income, you can set it off. Loss up to 50% of your income. That doesn't mean 50% of your loss. Loss up to 50% of your income. What is my actual loss? 4 lakh. How much is my income? Taxable income? 6 lakhs. How much is 50% of taxable income? 3 lakhs. Do I have 3 lakhs loss? Yes, I have 4 lakhs loss. Out of that 4 lakh, I can claim 3 lakh. And the remaining 3 will be taxable. And there is some, balance losses there. Unexhausted loss we can say. Or unclaimed loss. What to do with that 1 lakh remaining loss? You cannot carry forward and all. It is fully expired. There is a remaining loss of rupees 1 lakh that is fully expired. You don't have a provision to carry forward it to the next year. Current year deficit. Up to 50% of taxable profit can be set off from the taxable profit. This is what section 44A states. Are you with me? Hope you got the point. Now, so that is section 28 second specific items. I hope that point is also clear for you. Now listen, moving on to the next point. Third specific item under section 28 is export incentives. What is export incentives? You must tell me. What is export incentives? Say you are doing some export. You are getting some government grants or maybe something like a duty drawback, or you are getting some profit entitlement passbook or something. All the benefits earned by you shall be fully taxable under section 28. Hope you heard about duty drawback, profit entitlement passbook, etc. etc. What is profit entitlement passbook? So import license or duty entitlement passbook simply means, say you are an exporter and you want some raw materials. That raw materials you normally import. When you import something, you need to pay import duty. Yes or no? Say for example, I'm a fish exporter and I require some preservative for preserving its shelf life. So I'm importing that preservative. While importing, I need to pay the import duty. But what department say the department has given me a benefit. I can import 1000 liters of preservative every year without paying any import duty. I can import how much? 1000 liters. This 1000 is just a number, okay? This 1000 liters every year without paying any import duty. This is called as what? Duty entitlement passbook. Are you with me? Now, say what I am doing is, instead of importing this 1000 liters of preservative, I myself is manufacturing that preservative. I myself is manufacturing that preservative. Do I require this passbook or do I require this license? No. Then what will I do? I'll give it back to the government. No, I will sell it outside. Why should I give it back to the government? Okay, I'll sell it outside for a money, for some value. Yes or no? That value also will be taxable as an export incentive under section 28. Are you with me? So whatever export incentive that I've received by way of a duty entitlement passbook or a profit entitlement passbook or a duty drawback, whatever it is, all have to be assessed under section 28. Even though that is not your direct business profit, you have to tax it under section 28. I hope it is clear. Are you all listening? Moving on with the next item, item number 5, that is value of number doesn't matter, okay, 4 or 5, it's okay. Yes, value of benefit or perquisite received on account of business or profession. Value of benefit or perquisite received on account of business or profession. You tell me, benefit or perquisite. The perquisite normally taxable under section 15 under salary, right? Then why I am saying it under 28? Say I have received a perquisite or a benefit in relation to my business or profession. That benefit have to be assessed under section 28. For example, say you are a manufacturer. You are a manufacturer and I am one of your distributor. I'm one of your distributor. You told me that I have to distribute 1000, say for example, you are manufacturing bottles. You are manufacturing water bottles. And you told me that I have to sell 1000 cases of bottles this month. I have to sell how much? 1000 cases of bottle this month. If I sell this 1000 cases of bottle, you will give me a gold ring. You will give me what? A gold ring of worth 20,000. And I've agreed to that and I've sold 1000 cases of bottle. Now you are giving me a gold ring. The value of gold ring is taxable under 28 in my hands. It is not treated as a gift because it is received on account of my business or profession. Yes or no? So those items have to be assessed under section 28. This is actually the important item. Because normally they ask this as an adjustment in our exams. So if you have received any benefit or a perquisite like a gift or something in relation to your business or profession, that have to be assessed under section 28, not under IFOS. Under Pgbp itself, you have to process it. Moving on. Item number 5. It say any interest on capital or remuneration received by partner from partnership firm. Say you are a partner of a partnership firm and you are in receipt of what? Interest or remuneration from a partnership firm. Listen, you are a partner of a partnership firm and you have received interest on capital. What is interest on capital, friends? What do you mean by interest on capital? The partner will definitely contribute capital to the firm. Most of the firm will pay what? Interest on that capital to the partner. And that will be taxable in the hands of partner under Pgbp under section 28. Are you with me? Number 2, if that partnership firm is paying remuneration to working partners. If the partnership firm is paying what? Remuneration to what? Working partners. that also will be accessible under section 28. It is not under the head salary. Why it is not under the head salary? There is no employer-employee relationship between a partnership firm and a partner. Partner is one of the owner of that particular partnership firm, and hence, even though you can call that amount as a remuneration, that will not be assessed under the head salary. It have to be assessed under the head Pgbp in the hands of partner. Are you with me? So if a partner receives any interest on capital as well as remuneration from the partnership firm, then the same will be assessed in the hands of partnership firm under the head Pgbp. Yes. Moving on. So let's understand the next thing, friends. Listen. So item number 6. Item number 6, let's understand. They say non-compete fee. Non-compete fee received by a person. What do you mean by non-compete fee? Non-compete fee. Say I have opened a new academy nearby. Alright. And the owners of this academy comes to me and they said, don't open a new academy. We will pay you 10 lakhs. Then I said, thank you so much. I will take the 10 lakhs and put it in my pocket and say, tata, bye bye, and I will run away. So the 10 lakhs received by me also have to be assessed under Pgbp because it is a non-compete fee. I haven't started my business. Alright, I haven't started my business in a particular place. But if I am receiving any non-compete fee, that have to be assessed under Pgbp itself. Whether it is in relation to my business or profession, of course. Now, there is one more point. Or fees or amount for exclusivity. Exclusivity of intangibles. Fees or amount for exclusivity of intangibles. What do you mean by exclusivity of intangibles? Fees or amount for exclusivity of intangibles. I'll give you a common example for this. Who is the biggest car manufacturer in India? Who is the biggest car manufacturer in India? Maruti Suzuki. Forever. Yes or no? Most of the people, Indians, are actually very much interested in Maruti Suzuki's car. One of their hit models was Swift Diesel. Swift Diesel. It is right now, it is not there. It has been discontinued. But earlier, there was Swift Diesel. And the Swift Diesel uses multi-jet engine technology, which was actually developed by Fiat. But Indian customers say Fiat's engine is not good. But Maruti Suzuki's engine is super. Maruti Suzuki is actually using Fiat's multi-jet engine technology for developing their own diesel vehicles. So, what happens is this Fiat have to share this engine technology with Maruti. Yes or no? Are you with me? So, Maruti have to pay an amount to Fiat to exclusively use that particular intangible. That payment received by Fiat also have to be assessed under Pgbp. Fiat's main business is manufacturing car and selling it. But all the payment that they received in relation to intangibles for sharing it, for exclusively sharing with a particular company or a particular customer have to be assessed under section 28. It should not be a generic item. What do you mean by generic items? There are certain inventions where there is no patent registration and all. Everybody can use it. These are items which is properly registered and you are sharing it with someone exclusively and you are getting a payment. Those payments are covered under section 28. That's what I've written. Fees or amount for exclusivity of intangibles received by a person also shall be assessed under section 28 under Pgbp. Moving on. Item number 7. Item number 7, they say any proceeds under Keyman insurance policy. Keyman insurance policy. What do you mean by any proceeds under Keyman insurance policy? Pretty simple. What is Keyman insurance policy? You tell me. What is Keyman insurance policy? Say for example, say there is a, just like Sundar Pichai for Google. Sundar Pichai is actually a public person or a spearhead of Google. Yes or no? If something happens to Sundar Pichai, definitely Google's share value will come down. Are you all with me? So that person is a very, very important person for my company. So I'm taking an insurance on his life. If something happens to his life, or something happens like an incapacitation or something for him, then my company will suffer a loss. If a company is suffering a loss, then insurance company will pay me a fixed compensation. Are you with me? In the industry, this keyman insurance policy, so in the industry, this keyman insurance policy works in different way. At certain point of time, the proceeds will be given to employee. In certain policies, the proceeds will be given to the employer. In certain policies, the proceeds will be given to the legal hire of employee. Are you all with me? If some death or something happens, then the proceeds will be given to the legal hire of the employee. That will be taxable in the hands of legal hire under IFRS. If a loss suffered by the company, then the proceeds will be given to the employer. That will be covered under Pgbp. If some incapacitation or something happens to the employee and the proceeds will be given to the employee, it will be covered under salary. Are you with me? So, section 28 covers only when proceeds are given to the employer from the insurance company. Are you all listening? So, any proceeds under keyman insurance policy, we can write received by an employer, will be taxable under section 28. And moving on to the next item, that is item number 8. Item number 8, they say, when you convert your stock in trade into capital asset, when you convert your stock in trade into capital asset, fair market value as on date of conversion. Fair market value as on date of conversion have to be an income taxable under section 28. This is actually a notional income. Notional income. What do you mean by notional income? You are not receiving anything. So what do you mean by converting your stock in trade into capital asset? What do you mean by converting your stock in trade into capital asset? Say for example, I am a AC trader. I am a AC trader. What is my stock in trade? AC. Of course. I took 2 ACs and installed in my office. I took 2 ACs and installed in my office. It is called as what? Conversion of stock into capital asset. Are you with me? So when I am converting my stock in trade into capital asset, am I getting anything? Am I getting anything? No. But department say, when I'm converting my stock in trade into capital asset, the fair market value as on date of conversion of particular stock in trade have to be treated as a business income. It's a notional income. And the same day, you are supposed to do one more thing. I can treat that fair market value as a purchase cost of that capital asset. That means the AC which I installed in my office is one of my capital asset thereafter. That AC which I've installed in my office will become my capital asset from the date of installation. Yes or no? If it is a capital asset, then I have to capitalize some value and I have to claim depreciation on that value. Yes or no? And what is the value to be capitalized? The same fair market value I can capitalize and I can claim depreciation in future. Are you with me? So when I'm converting my stock in trade into capital asset, the fair market value as on date of conversion have to be assessed under Pgbp. The same fair market value I can capitalize and I can claim depreciation in future under section 32. I hope you guys are listening and I hope you got my point as well. This is a notional taxation. What is notional taxation? I am not receiving anything on the date of conversion, but this is the procedure. I have to treat that FMB. Why? Because when I purchase that AC, that will be treated as my business cost, one of my business expenditure. When I'm converting it, that AC is no longer my stock. So I need to nullify that effect. To make it proper, they say, you take the fair market value and treat it as your income. And the same fair market value you capitalize and claim depreciation in future. It's an old case law called Etish Trading Company. It's an old case law. In 2018, they brought in as a Finance Act amendment. Right now, it's not a case law. It's a part of section 28 itself. Moving on. Item number 9, that is any amount received on account of transfer of a capital asset, where 100% of its cost already allowed as deduction. What do you mean by 100% of the cost already allowed as deduction? Hope you heard about specified business. What is specified business? Deduction under section 35 AD, right? 35 AD also. Okay. What do you mean by specified business? Specified business. Hope you have studied this in your inter syllabus. See, we will cover specified business again. When we move on, we will cover specified business. Again, for the time being, if you are a specified business under 35 AD, you have a benefit. What's the benefit? You can claim your entire capital expenditure as a deduction straight away from your taxable profits. A normal business have to capitalize the cost and claim depreciation. But if you are a specified business, what you can do, you can claim all your capital expenditure as a straight away deduction from your business profit directly. Rather than claiming depreciation, you straight away charge that capital expenditure as an expenditure under 35 AD. That is the advantage of 35 AD specified business. Say for example, say I am a hospital with 100 patient beds. 100 patient beds is a specified business. A hospital with 100 patient beds is a specified business according to 35 AD. Say I'm a hospital and I bought a building. For 10 lakhs. This 10 lakhs is my capital expenditure, but I can claim this 10 lakhs as a deduction under 35 AD in the year when I purchased this particular building. I don't have to capitalize it and claim depreciation. According to the provisions of income tax, I can straight away charge that 10 lakhs as a expenditure. Now, say in year 3, I've sold that particular building. Say for 6 lakhs. I've sold that particular building for how much? 6 lakhs. Then what to do? All the 6 lakhs have to be at taxable income under section 28. Why it is taxable income under section 28? It is just like putting a reversal entry in accountancy. You expended 10 lakh and claimed it as a deduction. Later on you sell it or discard it or demolish it and you're receiving something back. Are you all listening? To balance that effect, that amount you got back afterwards is a taxable income under section 28. Just like a reversal entry in accountancy, any amount received on account of transfer of a capital asset where 100% of its cost is already allowed as a deduction under 35 AD. You have already claimed this entire 10 lakh as a deduction in year 1 from your taxable business profits. Later on, you sold that particular building and you received 6 lakhs back. Then this entire 6 lakh have to be assessed under section 28 as your taxable business profits. Just like a recovery of the deduction. Are you all with me? Moving on to item number 10. Item number 10, that is any profit from speculation business. From speculation business. What is the speculation business? You must tell me, what is the speculation business? See, speculative business means income or loss that a person earns or suffers on account of speculative transaction. What is speculative transaction? A transaction for purchase or sale of a good, including stock, without actually taking physical delivery. That simply means you are not buying anything, you are not selling anything, you are taking only positions. The best example is intraday trading. In the morning, if my position, in the evening, I'll take the reverse to earn profits. Yes or no? Arbitrages, things like that is purely speculative in nature. Income tax department defines speculative activities. So we will write a small note in relation to that. So please write, speculative transaction means it has been tested. It has been tested, I think, 4 times in new syllabus. It has been tested 4 times as an adjustment, not as a solved question, as an adjustment, I think 4 times in new syllabus. So we'll write this down. Speculative transaction means purchasing or selling commodities including stocks or shares otherwise than by actual delivery. Otherwise than by actual delivery. Example, you can write intraday trading. Intraday trading. Example, you can write intraday trading. Now, there are certain exclusions for the speculative transaction definition. What do you mean by exclusion? The following, even though it is in the nature of speculative transaction, will not be regarded as speculative transaction from the perspective of income tax. Are you with me? The following items which are about to discuss is pure speculative transaction, because we are not taking any physical delivery, but it will not be regarded as a speculative transaction. Why? Because it has been specifically excluded under the definition. So we will write, please write, the following shall not be regarded as speculative transaction. Shall not be regarded as speculative transaction. Item number 1, we will write hedging contract. Hedging contract in respect of raw materials. Hedging contract in respect of raw materials. So friends, tell me, what do you mean by hedging contract in respect of raw materials? Say for example, I am expecting my raw materials to be very costly after 6 months. So I am entering into a hedging contract to buy raw material at a lower cost in future. Alright. Say for example, I'll give you one example. These are purely SFM items. I'll give you an example for certain items. Say for example, please listen. Say I'm a jeweler. What is my raw material? Gold, right? Gold is my bullion, normally we call. That gold biscuit is normally my raw material. I am expecting gold prices to be very high after 6 months. I am expecting gold prices to be very high after 6 months. I am expecting around 1 lakh rupees. 1 lakh rupees. Or I am expecting 10,000 rupees for gram. 10,000 rupees for a single gram. Say assume it is around 4,000 rupees now. 4,000 per gram. I don't know what is the gold price now, but forget about it. Right now it is 4,000 rupees. I'm expecting it to be 10,000 rupees in future. So I'm entering a hedging contract with you to buy 1 kg of gold for how much? 6,000 rupees per gram in future. And you will enter into this contract and your expectation is in future gold price will be maximum 5,000. Your expectation is gold price will be maximum how much? 5,000. Then it will be a profit for you, because you can sell that 1 kilo of gold for how much? 6,000 according to the contract. Are you with me? It's basically a win-win expectation. My expectation, it will become 10. So I can buy it for 6,000 in future. Your expectation is the price will be up to maximum 5. And you can sell it for 6,000. That is your expectation. Right. Now, say after 6 months, say the price of gold is around 8,000. 8,000 per gram. The price of the gold, how much? 8,000 per gram. I am not, what do you say? It is not mandatory for me to exercise the contract. Rather, what I can tell you is, you have agreed for 1 kilo. Are you with me? So, you are supposed to give me how much? 1,000 grams of gold. For 6,000 per gram. Are you with me? So, what I will tell you is, you do one thing, 1,000 into 2,000 rupees you give me. Rather than giving 1 kilo of gold, you give me how much? 2,000 rupees. I will buy gold for 8,000 rupees from the open market. My effective cost is only 6,000 per gram. Are you with me? In such cases also there is no delivery, because you haven't given me 1 kilo of gold. But these transactions will never come under the purview of speculative transaction, because these are actually done for what? Guarding my raw material price fluctuation. If I'm earning something from that, that will be never regarded as what? My speculative profit. That will be adjusted in the raw material price itself. For me, the raw material price is only 6,000. In my books of accounts, the expenditure will be only 6,000. That 2,000 will be automatically adjusted in the purchase price. You don't have to treat it as a separate activity and you don't have to disclose this at the speculative profit. Not required. Are you with me? So this is hedging contract will be never treated as a speculative. It is speculative basically. No doubt, according to the definition, it is speculative. That's why they are saying, even though these are speculative, you are not supposed to treat it as speculative for the purpose of income tax department. Are you all with me? These are important, okay? Item number 2. Item number 2, hedging contract. Hedging contract in respect of stock and shares. Stock and shares by a dealer or investor. If I'm a full-time trader or an investor, then I'm entering in a hedging contract in respect of stock or shares, then that is also not regarded as what? My speculative transaction. Why? Because it is same. Stock and shares is my raw material. If I'm a dealer or a full-time trader, stock and shares are my raw material, yes or no? Whatever hedging contract I have entered for guarding the price fluctuation of my stock and shares will be never regarded as a speculative transaction. Next one, forward contract. Forward contracts are never regarded as what? Speculative transaction. What is forward contract? Hope you heard about arbitrage and all. Spot market, future market, there is a small price difference. You will increase the quantity so that you can encash that small difference and all. You study it in SFM, arbitrage, because it will take another 1 hour for me to explain arbitrage. There is a separate chapter in SFM. I forgot the chapter's name, some options, derivatives, yes. That is the chapter's name. You will come to know about arbitrage and forward contracts in SFM. So for the time being, it's a forward contract will be never regarded as a speculative transaction. Moving on. Trading in derivatives. Trading in derivatives. What do you mean by derivative? Options, futures, etc. is the best example. What do you mean by derivative? Define derivative. An item which derives its value from an underlying asset. Perfect. An item which derives its value from an underlying asset. In option, what is the underlying asset? It is the shares. Shares are the underlying assets in normally options. You will again study it in the derivatives chapter. Derivatives chapter SFM. These all are the items that are covered. So, trading in derivatives, it is pure speculative basically. Buying futures and options is pure speculative, but department say it is not a speculative transaction. You are not supposed to show it as a speculative income. Then, next item, trading in commodity derivatives. Trading in commodity derivatives. What is commodity derivatives? You can buy gold, platinum, currencies, then what do you say? Index itself you can buy, Nifty and all you can buy, you can short and you can buy, whatever you can do. Those items also will not be treated as what? Will not be treated as speculative. These are purely speculative. When you buy gold from recognized stock exchange, you will not get any physical delivery. You are only buying what? Notional asset. And you are not exercising it. At the end, you will sell it and you will accrue the margin. It's pure speculative nature, but departments say it is also not regarded as a speculative transaction. So these 5 items, even though it is in nature of speculative, you are not supposed to treat it as what? Speculative transactions. You should remember these 5 items because in examination, they will give you. You are not supposed to treat it as your speculative transaction. So friends, if these transactions are there, then what should be the treatment? Depends upon your frequency of activity either under Pgbp or capital gains. Depends upon the frequency of activities. Pgbp normal business, that's it. I didn't say it is not under Pgbp. I said it is not speculative. You can treat it as your normal business profit or you can treat it as your capital gains. That's it. Because it is a right anyways. It is a right. You have a right. Any property is treated as a capital asset according to the definition. So it has either your normal business or your capital gains. Normally, everybody shows it as your normal business. That's it. Because the frequency will be there. All right, the frequency. If I'm getting profit this day, today, I will definitely go and trade tomorrow. If I'm getting a loss, then it is like, I will get some profit in future. All right. So, normal business or under capital gains. That's what I can say. Now, these are anyways not speculative transaction. So friends, listen, if you have any speculative transaction and you are incurring any income or loss, you are supposed to compute it separately. You are not supposed to mix it with your normal business. Why? Because all the losses from speculative transaction can be set off only with income from speculative transaction, which is under section 73. You might have studied it in your set off and carry forward chapter. Speculative loss under section 73 can be set off only with income from speculation activities, not from normal business profits, not from any other head of income, because under inter-source set off and inter-head set off, there is a restriction that we will cover in which chapter? Set off and carry forward. So the point is very simple. If you have any loss from speculation transaction, you have to delta it. You have to adjust it only with the speculative profit. Are you with me? Say for example, I have incurred some and F&O losses, futures and option losses. Can I set it off with my normal business profit? Yes. If I am saying that there is a frequency of activities, then that loss I can definitely set it off from my normal professional income. Why? Because it is not under the definition of speculative. It is in the nature of speculative, but excluded from the definition of speculative activity. Are you with me? The same have been tested in exams. The same adjustment which I have told you have been tested in exams. And most of the students will automatically, if they don't know the definition, they don't know the negative list, then they will think that these are also speculative. And they will say it cannot be set off with the business profit. It can. It is possible. Are you with me? Provided it is your business activity. If the question says it is not your business activity, then not possible. Yes. So these are the things that I want to tell you under section 28. I hope this much is clear for you. Yes, friends. So we have covered the first section under PGP, under the head Pgbp, that is section 28. So that is the charging section. And there is one more income section under Pgbp. There is one more income section under Pgbp. Apart from that, 30 to 37 are deductions. Section 40 series, disallowances. Then 44A series, administrative provisions. Like 44AA, maintenance of books of accounts. 44AB, tax audit. 44AD, presumptive taxation. 44AD, presumptive taxation for notified professionals. 44AE, presumptive taxation for goods transporters. 44B, presumptive taxation for non-resident shipping business. Then 44BB, presumptive taxation for mineral explorers. 44BBA, presumptive taxation for aircraft business. 44BBB, presumptive taxation for turnkey power projects run by a foreign company. So these are there. 44B, from B to the remaining part will be covered as a part of NR taxation. We will cover up to 43B in Pgbp. The rest will cover in NR taxation because the rest is only applicable for non-residents. Yes. So we have one more income section under Pgbp. So let's understand which all are the other income section. That is section 41. It is called as deemed income. Section 41, we'll call it as deemed income. What do you mean by deemed income, friends? Section 41, deemed income. So deemed income simply means the following items or the items which I am about to discuss have to be mandatorily assessed under Pgbp, whether it is your income or not. That is called as what? Deemed income. So under deemed income, the first section that we are about to cover is section 41, subsection 1. So let's understand what is section 41, subsection 1. That is, the act says any expenditure or a loss, allowed as deduction earlier, later on recovered by way of waiver or remission, by way of waiver or remission, by way of waiver or remission. So let's understand. I'll tell you one example for understanding 41 subsection 1. Otherwise, it looks very confusing. Listen. Say for example, Mr. A. Alright, there is a person called Mr. A. And there is a person called JK. There are two persons, Mr. A and JK. Listen. Mr. A bought some goods from JK. Mr. A bought some goods worth 10 lakh. Worth 10 lakh in 2021-22 from JK. Mr. A is maintaining his books of accounts in mercantile system. In mercantile system of accounting. When he maintains his books of accounts in mercantile system of accounting, even though it is not paid, you can claim it as your deduction by putting a payable entry. Hope you know it. Right? Are you all listening? Now listen. Mr. A has claimed this 10 lakh as a business expenditure in the year 21-22. Say, in the year 2022-23, Mr. A has suffered huge loss. Mr. A has suffered huge loss and Mr. A approached JK. And JK told, I'm not collecting 10 lakhs from you. It's okay. I'm writing off that 10 lakhs from you. It is okay. Now you think it has been waived. It has been waived by JK in the year 22-23. Now friends, listen. In 21-22, when I purchased 10 lakh rupees goods, I might have claimed it as a deduction also. Yes or no? I will definitely claim that 10 lakhs as a business expenditure as purchases. Yes or no? In 22-23, what happened? My creditor told me not to make the payment. My creditor, who's my creditor? JK. In my books of accounts, JK is creditor. In JK's books of accounts, I am debtor. Fine. So, in my books of accounts, my creditor told me not to make the payment. Not to make the payment. So, department say, you are getting a benefit of 10 lakh. You claim that 10 lakh as a deduction in the previous years. So, you need to do one thing. When it is waived subsequently, you need to show that 10 lakhs as your deemed income under section 41 subsection 1. It's a deemed income. Why? Because in 22-23, I am not getting anything. But I am recovering a expenditure. I am not supposed to make payment for a past expenditure which I have already claimed. So that in accountancy we put reversal entries. In income tax there is nothing called reversal entry and all. So they say you treat that 10 lakhs as your deemed income. So listen, expense or loss allowed as a deduction earlier. Earlier means in 21-22. Later on recovered. How is the recovery? By way of waiver or remission. My creditor waived it or remitted it. Such amount have to be treated as my deemed income. In which year? In which year? In 22-23. That means the year of waiver. In the year of waiver, I need to treat it as my deemed income. Are you all listening? So that is the first item covered under deemed income under section 41 subsection 1. Let's study a small case law in relation to this. There's a small case law in relation to this. So that is called as Mahindra and Mahindra. Mahindra and Mahindra Limited 2018, which is cited by Supreme Court. Mahindra and Mahindra Limited, which is cited by the Supreme Court in the year 2018. So please listen. Say Mahindra and Mahindra took a loan from a company called KJC, Kaiser Jeep Corporation. They took a loan from this KJC. Alright, later on, this KJC company have been taken over. This KJC company have been fully taken over by another company called AMC, American Motor Corporation. This KJC company have been taken over completely by another company called AMC, American Motor Corporation. When KJC have been completely taken over by AMC, this loan also will come under whom? AMC. Yes or no? But AMC and Mahindra have some connections. Due to that, AMC completely waived that loan. AMC completely waived that particular loan amount. Mahindra is not supposed to give it back to AMC because they had some relations. Are you with me? For example, the loan amount say 10 lakhs. It is only for the purpose of example, okay? The real figures are not 10 lakhs, it's crores. So for the time being, only for the purpose of example, the amount is say 10 lakhs. So 10 lakhs is actually waived by whom? AMC. Now, Mahindra and Mahindra is getting a benefit. What is the benefit? They took a loan earlier, but they are not repaying it back. They don't have to also. Why? Because AMC have completely waived it. And Mahindra said it is a capital receipt. It's a pure capital receipt. It is nowhere given in Income Tax Act to tax this particular capital asset, because in the first day itself, I've told you, if it is a capital receipt, then it have to be specifically provided in the Income Tax Act to tax it. Yes or no? And M&M said it is not given anywhere specifically, so we are not taxing it. It's a benefit, of course, yes, but we are not taxing it. Then department said, no, you have to treat it as a waiver of loan under 41 subsection 1. Department said you have to treat it as an income under 41 subsection 1 as a deemed income. But Mahindra and Mahindra said it is impossible. Why? Because section 41 subsection 1 is super clear. It have to be an expenditure. That too allowed as a deduction in last year, which is recovered by way of waiver or remission. A simple waiver of loan cannot be taxed under 41 subsection 1. An expenditure claimed as a deduction earlier, subsequently waived only, will be covered under 41 subsection 1. When Mahindra and Mahindra took this loan, is that an expenditure for them? No. So they say it will not come under 41 subsection 1. Are you all listening? Then Income Tax Department said, okay, then you treat it as your benefit or perquisite received under section 28. It is treated as a benefit received under section 28. Treat it as a benefit received under section 28, because we have studied benefit or perquisite received on account of your business or profession. But Mahindra and Mahindra said this is not on account of any business or profession. We took a loan. The loan ultimately waived off. There was no other conditions. There was no target and all. That benefit is maybe due to some targets. Yes or no? Here there was no target, nothing. AMC simply what? Waived off. It is an indirect benefit. You cannot treat it as a taxable benefit under section 28. That was the contention of M&M. The case went to Supreme Court. Supreme Court said M&M, whatever said is right. It cannot be taxed under 41. It cannot be taxed under 28. It should be treated as a capital receipt. Both the contention of department have been denied by the Supreme Court in the case of M&M. Are you with me? Are you with me? So, Supreme Court denied the contention of Income Tax Department. It cannot be taxed under 41 subsection 1. It cannot be taxed under 28 as well. It should be treated as a pure capital receipts. That's it. So, that is the first case law that we have learned under 41 subsection 1. I hope it is clear. Then, the second thing to study under this particular definition, 41, is balancing charge. Balancing charge. That is the second item, which is under section 41 subsection 2. But I will cover balancing charge when we discuss section 32. When we discuss section 32, I will cover balancing charge. For the time being, I am skipping balancing charge, because we will cover terminal depreciation, balancing charge, everything together under section 32. Now, point number 3. Point number 3, what they say is proceeds from sale of scientific research assets. Sale of scientific research asset. Proceeds from sale of scientific research asset without using it for normal business. Without using it for normal business. Referred under section 35. This is section 41 subsection 3. What is section 35? Scientific research asset. Have you heard about section 35 scientific research asset? If you have an in-house scientific research department, all the capital expenditure that you incurred for that R&D is allowed as a deduction under section 35. Are you all listening? So, section 35, what is section 35? You have incurred a capital expenditure for your in-house scientific research and development department, R&D. That complete capital expenditure is allowed as a deduction under section 35. A normal assessee have to capitalize it and claim depreciation. But if it is a scientific research asset, you can claim it as a deduction straight away from your taxable profits. Are you with me? We will cover section 35 later on. So the point is, you claimed section 35 deduction at the time of purchasing an asset. Thereafter, your research is over and you're selling that asset. You're selling that asset and you're getting an income. That income have to be assessed as a deemed income under 41 subsection 3. It is similar to the 35 AD point which we have discussed under 28. Are you all listening? A simple example I'll tell you. Listen, I purchased a plant and machinery for my research purpose. My research is over. Once my research is over, what should I do with that plant and machinery? I have two options. I can sell it or I can use it for my normal business. If I'm using it for my normal business, then there is nothing called deemed income at all. When I'm selling it, I'm recovering the cost of that particular machinery which is already allowed as a reduction under section 35. Yes or no? When I'm selling that particular machinery selling that particular machinery outside, I'm getting a recovery of the expenditure which I've claimed already under section 35. That recovery is taxable under 41 subsection 3. You will get a better clarity when we discuss section 35. For the time being, all those assets which are sold outside without being used for the normal business, whatever the amount you comes in, that have to be assessed under 41 subsection 3. We will have a separate example when we cover section 35. Then, point number 4, recovery of bad debts. Recovery of bad debts. What do you mean by recovery of bad debts? What do you mean by recovery of bad debts? Say for example, JK sells some products on credit to a seller, so a buyer. That buyer is my debtor. This credit sale will be treated as a part of my income if I follows books of accounts in mercantile system. Yes or no? Now, say after 2-3 years, I understood that this buyer is not going to make me the payment. This buyer is not going to make the payment. Then what should I do? It is already treated as my sale earlier. After 2-3 years, if the debtor is not about to give me the payment, then I should treat as my bad debt. Yes or no? 1 lakh was the debt. I can claim that entire 1 lakh as a deduction under section 36 by calling it as bad debt. I've claimed it as bad debt. After 2-3 years again, that buyer came to me and he has given that 1 lakh rupees back to me. Then it is called as recovery of bad debt. Initially it was a credit sale. I thought that the buyer would not make the payment, so I claimed it as a bad debt. Thereafter the buyer came back and made the payment, and that is called as what? Recovery of bad debt. And recovery of bad debt is definitely taxable under section 41. Under section 41 subsection 4, recovery of bad debt is fully taxable. If you have recovered any bad debt which you have already claimed as a deduction, that entire recovery will be fully taxable in your hands. Are you all listening? So these are the 4 main items. We have more items under 41 that we will cover when we move on with the other sections, which we have to discuss section 36. Along with 36, I'll cover the remaining items under 41. So these are the main 4 items that you have to study under 41 for the time being. I hope till now it is clear. So friends, in the last session, we have discussed section 28 and 41 in relation to Pgbp, and the deemed income we have discussed 4 points. And now it's time for us to discuss another case law that is called as Raj Dhadarkar and Associates, which is cited in the year 2017 by the Supreme Court. So let's understand what exactly are the content in Raj Dhadarkar. Listen. So let's understand what exactly is the content in the case law. So I want all of you to be very attentive here. So what happened in this case is, say, assessee, we'll call Raj Dhadarkar, RD. Raj Dhadarkar is the assessee here. So RD, what they did is, they took a particular land on lease from municipality. Land on lease. They took a land on lease from municipality and they built temporary stalls. They built temporary stalls on this particular land and they rented it out. They rented it out. So they got some rental incomes. And Raj Darkar said it is their income assessable under Pgbp. Because what they are saying is their frequency of renting out is high. So we are planning to treat this rental income as an income accessible under Pgbp. But department said not possible. We will assess it under house property being rental income. We will assess it under house property. Then what Raj Darkar said is, listen, what Raj Darkar said is, to assess an income under house property, there is one condition. The condition is the person who receives the rent should be the owner of the house property. For taxing an income under the head house property, the person who receives the rent should be the owner of house property. Are you all with me? But under section 27 of house property, there is a concept called deemed ownership. And what do you mean by deemed ownership? That means if a person leases a particular property for more than 12 years in aggregate, then the person, that leasee, will be treated as the deemed owner of a particular property. Are you all listening? Say Raj Darkar leased this particular land for more than 12 years. So in this case, Raj Darkar shall be deemed to be the owner according to section 27 of income tax, and hence assessing officer said we will tax this rental income under house property itself. So they started fighting. Assessee want it to be under Pgbp and department want it to assess under house property. The case went before Supreme Court. Supreme Court given a contention or given a criteria to Raj Darkar stating that Supreme Court demanded Raj Darkar to submit documents. Which proves that this activity is from his business. Supreme Court told Raj Darkar to bring documents or documentary proofs, which proves what? That income is from his business. But Raj Darkar actually failed to submit documents in relation to that. And hence, Supreme Court said that this income will be accessible under house property, not under Pgbp. Are you all with me? Can you tell me any example of document which proves that this activity is or this income is a business income? Can you just give me one example of any documentary proof? Company MOA is more than enough. If it is a partnership firm, partnership deed. If it is sole proprietor, any initial licenses, that is more than enough. But Raj Darkar failed to submit any documents, and hence Supreme Court cited that this income have to be assessed under house property, not under Pgbp. I hope it is clear. And this case law has been given in bulleted points in a very detailed manner in the book. All right. Now, moving on. There is one more case similar to that. That is Chennai Properties and Investments Limited, which is cited in 2015 again by the Supreme Court. There, splitting of the property is treated as a Pgbp income. Why? Because if the assessee can prove that there is frequency of activities and the income is a Pgbp income, then absolutely it will be accessible under Pgbp. Are you all with me? If assessee can prove that a particular income is on account of his continuous transaction, then definitely it will be accessible under Pgbp, otherwise not. Now, let's move on to another case. We have another case to discuss, that is Gujarat State Fertilizers and Chemicals Limited, which is cited in the year 2018 by the Gujarat High Court. So, Gujarat State Fertilizers and Chemicals Limited. It's actually very easy case law. So, let's understand what happened in this case law. So, please listen. So, what happened in this case law is, listen, say, this Gujarat State Fertilizer and Chemical Limited company is a fertilizer manufacturer. So, fertilizer manufacturer. Say their one bag of fertilizer costed around 1000 rupees. These figures are only for the sake of understanding. These are dummy figures, only for communicating the concept. Okay. So, one bag of fertilizer costed around 1000 rupees. But Gujarat state government told assessee to sell it for 600. So assessee sold it for how much? 600. And state government gives rupees 400 for one bag of fertilizer directly to the assessee. It is called as a revenue subsidy. What do you mean by revenue subsidy? Earlier for diesel and petrol there was revenue subsidy. And what is this? So the customer, the farmer needs to pay only 600. The remaining 400 will be suffered by the state government or central government. The person who sells this fertilizer will get ultimately how much? 1,000. Are you with me? These kinds of subsidies by the government is called as what? Revenue nature subsidies. So instead of giving this 400 rupees in cash, state government has given bonds, especially fertilizer bonds having a value of 400 rupees. So instead of giving money, the state government has given what? Fertilizer bonds having a value of 400 rupees. And this fertilizer manufacturer sold this particular bond for say 300 rupees. Sold this particular bond for how much, friends? 300 rupees and incurred a loss. How much is the loss? The loss incurred by them is rupees 100. Now the question, assessee treated this 100 as a business expenditure. But assessing officer told that this is on account of transfer of bonds and have to be dealt under capital gains. That was the contention of assessing officer. Since it is a transfer on account of bonds, that loss have to be dealt under capital gains. That was the contention of assessing officer. But assessee said no. We are supposed to receive 400 rupees as what? Revenue subsidy. We didn't get that rupees. Instead of that, we got bonds. When we sold that bond in the open market, we only got 300. So that 100 rupees is a loss from business. We are not able to, generate, or we are not able to realize 1,000 rupees for a bag of fertilizer. We are only able to realize net 900 rupees. So we will treat that 100 rupees as a business expenditure itself. Are you all listening? So that was the debate here. And the Gujarat High Court, they held that this 100 have to be dealt under Pgbp itself. Why? Because assessee was able to realize only 900 rupees when they sold one bag of fertilizer. How they realized 900? They got 600 from the farmer and they got 400 rupees bond, but when they sold that particular bond, they only realized 300. So that 100 rupees is a loss of revenue from Pgbp and that have to be dealt under Pgbp. Assessing officer's contention is wrong. That was the judgment given by the Gujarat High Court. I hope that also is clear. Now we have one more case law in relation to this, that is K and Co, which is cited in the year 2014. One more case law, the last case law in the series. K and Co, cited in the year 2014 by the Delhi High Court. So what happened, I'll tell you. So assessee K and Co wants to start lottery business. They want to start lottery business. So they applied for the license. And state government told them to bring a bank guarantee. State government told them to bring what? A bank guarantee to give the license. So K and Co visited a bank and deposited an amount. To get bank guarantee. Alright, deposited an amount in a bank and the bank provided bank guarantee to the state government. That's why he got what? License. He got license to run lottery business. So from this deposit, every year there is some interest income. From this particular deposit, K and Co received some interest income every year. Assessing officer told K and Co to treat it as an income under IFOS. But K and Co told, no, this is on account of our business, so we will treat this interest income under Pgbp. Why under Pgbp? That deposit is not on account of any investment. We made, why? Because we require a bank guarantee to run our business. Alright, so that deposit have a business nexus. So all the income from the deposit has a business nexus and we will assess it under Pgbp. That was the contention of assessee. But assessing officer said no, any interest income from deposit have to be assessed under IFOS. So that was the debate. So ultimately what happened is the Delhi High Court told that this deposit is not for any investment purpose and hence all the interest from this business deposit have to be assessed under Pgbp itself, not under IFOS. So this judgment wasn't favorable to assessee. Are you all listening? So in a case law, there are a few things that you should note. Number one, name. You should study the name of the case law. Here, Quote and all is not required. Your quote, ITR, CTR number is actually not required, but name you should know. Number 2, debate. What is their problem? What was the fight? Number 3, in which section that debate comes from? So what is the related section of that debate? And finally, judgment. These are the 4 takeaways from a case law. I'm repeating again, name. Number 2, debate. What exactly is the problem? Number 3, related section. Number 4, judgment. These are the 4 things that you should note in a case. And by that I can say the intro part of the PGBP is completely over. We have completed 28 and 41. I'll call those things as an intro. Now we are about to start a new section, that is 29. Section 29 actually is we normally call it as a menu. We call it as a menu card. Why menu card? When you visit a hotel, you'll get a menu card, right? What all are the contents in a menu card? Starters, idli, vada, dosa, idli. Okay, everything will be there. You'll get the information of starters. Then main course. Then desserts. Yes or no? Along with the price. Along with the price. You visit Andhra along with the spice. They will show the number of mirchis. Single mirchi, 2 mirchi, 3 mirchi, 4 mirchi, 5 mirchi, etc. They will show the number of, the spiciness of that food also they will mention. So just like that, this 29 is a menu section. Why menu section? What all are the upcoming sections in PGBP? That's what section 29 states. Are you all listening? What all are the upcoming sections in PGBP? That's what 29 says. So let's see. Section 30 to 37 is admissible deductions. What is admissible deductions? What do you mean by admissible deductions? Admissible deduction simply means those deductions that can be claimed as a expense. Those expenses that can be claimed as a deduction. That is the best way. Section 30 to 37. Now section 40 is inadmissible deductions. What is inadmissible deduction? Inadmissible deduction. Disallowances. Those items that are never allowed as deduction. That is called as inadmissible deductions. Then section 40A, expenses or payments not deductible in certain circumstances, like excessive payment given to relatives, then payment exceeding 10,000 paid otherwise than by way of account pay, check out, account pay, bank draft, TCS, etc. Then what is section 41? Deemed income. So section 41 is deemed income, which we have already covered, and other provisions like 44AA, AB, AD, ADA, etc. is there. This is section 29. So 29, we don't have any takeaways. We don't have to study section 29. Moving on to the first part, that is admissible deductions from 30 to 37. So let's start with the first admissible deduction, that is rent, rates, repairs, insurance for building under section 30. So listen friends, if you are using a building, for your business or profession. This building have to be used for either your business or for your profession. Then 4 expenses in relation to this building can be claimed as a deduction under section 30. 4 expenditures in relation to this particular building is allowed as a deduction under which section? Section 30. Which all are the 4 items? Number 1, rent. Say for example, this building is used by me for my business purpose. I have taken it on rent. All the rental charges paid by me is allowed as a deduction under section 30. Then rates and taxes. What do you mean by rates and taxes? The municipal taxes, corporate tax, corporation taxes, etc. that I have suffered being an owner is allowed as a deduction under section 30 if I am using that particular building for my business or profession. Then repairs. What do you mean by repair? Repair means current repairs. What do you mean by current repairs? Say there are 2 types of repairs. We can say capital nature repairs and current or revenue nature repairs. What is capital nature? Say for example, if a particular expenditure increases life, usage, volume, capacity, etc. of my capital asset, then that expenditure will be in capital nature. Say for example, I extended this building. If I extend this building, definitely the volume or capacity or usage will be high. More number of students can sit in this particular building. All those expenditures will be considered as what? A capital nature expenditure, not allowable as a deduction under section 30. Say for example, you had a fight here and all the tiles got broken. Now I have to relay the tiles to conduct a classes. Yes or no? All those expenditure to relay the tiles is definitely a revenue nature expenditure and allowed as a deduction. All those expenditure to bring back an asset to its normal condition can be called as a current repair or a revenue nature expenditure. Only those nature expenditures are allowed as a deduction under section 30. Are you all here? Only those current nature expenses which are incurred by a person to bring back his asset to its normal condition is allowed as a deduction under 30. That's what they say. And finally, insurance. What do you mean by insurance? To be very precise, insurance premium. What do you mean by insurance premium? I've taken an insurance, say for example, an earthquake or a fire insurance for my building, and all the premium paid by me is allowed as a deduction under section 30. So 4 things in relation to my building. I want all of you to repeat with me. Which all are the 4 types of expenses? Rent, rates and taxes, repairs, and finally insurance. All those 4 things allowed as the deduction, provided it should be in relation to my building, which is used for my business or profession. Done. Moving on. So the next section that we need to study is section 31. That is, say you are using a plant and machinery or a furniture for your business or profession. You are using a plant and machinery or furniture for your business or profession, and you have incurred any current repair or insurance premium, then it is allowed as a deduction under section 31. So you are using a plant and machinery or a furniture for your business or profession, and you have incurred what? Current repairs or insurance premium. That both are allowed as a deduction under section 31. For plant and machinery and furniture, there won't be any rates and taxes. For using a plant and machinery, do we have to pay any taxes to the corporation, municipality, etc.? No. But an assessee can take plant and machinery and furniture for rent. How about the rental charges? Can you claim the rental charges of a plant and machinery which is used for business as a deduction under 31? The answer is no. Answer is no. Why? Because section 32, 36 are called as specified deductions. What do you mean by specified deductions? Whatever items covered under 30 to 36 is clearly given in the respective sections. Only those items are supposed to be claimed as a deduction. There is one more section under deduction, that is section 37. That is called as what? General deduction. So all those other things or other expenses which is in relation to your business, which is not covered from 30 to 36, is allowed as a deduction under 37. And hence we can say, if there is any rental charges in relation to plant and machinery, it will be covered under 37, not under 31. Why? Because section 30 to 36 is specific. Specific means what all are the expenditure, how much you can claim. Everything have been clearly mentioned under the respective sections itself. If you have some other expenses, then it is allowed as a deduction under 37, subjected to conditions mentioned under 37. I hope it is clear. So these are the 2 sections under deduction, section 30 and 31. So friends, repeat with me. What all are the items covered under 31? Repairs and insurance. Here also repair means what repair? Current repair, not those capital nature items. So moving on with the next item, that is called as depreciation under section 32. This is actually very, very important and very, very long. So section 32, depreciation, the third deduction under Pgbp. Listen friends. So first of all, for claiming depreciation, you need to satisfy certain conditions under section 32. Then only you can claim what? Depreciation. Let's understand which all are the conditions that we need to satisfy. Condition number 1, assets in respect of which depreciation is claimed must belong to certain specified categories. If an asset is under a specified category under Income Tax Act, then only you can claim what? Depreciation. So I have a question to you. How many categories of assets are there in income tax? So how many categories of assets are there? 5 categories. Very good. Which all are the 5 categories? So tell me which all are the categories. Number 1, it is building. Number 2, furniture and fittings. Number 3, plant and machinery. It has subcategories also. Number 4, intangible assets. Number 5, ship. These are the 5 categories we have. Now listen. Assets should be owned either partly or wholly by the assessee. Assessee should be the owner of a particular asset to claim what? Depreciation. Ownership doesn't mean legal ownership. It can be beneficial ownership as well. What do you mean by beneficial ownership? Asset purchased by me, but in the name of some other person. Absolutely no problem. If I have invested the amount, I am using it for my business, I can claim depreciation. Now, condition number 3, asset should be actually used by the assessee for the purpose of business or profession during the previous year. In the relevant PY, you have to use that particular asset for your business. And finally, assets should be used in the relevant PY to claim the depreciation. The third point is asset should be used by the assessee in the relevant PY. Fourth point is asset should be used in the relevant PY. Almost similar. Third one, used by the assessee for his business. Fourth one, it should be used in that year itself to claim depreciation. So these are the 4 main points to claim what? Depreciation. You don't have to by heart all these points. Okay. It is only for the understanding. I'm discussing all these 4 points. Now, let's understand which all other categories we have. As I've told you, intangible and tangible we can say. Under intangible we can say building, furniture, plant and machinery, and ship is also there. And under intangible, know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature acquired after 1st April 1998, but not being goodwill of business or profession. If you have goodwill as your asset, you cannot claim depreciation on the value of goodwill. Why? There is no depreciation on goodwill. So, except for goodwill, you can claim depreciation for all other intangible assets. The reason is goodwill never depreciates during the course of business. The value will go up only. If you do good business, it will go up. If you do very bad quality products, then it will definitely come down. It is not on account of normal course. It is on account of your activities. So, goodwill, you cannot claim any depreciation. Again, for land and all, you cannot claim any depreciation. For live animals, you cannot claim any depreciation. So, let's discuss a few more points in relation to this particular depreciation. Listen, all the points are there in the material. I want all of you to be very, very attentive here. So, first point is in relation to usage. Usage. Now, how do you compute depreciation in accountancy? How do you normally compute depreciation in accountancy? It's based on the number of days used in a year. Based on that number, you claim proportionate depreciation in accountancy. Yes or no? But in income tax, it is not like that. If you have used a particular asset for your business, you can claim depreciation. It is not based on the proportionate number of days. Say, for example, if I've used a particular asset for my business, I can claim full rate of depreciation that year. However, there is one exception to that point. What is that exception? If in the year of purchase, if I have put to use an asset for less than how many days? 180 days, then I can claim only 50% of the normal rate. This is what that says. So, to conclude, we can say it like this. Even if I've used a particular asset for 1 day, I can claim full depreciation. But in the year of purchase only, there is a restriction. And what is the restriction? In the year of purchase, if I put to use an asset for less than how many days? 180 days. 180 days doesn't mean 6 months. 180 days means 180 days. You have to count it. Okay, 180 days, don't think it is 6 months. It is 180 days itself. That simply means you have put to use an asset for less than 180 days in the year of purchase. Then how much is your normal rate? 50% will be your effective rate of depreciation. I'm not saying the rate of depreciation is 50. Whatever is your normal rate, that rate's 50% only. You will get it as what? Depreciation. Are you with me? In all other cases, you can claim full rate as depreciation, even if it is only 1 day usage. In the subsequent years and all. Once after the purchase year, in the subsequent year, say you used a particular asset for only for 1 day, you can claim what? Full amount as depreciation. I hope you got my point. Now, next point is, if an asset is used proportionately for personal purpose and official purpose, how to claim depreciation? If an asset is used proportionately for official purpose as for personal purpose, how do you claim depreciation? You claim depreciation proportionately, 40% for personal purpose, 60% for business purpose. You claim depreciation and only charge those 60% of the depreciation as a deduction. Are you all getting my point? It does not require any further explanation. These are very, very simple points. Now, next point. It is in relation to usage again. For claiming depreciation, you have to actually put to use an asset. It is not the purchase. It is put to use. What is put to use? It is installed and actually used in your business. But departments say kept ready for use is also put to use. What? Kept ready for use is also actual usage. What do you mean by kept ready for use? Say for example, this academy has fire extinguishers. This academy has fire extinguishers. Every year end, this academy wala will light fire and they will use that extinguisher for claiming depreciation. Is that required? No. Kept ready for use is more than enough to claim what? Depreciation. You have an asset, it is ready for usage, then you can claim what? Depreciation. Whether you actually turn on that asset or not, if it is ready for usage, you can claim what? Depreciation. Or I can give you another example. I bought a generator. This year there was no power cut. I bought a generator. This year there was no power cut. Can I claim depreciation? Of course, yes. If it is installed, I can claim what? Depreciation, because kept ready for use is more than enough. Actual usage is not required. Now, these are the things that you should know in relation to what? In relation to what? Usage. Now, let's study a case law in relation to this usage. There is a small case law. It is called as ICDS Limited. ICDS Limited, which is cited by the Supreme Court in the year 2013. So let's understand what exactly is ICDS. This is not Income Computation Disclosure Standard, okay? It's the name of a company. ICDS, not Income Computation Disclosure Standard, okay? Yes. So this ICDS company was a NBFC. NBFC engaged in the business of leasing and hire purchase. Leasing and hire purchase. They used to lease car also. They used to lease car as well. Say for example, there was one customer. This ICDS Limited has leased the particular car, a new car to a customer. Are you all listening? There was one customer and this ICDS Limited, what they do is they leased this new car to a customer, and they did one more thing. This new car's RC is there. What is RC? Registration certificate. In that RC, in the ownership details, this customer's name was there. In the RC or registration certificate, the customer's name was given as the owner. But all the amount is invested by the ICDS and the customer pay only the annual rental fees to the ICDS. The customer does not have any ownership over the car. But in the RC, in the details as a owner detail, it is the customer's name was there. And what ICDS did is like they claim depreciation for this car. They claim depreciation for this car, and income tax department denied depreciation. Assessing officer denied depreciation, stating that in the ownership RC certificate, in the owner's column, it is not your name. It is the name of your client. So he is the real owner and you cannot claim any depreciation on that particular asset. This was the contention of assessing officer. And they started fighting and the case went to Supreme Court. Supreme Court said, for claiming depreciation, there are twin conditions. Number one, asset should be used for the business of assessee. Number two, assessee should be the owner of the asset. So twin conditions are there. Number one, usage. Number two, ownership. Let's check the first condition, whether it is used for the business of assessing. You tell me whether this particular car is used for the business of assessing. The answer is yes. It is not used by the assessee, but it is used for the business of assessing. Like, who uses this mic? Me. Who owns this mic? The academy. Who can claim depreciation? The academy can claim depreciation. Whether I bought this mic in my name, if the bill contains my name or not, if academy pays the bill and academy gives this mic to the faculties, then definitely academy can claim depreciation. Likewise, what Supreme Court said, This is actually used for the purpose of business of assessee because the assessee's business was rent a car. Assessee was also leasing cars. So usage is there. How about ownership? What is ownership? The person who have the control over the asset is said to be the owner. It is not RC. In Income Tax Act, the word ownership is never defined. So in Income Tax Act, ownership simply means the ultimate authority over that particular asset can be called as the owner. It is not RC owner. RC is only for the Motor Vehicle Department, not for Income Tax Act. Income Tax Act, owner simply means the person who has the capacity to retain possession. And here the owner ultimate possession or ultimate right to retain the possession was with ICDS Limited, and hence they can be called as the owner. It's not about the RC book. It's all about the real right, the real power. So they say, Supreme Court said ultimately, both the usage and ownership condition is satisfied and ICDS can claim what? Depreciation over the assets cost. Are you all with me? So this is the case ICDS Limited, which is cited by the Supreme Court in the year 2013. It's an easy case only. Now, moving on with other thing in relation to this. Listen, there is one more thing in relation to this ownership. Ownership, there is one more thing. Listen, say for example, I took a building for rent. I took a building for a rent. I am JK and I runs an academy. I took a building for rent. This building have a capacity to accommodate 100 students. This building have a capacity to accommodate how many students? 100 students. In one batch, there was 150 students. So what I did is like, I extended this building. After getting approval from the original owner. So I extended and incurred 10 lakhs for extension. I've expended how much? 10 lakhs for extension. Say it is a temporary extension. Alright, the owner told you can extend on your own cost. I am not planning to extend this. So I myself extended the building. First of all, the first thing, can I claim this 10 lakhs as a current repair expenditure? Can I claim this 10 lakh as a current repair and charge it under 30? Not possible. I cannot claim it as a revenue nature or a current repair expenses. That is not possible. Now, can I capitalize this 10 lakh and claim depreciation? For that, there is one problem. I have to be the owner of the building. Yes or no? Even after extension, I don't have any right over that particular extended area. The ultimate owner is the original owner. Are you all with me? In such scenarios, departments say, this extended owners, I will be considered as the deemed owner of this extended area. The person who expended shall be the deemed owner of this extended area only for the purpose of computing depreciation. Why? Only for the purpose of computing depreciation. From tomorrow onwards, I am not supposed to say this is mine. You can take the other one. This blue area is mine. Because according to the Income Tax Act, I am the deemed owner of this blue area. It is mine. Not possible. Income Tax Act is very clear. Only for the purpose of computing depreciation, I will be considered as the deemed owner. Are you all listening? Yes. And let's move on with the next case that is called as A. Shivakami and another. Okay. Srimati A. Shivakami and another. Don't ask me who is this another, okay? That you have to ask Shivakami. Shivakami and another. That is the reported name of the case law. Who is that another? That we don't know. We don't have to know, first of all. So Shivakami and another, what happened is, say Shivakami was a sole proprietor having BESS. She has some BESS. Alright. So these BESSes were not registered in her name. These BESSes were not registered in her name. Say the owner was her husband. But in the P&L account, all the, ticket cost was the revenue in the P&L account of Shivakami. Alright. And she claimed depreciation for that BESSes also. And assessing officer said, okay, the revenue from the BESS is okay, but depreciation not allowable. Why? For claiming depreciation, you have to be the owner of the BESS. And ultimately, Madras High Court said, not necessary. Shivakami invested amount in the BESS. She is using that particular BESS and she is showing the revenue from the BESS as her income in the P&L. That contention is accepted by department. Now department cannot say, we will not give you what? Depreciation. Alright. So all the BESSes, all the three BESSes she had, all the three bases, on all the three bases, she can claim what? Depreciation. This is again the concept of deemed ownership. Again, what is deemed ownership? Legal ownership is actually not required. If you have expended money and you are using it for your business, you can claim what? Depreciation. Whether or not that asset is in your name doesn't matter. So this is how you must compute depreciation. These are the preconditions before you claim depreciation. I hope this much is clear. Now moving on with the computation of depreciation. How do you compute depreciation, friends? I want all of you to write these things which I am about to write. Okay. How do you compute depreciation? Computation of depreciation under section 32. How would you compute depreciation? There are actually two methods in income tax for computing depreciation. You tell me which all are the methods? WDV and SLM basis. Very good. So there are two methods for claiming depreciation. Number one, we will call it as SLM basis. What is SLM? Straight line method basis. And number two, it is WDV basis. What is WDV basis? Written down value basis. So who can claim depreciation under SLM basis? Assessee who is in the business of power generation or power generation and distribution at their option may opt for SLM basis. What do you mean by at their option may opt for SLM? They have an option to choose between SLM and WDV. Nobody is mandating them to choose SLM. If they think that SLM is better, they can. Otherwise, they can opt with WDV. Only power generation or power generation and distribution assessees have the option to choose SLM. All others have to mandatorily go with WDV. Are you with me? All others we can write. All others have to mandatorily choose WDV basis. Now listen, how do you compute depreciation in SLM basis? I'll give you an example. I will give you an example for a better understanding. Say for example, year 1, I purchase an asset. Say for 10 lakhs, where I can claim depreciation at 10%. Now you tell me, what is my year 1 depreciation figure? It will be 1 lakh. What will be my year 2 depreciation figure? Again the same 1 lakh, because in SLM every year the amount of depreciation will be constant. Yes or no? Every year the amount of depreciation will be constant in SLM. That's what is called a straight line method. Are you all with me? So after these two depreciation, how much is my balance value? It is 8 lakh. That is in year 3. Year 3, my balance value will be how much, friends? 8 lakh. Now the first thing that I want to tell you is, in accountancy, please listen. In accountancy, when you are selling an asset in between, that means in between a year, you can claim depreciation up to the date of sale in accountancy. Yes or no? Can you do that in income tax? Not possible. If you are selling an asset in between, for that asset, you cannot claim any depreciation till the date of sale. If you are maintaining that asset with you till the year end, then only you can claim what? Depreciation. Are you all listening? If you are selling a particular asset in between, for that asset you cannot claim depreciation till the date of sale. You have to maintain an asset with you for claiming depreciation under section 32. Now listen, say in year 3, I am selling this asset. Selling this particular asset, say for 5 lakhs. I've sold this particular asset for how much? 5 lakhs. How much is my loss, friends? The asset had a value of 8 lakh in year 3 and I've sold it for how much? 5 lakhs. How much is my loss? That loss is 3 lakh. That 3 lakh can be called as what? Terminal depreciation. Terminal depreciation, and I can claim it as a deduction under section 32. The 3 lakh is not a loss from the head capital gains. That 3 lakh can be claimed as a deduction under section 32 by calling it as what? Terminal depreciation. Now you tell me, who can claim terminal depreciation? power generators or power generators and distributors, if they opt for SLM basis and they have sold an asset for a loss, that loss can be claimed as a deduction under section 32 by calling it as terminal depreciation. Is that clear? Hello, is that clear? Now, say I've sold this asset. I've sold this asset for 9 lakhs. I've sold this asset for how much? 9 lakhs. How much is my gain or profit? 1 lakh. This gain have to be treated as what? Balancing charge. Balancing charge, which is under section 41. Hope you remember. We have skipped balancing charge and I've told you that we will cover balancing charge when we discuss section 32. Okay, today morning. So, balancing charge simply means if you are selling an asset, for a value which is higher than the balance value, then that excess have to be treated as what? Balancing charge under 41. And this balancing charge is only applicable for whom? Power generators or power generator and distributors if they have opted for SLM basis. Are you with me? In WDV basis, it's altogether different. In WDV basis, it is section 50. There is nothing called balancing charge and terminal depreciation in WDV basis. It is only in the SLM basis we have balancing charge and terminal depreciation concept. Are you all listening? Scenario 3. Scenario 3, I've sold this asset for say 14 lakhs. I've sold this asset for how much? 14 lakhs. Now friends, you tell me, how much is my total profit? Total gain? The asset have a value of 8. I've sold it for 14. How much is my total gain? 6 lakhs. And department say, out of this 6 lakhs, how much is the amount that I got over and above the original cost of acquisition? How much is the amount that I got over and above original cost of acquisition? 4 lakhs. What is original cost of acquisition? 10 lakhs. I've sold it for 14 lakhs. So the profit which is over and above original cost of acquisition always have to be dealt under capital gains. So out of this, 4 lakh have to be assessed under capital gains. And how much is my total profit? 6 lakh. The remaining 2 lakh profit shall be taxed under 41 as what? Balancing charge. Now friends, you tell me, what is this balancing charge? The depreciation that you claimed earlier, when at the time of sale, if you have recovered that, that will be called as what? Balancing charge. Listen, the last example. Listen, I purchased an asset. Everybody, please listen here. I purchased an asset for how much? For 10 lakhs. Are you all listening? I purchased an asset for 10 lakhs. I've claimed depreciation of 1 lakh each for 2 years. Now the remaining value is 8 lakh. When I'm selling this asset for 14 lakhs, there are 2 gains. Gain number 1, I can recover the amount of depreciation that I've claimed in the past 2 years. Yes or no? Gain number 2, I got 4 lakhs over and above its original cost. So department say all those depreciation recovery have to be treated as your income under Pgbp. Why? Because you have claimed depreciation as a deduction from Pgbp. To balance the effect, that word itself is self-explanatory. Balancing charge. To balance the effect, you have to tax the 2 lakh under Pgbp by calling it as a deemed income under section 41 subsection 2. The remaining gain, which is over and above its original cost, have to be dealt under capital gains. Are you with me? If I'm selling it for exact 10 lakhs also, 2 lakhs is recovery of depreciation. That recovery have to be taxed under Pgbp by calling it as balancing charge. I hope it is crystal clear. Are you all with me? So we were discussing the depreciation computation which is in relation to SLM basis. I hope it is clear. So friends, let's solve a question in relation to this. So I want all of you to read question number 3, which is in page number 4. This is it's actually a very small question. You can read it from here itself. Okay, go through question number 3 in page number 4 and give me the answer. Yes, friends. So let's read the question. Important Limited is a power generating unit. On 1/4/2020, it purchased a plant for 50 lakh eligible for depreciation at 15% on SLM basis. Compute the balancing charge or terminal depreciation assuming that the plant is sold on 21st April 2022. So you tell me, which is the year of purchase? which is the year of purchase in that particular question. It is 2020, 1st April. Yes or no? And how much is the purchase cost? PC means purchase cost. How much is the purchase cost? 50 lakhs. So, first of all, you can claim depreciation for the year 2020-21. How much is the depreciation? 15%. How much is 15% on 50 lakhs? 7 lakh 50,000. Now again you can claim depreciation for 21-22 also. That is again 7 lakh 50,000. In the year 22-23 you sold that particular asset and hence you cannot claim any depreciation. Now you tell me what is the balancing value or balance value? 35 lakhs. Now when you have sold that particular asset for scenario number 1 for 7 lakh 50,000, you are incurring a loss. Yes or no? How much is the loss? 27 lakh 50,000, and that can be claimed as what? Terminal depreciation. Terminal depreciation and charged as a deduction under section 32. Done. And part B or question B. What is B? When you sold that particular asset for 30 lakh, again you are incurring a loss. How much is the loss? 5 lakhs. That loss also can be claimed as terminal depreciation under section 32. And scenario number 4, or sorry, C. What they say? You sell it for 40, sold it for 45 lakhs. Then there is a profit. How much is the profit? 10 lakhs. That profit will be treated as a balancing charge. Balancing charge and assessable under where? It is under 41. Subsection 2. Now, next is point number D. What is point number D? Not point number D, part number D, it is 55 lakhs. So when you are selling that particular asset for 55 lakh, how much is your total profit? It is 20 lakhs. Out of 20 lakh, how much is the recovery of depreciation? 15 lakhs is your recovery of depreciation. So that 15 lakh will be treated as balancing charge. And the remaining 5 lakh shall be capital gains. Are you all here? This is the final answer to the question. I hope it is clear. It's only an easy question. Now, let's compute the depreciation under WDV basis. So, we will move on to WDV basis. Since I don't have space here, I will write a separate note. Okay, you can write a connector, a go-to connector. Hope you have studied this connector in the flowchart, ITSM. Yeah, we can use the same connector here. Now, WDV basis. How do you compute depreciation in WDV basis, friends? Hope you know. How do you compute depreciation in WDV basis? When you claim depreciation in WDV basis, first you create a block. First you create a block. On the value of block, you charge depreciation. Are you all here? The first thing to do is to create a block. On the value of block, you are supposed to claim what? Depreciation. What do you mean by block? What do you mean by block? Asset under the same category with the same rate will be categorized as a single block. Asset with the same rate under the same category will be treated as a separate block. Alright, we don't have to by heart all the blocks in income tax and all because the block will be already given in the return. Our only job is to fill the blocks. We don't have to create a block. It will be already there in the return. Our job is to only fill the values in the block. So let's see how many types of assets are there. That is our next thing. So let's understand which all are the types of assets and what all are the rates. A few rates you have to study. Others you don't have to. A few rates you have to study. So I want all of you to take the material and highlight these things. So number 1, building which is not used for residential purpose. A normal building other than guest house and all, the rate of depreciation is 10%. Say for example, for this academy, this particular building, what is the rate of depreciation? 10%. Say this academy have a guest house and what will be the depreciation? 5%. That you don't have to study. Okay, building, normal rate, 10%. Register this in your mind. Building, normal rate in WDV, how much? How much? 10%. Then, if it is a temporary structure and all, rate will be 40. That also is not required. Those items which I am highlighting, you need to by heart. Alright, those items which I am highlighting, you need to by heart because there are certain questions where they don't specify the rate. That you should know. Now, the next thing is furniture and fittings. Rate is 10%. You know what is furniture? What is fittings? What do you mean by fittings? Say fittings means, listen, fittings includes electrical fittings like electrical wiring, switches, sockets, other fittings, fans, lights, etc. Light point, pipes, etc. can be called as what? Fittings. Now friends, listen. For that, how much is the rate? 10%. Now, plant and machinery, general rate is 15%. What is general rate? Say I have a generator, normal plant and machinery rate is 15%. That is at the end. At the end, the next page, you can see plant and machinery general rate 15%. That you have to mark. Now, that you have to study. Okay. Now, moving on. There are certain other, I've already told you that plant and machinery have certain subcategories. Are you all with me? Those rates also have to be, certain rates have to be by-hearted. Number 1, motor car. Other than those used in running them on hire. Rate is 15%. What do you mean by motor car? Other than those used in running them on hire. What do you mean by motor car? Other than those used in running them on hire. Okay friends, tell me, what do you mean by this motor car used for other than running them on hire? That means, say for example, this academy have a motor car which is used for their promotions. Alright, that motor car they can claim depreciation at 15%. If instead of this academy, say I runs a rent-a-car business or a taxi business, then the rate would be 30%. Motor car, bus, lorry, etc. used in the business of running them on hire, the rate is 30%. You must study that also. You must study that also. So, normal rate for a motor car is 15. If I am using that motor car, bus, lorry, etc. whatever it is, for hire, that means a goods transporter or something, or rent a car or something, then definitely the rate will be 30%, double. Then the next thing which is required is air pollution control equipment, water pollution control equipment, solid waste control equipment, solid waste recycling and resource recovery systems. The rate is 40%. If you have a air pollution or water pollution control equipment, the rate of depreciation is at 40%. That also is required. Then next is windmill. The rate is 40%. For windmill, the rate is 40%. You study only windmill, rate 40%. Then, moving on with the next page. In the next page, computer including computer software, rate is 40%. Say you want a software, rate is 40%. What do you mean by computer? It is not alone the computer, printer, scanner, etc. Those peripherals, everything will form part of the computer, and for that, rate is 40%. Projector is a general plant and machinery. Mobile phone is a general plant and machinery, not computer. Printer, scanner, UPS, etc. can be called as what? Computer. Are you all here? And the rate is 40%. Then, book. Whether it is annual publication or not, rate is 40%. What do you mean by annual publication? So, income tax related books are annual publications. It is for a financial year. Next year, you have to buy a new book. For those books, I can claim depreciation only at 40%. Then for ships, whatever the type of ship you have, the rate is 20. You can write ship as 20%. And intangible assets, how much is the rate? 25%. And what's the definition for intangible assets, friends? Listen, what's the definition? Know-how, patent, copyright, trademark, licenses, franchises, or any other business or commercial right of similar nature. What do you mean by any other business or commercial right of similar nature? Ejusdem generis. All those items that are in, which has the character of know-how, patent, copyright, etc. can be called as intangible asset, excluding goodwill. That's why they have given a negative list under that. Excluding goodwill of business or profession. And how much is the rate? 25%. So these rates, those which I have highlighted, you have to study. Others, it is not necessary. In most of the questions, they will give the rate. But there are a few attempts where they haven't given the rate. You should know the rate as well. So now the next point is, how do you claim depreciation under WDV basis? And there is a computational format in your book. You can check that. How do you claim depreciation under WDV basis? So let's understand how to claim depreciation. Listen. So the first thing to do is, you take the WDV of the block at the beginning of the year. It is also called as what? Opening WDV. What is opening WDV? Closing WDV of last year is said to be the opening WDV of this year. Yes or no? You take that. Then you add additions. What do you mean by additions? Current year purchased items. Then you total both the opening and additions. From that, you deduct what? Deletions. What is the deletions? Sales. Now there is one important thing. This is a fixed format. Irrespective of the date of sale and date of addition, the first thing to do is always add. Then only deduct. Say, simple example I'll tell you. Say for example, on 15th April of a previous year, I sold some asset. On December of that same year, I purchased an asset. What to do? Add purchase first. Then only delete sales. Are you with me? This is a fixed format, not date chronology. You are not supposed to follow the date order. You are supposed to follow this format while computing depreciation. Then, on the remaining value, you can claim what? WDV. That remaining value cannot be negative. Why? Why? I'll discuss when we explain section 50 today itself. That is the next section that we are about to take, section 50. When there is a sale, your block value will never go negative. There is a reason for that. That I'll tell you later. Now, on that you can claim depreciation. And after claiming depreciation, that will be the closing WDV. And the same will be the opening WDV for next year. Are you with me? So, this is the format for computing what? Depreciation. You take the opening, additions, deletions, remaining value, you claim depreciation. And now friends, there are a few things that you should know while computing depreciation. I'll give you a full-fledged example which has 32, section 50 and everything in relation to depreciation. I want all of you to be very, very attentive here. Are you all listening? So let's solve a problem. Not problem, sorry. Let's take an example in relation to WDV basis. Listen. I am Mr. JK. I have 3 plant and machineries. Plant and machinery A, plant and machinery B, and plant and machinery C. Both are under 15% rate category. Both are under 15% rate category. I hope all of you are listening. Are you? Now, the total value of the block, we can call it as WDV value, is 10 lakhs. The total value of the block is how much, friends? 10 lakhs. The first thing to notice, income tax department will be least bothered about the individual WDV value of an asset. How much is the WDV value of A? How much is the WDV value of B? How much is WDV value of C? Department doesn't care. Department only care about the block. How much is the total WDV value of the block? That is what is required. Are you all with me? Under WDV basis, there is nothing called an individuality for an asset. It's all about the block. You compute the block value. How much is the remaining block value? That is the relevant value for us. Now, say there is a sale. We will take it as case number 1. I have sold plant and machinery A for 6 lakhs. I have sold plant and machinery A for how much value, friends? 6 lakhs. The first thing to notice whether sales value exceeded WDV value of the block. You tell me whether sale value of an asset exceeded WDV value of block. The answer is no. If the answer is no, then there is no capital gain impact. Then the next thing to check is, are there any asset remaining in the block? You tell me. Is there any asset remaining in the block? Yes, there is plant and machinery B and C is remaining. Yes or no? There is B and C and the block have a value. And how much is the remaining value? How much is the remaining value? 4 lakh. On this 4 lakh, I can claim what? Depreciation at 15% in that year of sale. Are you with me? This is example number 1. That example simply means when you are selling an asset from a block and the sale value does not exceed WDV value, then there is no capital gain impact. On the remaining value, you can claim what? Depreciation. I'll give you a note in relation to this. This will not be there under Pgbp. This is under capital gain. Section 50 it is. This is under capital gain. But you need to know 32 and 50 together. Otherwise, you will never understood the concept. Alright, I want all of you to understand the concept thoroughly. That's why I'm taking section 50 along with 32. Listen. Scenario number 2. Scenario number 2. I've sold plant and machinery. I've sold plant and machinery A for 12 lakhs. I've sold plant and machinery A for how much value, friends? 12 lakhs. Now you tell me whether sales value exceeded the WDV value of the block. Yes or no? Yes. If the answer is yes, then that excess value shall be deemed to be short-term capital gain under section 50. How much ever is the excess value, that shall be deemed short-term capital gains under section 50. What is this deemed short-term capital gains? Irrespective of the period of holding of the asset you have sold, whether it is a long, whether it is short, whether it is held for 5 years, 10 years, whatever it is, doesn't matter. If when there is a sales from block and the sale value exceeds WDV value, excess value shall be deemed to be short-term capital gains under section 50. Now you tell me how much is the short-term capital gains here? 2 lakhs. And the block value, the WDV value have to be taken as 0. And the remaining block value have to be taken as 0. Because excess we have already dealt it under capital gains. The remaining value have to be taken as nil, 0. Now the question is there any assets remaining in the block? Yes, you have B and C. But can you claim depreciation on the B and C? If you want to claim, you claim it. You charge 15% on 0. You will get how much? 0. That simply means you cannot claim depreciation afterwards. Are you with me? Are you all with me? Yes. Say in the next year, asset B is sold for 1 lakh. Then what is the treatment? Entire 1 lakh will be short-term capital gain. Why? Because the entire 1 lakh is over and above the block value. Because the block value is 0. When there is a subsequent sale in that block, that means asset B is sold in the next year, then entire sale value will be short-term capital gain under section 50. Is that clear? Yes or no? Scenario 3. There is one more scenario. Scenario 3, what they say is, I have sold plant and machinery A, B and C for say 7 lakhs. I've sold plant and machinery A, B and C for how much value, friends? Altogether 7, not 7 each. Altogether 7. Then you tell me whether sales value exceeds WDV value of the block. No, sale value doesn't exceed WDV value of the block. Now, there is remaining value in the block. How much is the remaining value in the block? How much is the remaining value in the block? Initially it was 10. I've sold A, B and C for 7. How much is the remaining value? 3 lakh. But there is a problem. There are no assets remaining in the block. Yes or no? There are no assets remaining in the block. If there is no asset, you cannot claim depreciation on that 3 lakh remaining value. Normally, if there is remaining value, we charge depreciation on the remaining value. Yes or no? Here there is remaining value, but there is no asset. So what to do? So you have to treat this 3 lakh as short-term capital loss under section 50. That remaining value shall be treated as a short-term capital loss under section 50. Now let's summarize. Let's summarize and draw a flowchart in relation to 32 as well as 50. We are mixing it together. Now listen. So we will write it like this. I want all of you to take a note of this flowchart. Alright. So when there is a sale of asset, when there is a sale of asset from block, what should be the treatment? The first thing to check is what? What is the first thing to check? Whether sales value exceeds WDV value. Whether the sales value exceeds WDV value. If the answer is yes, you tell me what to do. Excess shall be deemed short-term capital gain under section 50. Excess shall be deemed STCG under section 50. Now, if the answer is no, what do you mean by answer is no? Sale value does not exceed WDV value. If the answer is no, you tell me what should be the treatment. There is one more thing to check. What is the thing? Whether whether assets remaining in the block. Assets remaining in the block. Whether assets remaining in the block. Whether there is any assets remaining in the block. Now friends, you tell me, if the answer is again yes, that means sale value does not exceed WDV value. That means there is value in the block as well as assets in the block. You tell me what is the treatment? There is no capital gain impact. On the remaining value, you can charge depreciation at normal rates. Are you with me? You can charge depreciation at normal rates on the remaining value. So, depreciation on WDV value and no capital gain impact. No capital gain impact. If the answer is no, what do you mean by answer is no? The sales value does not exceed WDV value, but there is no asset remaining in the block. Then what to do? Then the remaining value shall be what? Deemed short-term capital gains. Short-term capital loss, not gains. Short-term capital loss under section 50. Deemed short-term capital loss under section 50. Now let me ask you one question. You tell me, accountancy depreciation or income tax depreciation, which is easier? Normally people say accountancy depreciation is very easy, income tax is very confusing, but I'll tell you income tax is very easy. I'll tell you the reason also. Listen, say I am a huge company. I have 100 assets in my block. I've sold 50 assets in 50 dates. How to compute gain? First of all, I need to compute all the depreciation till the date of sale. 50 computations for depreciation. Then 50 capital gains computation. Yes or no? In income tax, single shot I can claim. If I'm selling that 50 assets from a single block, you take the total value of the sale value, apply it on the block. If the sale value exceeds the block value, shorter capital gains. Otherwise, no capital gains, charge depreciation on that. Are you with me? So when it comes to practicality, income tax depreciation computation is just like turning on a switch. But accountancy depreciation, you need to take a calculator, compute everything separately. Headache. Are you with me? The only point is you should know the concept under section 50. That should be studied along with section 32 itself. It is covered under capital gains under section 50. Are you all here? So this is how you compute depreciation in the case of a depreciable asset. Now there is one more problem. There is one more issue that may come in. Listen. So I cannot give you a theory for this. This is a practical scenario. But you should know this also. Listen. Say for example, my opening WDV was 10 lakh. Are you all listening? There was an addition, but that asset is put to use for less than 180 days. There was an addition, but the asset was put to use for how many days? Less than 180 days. And the value was 5 lakhs. And the value was how much? 5 lakhs. There were 3 assets in the block, including that additional assets. There were 3 assets in the block. Now I sold. What is the total value? It will be 15. Both opening and additions, the total value will be 15. Say I've sold one of the asset. For 12 lakhs. I've sold one of the asset for what value, friends? For 12 lakhs. When I sold this asset for 12 lakhs, is there any remaining value in the block? Remaining value? Yes. How much is it? 3 lakh. Is there asset remaining in the block? Yes. 2 assets are remaining in the block. That simply means I can claim depreciation. But what rate? If this 3 lakh is on account of opening asset, I can claim say 15% depreciation. If this 3 lakh is additional assets remaining balance, then I can claim only 7.5% depreciation. Yes or no? We don't know 3 lakh is on account of which value, whether it is opening or whether it is additional. In such situation, you need to follow FIFO method. What is FIFO? First in, first out. When the total value of asset is 15 and you sold something for 12, out of that 12, 10 lakhs is already gone because that is the first in item. Then the remaining 3 is on account of addition of assets. Are you with me? You need to follow FIFO when you compute depreciation in relation to sales. Are you all with me? Yes or no? Now let's solve a problem. So friends, I want all of you to take page number 20. Page number 20 in your question sheet. Take question number 5. Page number 20, question number 5 and solve it. So we'll solve it together, friends. So Sincania and Co. a sole proprietorship owns 6 machines put in use for business in March 2022. The depreciation on these machines is charged at 15%. And the written down value of these machines as on 1st April 2022 was 8,50,000. So I will note down all the important values. So the opening WDV is already given in the question. How much is the opening WDV, friends? 8,50,000. How many assets we have in the block? How many assets we have in the block? Opening, it is 6 assets. Yes or no? So I will note that also. So 6 machines. We have opening around 6 machines and the value is 8,50,000. Now listen, what it is 3 of the old machines were sold on 10th June 2022 for 11 lakh. For the time being, ignore that because always add additions first. And a second hand plant and machinery was bought for 8,50,000 on 30th November 2022. So it is an addition which is put to use for less than 180 days, because if you start counting from 30th November onwards, anyways it will be less than 180 till 31st March 2023. Yes or no? So we can say it is an addition for less than 180 days. So less than 180 day addition. How much is the value? 8,50,000. So you tell me how much is the value of opening plus addition? 17 lakhs. Now he sold 3 machines. He sold 3 machines. And what is the value of the 3 machines he sold? 11 lakhs. And is there any remaining value in the block? How much is the remaining value? 6 lakhs. Is there assets remaining in the block? How many assets? Not 3. We have 4 because one addition is also there. We have 4 assets in the block as well. Yes or no? And hence, what should be the verdict? No short-term capital gain. That is not applicable. But there will be depreciation on this 6 lakhs. Now you tell me what should be the rate of depreciation on that 6 lakh? 7.5%. Why 7.5? Because all the opening have been completely wiped out because we follow FIFO basis. So the remaining 6 lakhs is on account of addition, and that addition is for less than 180 days, and hence we can claim only 7.5% as the rate of depreciation. Is that clear? So you tell me 6 lakhs into 7.5%, how much is the depreciation? 45,000. 45,000 is the amount of depreciation. The remaining value shall be 5,55,000. That is the closing WDV. Yes or no? Now let's answer the questions. Okay, there are certain questions they have asked. Determine the claim of depreciation for assessment year 23-24. We have already computed it. 45,000. Compute the capital gain liable to tax for assessment year 23-24. Answer is nil or 0. If Sincania has sold those 3 assets in June 22 for 21 lakhs, will there be any difference in the above working? So let's see whether there is any difference in the above working. So let's recompute it. Opening is the same 8 lakh. Then 8,50,000 rupees. Then addition same 8,50,000 rupees. Adding these two same 70 lakhs. But the sale value is 21 lakhs. So the remaining value have to be written as what? 0. And how much is the excess value? Excess value is 4 lakhs. That shall be deemed short-term capital gain under section 50. And there is no depreciation on that block in future. That is the difference in the answer if the sale value is 21 lakh. Are you all with me? Hope it is clear. So friends, yesterday we have completed the concept of depreciation, and now we are about to start the next concept that is called as what? Additional depreciation on plant and machinery, which is covered under section 32 subsection 2a. So let's understand what exactly is this additional depreciation. So listen friends, if you are a manufacturer, say you are a manufacturer or you are in the business of power generation. You are in the business of generation of power or transmission or its distribution, opted for WDV. Alright, in the case of power generators, they have to opt for what? WDV method, or you have to be a manufacturer. If you are a normal manufacturer, then you can only opt WDV. You don't have an option to choose between SLM and WDV. Obviously, your method of depreciation will be WDV. Now, you have bought some eligible plant and machinery. You purchase some eligible plant and machinery. Then what department says is, on the actual cost of eligible plant and machinery, you can claim what? Additional depreciation at 20% in the first year of its purchase. So what department say is, listen friends, it's a very simple concept. See, you are either a manufacturer or a power generator opted for WDV basis, and you have purchased some eligible plant and machinery. Then on the actual cost of eligible plant and machinery, you can claim what? Additional depreciation at what rate? At 20% rate, only in the first year of its purchase. That's what the Act says. Now there are a few more things that you should know. The first thing is, additional depreciation can be claimed only on the first year of purchase, not afterwards. It is not like normal depreciation. Normal depreciation, you can claim it throughout the life of a particular asset. But additional depreciation, you can claim only in the first year of purchase. That is the first thing. Number two, you have to be a manufacturer. You should purchase eligible plant and machinery as well. What is this eligible plant and machinery? Again, the word eligible plant and machinery is not defined in income tax. Rather, they say negative list. What do you mean by negative list? All those things which are not covered under negative list will be a part of eligible plant and machinery. So let's understand which all are the items that comes under the negative list. Listen. So eligible plant and machinery does not include these items. Eligible plant and machinery does not include these items. That means these are the negative list for the definition eligible plant and machinery. So let's understand which all are the negative list. Item number one, ships. Basically, ship is not a plant and machinery, but only for the sake of understanding, I have given ship. Then aircraft. If you have ship or aircraft, then it shall never be treated as your eligible plant and machinery. Then second item, any machinery or a plant which before its installation by the assessee was used within or outside India by any other person, it also means what? Second hand plant and machinery. Say you have some second hand plant and machinery. You bought some second hand plant and machinery. My question is, can you claim normal depreciation? The answer is yes. There is no problem in claiming normal depreciation. But the problem is, you cannot claim additional depreciation. That's it. Because it is not an eligible plant and machinery. Then, third one. Any machinery or a plant installed in office premises. Then, residential accommodation or guest houses. Any plant and machinery which is installed in office premises, residential accommodation and guest houses are also not eligible plant and machinery. Say for example, a computer is normally an office appliance. Can you claim additional depreciation on the value of computer? No. But if the computer is installed in factory, definitely you can claim what? Additional depreciation. So all those items which are actually installed in a factory, definitely you can claim additional depreciation. Now, office appliances and road transport vehicle is the next item. As I've told you, pure office appliances, you are not supposed to claim any additional depreciation. Next is road transport vehicle. What do you mean by road transport vehicle? Say for example, your car, lorry, jeep, etc., which is used for your business. For those items, you cannot claim additional depreciation. But let me tell you one thing, friends. Have you heard about forklift truck? See, forklift truck simply means it is just like a crane. It has two pillars like this and it will hold containers and other heavy items. It will load it in the lorry, take it from lorry or load it in the ship, etc. So forklift truck, normally you can see it in airport and all. Alright, so this forklift truck do have an engine, do have wheels. You can actually drive it through the road, but it is not a vehicle. And hence you can claim what? Additional depreciation on forklift truck. Are you all listening? Second thing, dumpers. Have you heard about dumpers? What do you mean by dumpers? We'll call it as tippers, where your carrier raises. Alright, those dumpers which is exclusively used inside the factory premises also can be called as what? A normal plant and machinery, an eligible plant and machinery. A dumper which is exclusively used inside factory premises. Say for example, there are certain companies where they have at least 50-60 acres of land. Their warehouse will be at one corner and their production will be in the other corner. So they have to shift their products from warehouse to, or from production to warehouse, or from raw material yard to production. So for those things, if you are using a dumper exclusively inside your factory premises, definitely you can claim what? Additional depreciation. Are you all listening? It has been tested in, if my memory is right, it is in July 2021, that corona attempt. July 2021, they have tested this thing. So dumpers and forklift trucks, etc., which is exclusively used inside the factory, definitely you can claim what? Additional depreciation. It is not regarded as what? Road transport vehicle, even though you can drive it through road. Now, moving on to the next item. Any machinery or a plant where whole of the part of the actual cost is already allowed as a deduction in computing income chargeable under Pgbp. What do you mean by any machinery or a plant where whole of its cost is already allowed as deduction? What do you mean by that? Say for example, 35AD, specified business asset. Yesterday, I have hinted about 35AD asset. What was 35AD asset? Say you are a specified business, then you can claim 100% deduction for your capital expenditure. A normal business have to capitalize the capital expenditure and claim depreciation. But if you are a specified business, you can claim 100% deduction for all your capital expenditure. If you have already claimed 100% deduction for a capital asset, thereafter you cannot claim any additional depreciation. Thereafter you cannot claim normal depreciation as well. Are you with me? Why? Because already 100% of the cost is already allowed as a deduction. Thereafter no additional depreciation, no normal depreciation. So friends, these are the assets where you cannot claim additional depreciation. Now, listen, and there is one more explanation in relation to this additional depreciation. What department says is, just like the normal depreciation, in the year of purchase, if you put to use an asset for less than 180 days, you can only claim 50% of the normal depreciation as a deduction. Hope you remember, yesterday we have discussed it. Yes or no? Just like that, say, additional depreciation also there's a restriction. If in the year of purchase you have put to use an asset for less than 180 days, then rate of additional depreciation will become 10% instead of 20%. What is this 10%? 50% of 20, that will become effectively 10% will be the additional depreciation rate. But there is a problem. It is not like a normal depreciation. Additional depreciation can be claimed only in the first year of purchase. Yes or no? So department say, you do one thing. If in the first year of purchase, if you are put to use an asset for less than 180 days, then you claim only half the additional depreciation and you claim the remaining half in the subsequent year. Are you with me? For normal depreciation, such an adjustment is not there, not required. Why? Every year you can claim normal depreciation, but only on the first year of purchase you can claim what? Additional depreciation. So departments say, if in the first year, if you are put to use an asset for less than 180 days, then half the rate of additional depreciation is the eligible depreciation. But on the subsequent year, you can claim the remaining half as a deduction. Are you all with me? Yes or no? So this is the adjustment in relation to additional depreciation. Now friends, I want to share a few more things with you. You might have heard about section 32AD. If you have installed a manufacturing setup in a notified backward area, then you can claim additional depreciation at the rate of 35% instead of 20%. And you can claim a special deduction under 32AD as well at 15% on the eligible plant and machinery. Those things is not there in income tax right now. 32AD has been completely scrapped. That's why I'm not skipping 32AD. It is not there in Income Tax Act right now. So only the additional depreciation rate prevailing is 20%. That too, less than 180, it will be effectively 10%. I hope it is clear. Now there is one thing that you have to remember. Say for example, there is a small CBDT circular. It is not that important and all, but still, let me cover that too. Say, can you call printing as a manufacturer? Can you call printing business as manufacturing? The answer is department by way of a CBDT circular states that printing is also regarded as a manufacturing. And hence, those printers and publishers also can claim additional depreciation on their eligible plant and machinery. Are you with me? Only for the purpose of computing additional depreciation, this printing or publishing would amounts to manufacture or production of article. That also means you can claim what? Additional depreciation on the eligible plant and machinery of printers and publishers. I hope that is also clear for you. This is only for the purpose of computing additional depreciation, not for normal purpose. Only for the purpose of computing additional depreciation, printing and publishing is also regarded as a manufacture. So let's move on with the additional depreciation concept, and there is a small case law called as BSES Yamuna. Yesterday I have told you about this. Say for example, printers, scanners, etc. will be always treated as a plant and machinery computer, not a general plant and machinery. Printers, scanners, UPS, etc. But mobile phones, telecommunication devices, etc. are general plant and machinery, and the rate will be 15%. Are you all listening? Mobile phones and telecommunication devices like intercom and all, EPABX, we will call it as EPABX. Things like this is telecommunication devices. These are always treated as what? General plant and machinery. So that's all about depreciation and additional depreciation. I hope the concept till now is clear for you. So friends, let's move on. So the next concept is depreciation in certain special cases as per 6th proviso to section 32 subsection 1 clause 2. So let's understand what exactly is this particular point. Listen friends, it's actually a very simple concept. Say for example, listen, say I am JK Limited. I am JK Limited and there is another company called say PK Limited. There is another company called PK Limited. I've sold some capital assets to PK Limited. I sold some capital assets to PK Limited. Now you tell me, in the year of sale, can I claim depreciation for the capital asset which I've sold? In the year of sale, can I claim depreciation for the capital asset which I sold in the year of sale? The answer is no. It is only the buyer can claim what? Depreciation on this particular capital asset. Depends upon the number of days that he have put to use that capital asset in the year of purchase. If it is more than or just 180, he can claim full, otherwise half. Are you all with me? But there are certain exceptions to this point. Say for example, amalgamation, demerger, conversion, succession, etc. So let's understand what exactly is this amalgamation, demerger, conversion, succession, etc. So friends, please listen. What do you mean by amalgamation? What do you mean by amalgamation? See, there are two types of amalgamation basically. There are two types of amalgamation. Number one, amalgamation by way of merger. What is amalgamation by way of merger? There is one company and another company. They join hands together to form a single company to do the business jointly. This concept is called as amalgamation by way of merger. And second one, amalgamation by way of absorption. What is amalgamation by way of absorption? Say there is one company, it will absorb the another company and they will form together in the name of the original company. Say for example, JK Limited is absorbing PK Limited. Then PK Limited and JK Limited will form a single company, but in the name of JK Limited. And shareholders of PK Limited also will form as a part of JK Limited. This is what is called amalgamation by way of absorption. Are you with me? Now, in the amalgamation, there are a few things that you should note. So listen friends, say in the event of amalgamation, say we will take as say JK Limited and say PP Limited. There are two companies, JK Limited and PP Limited, and a new company will come here that is called as JP Limited. So JK Limited and PP Limited is joining their hands together to form a new company that is called as what? PP Limited. Now friends, listen. This JK Limited and PP Limited is commonly known as what? Amalgamating company. Amalgamating company. Now this new company JP Limited is called as what? amalgamated company. Amalgamated company. Alright, so there are two companies, amalgamating and amalgamated. Are you all with me? Now, in the event of amalgamation, all the assets from amalgamating company will be transferred to what? Amalgamated company. In the event of amalgamation, all the capital assets from amalgamating company will get definitely transferred to amalgamated company. But this transfer of assets is not regarded as transfer under section 47 of income tax. According to the provisions of section 47, when an amalgamating company transfers their capital assets to amalgamated company, it is not regarded as a transfer, because in the eyes of income tax it is not a sale. It is not a transfer. Income tax says it is only a business reorganization. Are you all with me? And now you tell me, so when there is an amalgamation, what to do? I'll tell you. Say for example, JK Limited has some assets in 2021-22. In 21-22, JK Limited has some assets. They got amalgamated on 1st April 2022. They got amalgamated on which date? 1st April 2022. So what to do is, say JK Limited have plant and machinery block having a closing WDV of 10 lakhs. In 21-22, the closing WDV of the plant and machinery was how much? 10 lakhs. When amalgamation happens, this entire capital asset will form part of block of whom? JP Limited, that is amalgamated company. Yes or no? The amalgamated company should take this 10 lakh as the WDV value and should claim depreciation at applicable rates in the year 22-23 onwards. Alright, even if this block is transferred for a value, doesn't matter. It is always the closing WDV of the amalgamating company, or we can say the predecessor should be the opening WDV of the successor. Are you with me? Who is the predecessor here? Amalgamating company. Who is the successor? Amalgamated company. Are you all with me? So when there is an amalgamation and transfer of capital asset, it is not regarded as transfer according to section 47, and hence the WDV value should be transferred as it is. You are not supposed to change anything. The WDV value should be transferred as it is to the successor. Are you all with me? Now there is one problem. Say there is an amalgamation in between. What do you mean by in between? Say the amalgamation happened on 1st January 2023. Amalgamation happened on when? 1st January 2023. In such case, what to do? In such case, what department says, in the year that is 22-23, both the amalgamating company and amalgamated company have used that particular plant and machinery. Both of them has used. Yes or no? In the year of amalgamation, in the last example, amalgamation was perfectly on 1st April 2022. So there was no confusion in the year 22-23. But in this example, the amalgamation happened in between an year. So what to do? What department says is, the plant and machinery's total value is how much? 10 lakh. You claim depreciation as a normal case. And how much will be the depreciation? 15% on 10 lakh. 1,50,000. You claim depreciation as if there is no amalgamation. Then you split the total depreciation between the amalgamating company and amalgamated company in the year of amalgamation. Why? Because both of them has used that particular capital asset. Are you all with me? You compute depreciation as if there is no amalgamation happened. Then you take the depreciation figure and proportionate that depreciation based on number of days used by the amalgamating company and amalgamated company. Are you with me? Now you tell me how to split this 1,50,000. 1,50,000 divided by 365. The total days used is 365 into how many days used by JP Limited? From 1st January onwards, January 31, February 28 and March 31, that will be 90 days. How much will be 1,50,000 into 90 by 365? 36,986 will be the depreciation that can be claimed by JP Limited. And how much is the remaining value? 1,50,000 minus 36,986. 1,13,000 013. 113,013 will be the amalgamation of JK Limited. Are you all with me? The same happens with PP Limited when they transfer their capital assets to JP Limited. The same happens with PP Limited also. I have only considered the effect of one of the amalgamating company. For the other amalgamating company also the effect is same. You have to split the depreciation based on the number of days of use. Now you tell me how much is the remaining closing WDV for that year? What will be the closing WDV for that year? 8,50,000 will be the opening WDV of that particular JP Limited for the next year. After claiming all the amalgamation, how much is the closing WDV? That closing WDV should be used as the opening WDV of the amalgamated company for the next year. Are you all with me? Yes or no? Same happens with demerger as well. Now friends, you tell me what is demerger. See, demerger, we don't say it is the reverse of amalgamation, okay, basically. Demerger means, say for example, we will take Google as an example. Google. So Google have tech business and flower business. Okay, Google both handles tech and flowers. And Sundar Pichai is the CEO of both tech and flowers. Do you think that Sundar Pichai will be able to excel in flowers? No, he is excellent in tech, no doubt in that. But can he improvise flower sales and all? Is that possible? No. So it is better to create Google Flowers Limited. Google Flowers Limited, and to appoint someone who is an expert in this industry as the head of the company for a better management efficiency. Are you all with me? The shareholders of the company will be the same. So the original owner of the Google is say JK. I owned Google. I will be the owner of this Google Flowers as well. The shareholding pattern will not be changed. There will be slight changes. The management will be totally different. For the better management efficiency, we normally think about what? Demerger. Are you with me? Now friends, listen. So in the event of a demerger, we can say the original Google company who owns tech as well as flowers is called as what? This company is called as demerged company in the event of demerger. So it is called as what? Demerged company. Demerged company in the event of demerger. And the new company which is formed, what is the name of the new company, friends? The new company which formed with this flower division, what is that name? Google Flowers. Google Flowers Limited. That new company is called as what? It is called as resulting company. Demerged company and resulting company. Now friends, there will be transfer of capital assets from this flower division from original Google company to Google Flowers. All the assets and liabilities of the flower division will get transferred to Google Flowers Limited. Yes or no? Basically, that is not regarded as a transfer because this is also a reorganization of your activities. This transfer of capital asset is also not regarded as transfer under section 47 of Income Tax Act. It is also not regarded as transfer. Now you tell me what will be the impact. All the things which we have discussed in amalgamation, same in the demerger as well. In between a year, if demerger happened in between the year, you claim depreciation in full, then split depreciation between the demerged company and resulting company based on the number of days of use. Are you with me? Whatever we have learned in amalgamation, same is there in the demerger as well. I hope it is also clear. Are you all with me? So this is in relation to demerger, friends. And there are a few more things. Next is conversion. Conversion. Say, to be very precise, conversion of a sole proprietorship business or a partnership firm into a company. Conversion of a sole proprietorship business or a partnership firm into a company. In such conversions also, there will be transfer of capital assets from the predecessor to the successor. In such case, the transfer is also not regarded as transfer according to section 47 of income tax, and hence what will be the impact? Same as that in amalgamation and demerger. You claim depreciation in full, then split the depreciation between the predecessor and the successor. Now, not yet over. Then there is one more conversion that is called as conversion of a private limited company or an unlisted public company to LLP. When you convert a private limited company or an unlisted company into LLP also, again it is not regarded as a transfer, and all the points that we have learned in amalgamation and demerger will be repeatedly come in this conversion as well, including depreciation, including the WDV, everything is the same. And there is one more case that is called a succession. Say succession of business. Succession of business. Otherwise than by death. Otherwise than by death. What do you mean by succession otherwise than by death? The father is actually transferring all his business to his son, or otherwise than death. Then all the assets of the father will be automatically transferred in the name of son. That is also not regarded as a transfer, and hence all the impact that we have learned under amalgamation will be there also. You claim depreciation and split it between what? The predecessor and successor. Are you all here? Hope it is clear also. Alright, so I hope this much is clear for you. So these are actually very simple points, and there are some problems that we have to solve in relation to this that we will deal in the afternoon session. Alright, so let's move on, friends. So let me ask you one question now. On what value we normally compute depreciation? On what value we normally compute depreciation? So on the value of actual cost, we compute what? Depreciation. Now the question is, what is this actual cost? Actual cost simply means your purchase cost plus all direct expenses like loading, unloading, transportation, installation, testing, etc. charges till you put to use that particular asset for your business. All the direct and incidental costs that till you put to use a particular asset for your business will be regarded as actual cost. On the value of actual cost, we have to compute what? Depreciation. Are you all listening? It is not only on the purchase cost. It is on the actual cost that you should compute your depreciation. Actual cost means all the incidental cost that is in relation to put to use an asset in your premises. It includes interest cost if there is a qualifying period for the asset that you have purchased. Hope you have learned borrowing cost in AS. Have you learned borrowing cost in AS? It is similar to that. I'll give you one example for a better understanding. Listen. Say on 1st April 2022, I purchased an asset. Say for 10 lakhs. The entire amount was on loan and the interest rate is as 10%. So the asset cost is 10 lakh. I got the fund by way of a loan. I took a loan for purchasing this particular asset, and what is the interest cost for that? 10%. Now it took around 10 months. It took around 10 months. Say I will take the interest as 12%. Okay. I'll take the interest as how much? 12%. You know the reason. Alright. Now it took around 10 months for me to install that asset in my premises. I took around 10 months to install that particular asset in my premises because there was a lot of installation, process was there. Now, listen. So, then for the rest of the 2 months, I have actually put to use that asset. Put to use. Now, you tell me, what is the total interest for the year? How much will be the total interest cost for that loan? That will be 1,20,000. This loan is actually taken for your business purpose. So this entire 1,20,000 is a eligible deduction, but there is a problem. That 10 lakh is actually taken for purchasing an asset, and that asset required some qualifying period to put to use for your business. Yes or no? So what department say is proportionate interest till put to use date have to be a part of your actual cost. Only the remaining interest cost is allowed as a deduction from your taxable profits. So what you need to do is, you took around 10 months to install that asset in your premises, yes or no? So you take that entire 1,20,000 interest for the year, divide it by 12 months, then multiplied by 10 months. So how much will be the proportionate interest? It will be 1 lakh. This 1 lakh interest have to be capitalized along with the actual cost of asset. Only the remaining 2 lakh, not 2 lakh, 20,000, you are supposed to claim it as a business expenditure. So this is what is the treatment when there is a loan taken for purchase of an asset and the asset requires some period to put to use for your business purposes. Are you all with me? Just like the borrowing cost, the treatment is exactly same. You have to put this also as a part of your actual cost. Now, there is one more thing that you should know in relation to actual cost. Listen. Say another example. Say I purchase an asset. I purchased an asset for 10 lakh. For 10 lakh. Then I can capitalize this entire 10 lakhs as an actual cost and I can start claiming depreciation on that particular 10 lakhs if I put to use that particular asset for my business. Yes or no? Yes or no? Now listen friends, there are a few things. What department says, while making payment, if a single day payment exceeds 10,000 rupees, exceeds how much? 10,000 rupees. Then the method of payment have to be either account pay cross check or account pay bank draft or electronic clearing system or through prescribed electronic modes. If while making payment in relation to a particular capital asset, that means while disbursing actual cost, if a single day payment exceeds how much? 10,000 rupees. Single day payment exceeds 10,000 rupees, then the method of payment is mandatory. It have to be either by way of account pay cross check or account pay bank draft or electronic clearing system or through prescribed electronic modes. If I have made the payment in any other manner, then what will happen? That entire payment will not be treated as a part of actual cost. Say for example, while making 10 lakhs amount, I paid 2 lakhs in cash. 2 lakhs in cash and 8 lakh by account pay check. Then what will happen? I can only treat this 8 lakh as the actual cost and I can claim only depreciation on this 8 lakh only, not on the 2 lakh, because while discharging the payment also, the method of payment is actually mandated by the department. Now, what do you mean by account pay cross check? Crossing the check by writing it as account pay. Only the pay's account, he can disburse that particular check. Account pay bank draft is also an account disbursable bank draft. What is ECS? Electronic clearance system through the bank account. What is this prescribed electronic modes? UPI, your Google Pay, Aadhaar Pay, Beam Pay, debit card, credit card, etc. will come under the prescribed electronic modes. So your payment must be in any of these methods. I hope this is also clear for you. Now listen friends. So there are a few actual cost special scenarios in income tax. Actual costs in certain special situations. All right. Out of this, there are, I think in my memory, there are around 20, how many items are there? There are around 18 items are there. But out of these 18 items, 2 or 3 is very important. Out of these 18 items, 2 or 3 is very important. Actual cost scenarios. I'll give you one example for this. Say for example, you are a specified business and you claimed entire cost of a asset as a deduction under 35AD. After claiming the deduction, what will be the actual cost of the asset? 0. That simply means you cannot claim depreciation. Those are the special circumstances. Out of this, certain things you have to be very careful. I'll tell you that important things only. The rest you can read it by yourself. Again, listen. The first thing that I want to discuss is this point, that is a second-hand plant and machinery or a second-hand asset and the assessing officer is satisfied that the main purpose of transfer of asset directly or indirectly to the assessee was for reduction of a liability of income tax directly or indirectly to the assessee. It's a fantastic point. Then the actual cost to the assessee for a depreciation purpose shall be an amount which assessing officer may determine with the previous approval of joint commissioner. What do you mean by this? Listen, I'll give you an example for this. This is also a small anti-avoidance measure. Listen, say for example, Mr. JK purchased a second-hand asset. Purchased the second-hand asset. Is purchasing a second-hand asset a problem in income tax? Is purchasing a second-hand asset a trouble or a problem in income tax? Nothing. It is not at all any violation. It is very much allowable. Say, I purchased a second-hand asset for, say, 15 lakhs. For how much value? 15 lakhs. But the fair market value of the same asset was only 10 lakhs. What is fair market value? We call it as open market value. Open market value of that particular asset was only 10 lakhs. Assessing officer came to know about, at the time of assessment, assessing officer came to notice this. And he asked, why you purchased it for 15 lakh when it is available in the market for 10 lakh? There was no proper reply from the assessing. That simply means assessing officer will say, you purchased it for a higher value to claim extra amount as depreciation. This is not a genuine transaction. If assessing officer thinks that, or assessing officer proves that the very purpose of this transaction is to claim more depreciation, then AO have the power to recompute actual cost of that particular asset. AO have power to recompute the actual cost of the asset with the approval of joint commissioner. Who is joint commissioner? The higher authority. AO can do this only with the approval of joint commissioner. We call him as JC. Are you all here? Yeah. So AO can recompute the actual cost with the approval of JC. Now friends, listen. What is this recompute? That means according to his discretion, he will recompute the actual cost. Normally, he will bring down this 15 to 10 lakhs. That's what he do. Are you all listening? So, if a second-hand asset is purchased for a higher value and AO proves that it is only for the purpose of claiming extra depreciation, then AO have the power to recompute the actual cost of that particular asset. It's a discretionary power of assessing officer. That is number one. Now, under this, there is one more point that we should know. You can tick all these things, okay? You can tick all these things. There is one more point that you should know, that is number 5. Because once they have mixed this 4 and 5 and asked the question. Alright, now, where any asset which had once belonged to the assessee and had been used by him for the purpose of his business or profession and thereafter transfer the property and reacquired by him, then actual cost to the assessee for depreciation purposes shall be the written down value at the time of original transfer or actual price for which the asset is reacquired by him, whichever is less. What do you mean by this? Say, for example, asset, say for example, Mr. JK was using an asset, using a plant and machinery for his business purpose. The WDV value of the plant and machinery was 10 lakh. WDV value for plant and machinery in the year 21-22 was say 10 lakh. I sold this plant and machinery to Mr. P. So Mr. K, I've sold this plant and machinery to whom? Mr. K. After 2 years, I purchased it. I again reacquired it. What do you mean by reacquired? An asset once used is sold. Thereafter, I repurchased the same asset. Are you with me? Say I repurchased it for how much? 12 lakhs. I repurchased it for how much value? 12 lakhs. Now you tell me, what is the repurchase cost of the second-hand plant and machinery? Basically, really it is 12 lakhs. But department say, while computing actual cost, if an asset once used have been sold and reacquired, then the actual cost shall be either repurchase price or original WDV value at the time of initial transfer, whichever is lower. That means the WDV value of that particular plant and machinery before you sell, or the repurchase price, whichever is lower only you can claim it as cost of acquisition at the time of repurchase of an asset. I hope that also is clear. Are you all here? Arey, please respond. Okay friends, now I want all of you to solve a problem which is in page number 6 of our question sheet, page number 6, that is question number 8. Go through this question, it's a fantastic question. Alright, so I want all of you to create a flow chart based on this question, otherwise you won't be able to answer this question. It's a fantastic question. Go through this question carefully, draw a flow chart and give me the answer. So friends, let's read the question together and let's find out the answer. So Rameshwaram, after purchase, put to use on 15/12/2020, a machine worth 3 lakh, which is eligible for depreciation at 15% under the Act. He sold this machine to Ganesham on 1st January 2022 for 3,20,000. The fair market value of that month was 2,50,000. Who after having used the machine for his business purpose, again sold it back to Rameshwaram on 15 November 2022 for 3,10,000. Compute the amount of allowable depreciation and the chargeable capital gain, if any, for assessment year 21-22 to 23-24. So this question, you have to compute gains as well as depreciation effect for multiple years. Yes or no? Now, what they are saying is, assuming that this was the only machine in the block of asset held by both Rameshwaram and Ganesham. So you can assume that this is the only block. So there are no other block of assets. So no other assets remaining in the block. Are you with me? So this is the only block in that, only asset in that particular block. So let's draw a flowchart based on this particular question. So that will actually help you to give the answers. So listen. So there are two persons called Rameshwaram and Ganesham. So I will call it as R. So Rameshwaram bought an asset on 15/12/2020. He purchased an asset for what value, friends? For 3 lakh. Then which is eligible for depreciation at 15%. So the first thing to notice, he sold this machinery on 1st January 22. That means in 21-22 year. The purchase happened in 2020-21. Yes or no? The purchase happened in the year 2020-21. So the first thing that you should know is he can claim depreciation for the year 2021. Are you all with me? The purchase cost is 3 lakh and he can definitely claim what? Depreciation on this particular 3 lakh. And how much is depreciation? 15%. How much is far? But you cannot claim that entire 15%. Why? Because it is purchased on 15th December 2020. So how much will be the effective depreciation? The effective depreciation will be only 7.5%. Tell me how much is 7.5% on 3 lakh? 7.5% on 3 lakh? 22,500. You claim this depreciation, how much will be the closing WDV value? 2,77,500. That will be the closing WDV value for 2021. Now friends, listen. In the next year, that means in 2021-22, on 1st January, he sold that particular asset to whom? To Ganesham, right? To G. Now you tell me, in 21-22, that means in the year of sale, can you claim depreciation for that particular asset? No, because that is the only asset remaining in the block. That's what the question says. So what to do? Let's check. How much is the sale value? Sale value, how much? That is 3,20,000. Yes or no? How much is the closing WDV value of the block? Or how much is the WDV value of the block? 277,500. Now you tell me, how much is the excess amount? Excess amount 42,500 shall be deemed to be short-term capital gain under section 50 in the hands of Rameshwaram in the year 21-22. I hope that also is clear. We have learned how to compute short-term capital gain in case of depreciable asset yesterday. I hope it is clear. Now friends, now let's compute the effect of Ganesham. So we will write Ganesham. In the year 2021-22, Ganesham purchased the second-hand plant and machinery. Yes or no? Purchased the second-hand plant and machinery. Second-hand plant and machinery because he purchased it from Rameshwaram. So it is a second-hand plant and machinery. How much is the purchase cost? How much is the purchase cost, friends? 3 lakh 20,000 is the purchase cost. They have given fair market value of that particular asset in brackets. How much is the fair market value of that particular asset? It was only 2,50,000. So you need to, there is an indirect hint in the question. The fair market value is only 2,50,000. Purchase price is 3,20,000. So what is the indirect hint? He purchased it for a higher value compared to the fair market value, and hence assessing officer will come there and recompute. But one point is missing, whether there is any adequate or genuine reason for the higher purchase cost. That is not given in the question. So you must assume that there is nothing. Otherwise, they should clearly specify. Are you with me? You can assume otherwise also, but institute has never given an alternative answer for this. Institute haven't given an alternative answer for this. So it is better. Why? Because they have given FMV, because they want you to take that particular actual cost, special circumstance. Are you with me? So institute haven't given an alternative answer, but in my opinion, you can assume otherwise also. There might be some genuine reason. There might be some genuine reason for the high price. Alright. But since there is no alternative answer given by the institute when they ask this, it is better to assume it is a, what do you say, fair market value itself as the cost. That is the best way to solve this answer. Now listen, the FMV is 2,50,000. So what to do? According to the actual cost special scenario or special circumstance, Ganesham is only supposed to take actual cost as how much? 2,50,000 only. Hope you remember this particular example. JK purchased an asset for 15 lakh when the FMV was 10 lakh. Then AO have the power to recompute the cost and bring it down to 10 lakh. That was the last paragraph that we have discussed. Now let's come back to the answer. So 2,50,000 should be the effective actual cost. So you tell me the purchase date. Purchase date 1st January 2022. So he can claim depreciation. And now you tell me how much is the rate of depreciation? Only 7.5%. Now you tell me how much is 7.5% is on 2,50,000? 18,750 is the depreciation. After claiming depreciation, how much is the closing WDV? 2,31,250 is the closing WDV. This happened in the year 2000. We have already written the year above 21, 22. Now listen. Then what they are saying is, then again, who after having used the machine for this business purpose again sold it back to Rameshwaram. The Ganesham sold it back to Rameshwaram on 15/11/2022. That means in the year 2022-23, Ganesham sold this. So how much is the sales value? Sales value 3,10,000. Now you tell me how much is the closing WDV or how much is the WDV value? 2,31,250. Is there any excess? Yes. How much is the excess value? 28, 78, 750 is the excess value. That will be short-term capital gain under section 50 in the hands of Ganesha. Now it's not yet over. Go back to the Rameshwaram case, and in the year 2022-23, Rameshwaram purchased an asset which was initially used by him earlier, sold it to Ganesham, then reacquired it. Yes or no? You tell me how much is the repurchase price? Repurchase price was 3,10,000. Repurchase price was 3,10,000. Yes or no? How much was the original WDV at the time of transfer? Original WDV at the time of original transfer was 277,500. Now you tell me how much should be the actual cost? Actual cost due to that special circumstance is the lower figure, that is 277,500, and he can claim depreciation at how much rate? Now you tell me which is the year of sale, sorry, date of sale. It is on 15th November 2022. That means again less than 180 days. So effective rate of depreciation is 7.5%. Tell me how much is 7.5% on 277,500? 30, 20,813. So you can claim the depreciation. How much is the closing WDV? 56,687. That is the closing WDV, and that is the final answer to the question. I hope it is clear. Okay, friends, there is one more special circumstance in actual cost. So let's deal that now. So let's understand what is the next special circumstance in determining actual cost. This is the one. Listen. So where a building which was previously the personal property of the assessee is brought into use for the purpose of business or profession, then how to determine the actual cost? The actual cost to the assessee for a depreciation purpose, that is the actual cost of the building to the assessee as reduced by notional depreciation. What do you mean by this? I'll give you an example for a better clarity of this particular provision. Listen, say I had a building which I purchased in the year 2021-22 for 10 lakhs. I purchased a building for 10 lakhs in 2021-22 and I've used it for my personal purpose. Personal purpose. What do you mean by personal purpose? Maybe I haven't used it for my business purpose. That's it. I've used it for some other purpose. Maybe I've used it as my residence. Then in 2022-23, I introduced that particular building as my capital asset to the business. In 22-23, I introduced that particular business as my capital asset to my business. When I introduced that particular building, which is used earlier for my personal purpose into my business, what should be the actual cost? You cannot take that entire 10 lakh as the actual cost. What should be done is, you need to reduce notional depreciation for the year of usage. I've used it for 1 year for my personal purpose. Yes or no? So the notional depreciation should be 10% because the rate of depreciation for a normal building is 10%. So notional depreciation means 10% on 10 lakh. And how much is 10% on 10 lakh? 1 lakh. That 1 lakh have to be reduced and 9 lakh should be the actual cost when you introduce that particular building in the year 22-23 for your business purpose. It doesn't mean you can claim that 1 lakh as depreciation. That's a notional depreciation that you have to remove from the actual cost to determine the actual cost of a building which is previously used as a personal property. Are you with me? Are you all here? This is only applicable for buildings, not for car and all. For car and all in the second year also you can take the original cost of acquisition itself as the actual cost. You don't have to do anything. It is only for building that you have to do this particular calculation. Are you all with me? Great. Now let's move on. There are no other special circumstances are there, but I'm not saying that all others are very important. So let's move on with the next points. Listen. So the next thing that you should know is carry forward and set off of depreciation. Section 32 subsection 2. So friends, tell me, what do you mean by carry forward and set off of depreciation? Carry forward and set off. Say for example, if you have unabsorbed depreciation, unabsorbed depreciation. I hope you know what is unabsorbed depreciation. What is unabsorbed depreciation? Current year depreciation you have. You don't have any profit to charge off your current year depreciation. So that current year depreciation which is not absorbed by profits are called as what? Unabsorbed depreciation. That can be carried forward to unlimited subsequent years. That means there is no limit. You can keep on carry forwarding it to subsequent years. Are you with me? There is no limit for the carry forward of unabsorbed depreciation. You can carry forward it to subsequent unlimited years and you can claim it as a deduction in subsequent year profits. That's what the department says. So if you have unabsorbed depreciation in a year, you can carry forward it to unlimited subsequent years and claim as a deduction. That's it. So these are the things that we have to study in relation to depreciation. I hope all the points are super clear for you. So moving on with the next concepts, friends, that is tea development account, coffee development account, rubber development account, which is under section 33AB. So let's understand what exactly is 33AB. All right. So listen, we can say it is a special provision, which is a deduction provision applicable for those assessees who does growing and manufacturing of either tea or coffee or rubber in India. So if you are in the business of growing and manufacturing either tea or coffee or rubber in India, then you are eligible to claim this 33AB deduction. So friends, what do you mean by growing and manufacturing tea, coffee, rubber? See, growing and manufacturing of tea, coffee, rubber means, say for example, I will take tea. All right. Say the tea plantation, they will pluck the tea leaves. They will clean it. They will process it. They will grind it and they will dry it. From that, you will get the tea dust. Normally, we use tea dust to make the tea. Yes or no? So there is a extra processing required to make it marketable. You cannot directly, you can actually sell tea leaves directly to the market. If you're selling tea leaves directly to the market, then it is agricultural activity. But you are selling tea dust, then it's altogether different. That is growing as well as manufacturing of tea dust. Are you with me? Are you all with me? Now, so if you are in the business of either tea, coffee or rubber, growing and manufacturing in India, then you are an eligible business to claim a deduction under 33AB. So let's understand what all are the conditions to claim a deduction under 33AB. The first condition that they say is you should make a deposit with NABARD, any amount in a special account maintained in accordance with the scheme approved by the tea board, coffee board or rubber board, or any amount in an account to be known as a deposit account with the previous approval of central government. So for claiming this 33AB deduction, there is a pre-requirement. What is the pre-requirement? You must make a deposit either with NABARD or with a central government approved special account that is called as deposit account maintained in a nationalized bank. Are you with me? What is NABARD? So we can say it is a National Board for Agriculture and Rural Development, NABARD, or you have to make a deposit with deposit account with a nationalized bank. That is also fine. So the point is you have to make a deposit. Then when should you make the deposit? Department say either in between the PY or at least before due date of filing your return or before 6 months from the end of the previous year, whichever is earlier. So there is a time frame to make the deposit. What is the time frame, friends? You can make the deposit during the PY. Absolutely no problem. Or you have a choice. From the end of PY, you can take another 6 months to make the deposit. Or before filing return, whichever is earlier. So as a theory, we can say before expiry of 6 months from the end of relevant PY or before due date of filing return for that PY, whichever is earlier. Which PY, friends? The PY which you are about to claim this deduction. If you want to claim this deduction, you must make a deposit. So the deposit should be made before 6 months from the end of relevant PY or before due date of filing return, whichever comes first. Then, how much is the deduction, friends? The deduction shall be lower of, listen, the deduction shall be lower of an aggregate amount of deposit in a year. Aggregate amount of deposit made in a year or 40% of the profits from business, whichever is lower. Either the deposited amount or 40% of your business profits, whichever is lower, is your deduction from 33AB. Now friends, listen, but there is a problem. 40% on what? Profits. What is profits? The word profit here means it is not the P&L profit. You should take the profit which is computed as per Pgbp but before claiming 33AB deduction. That means except 33AB, every other provisions you have to apply. After applying that, you will get a figure and that figure is said to be the profits and on that figure you take 40%. Why except 33AB? Why except 33AB? We don't know. That's what we are about to determine. Only, right. So listen, the point is a sum equal to aggregate of the deposits made or 40% of the profits of such business, and the definition of profit is here in the brackets as computed under Pgbp before making any deduction under this section and before adjusting brought forward business loss as well. What do you mean by brought forward business loss? If you have any loss last year, you will brought forward that business loss to this year before adjusting that brought forward loss also. How much is the net profit coming? That simply means we can say current year profit before adjusting 33AB. Are you all listening? Current year profits before adjusting 33AB. On that, you take 40%. or 40% or amount deposited, whichever is lower shall be your deduction under 33AB. I hope it is clear. Now there are a few conditions. You have to maintain separate books of accounts and get it audited by a chartered accountant, and you need to file your return as well as the audit report to the department for claiming this particular deduction. You must maintain your books of accounts, get it audited by a chartered accountant, and you need to submit your return as well as audit report on time to claim this 33AB deduction. That is not that important for us anyways. Now, moving on. Next is, so it shall be sufficient compliance with the provision of this section if such assessee gets the accounts of business audited under any other law and furnishes a report of audit and a further report in form 3AC in prescribed manner or form under this section. Just like the tax audit, you have done statutory audit, that is more than enough. Along with the statutory audit, you submit this form as well. That's it. You don't have to do a separate procedure. Are you all with me? Just like we combine statutory audit and tax audit. You do tax audit, you do statutory audit. Along with that, you can file a separate form 3CA, 3CB, and Akshar 3CD. You don't have to take separate days for separate audit. Along with that, you can do. The same has been prescribed here as well. That is also not very relevant for us from an examination point of view. Then the next point is important for us. That is, any amount standing to the credit of the assessee in the special account or deposit account cannot be withdrawn except for the purposes specified in the scheme. What do you mean by this? Listen. Say, if you are a tea, coffee or rubber grower and manufacturer in India, then what is your specialty? You can make a deposit to the special account and you can claim that deposited amount or 40% of your profits as your deduction under 33AB. Yes or no? Now the problem is you have made lot of deposits in the deposit account. What should be the purpose of this deposit account? You cannot simply withdraw amount from the deposit account and use it according to your wish. Not possible. When you withdraw amount from the deposit amount, its utilization should be only for specified purposes, which is prescribed by the tea, coffee or rubber board. Are you all here? You cannot use the amount deposited for any purposes. It can be withdrawn only for specified purposes, which is recommended by the tea or coffee or rubber board. Depends upon the assessee's business. So that's what they say. Amount standing to the credit of assessee in the special account or a deposit account cannot be withdrawn except for the purpose specified in the scheme. That means it can be withdrawn only for the specified purposes. Then, and what all are the specified purposes? We don't have to study because it will be recommended by the tea board, coffee board and rubber board. It is not recommended under income tax law. Now, so if the deposit amount is withdrawn by the assessee and is utilized for the following purchases, then the whole of such amount so utilized will be treated as a taxable profit for that year and taxed accordingly. So friends, listen. So friends, the point which I was saying is this one. So if deposit amount is withdrawn by the assessee and is utilized for the following purchases, then the whole of such amount so utilized will be treated as taxable profit of that year and taxed accordingly. That simply means these A, B, C, D can also be called as what? Negative list. What is negative list? For these purposes, you are not supposed to withdraw any amount from deposit account. Are you all with me? For these purposes, you are not supposed to withdraw any amount from deposit account. Let's understand which all are the purposes. We can also call it as a negative list of activities. Number one, any machinery or a plant installed in office premises, residential accommodation, including a guest house. When you are withdrawing an amount and utilizing that amount for purchasing a plant and machinery in the residential accommodation, guest house or office premises, that is an ineligible purchase. And if you have invested in any of this, then what will happen? In the year of purchase, the amount withdrawn shall be deemed to be your taxable profits under Pgbp. Why? Because at the time of deposit, we have given you deduction. And we have clearly stated that the amount should be withdrawn only for specified purposes. All these purposes are not specified purposes. And hence, if you have utilized your money for any of these purposes, then what will happen? That entire money shall be treated as your deemed income, taxable under Pgbp. I hope it is clear. Are you all listening? Now, point number 2. Any office appliances other than computers, however, if computers are purchased for utilizing an office premises, then such amount will be taxed accordingly. Simply it means office appliances you are not supposed to purchase, but computer installed in factory is eligible. Installed in office, you tell me what will happen? Installed in office, not eligible. Okay, computer installed in factory is definitely eligible, and computer installed in office is not at all eligible. I hope it is also clear. Moving on to the next item, any machinery or a plant where all of its actual cost is already allowed as a reduction in computing income under Pgbp. What do you mean by all of its cost is already allowed as a reduction? Scientific research asset or something, section 35. Because tea, coffee, rubber is not a specified asset, specified business. So, the 100% deductible asset here will be only section 35 assets. If you purchase any section 35 assets, again, you are not supposed to do it. You are supposed to purchase all other assets and all. Now, any machinery or a plant specified in the 11th schedule. There's a thing called 11th schedule in income tax. You don't have to study the list of 11th schedule item and all. But it is there as a part of the negative list. So, there is a thing called 11th schedule in income tax. All those assets specified in the 11th schedule are also a negative listed item. You don't have to study the 4th point. For you, for examination purpose, ABC is more than enough. So, you are not supposed to utilize the amount withdrawn for any of these purposes. I hope that also is clear. Now, listen. There are a few more points in relation to this. So, let's understand each and every point in a detailed manner. Listen. So, the 5th point. Let's understand what exactly is the 5th point. Listen. So, moving on to the next condition, what they say is, so, apart from the above, the deposit amount can also be withdrawn in the following circumstances. These two are the allowed circumstances, or we can say permissible circumstances. Impermissible circumstances. These three are the permissible circumstances. Listen, if you withdraw the amount on closure of your business or dissolution of firm. What is closure of business? You have discontinued business, so you withdrawn the entire amount from the deposit account. Or dissolution of firm. You were a partnership firm. You ended up your business. You are in a dissolution and you have withdrawn all the amount from the deposit account. Then what will happen if you withdrawn like that? If any amount withdrawn from the deposit account on closure of his business or dissolution of firm, then the whole of such withdrawn amount shall be deemed to be profits and gains from business or profession of that previous year. What do you mean by that previous year? That previous year. In the year of withdrawal. In the year of withdrawal, it will be fully taxable as a deemed income under Pgbp and shall be chargeable to tax as income of that previous year as if the business had not been closed or firm had not been dissolved. So, it is just like a deemed income under Pgbp. Now, if you are withdrawing the amount on account of liquidation of a company or death of an assessee or partition of Hindu undivided family, then it is altogether different. In such cases, the amount withdrawn shall not be taxable. It is outside the purview of taxability. That simply means you withdrawn the amount on account of either liquidation of a company or a death of an assessee or partition of HUF. Then what will happen? There is no deeming fiction. That means there is nothing called a deemed income under Pgbp. That is completely outside the purview of taxation. Moving on with the next condition, where the amount withdrawn from the deposit account for being utilized by the assessee for the purpose of business and is not utilized in accordance with the scheme or a deposit scheme in that year. Here you must underline that year. Give a double underline for that year. The unutilized amount shall be deemed to be the profits and gains and chargeable to income tax as income of that year. Friends, please listen. There are a few important things in this paragraph. What this paragraph says is, listen, say for example, in 2022-23, I have withdrawn, say 10,000 rupees from deposit account. I have withdrawn how much, friends? 10,000 rupees from deposit account. Then I must utilize this particular 10,000 for specified purposes only. Are you all with me? That is the first thing that we should note. I am supposed to use it only for specified purposes. Say I have utilized it for some other purpose. Then what will happen? That entire misutilized amount shall be deemed income in the year of withdrawal. Are you with me? And there is one more thing. Say I have utilized it on 15th April 2023 for a notified purpose. Then also that withdrawn amount shall be deemed to be my income taxable under Pgbp. Why? Because the point is, if you are withdrawing an amount, you must utilize it in the year of withdrawal itself for the specified purposes. If you are utilizing in the next year, even if it is for a specified purpose, you will not that amount withdrawn shall be your deemed income under Pgbp. So the moral of the story is pretty simple. Withdraw an amount, utilize it for specified purpose in the year of withdrawal itself. In our example, year of withdrawal was 22-23. Date of utilization was 15th April 2023. That means in the year 23-24, if you have utilized it, then it will be a deemed income in 22-23 itself. You withdraw an amount, utilize it in that year itself for specified purpose, then there is no problem. Otherwise, that withdrawn amount shall be a deemed income under Pgbp in the year of withdrawal. I hope that point is also clear. Is that clear, friends? So moving on with the next condition, friends. So condition number 7, lock-in period for asset which is purchased in accordance with the scheme is 8 years. What do you mean by lock-in period? Friends, lock-in period simply means you are not supposed to sell that particular asset for another 8 years. Which asset? You have deposited some amount in deposited account and take a deduction. Now you are withdrawing an amount and utilizing that withdrawn amount for an eligible plant and machinery purchase. That eligible plant and machinery is not supposed to transfer for another 8 years. Why? Otherwise, you will purchase an eligible plant and machinery and then you will sell it and realize the money back. Yes or no? So what they say, you utilize it for eligible plant and machinery, but you are not supposed to transfer that eligible plant and machinery for another 8 years. That is called as lock-in period. Now you tell me, what if I've transferred that particular eligible plant and machinery within 8 years? What will happen? Department say, where an asset above is transferred in any previous year by the assessee at any time before the expiry of 8 years from the end of PY in which it was acquired, then such portion of cost relatable to the deduction allowed under 33 AB subsection 1 shall be deemed to be Pgbp of the previous year in which the asset is sold or transferred and shall be chargeable to income tax as income of that previous year. So if you have violated that 8-year lock-in period condition, then what will be the consequence? In the year of violation, proportionate deduction claimed earlier at the time of deposit shall be your deemed income under Pgbp, because the act is very much clear. You are not supposed to transfer that particular asset for another 8 years. You violated that condition. The consequence is deemed income. And how much is deemed income? The entire amount withdrawn and utilized for that particular asset shall be your deemed income. Are you with me? Now, moving on. Point number 9. There are certain exceptions also. These are actually not required. There are certain exceptions for this case also. Let's understand. You don't have to study this, but let me explain this also. Such restrictions will not apply in the following cases. Number 1, where asset is sold or otherwise transferred to government. Your plant and machinery is taken over by the government within 8 years. No problem. Or local authority, panchayat, municipality, etc. Or to any statutory corporation or government company you are transferring it. That lock-in period condition is not applicable. Then, sale or otherwise transfer in connection with succession of a firm by a company, provided that all the conditions in relation to succession should be satisfied. There are certain conditions in relation to succession. What is succession? Succession of a firm by a company. Earlier you were firm, now you converted yourself into a company. That is a conversion basically. But in the eyes of income tax law, both are different persons. Because firm is a person with a PAN and company is another person with a PAN. You will be the same owner. But doesn't matter if in that conversion also If there is a violation of lock-in period condition, doesn't matter, they will not tax it. So there are certain conditions also. They say all the assets and liabilities of the firm should become the assets and liability of the company, and all the shareholders of the company were the partners of the firm immediately before the succession. That means all the partners of the firm have to become a shareholder of the company. Plus, all the assets and liabilities of the firm have to be taken over by the company. If both are satisfied, then transfer on account of conversion also is not a problem. Then, moving on. This point is not that important, but still, moving on with the next condition, excess deposit. Any excess deposit made during the previous year is not treated as a deposit made for the next year. What do you mean by not treated as a deposit made for next year? See, earlier we have discussed that under 33AB, your maximum deduction shall be either deposited amount or 40% of your business profits, whichever is lower. Hope you remember that. 40% of business profits or amount deposited, whichever is lower is our deduction. Say I have deposited 10 lakh and 40% of my business profits was only 8 lakh. How much I will get it as a deduction? 8 lakh being the lower figure. But my deposited figure is 10 lakh. There is an excess of 2 lakh deposit. Can I treat that as a next year deposit? Not possible. Not possible. I cannot carry forward it and claim it as a deposit in the next year. That is not possible. This year deposit always will be this year's deposit. There is nothing called a carry forward of excess deposit and all. Not permissible. Moving on. Point number 10. Where amount standing to the credit of assessee in a special account is utilized by the assessee for the purpose of any expenditure in connection with business in accordance with the scheme, then such expenditure shall not be allowed in computing the income chargeable under Pgbp. Listen, this is a very, very interesting point. I want all of you to read this paragraph first. Can you read that paragraph? So tell me, friends, what do you mean by this point? So where an amount standing to the credit of assessee in special account is utilized by the assessee for the purpose of expenditure in connection with his business, again the same is not allowed as a deduction from Pgbp. Why? At the time of deposit, we already given you a deduction. Now you are withdrawing the amount and you are expending it for a specified purpose. That expenditure is again not allowed as a deduction. Why? At the time of deposit itself, we have given you a deduction under 33AB. If we allow you to claim that expenditure again as a deduction, it will be double deduction. Listen, say for example, I have deposited 1000 rupees in deposit account. I have deposited 1000 rupees in deposit account and claimed it as a deduction under 33AB. Now, after 2-3 years, I am withdrawing this 1000 and have utilized it for an eligible purpose. Eligible purpose in 2025-26. In 25-26, I cannot claim this 1000 again as a business expenditure. Why? In 22-23, at the year of deposit itself, I have given that 1000 as a deduction. Again, and its utilization is again not allowed as a deduction. For one deposit, you got a deduction. Its utilization again cannot be claimed as a deduction. That's what the department says. Listen, where amount standing to the credit of assessee in special account is utilized by the assessee for the purpose of any expenditure in connection with the business in accordance with the scheme, then such expenditure shall not be allowed in computing income chargeable under Pgbp, because at the time of deposits itself, you would have taken a deduction. Thereafter, again, utilization, you cannot claim the same as a deduction. That's what the department say. I hope it is also clear. Moving on, friends, with the next condition. Hope you heard this in your inter portion. Even if not, don't worry. See, say for example, we'll take tea growing and manufacturing. For the time being, please listen. We'll take an example of tea growing and manufacturing. Tea growing and manufacturing. So friends, tell me, say I am a tea grower as well as a manufacturer. Then all the profits, I've earned some profits, say 10 lakhs. I've earned some 10 lakh rupees profits. Are you all listening? This 10 lakh rupees profit I got from growing and manufacturing tea. Yes or no? Then some portion of this 10 lakh is my agricultural income and some portion of this 10 lakh is my business income. This is called as composite income. Are you with me? And there is a rule in income tax, that is rule number 8. If such a scenario is there, then 60% of this 10 lakh shall be deemed to be agricultural income. Only 40% should be treated as business income. So out of this 10 lakh, I am supposed to pay taxes only for 4 lakh. Why? Because 60% shall be deemed to be agricultural income. So listen friends, if I am in the business of tea growing and manufacturing, out of my total profit, my total sales revenue minus all the expenses, the total profit is a composite profit. The total profit can be split into two. 60% will be automatically deemed to be agricultural income and 40% shall be only taxable business profits. Are you with me? From that 40%, I can claim 33AB deduction as well. From that 40%, I can claim what? 33AB deduction as well. That's why I've written plus deduction available under 33AB. So if you are a tea growing and curing business, then rule 7B will be applicable. 75% will be my agricultural income and 25% will be my business income plus 33AB deduction. From that 25%, I can claim again 33AB deduction. If I'm in the business of tea grown, cured, roasted and grounded, roasted tea beans, if I'm in that business, then 60% is agricultural income, 40% is business income because more processing is there. Again, plus deduction. If I am in the business of rubber growing and manufacturing, rule 7A, 65% as agricultural income, 35% as business income, plus 33AB deduction. Now there is a confusion. When I say all these things, there can be a genuine confusion for a student. How do we incorporate all of this in a question? For that, there is a step for calculation. How do you incorporate all these things in a numerical question in examination? Because there are a lot of things here. So how to incorporate everything? Listen, first of all, say we'll take the example of a tea growing and manufacturing business. If I'm in the business of tea growing and manufacturing, first of all, you compute normal Pgbp income. Don't even worry about the agricultural activity, business activity and all. You compute normal Pgbp income by applying section 28, 41, deductions, disallowances, etc. Are you with me? Then you claim 33AB deduction afterwards. You claim what? 33AB deduction because we require profits. We require what? Profits. 40% of profits shall be what? 40% of the profits shall be your limit. That's second limit. Now you claim 33AB deduction. Then you apply the rule. Apply rule means what? 60-40, then 25-75. I think earlier I've told you from that 40% claim 33AB. It's not like that. You claim 33AB, then only split the 60-40. Are you with me? You claim 33AB, then only split the 60-40 or 75-25, whatever it is. Now, only after that, you will get taxable business profits. From that figure, you deduct brought forward business losses. You deduct what? Brought forward business losses. What do you mean by brought forward business losses? Past year business losses. Alright. Now, after that, you will get final income taxable under Pgbp. So, you have to be very, very careful with the steps. We'll repeat the steps again. Listen, if I'm in the business of tea growing and manufacturing, first of all, I should compute total income as if it is a normal business. Pgbp income as if it is a normal business. Then 33AB. Thereafter, 60-40 split. Being tea growing and manufacturing, it is 60-40. From the 40% business profits, set off brought forward business loss. From that, I will get the final taxable Pgbp income. And one more thing is there. If I am directly selling tea leaves, I have tea growing and manufacturing, as well as I am selling directly tea leaves. That will be 100% agricultural income. If I am directly selling tea leaves, that will be 100% agricultural income. I don't have to consider it as a part of my business income. That is fully exempted. Then, another point, non-separable expenses shall be fully deducted under 14A is not applicable in such cases. Non-separable expenses shall be fully deducted. What is non-separable expenses shall be fully deducted? Listen friends, there is a thing called 14A in income tax. What is 14A? You have some exempted income. That exempted income is not at all taxable. That's why it is called as exempted income. Yes or no? All the expenses in relation to exempted income shall also be a disallowance because you cannot claim any expenses in relation to exempted income as a deduction. If there is a non-separable expense, what do you mean by non-separable expense? I have exempted income as well as taxable income, and there is a common expenditure which cannot be separated. Then what should be done? 14A says that expense also shall be a disallowance. if there is a non-separable expense. That means I have taxable income and exempted income, and I've incurred a common expenditure which is not separable, then that is fully disallowed under 14A. But when you compute this tea growing, rubber growing and coffee growing and all, you should not consider 14A. You can claim it as a normal expenditure, then only you apply that 60-40 rule, so that it will automatically get satisfied. Are you all with me? So this is what they say in relation to 33AB. I hope the theory is clear. Now listen, let's summarize. So what is 33AB? You are a tea, coffee or rubber growing and manufacturing in India. You must make a deposit with a deposit account or a special account. And what is the time of deposit? Either before 6 months from the end of the relevant previous year or before due date of filing your return, whichever is earlier. If you make the deposit, you will get a deduction. How much is your deduction? Either 40% of your profits. And what is profits? Profits which is computed applying the Pgbp provisions just before 33AB and brought forward business laws. Or you take actual amount deposited, whichever is lower, as a deduction. Once you claim the deduction, then the amount withdrawn from the deposit account can be utilized only for specified purposes. Specified purposes, which all other specified purposes not given in Income Tax Act, that is according to the tea board, coffee board, rubber board, etc. But there are certain negative lists given. Which all are the negative lists given in the list? Number one, you are not supposed to utilize it for any office appliances or machinery or plant to be installed in office, residential guest house or residential accommodation or guest house. Then you are not supposed to use it for any plant and machinery where 100% of the cost is already allowed as a deduction. Thereafter, they say, when you withdraw an amount, you must utilize that amount in the year of withdrawal itself for the specified purpose. And the composite income concept is also very important. And steps for calculation, don't forget. What are the steps for calculation? You compute the income as if it is a normal business. Then apply 33AB. Only after that you apply that 60, 40, 75, 25, whatever the rule is. Thereafter, you will get the taxable profit. From that, you claim the brought forward business loss. Then you will get the net taxable income from Pgbp. I hope it is clear. Okay, friends, now it's time for us to solve a question in relation to this. So please take page number 6, question number 9. Take page number 6, question number 9. It's a fantastic question. Go through this question and give me the answer. So, friends, let's read the question together and let's get the answer. G Limited, a company in which public are substantially interested, is engaged in the business of growing and manufacturing in India. What do you mean by public are substantially interested? That means a public limited company, G Limited. Okay, it's a public limited company. It doesn't make any difference, okay, but I simply said it. Is engaged in the business of growing and manufacturing tea in India. For the previous year ended 31st March 2022. Its composite business profits before allowing deduction under 33AB is 60 lakh. So its composite business profits is given for which year? For year ended 31st March 2022. That means, tell me the previous year. It is 2021-22 PY. How much is the composite business profits? Composite business profits before 33AB deduction is 60 lakhs. That's what the question says. That also means we can claim what? 33AB deduction from that 60 lakhs. Now, on 1/9/2022, it deposited a sum of 11 lakh in T development account. So, on 1/9/2022, it deposited an amount of 11 lakh in T development account. So, during the previous year 2021, G Limited incurred a business loss. That is the preceding year's business loss. How much is it? 14 lakhs, which has been carried forward. On 25/1/2023, it withdraw. So, 25/1/2023 means it is the next year, 22-23. So, first of all, let's complete all the adjustments in 21-22. Then we will move on to 22-23. So, we have deposited. How much is the deposited amount? Deposited amount is 11 lakh. So, under 33AB, lower shall be allowed as a deduction. Either the deposited amount of 11 lakh or 40% of your business profits. Yes or no? Business profits means profit which is computed as per Pgbp just before 33AB deduction. That is already given in the question, that is 60 lakhs. So, 60 lakhs into 40%. How much will be the figure? 24 lakhs. So you tell me whichever is lower means how much you will get it as a deduction. 11 lakh rupees you will get it as a deduction that you can deduct. From that, how much is the remaining amount, friends? 49 lakhs is the amount after claiming 33AB deduction. Since he is a T as well as T growing and manufacturing SSE, what he can do is he can use rule number 8 and he can split that composite business profit 60-40. Yes or no? So out of this, 40% only shall be business profits. Only 40% shall be business profits. Tell me how much is 40% on 49 lakh? 19 lakh. 60,000 is only the business taxable business profits by applying the 60-40 rule. Now listen, there is a brought forward business loss. How much is a brought forward business loss? It is 14 lakhs from the past year. So you can deduct it from that. After that, how much will be your taxable business profits? Business profits in the year 2021-22 shall be 5,60,000. By that we can say all the adjustments in relation to 21-22 is completely over. Are you all with me? Now let's move on to the next year, that is 22-23. What all happened in 22-23? Let's see. So the question says in 22-23, that means on 25th January 2023, he withdrawn an amount of rupees 10 lakh from the deposit account, which is utilized as under. So he withdrawn around 10 lakh rupees from the deposit account. Yes or no? So 10 lakh rupees is the withdrawal amount. And how much is the utilization? That is also given. 6 lakhs for the purchase of non-depreciable asset as per the scheme. What do you mean by as per the scheme? Allowed activity. So no problem. Then 3 lakh for the purchase of machinery to be installed in office premises. Is that a problem? Yes, it is a inadmissible utilization. Then 1 lakh was spent for the purpose of scheme on 5/4/2023. Is that a problem? Yes. Why? It is as per the scheme, but the utilization date is the subsequent year, not in the year of withdrawal. Here the year of withdrawal is 22-23 and year of utilization is 23-24. Hence, this also will become a misutilization. So you tell me how much is the misutilized amount? 4 lakh is the total misutilized amount out of the lot. Yes or no? So we can write in the PY 2022-23 total misutilized amount. Misutilized amount will become 4 lakh rupees. Now, what will happen to this misutilized amount? That shall be a reversal of 33AB. Yes or no? Instead of saying like that, department say you treat it as a deemed business profits. Are you with me? Deemed business profit simply means it's a reversal of 33AB. Now you tell me, if there is a reversal of 33AB, then that figure is also your composite business profits. If you have reversed 33AB, that reversal figure is also your composite business profits. That also can be splitted into 60-40. Yes or no? Say, listen, or in different way I can say, in 21-22, I deposited 11 lakh on a condition that I will not utilize it for any not specified purposes, or I will utilize it only for specified purposes. Yes or no? But I misutilized it. Misutilization simply means out of this 11 lakh, 4 lakh is not eligible as a deduction. Out of that 11 lakh deposit, I have misutilized 4 lakh. That simply means in the next year, out of 11, 4 is not a allowable deduction. So this 4 is also a composite business profit. And what I'm supposed to do then, taxable business profit shall be 40% of this 4 lakh. How much is 40% of 4 lakh? 1,60,000, because the remaining part will be my agricultural income and that will be fully exempted. Only for that 40% I need to pay taxes according to the income tax law. I hope you got my point. Is that clear, friends? Moving on, the question is not yet over. Then what they are saying next? You are required to determine the business income of G Limited and the tax consequences that may arise from the above transaction in the relevant assessment years. That's fine. We have already computed. What will be the consequence if the asset which was purchased for 6 lakhs is sold for 8 lakh in April 2023? If you are purchasing an asset and the asset is an eligible purchase, then for the next 8 years, you are not supposed to transfer it. Are you with me? If there is a violation for lock-in period condition, there are two consequences. Number one, that amount which is utilized for purchase shall be your deemed business profits. Yes or no? And in this question, you purchased it for 6, sold it for 8. So there will be a capital gain also. Why? Because your sales value is over and above original cost of purchase. Yes or no? So let's compute both together. That too in the year April 23 means which year, friends? April 23 means it is in the year 23-24. So again previous year 2023-24 sales for how much? 8 lakhs. Then cost of acquisition of that asset 6 lakhs. 2 lakhs shall be short-term capital gains. That is first consequence. And there is one more consequence, that is deemed income. Deemed business profit for violation of lock-in period condition. How much is the deemed business profits? 6 lakhs. Because that is the amount which you utilize to purchase that particular asset. That 6 lakhs will be your deemed business profits. Now friends, that is also a reversal of what? 33AB in a sense. Yes or no? And hence what is the verdict? The 6 lakhs also have to be split into 60-40. Are you with me? So what you need to do is out of this only taxable business profits shall be 40%. How much is 40% on 6 lakh? 2,40,000. That is the final answer to the question. I hope it is clear. So friends, by that I can say 33AB is completely over. Then now let's learn cousin brother of 33AB. That is 33ABA, cousin brother. And it is actually an irrelevant section for our examination. But still, I will quickly summarize what is 33ABA. Why I called it as cousin brother? Because it is similar to 33AB. So site restoration fund 33ABA is the next item, which is not very important and all, but we will cover it quickly. It is applicable for all associates engaged in the business of prospecting for petroleum or natural gas, or extraction or production of petroleum or natural gas, or both in India. If you are in the extraction or production of petroleum or natural gas or both in India, then you can claim what? Deduction under 33ABA. Now, there are certain conditions like 33AB. Which all are the conditions? The assessee should have entered an agreement for such business with central government for claiming deduction under 33ABA. First, you should have a special agreement with central government. Then only you will be able to claim 33ABA. Please don't mark it, okay? Because it is actually not at all relevant for our examination. Only for the purpose of explaining, I am saying it. Alright? Don't mark it. Just listen. That is more than enough. Then, what is next? Assessee must deposit an amount like that, like earlier section. You should deposit with the SBI in a special account, any amount, or in a site restoration account which is notified by the government. Either you should deposit in a special account with SBI or a site restoration account which is notified by central government. When should you make the deposit? It should be deposited before the end of PY. 33AB, you had time till 6 months. But here they say, in between the PY itself, you have to deposit. Then, you need to maintain books of accounts, get it audited by a chartered accountant, you need to submit the return, you need to submit tax audit report as well for claiming this deduction. Now, how much is the quantum of deduction? The quantum of deduction shall be lower of either amount deposited or 20% of your profits before claiming 33ABA deduction. Similar to what we have learned under 33AB. Either 20% of your business profits or amount deposited, whichever is lower. And what is business profits? That is profits computed as per Pgbp just before 33ABA and brought forward business loss. Now, again, its utilization, restriction, everything is similar to 33AB without any change. The deposited amount should be withdrawn only for specified purposes. certain negative list of plant and machineries are there. Then in the year of withdrawal itself, you have to utilize. Then if you utilize it for an eligible plant and machinery, there's a lock-in period of 8 years. If you transfer that plant and machinery within 8 years, then what will happen? Deemed business profits. All the points which you have covered under 33AB is parallelly there in 33A, as well. Is that clear, friends? Since it is not that an important section, let's move on to the next provision that is actually important. That means expenditure on scientific research, which is under section 35. So let's understand what exactly is the expenditure on scientific research. So listen, friends, the scientific research expenditure can be splitted into two. Section 35 scientific research expenses can be splitted into two. Number one, in-house scientific research. Scientific research expenses. What is in-house scientific research expense? What is in-house? So friends, in-house scientific research expenses simply means what? Our own research and development department. All the expenses in relation to that. Now, or we can give outside contributions. Outside contributions. What do you mean by outside contributions? You can give a donation to those who are notified scientific research, persons. Just like an institution or association who does notified scientific research. You can give a donation and claim it as a deduction. So, under 35 can be splitted into either in-house or outside contribution. So first, let's learn in-house scientific research expenses. So I want all of you to take a note of this flowchart. So we are actually planning to study this by way of a flowchart. So I want all of you to take a note of this flowchart. Listen. So in-house scientific research expenses. Scientific research expenses. This in-house scientific research expense can also be splitted into two. In-house scientific research expenses also can be splitted into two, friends. What are the splits? Number one, they say revenue nature expenses. Revenue nature expenses. And number two, what will be number two? Capital nature expenses. Capital nature expenses. So friends, you tell me, what do you mean by revenue nature in-house scientific research expense? Can you give me an example? So examples for revenue, we can say salary paid to scientific research personnel, rent, power and fuel, then traveling expenses, food expenses, purchase of raw material, etc., etc., etc. Now, how about capital expenditure? Can you give me an example for capital expenditure? So for capital expenditure, I can say purchase of building, purchase of land, purchase of apparatus, purchase of plant and machinery, purchase of generator, etc. can be called as an example for capital expenditure. Now friends, listen. This revenue expenditure again can be split into two, and that is pre-commencement and post-commencement. Revenue nature expenses again can be split into two, that is pre-commencement revenue expenses and post-commencement revenue expenses. What is pre and what is post? You tell me. So listen friends, pre-commencement simply means all the expenses which are in revenue nature just before the commencement of your business is said to be what? Pre-commencement. And what is post-commencement? All the expenses that you have incurred, it is in revenue nature, which is in relation to your scientific research, which after your commencement is said to be what? Post-commencement. So pre-commencement means before commencement, not incorporation, before commencement of business, and post-commencement means after commencement. Now, how do you claim deduction? So departments say the pre-commencement expenses. So expenses such as salary to scientific research personnel. Scientific research personnel. Scientific research personnel. And purchase of raw materials. Purchase of raw materials for scientific research. Listen, expenses such as salary to scientific research personnel. I think I've written scientific twice, okay? scientific research personnel and purchase of raw material for scientific research which is incurred 3 years immediately preceding year of commencement. Year of commencement is allowed as a deduction. Immediately preceding commencement, don't write year of commencement, okay? Immediately preceding commencement is allowed as a deduction. Allowed as deduction in the year of commencement. In the year of commencement. In the year of commencement. So friends, listen. What they are saying in the pre-commencement scientific research revenue nature expenses, can you claim all the pre-commencement revenue nature expenses as a deduction? The answer is no. Two types of expenses which are pre-commencement and which are in relation to your scientific research are only allowed. What are the two types? Number one, salary paid to your scientific research personnel. Say for example, salary paid to scientist, allowed as a deduction, which is incurred before your commencement. Plus, purchase of raw materials for your scientific research. Both of them are allowed as a deduction. And both of them, which is incurred when? Which is incurred immediately preceding 3 years before the commencement is allowed as a deduction when? In the year of commencement. Only after commencing the business, there will be Pgbp head. Only from that date, you can claim 35 deduction. Are you with me? So, very simple friends, all the revenue nature, scientific research expenses, if it is pre-commencement, then scientist salary plus raw material purchase cost, that too incurred 3 years before the period of commencement is allowed as a deduction in the year of commencement. Are you with me? Now, how about post-commencement revenue related expenses allowed as a deduction? Allowed as deduction in that year itself. In that year itself. We can say all types of post-commencement revenue nature expenses are allowed as a deduction in that year itself. What do you mean by all types? Rent, power, fuel, traveling, stationery, etc. is fully allowed as a deduction in that year itself. In the year in which it is incurred. Are you with me? Yes or no? Alright friends. Now, how about capital nature expenses? In capital nature expense, the first thing to notice, you will never get any deduction for expenditure on land. If you are incurring a capital expenditure on purchase or development of land, you will never get it as a deduction. Why? Because land is land always. Whether you have done some scientific research or not, there will be land. So, you will never get any deduction for capital expenditure incurred on land. So, we can say excluding land. Excluding land. You can split that also into two. You tell me which are the splits. Scientific research, capital nature expenses. You can split that also into two. That is pre-commencement and post-commencement. Pre-commencement and post-commencement. In pre-commencement, what we can write is all capital nature expenses incurred 3 years immediately preceding commencement, allowed as deduction. Allowed as deduction in the year of commencement. In the year of commencement. So friends, listen. What do you mean by all capital nature expenses? Whatever capital nature expenses excluding land, which is incurred for your scientific research like building, plant and machinery, apparatus, etc., which is incurred 3 years immediately preceding the date of commencement is allowed as a deduction in the year of commencement. That also means one more thing. You don't need to capitalize it and claim depreciation. Rather, you can straight away charge it as a deduction under section 35. Normally, what is the treatment for capital expenditure? We used to capitalize it and claim depreciation under section 32. Here it is not required. Instead of that, what you can do is all the capital expenditure which is incurred 3 years before the point of commencement is allowed as a deduction straight away in the year of commencement of your business under section 35. We can say 100% deduction for the capital expenditure in the year of commencement for the pre-commencement expenses, which is incurred 3 years before the commencement. Now, how about post? All capital expenses for scientific research allowed as deduction in that year itself. In that year itself. What is that year itself? In the year in which you incurred that particular capital expenditure, you can claim it as a deduction. That's it. In the year in which you have incurred that capital expenditure, you can claim it as a deduction. Otherwise, not. That's what they say. Again, this also excludes what? Land. Land exclusion is a common thing. For land, you will never get any deduction under section 35. Is that clear, friends? Now, there are a few things that we should note. Listen, the first thing to note is, say it is here. Salary paid to scientific research personnel. What do you mean by salary? Salary means basic, DA, allowances, perquisites, etc. Everything will come. Yes or no? But department say, in case of pre-commencement salary, it specifically excludes perquisites. Excludes perquisites. What do you mean by excludes perquisites? If the employer has given any perquisites before commencement to the scientific research personnel, that perquisite, the value of perquisite is not allowable as a deduction under section 35. But post commencement you can. Post commencement is definitely allowed as a deduction. Pre-commencement salary excluding perquisites are allowed as a deduction under section 35. Are you with me? Pre-commencement salary excluding perquisite. In post commencement it is allowed. Then another thing is there. That is, say, listen friends, when you charge this capital expenditure to your profits, do you think that you have that much profit in the first year to absorb all of your capital expenditure? No, because capital expenditure will be comparatively huge. So, what department says is, unabsorbed capital expenditure for scientific research can be carried forward for unlimited subsequent years. Can be carried forward for unlimited subsequent years. That's what the act says. If you have unabsorbed what capital nature scientific research expenses, you can carry forward it to unlimited subsequent years. Again, one more thing is there. How about revenue nature expenses? What to do with this revenue nature unabsorbed expenses? That will automatically fall under the normal business laws. Are you with me? Revenue nature scientific research expenses will automatically be a part of the normal business laws. And according to section 72, set off and carry forward. How many years you can carry forward? Maximum 8 years. Only for unabsorbed capital portion of scientific research expenses, unlimited subsequent year carry forward is prescribed. Are you with me? Now friends, one more point. Once you have claimed a deduction under section 35, you are not supposed to claim depreciation on that asset again. Why? 100% of the cost is already allowed as a deduction. Thereafter, we are not planning to give you any depreciation deduction. Are you all here? Yes. Now friends, let's understand. And there is one more thing. Earlier, for manufacturers and biotechnology businesses, you can claim 150% as a deduction. Earlier. Right now it is not there. Even if you are a manufacturer or a biotechnology business, for in-house research expenses, maximum deduction shall be 100%. You expend 100 rupees, deduction is 100 rupees. Earlier, you expend 100, it was 150 rupees. Right now they have restricted it to 100. So even if you are a biotechnology business or manufacturers, your deduction will be maximum 100%. Only for repeaters I am saying. Now, moving on with the next point, friends, listen. What will happen in relation to outside contribution? That's what we are about to discuss. So let's learn about outside contributions. when you are contributing or donating to outside parties, how to claim deduction under section 35. That's what we are about to discuss. Are you all listening? So friends, let's understand. We can split this into four. Number one, any contribution to an institution or association does notified scientific research, 100% allowed as deduction. What do you mean by 100% allowed as deduction? Say I am a company and I'm donating some amount to a scientific research institution or association which is approved. That entire donation is allowed as a deduction under section 35, whether that donation have a business nexus for me, whether I have or I haven't, doesn't matter. You donate, take it as a deduction. That's it. Number two, to an approved Indian company, which does scientific research. If you are donating some amount to an approved Indian company which does scientific research, again, that donation is also allowed as a deduction under section 35. Then, point number 3, 100%. All cases it is 100%, okay? You need to copy this everywhere. All cases it is 100%. All cases it is 100%. Yes. Happy now? Yes. Now, listen. Approved Indian company. Now, let's move on to the third one. That is, you are contributing to an institution or association which does social science and statistical research. Approved social science and statistical research. For that case also you will get 100% as a deduction. And finally, to the last point, what they are saying is you are contributing to IIT or National Laboratory or IIT for approved scientific research programs. That case also you will get 100% as deduction. So for all the contributions, maximum deduction shall be 100% of the contributed amount. Are you all here? So 4 types of contributions you will get it as deduction. Number 1, institution or association which does approved scientific research program. Number 2, an approved Indian company which does scientific research. Number 3, institution or association which is approved and which does social science of statistical research. And number 4, IIT or National Laboratory for their approved research programs. If you give any donation, then the donated amount is allowed as a deduction. Now friends, listen, there is one more thing that you have to be very careful. See, listen, at the time of donation, they had approval. After 1 month, they lost their approval. What to do? At the time of donation, they had approval. After 1 or 2 months, they lost their approval. In such scenario, what to do? In such scenarios, you can claim it as a deduction. Only at the point of donation, if it is approved, allowed as deduction. Afterwards, what happens is not our headache. Are you all with me? So donor have to make sure that at the time of donation, it should be an approved institution. Thereafter, what happens is not our problem. Are you with me? All right. So these are the items that are covered under section 35. I hope it is clear. All right, friends. Now let's move on to the next topic, that is section 35 ABA. That's what we are about to discuss. Section 35 ABA. So let's understand what is this section 35 ABA. That is amortization of spectrum fee for purchase of spectrum. Friends, you tell me, what is the spectrum fee? Spectrum simply means what? The natural frequency used by the internet service provider to give you the internet, right? Now, for using spectrum, this telecom operator or the telecom company or the internet service provider have to give a license, have to take a license from the central government, from the Ministry of Telecom. They have to take a license. And there will be a huge license fee suffered by the ISP, that is Internet Service Provider. How to claim that huge expense as a deduction? What the Act says, that capital expenditure incurred by the Internet Service Provider is allowed as a deduction throughout the period of license. What do you mean by throughout the period of license? Say for example, I am an Internet Service Provider, paid 10 lakh rupees for 10-year license, then I can claim 1 lakh each for the next 10 lakh as a deduction for the next 10 years as a deduction under 35A. You take the lump sum amount paid divided by the number of years of license and you claim it proportionately each year. That is called as amortization of spectrum fee for purchase of spectrum. Are you with me? So when they incur a huge capital expenditure in the initial year, what they can do? They need to take that expenditure, they need to divide that expenditure by the number of years of license and they can claim it proportionately. So that's what they say. Any capital expenditure incurred for acquisition of any right to use spectrum for telecommunication services, either before commencement of business or thereafter, at any time during the PY, and for which payment has been made to obtain a right to use spectrum. How to claim deduction? The payment made in equal installments over the period from the year in which the payment actually made to the year in which spectrum license comes to an end. There are a lot of things covered under these two paragraphs. I'll give you 2-3 examples for a better clarity. Listen. Say for example, say in year 1, I am a telecom company. And in year 1, I have paid 10 lakh rupees. I have paid how much, friends? 10 lakh rupees as telecom fee. Sorry, spectrum fee. As spectrum fee. Alright, for how many years? 10 years. Then how do you claim deduction? Year 1, I can claim 1 lakh. Year 2, I can claim another 1 lakh. Year 3, I can claim another 1 lakh. Till year 10, I can claim 1 lakh, 1 lakh, 1 lakh each. Under which section? 35A. That's the first thing that you should note. And number 2, if I haven't made the entire payment in year 1, then what will happen? Because this deduction is based on actual payment. For taking deduction, you need to actually make the payment. If you haven't made the payment, then you will never get it as a deduction. Now listen, friends. Say in year 1, I have paid only 8 lakhs. I have paid only how much? 8 lakhs. The total license fee was 10. I paid only 8 lakh for 10 years. Then how to take deduction? 8 divided by 10. I can claim 80,000 every year. I can claim how much, friends? 80,000 every year till year 10. Now, say in year 3 beginning, I've paid the remaining 2 lakh also. I paid the remaining how much? 2 lakh also. From year 3, how many years balance? 8 years. 3, 4, 5, 6, 7, 8, 9, 10. You have 8 years balance. Yes or no? So the 2 lakh divided by 8. How much is 2 lakh divided by 8? So 2 lakh divided by 8 will be 25,000 plus 80,000. So from year 3 onwards, you can claim how much? 1 lakh 5,000 as a deduction till year 10. Are you with me? If you are making proportionate or installment payment, those installment you are paid divided by the number of years of license shall be the deduction under 35A. Are you with me? And friends, one more doubt. What if you have paid this license fee before commencement itself? You paid license fee before commencement. Then after 2 years you started your business. Maybe due to some reason. After 2 years only you started your business. How do you get the deduction? When the moment you start business, how much is the amount paid divided by the remaining number of years? That's how you should claim deduction. Are you with me? Before commencement of business itself, you took a license. Then after 2-3 years, you started your business. At the moment when you start your business, total amount paid divided by the year balance shall be the amortization for each year. I hope you got my point. Moving on. Say there is a transfer of this particular license in between. What to do if there is a transfer? So let's understand. If there is a transfer of spectrum fee or spectrum license, what to do with that? That's what we are about to learn. So be very, very attentive. Listen. Say in year 1, I've paid 10 lakh for 10 years. Then year 1, I can claim 1 lakh rupees as deduction. Yes or no? Yes or no? The first year I can claim 1 lakh rupees as an amortization. Year 2 also I can claim another 1 lakh as an amortization. Now you tell me, how much is my balance in year 3? How much is the unamortized value in year 3? We call unamortized value as 8 lakhs. Yes or no? Now I am selling this 8 lakhs. I am selling not this 8 lakhs, I am selling that license. I am selling that license to a third party. And what will happen? That's what we are about to discuss. When I am selling it for 5 lakhs or say 6 lakhs, I have sold this for how much? 6 lakhs. Then what will happen? I am incurring a loss. How much is my loss? 2 lakhs. I have sold that entire license for 6 lakhs. Then I am incurring a loss. Then what to do with the loss? That loss can be straight away claimed as a deduction under 35 ABA. That's it. Just like the terminal depreciation concept. It is not called as terminal depreciation. Okay, I'm talking about the concept. It is similar to the terminal depreciation. In the year of sale, if I'm incurring a loss, that loss is allowed as a deduction under 35 ABA itself. You can call it as an amortization. You can call it as an amortization under 35 ABA. Don't call it terminal depreciation and all. Are you all listening? Moving on. Scenario number 2. Scenario number 2, I'm selling it for 9 lakh. I'm selling it for 9 lakh. You tell me the treatment. Just like balancing charge, 1 lakh rupees shall be deemed income from your business profits. Deemed profits from your business. It is not called as balancing charge. The concept is similar to balancing charge. Are you all listening? Scenario number 3, I am selling it for 15 lakhs. I am selling that particular license for how much value, friends? 15 lakhs. You tell me the treatment. 2 lakh rupees profit. That means 2 lakh, I've claimed it as amortization in the past years. That shall be deemed business profits. And how about the remaining 15? That means original cost is 10. Sales value is 15. So the 5 lakhs shall be what? Short term or long term depends upon the period of holding. Here I cannot say it is short term always. Short term or long term depends on the period of holding. Since it is third year, it will be short term because the period of holding here is 36 months. Since it is third year, it is short term. But in practical, depends upon the period of holding. It may be long or short. It is under capital gains. That's what I can say. The concept is actually similar to the terminal depreciation balancing charge. Are you all listening? Are you all here? So this is the impact of transfer of a spectrum license. And one more thing is there. Say for example, say for example, this JK Limited bought a license fee and have claimed amortization for 2 years. Now the balance is 8 lakhs. In the event of amalgamation, that license got transferred to amalgamated company. In the event of JK went into an amalgamation, have been absorbed by another company. Alright, under an amalgamation scheme. Then what to do with that remaining 8 lakhs? The amalgamated company can claim the remaining balance installment because it is not regarded as a transfer. The same happens with the demerger also. In the event of demerger or amalgamation, if that license is going to the amalgamated company or resulting company, then the successor can claim the remaining number of installments. Are you with me? Yes or no? This is not that very important for our CA finals, but CMA final examination, they have tested it. Again, for CA finals, these are not very, very important, but I don't know whether they will test it or not. So it is better to study this. Is that clear? Super. Now friends, there is one more section which is it's actually twin brother. I'll call it as a twin brother. So let's understand who is the twin brother to 35 ABA. That is 35 ABB is the twin brother. What is 35 ABB? expenditure for obtaining license to operate telecommunication services. You tell me, what is this license to operate telecommunication services? Just like our spectrum licenses, you should take telecom licenses for giving telecommunication services to your clients. So if a company has suffered a telecom license, how do they amortize it? Again, license fee paid divided by the number of years of license. Deduction, transfer, everything is ditto same as that of 35A. Only one difference. Number one, section number. Number two, instead of spectrum license, it is telecommunication license. Apart from that, everything is same. Incurred an expenditure, you can claim it as a deduction based on your actual payment. Actual payment divided by the number of installments. The case of transfer, amalgamation, demerger, etc. is exactly the same in the case of 35A as well. I hope it is also clear. They could have put this telecommunication licenses, services also under 35A, but both are different actually. Both are different services. That's why they have created two different sections. Are you all listening? Alright friends, now it's time for us to discuss section 35AD, also known as investment linked deductions or tax incentives. We call it as deduction for specified businesses. So please listen. If you are a specified business, then you can claim 100% deduction for all of your capital expenditure. What do you mean by specified business? That means a business given under 35AD. If you are in the list of 35AD, then instead of capitalizing capital expenditure and claiming depreciation, you have one option. What is that option? You can directly charge the entire capital expenditure as a deduction under 35AD. But there are certain restrictions, limitations, etc., etc. That's what we are about to discuss right now. Starting with, for all capital expenditure, excluding expenditure for land, goodwill, financial instrument, you can claim 35AD deduction. You can claim 35AD deduction for all capital expenditures, excluding, which are the exclusions? Land, goodwill, financial instrument. You bought a land, it's a capital expenditure, no deduction. You bought some goodwill, it's a capital expenditure, not a deduction. You bought some financial instruments like securities or something, it's a capital expenditure, no deduction. Apart from these three, whatever other capital expenditure that you incur, you can claim it as a deduction under 35AD, provided you should be a specified business. Now the question is, who all are specified business? And there is one more thing, you should study the list of specified businesses. You should remember who all are specified businesses. So let's understand who all are the specified businesses according to the provisions of income tax. Number one, setting and operating a cold chain facility. If you are in the business of setting up and operating a cold chain facility, you will be treated as a specified business. What is cold chain facility? Cold chain facility, not French fries. See, this cold chain facility means you are preserving meat, skin, livestock, etc., fish, etc., fruits, etc. You are in the business of cold storage. It's called as cold storages. So if you are in the business of cold chain facility, you are a specified business. And what is your advantage? For all the capital expenditure that you've incurred, you can claim it as a deduction in the first year of business itself. You can charge everything in the first year itself. Or whatever year that you are incurring, in that year itself, you can claim it as a deduction. Now moving on, say, if you are in the business of warehousing facility for storing agricultural produce. What do you mean by warehousing facility for storing agricultural produce? That means you are a warehouser. Alright, not agricultural producer. Agricultural producer is not at all a business. That is fully exempted, provided there is no processing, provided only you are providing some basic operations. Alright, now listen, if you are providing warehousing for storage of agricultural produce as a business, then that is called as a specified business. And what is the advantage? You can claim 100% of your cost as a deduction under 35AD. Then point number 3, a cross-country natural gas or crude or petroleum oil pipeline network for distribution, including storage facilities being an integral part of such network. You have a cross-country oil pipeline business. You transport oil from, say, business from India to Sri Lanka. you have a underwater pipeline network distribution business. That is a specified business. Or you are transporting this oil from India to Myanmar. Alright, that is also a specified business. So it is not mineral oil explorers, not extractors. They say a cross-country natural gas or crude or petroleum oil pipeline network distribution. You are a specified business. Then point number 3, building and operating a hotel of 2-star or above category anywhere in India. You know what is star category, right? What do you mean by 2-star? Star means based on your amenities and facilities, you need to apply to the Department of Tourism. They will come and certify whether you are a 2-star, 3-star, 4-star, 5-star, 7-star, whatever it is. Are you with me? So listen, if you are a 2-star or above category hotel in India, you are a specified business. A normal tea shop, is it a specified business? No, you have to be either a 2-star or above category. Moving on with the next one is building and operating a hospital anywhere in India with at least 100 beds for patients. So you are in the business of hospital and you are providing 100 patient bed facility. What is this 100 patient bed facility? You should have a infrastructure to accommodate patients. Small clinics and all are not regarded as a specified business. If you are a hospital in India having 100 or more patient beds, you will be treated as a specified business. Next one is developing and building a housing project under scheme for slum redevelopment or rehabilitation. What do you mean by slum redevelopment or rehabilitation? Slum redevelopment or rehabilitation means, say there are old dwellings in a slum, old houses. So government will take initiative and they will rebuild new houses for them. Those who are actually poor, who are not able to afford a new house. So it is called as a slum redevelopment or rehabilitation scheme. We are rehabilitating those people who are staying in slum. In Maharashtra, Mumbai, there is a slum called Dharavi. Actually, it happened over there. There was a redevelopment or rehabilitation scheme was there. Are you all with me? Now, if you are in that business, you are building this small houses as a part of slum redevelopment or rehabilitation, then you are treated as a specified business. Moving on with the next one, developing and building a housing project under a notified scheme for affordable housing framed by central government or state government. What do you mean by affordable housing? A small house with a limited square feet will be considered as an affordable housing. I hope in GST you have studied about affordable housing. There is a difference in rate of GST if it is an affordable housing. Affordable housing simply means just like a studio apartment, a small house with a limited square feet area. If you are in that business, that means building affordable housing, you will be considered as a specified business. And friends, you should understand one thing. Say I am building normal houses as well as affordable houses. Then one affordable house building will be separate specified business and the normal house building will be what? A normal business. Are you all with me? If I am doing multiple things, you have to segregate, maintain separate books of accounts. I need to categorize it separately. Moving on. Production of fertilizer in India. If you are a fertilizer manufacturer in India, you will be considered as a specified business. And moving on the next one, setting up and operating an inland container depot or a container freight station notified and approved by Customs Act 1962, ICD and CFS, that is Inland Container Depot or Container Freight Station. You tell me what is ICD, Inland Container Depot? Inland Container Depot simply means a place where you store your containers. It is normally near to docks, near to the ports. You have what? This Inland Container Depot. From the ship, it has been placed in an ICD, Inland Container Depot. And there is another thing called Container Freight Station. Have you seen the trailer lorry which carries this containers? And that business, that freight business, if I'm running a trailer lorry for carrying this containers to different parts, then I'll be considered as a container freight station. So, Inland Container Depot or a container freight station which is approved under the Customs Act, if I'm running that business, I'll be a specified business again. Then moving on to the next one is beekeeping and production of honey and bee wax. Beekeeping, production of honey and bee wax are definitely specified businesses. Next one, setting up and operating a warehousing facility for storage of sugar. Friends, listen, warehousing facility for storage of sugar. You tell me whether sugar is an agricultural produce or not. Sugar is not a primary agricultural produce. Sugar is a processed product. Sugarcane is the primary agricultural produce. You are warehousing sugarcane. Can you call it as a specified business? Yes. Why? Because warehousing of agricultural produce is definitely specified business. You are warehousing sugar. Is it a specified business? Yes, because it has been specifically given in the Act. Just like warehousing potato. Can you call it as a specified business? Yes, potato is a agricultural produce. Warehousing potato chips. Can you call it as an a specified business? No, because potato chips is not a direct agricultural produce. It is a processed product. Are you all with me? So in the case of sugar, be very careful. They have specifically given warehousing of sugar is a specified business. Moving on. Laying and operating a slurry pipeline for transportation of iron ore. If you are in the business of transportation of iron ore, then you will be called as a specified business. We call it as a slurry pipeline for transportation of iron ore. So, transportation of iron ore business is also a specified business. Now, moving on to the next one is setting up and operating a semiconductor wafer fabrication manufacturing unit. So, if you are in the business of manufacturing semiconductors, then you will be considered as a specified business. What is semiconductor? You know what is semiconductor, right? In most of the electronic items, we have to make use of a semiconductor for its proper working. Now, moving on to the next item and the final item, operating a infrastructure facility by an Indian company. What do you mean by infrastructure facility? You are an infra development company like road, rail, bus stands, railway stations, etc. You'll be considered as a specified business. So these are the list of specified businesses we have in India. So I want all of you to go through this list of specified businesses. Just have a plain reading of all of the specified businesses. Now, these are the list of specified businesses. Now, friends, there is an important thing that you should note. If you want yourself to call as a specified business, then there are certain dates. But don't study these dates. It is only for an information purpose I am telling this. You don't have to by heart this dates. Are you all with me? So, if you want to call yourself as a specified business and to claim deduction under 35 AD, if you are in the business of laying and operating a cross-country natural gas, petroleum, oil, pipeline network, you should start your business on or after 1st April 2007. Say I am a oil pipeline network distributor. I started my business in 2000. Can I claim 35 AD deduction? No. I should start on or after 2007 because it has been notified from 2007 onwards. Are you with me? Likewise, for building, that means 2-star or above hotel in India, then building and operating a hospital, then slum redevelopment or rehabilitation, the date given as 1st April 2010. Then for affordable housing project, an infrastructure company, fertilizer company, then the date given is 1st April 2011. Then inland container depot, beekeeping, sugar warehousing, the date given is 2012 April. All are 1st April 2012, etc., etc. Now, laying and operating a slurry pipeline for a transportation of iron ore or semiconductor wafer fabrication manufacturing unit, 1st April 2014. Then infrastructure facility, it is 2017. And cold chain facility, warehousing facility for agriculture produce, etc., it is 2009. So these dates are also there in income tax. Only you start by this date or after this date, you will be called as a specified business. Otherwise, not. Are you with me? Now, there is a small thing that you should know. Listen. Say for example, what I've did is like, I've started, say, an oil pipeline network distribution business in 1st April 2000. Alright, today is 1st April 2007. I came to know that if I have started my business on 1st April 2007, I can claim what? 35 AD deduction. But I've already started my business. So what I did is like, I dissolved my business. Then I started again. I dissolved my existing business. Then I started again in the new name. Can I treat as a new specified business? No, not possible. If the existing business is reconstituted, then that will be never considered as a specified business. Are you with me? This is to promote more new businesses. They have brought in these kinds of 35 AD deduction. All the existing businesses, no, you are already there. You don't need any more promotion. You be there. To promote new number of businesses, they have brought in these kinds of amendments. If you have reconstituted yourself as a new business, it is not permissible. So, department has given certain criteria for that. Let's understand the criteria. Listen, the first criteria they say, for claiming deduction under 35 AD, specified business should fulfill the following conditions. Again, these are all not important for our exam. I will write all those important things only. All right. Only for the purpose of explaining, I'm telling all these things. These are not very important. Never asked in exam. Now, it should not be set up by splitting or reconstruction of a business already in existence. If you have already in existence before that date, which I've mentioned, and you are simply reconstituting, you will be never considered as a specified business. You will never get deduction under 35 AD as well. Now, it should not be set up by transfer to specified business of machinery or plant and machinery previous to use for any purpose. In order to satisfy this condition, the total value of plant and machinery so transferred should not exceed 20% of the value of plant and machinery used in specified business. What do you mean by that? In 2000, listen, in 2000, I've started an oil pipeline network distribution. Are you all with me? I had an asset of worth 100 crore. I had an asset of worth how much? 100 crore. Now, on 1st April 2007, I came to know that what? If I started from this date onwards, I will get what? Specified business deduction. So what I did is like, I dissolved myself and I started a new company in the name of a new person. I've started a new company in the name of new person. And the new person is also using this 100 crores asset. Then also department will say, this 100 crores asset is already used by a specified business earlier. Now you cannot simply buy the same and claim deduction. Not possible. Rather what I can do is, listen, instead of 100 crores, I've invested 1000 crores. I've invested how much? 1000 crores. Out of this 1000 crore, 100 crore also is coming. Then what I can say? Out of my total new investment, only 10% is the plant and machinery used by the old specified business. Yes or no? That is permissible. So what department say is, in order to satisfy this condition, the total value of plant and machinery so transferred should not exceed 20%. In 1000 crores, I can use up to 200 crores old assets. Not more than that. If I use more than that, then it will not be treated as an eligible specified business. Are you guys with me? When I'm reconstituting a business altogether in a new form, can I use old machineries? Yes. How much I can use? Out of my total machineries in the new company, 20% or less should be the old machineries. Then it is okay. Otherwise it is not okay. It is only for machineries. Because for land and all, we cannot build new land. Can you build new land? No. It's impossible. Restriction is only for what? Machineries. You can use old building and all, no problem. Restriction is only for the machineries. Are you guys listening? Hope you got that point as well. Now, the machineries or plant would not be regarded as previously used if it has been used outside India by a person other than the assessee, provided following conditions are satisfied. So it is a foreign imported second-hand machinery, it's okay. Indian used second-hand machinery is not okay. If it is a foreign imported second-hand machinery, it is fine. And what are the criteria for that? They say such plant and machinery was not to be used in India at any time prior to the date of its installation by the assessee. That simply means even if it is a foreign imported asset, then that asset should not be used in India at any time before you claim this deduction. Then the plant and machinery was imported into India from a foreign company. It should be an imported plant and machinery. No deduction in respect of depreciation of such plant and machinery has been allowed at there too. You should not claim any depreciation for this plant and machinery from Income Tax Act 1961. If it is a pure foreign imported plant and machinery, all of these criteria will automatically get satisfied. Are you guys listening? So let's continue, friends. Let's continue with the other conditions. That is, there are certain few more conditions in relation to 35 AD deduction. These are important conditions. So let's understand which all are the conditions that we should study. Listen, an expenditure in respect of payment or agreed to the payment made to a person. That simply means, say for example, I bought a building for 10 lakh rupees. Can I claim this entire 10 lakh as a deduction under 35 AD if I am a specified business? The answer is yes, because all the capital expenditure, excluding land, goodwill, financial instrument, I can claim it as a deduction. So I can claim that cost of building as a deduction under 35 AD. But there is a condition. When I'm making payment, if the single day payment exceeds rupees 10,000, then the method of payment have to be either account pay cross check or account pay bank draft or electronic clearing system or prescribed electronic modes like debit card, credit card, Aadhaar Pay, Beam Pay, Google Pay, whatever it is. If I am making the payment in any other mode, then you tell me what will happen. That portion where I violated this, I will not get it as a deduction. Say out of 10 lakh, 2 lakh cash and 8 lakh through bank. 2 lakh is not allowed as a deduction under 35 AD. Similar to the explanation which we have covered under actual cost. Hope you remember. So you should study this particular explanation. Then explanation number 2, this is actually not important, but still the deduction shall be allowed to the assessee only if accounts of the assessee for the relevant PY have been audited by a chartered accountant and the assessee furnishes audit report in prescribed form, duly signed and verified by the accountant. In income tax, they use the word accountant. And who is accountant for the time being? It is chartered accountant. Again, for the time being, because we don't know whether central government in future will alter this definition and add cost accountants or company secretaries into this. There is a possibility that we don't know. They have given a representation and all earlier. So it may happen. All right. Now, for the time being, accountant only means what? Chartered accountants. Now listen. Next is the expenditure incurred wholly and exclusively for the purpose of specified business prior to the commencement of operation is also allowed as a deduction in the year of commencement. Simply means if you have incurred a pre-commencement expenditure, capital expenditure for your specified business, what to be done? Just capitalize it in the year of commencement and claim it as a deduction. There is nothing called a 3-year limit and all. Under section 35, scientific research, we have studied scientific research capital expenditure which is incurred 3 years before the date of commencement is only allowed as a deduction. That was under scientific research, section 35. Under 35 AD, there is no such restriction. If there is a pre-commencement capital expenditure for your specified business, entire capital expenditure is allowed as a deduction in the year of commencement. I hope it is clear. Now, the fourth one, we have already covered it. Now move on to the fifth one, that is also important. You study fifth one, that is also important. Listen. If you have claimed 35 AD deduction from a particular business, from the same business afterwards, you are not supposed to claim chapter 6A C heading deductions or 10AA exemptions or vice versa. What do you mean by this, friends? Listen. Say for example, I have a specified business. I have a specified business. All right. Now, from the specified business, if I am claiming 35 AD deduction from the same business for the same year, I cannot claim 10AA exemption. That is the first thing that you should know. What is 10AA exemption? 10AA exemption. Say for example, you have a entity. 10AA exemption simply means exemption that can be enjoyed by entities or units in ZES, Special Economic Zone. Have you heard about SEZ, Special Economic Zone? So friends, listen, if you have started a business unit in a Special Economic Zone notified by government, then you can claim an exemption according to 10AA. And what is that exemption? Act say, for the first 5 years, 100% of your export profit is allowed as deduction. For the second set of 5 years, 50% of your export profit is allowed as deduction. For the third set of 5 years, it is 50% of your export profit or amount invested in ZES reinvestment reserve account, whichever is lower, is allowed as deduction. So we'll get an altogether deduction for 15 years from the year of commencement. Are you all listening? If you have started an entity in Special Economic Zone, then Income Tax Department say for the first 5 years, don't pay any taxes for your export profits. What is export profits? The profits from exports. Then for the next 5 years, that means 1, 2, 3, 4, 5, 100% export profit is exempted. Next 5 years means 6, 7, 8, 9, 10. You can claim 50% of the export profit as an exemption. Then for the next 5 years means 11, 12, 13, 14 and 15th year from the commencement. You can claim either 50% of export profit or amount invested in ZES reinvestment reserve, whichever is lower is allowed as a deduction. Are you with me? Not deduction, exemption. Are you with me? Say for example, I've started a 4-star hotel in ZES. 4-star hotel in ZES. I am a specified business as well as I can claim 10AA exemption. Nobody will start a 4-star hotel in ZES, first of all. But this is only for the purpose of example, I'm saying. I've started a 4-star hotel in ZES. Same time, I'm a specified business as well as I can claim 10AA exemption. Yes or no? I can only choose one. If I claim 35AD, no 10AA exemption. If I claim 10AA exemption, no 35AD deduction. That's what is called vice versa. Took one, I will not get the other. Are you with me? But there is a thing. Say for example, JK Limited is a company having two businesses. JK Limited is a company having two businesses. Business number 1, say mobile manufacturing. Mobile manufacturing, it is in ZES. Business number 2, 4-star hotel. That is in normal area. This is under the same company, two business divisions are there. For the 4-star hotel, I can claim 35 AD. For this mobile manufacturing in ZES, I can claim 10AA exemption. This is not assessee specific, it is business specific. Are you with me? If a same person having two businesses, one in ZES and the other one specified, he can claim both in a single year, no problem. But for the same business, you are not supposed to claim both. Either 10AA or 35 AD. Are you all here? Similar to this, they are also saying a restriction for Chapter 6A C heading deductions as well. What do you mean by Chapter 6A C heading deductions? So Chapter 6A C heading deductions are not 80C, 80D, 80DD, DD, etc. Those are not Chapter 6A C heading deductions. C heading deductions starts from 80I, 80I, IA, IAB, then IAC, IB, IBA, IC, IE, JJA, then next is JJAA, 80LA, 80P, PA, QQB, RRB. For your finals, you don't have to by heart all these things. For your finals, you should know there are chapters 6A C heading, which starts from 80I. That's it. Ends with 80 RRB. You might be familiar with 3. Number 1, JJAA. Deduction for creating additional employment opportunities and subject to certain conditions. 80 QQB, deduction for royalty for book authors who are writing books, scientific related literary books, etc. If you are writing, you will get a deduction for the royalty income that you have earned. Number 3, 80 RRB, that is for royalty you have received for patents in your name. You are an inventor and you have registered a patent in your name and you are getting royalty for that patent, you can claim 80 RRB deduction. So the moral of the story is, if you are a specified business and you are eligible for Chapter 6A C heading deduction, you can take either C heading deduction or 35 AD deduction. You cannot take both from a single business. This is also business wise, not assessee wise. Are you with me? If a same assessee have multiple businesses, from one business, I can take 10AA or Chapter 6A C heading. From the other business, I can take 35 AD as well. There is no restriction. Are you all here? This has been tested once. I think it's in RTP, if I'm not wrong. There is a question similar to this. They are mixing all these things. Now, friends, one thing you should be very careful. Those points which I stress, certain points I normally tell, these are important, these are not. What is the criteria for saying these are important and these are not? Already asked. Those items that are covered under practice workbook, practice manual, those things which are covered under practice manual, that's what I'm stressing too much. Because there are a lot of repetitive items they used to ask. But we are covering everything because again, as you know, we cannot rely on the past exam questions alone. We should anticipate some questions from other areas as well. Moving on. So the point which we have discussed is, from the same business, you cannot claim both 10AA as well as 35 AD or Chapter 6A C heading as well as 35 AD. Now, moving on to the next point, friends, that is, If you have, assessee cannot claim deduction in respect of such expenditure incurred from specified business under any other provisions of this act. This is mainly for the purpose of depreciation. You claim 35 AD deduction. For the same expenditure, don't come and ask for what? Depreciation. You will never get any depreciation because 100% of the cost is already allowed as deduction. Thereafter, you will not get any depreciation. Now, point number 7 we have already covered, the date of commencement. Then, next is 73A, that is, when you charge your capital expenditure straight away to your profits, you will definitely end up in what? Loss. If you are in loss, then that loss is called as specified business loss. If you have specified business loss, you can set it off only with specified business profits. You cannot set off specified business loss with normal business profits. Not possible. Are you all listening? You cannot set off specified business loss with normal business profits. Specified business loss can be set off only with specified business profits. If you don't have specified business profits in a year, then what to do? You need to carry forward that particular loss to unlimited subsequent years. Department say under 73A, you can carry forward specified business loss to unlimited subsequent years. I hope you guys are listening. Now, next point that I want to say is, that is, as per section 35 AD, subsection 6A, assessee shall be deemed to be carrying on specified business of building and operating hotel if assessee builds a hotel of 2-star or above category. Thereafter, he transfers the operation of hotel to another person, and he, however, should continue to own the hotel. That simply means you are in the act, they say building and operating hotel. Are you all listening? Now, can you just read that point number 9 for me? Just have a quick reading on that point number 9. Tell me what exactly is point number 9. I build a 4-star hotel. Then I transfer that 4-star hotel. And the person who bought the 4-star hotel is continuing that hotel. I've incurred a loss. I can claim it as a specified business loss even though I'm not owning that particular hotel. I can claim it from my specified business profits. But I should have some other specified business profit to claim. Are you with me? This benefit is only there for hotels, not for others. You develop a hotel, transfer it, no problem. At the time of development, whatever loss that you have incurred, you can what? You can set it off with the other specified businesses. Now, moving on to the other point is, where due to close connection between assessee and other person, or for any other reason, it appears to the AO that profits of specified business is increased to more than ordinary profits, assessing officer shall compute the amount of profits of such eligible business on a reasonable basis for allowing the deduction. Listen friends, say for example, me and my friend, I am running a specified business. and my friend is running a normal business. I am buying a lot of products from my friend. at a very low cost. And thereby I am increasing the specified business profits. The purchase price is less, my profit will go up and my friend's profit will come down. But I am being a specified business, I can claim a lot of deduction. Yes or no? If it is noticed by assessing officer, then he have the power to come and recompute the profits. Are you all with me? It is not necessary that me and my friend should be related. Due to the close connection between two parties, if the specified business profits are unreasonable in the opinion of AO, then he have the power to recompute the profits. Are you with me? So moving on to the next point, friends, what they say is inter-unit transfer, where assessee carries on at least 2 units. One of its unit is eligible under 35 AD and at least 1 unit is not eligible for exemption. Goods and services are transferred from eligible unit to any non-eligible unit or vice versa. The consideration for such transfer does not correspond to the market value of the goods as on the date of transfer. Then deduction shall be computed as if the transfer in either case had been made at market value of such goods or services as on that date. I have 2 units, one specified and the other one normal. If the transaction between these two, are you all listening? I have a specified unit and a normal unit. And if the transaction between the specified and normal is not in market value, then the department will come and recompute all the transaction in market value. Because if the transaction is not in market value, then what may happen? Then assessing officer know that there will be some adjustment of profits. I will try to charge more profits on the specified business. Why? Because I can claim a lot of deduction. That is not permissible. Then, moving on with the next point, Section 35 AD subsection 7A provides that asset in respect of which a deduction is claimed and allowed under 35 AD shall be used only for specified businesses for a period of 8 years. You purchase the capital expenditure, you purchase an asset and claimed it as a deduction under 35 AD. There is a lock-in period for that particular asset. How many years is the lock-in period? 8 years. For the 8 years, listen, for the 8 years, you are not supposed to transfer that asset to your any other unit. It doesn't mean that you have to sell it. You are not supposed to transfer it to any other unit also. What do you mean by you are not supposed to transfer it to any other unit? Listen. Say for example, I have two businesses. Number one, normal business. Number two, specified business. Are you all listening? Normal business and specified business. I bought an asset, a plant and machinery for specified business. Both are owned by me. Both businesses are owned by me. I bought an asset of value 10 lakhs for my specified business. Alright. And I claimed it as a deduction under 35 AD. Alright. Now, I am supposed to use this particular plant and machinery for this specified business for the next 8 years. I am not supposed to transfer this plant and machinery to my normal unit. Why? So, the reason behind this lock-in period is I will buy all the assets in the name of specified business. Then I will simply transfer it in the name of normal business and I will take 35 AD deduction. To restrict that, they say if I bought an asset for specified business, I must use it for 8 years. Thereafter I can transfer, no problem. Thereafter I can transfer. The next 8 years, I am not supposed to transfer it to my normal business. I hope it is also clear. Now listen. They are also saying a few more things. That is, if I've transferred this particular asset in the name of, in my other unit to the other normal unit, then what will happen? Then the department say, I will show it in the example. Say, year 1, I bought an asset for 10 lakh and I claim it as a deduction. In year 2, I transferred this asset to the normal business. Then what will be the consequence? I violated the 8-year lock-in period condition. Yes or no? What will be the consequence? Department say, you take that 10 lakh as deduction. At the time of deduction, we clearly stated that you are not supposed to transfer it to your other unit for the next 8 years. But you have violated it. Yes or no? Due to that violation, there will be a deemed income taxable in your hands because you have claimed 100% of the actual cost of deduction on a condition that you will use that asset for specified business for the next 8 years. But you have violated it. So, the deduction allowed earlier shall be deemed to be your income taxable under Pgbp. But there is a thing, I have used this asset for 1 year for my specified business. Yes or no? So, what I can do is, I can deduct 1 year notional depreciation. 1 year notional depreciation at 15% since it is a plant and machinery. 15% on 10 lakh means how much? 1,50,000. I can deduct this 1,50,000 and the remaining 8,50,000 shall be my deemed income from my Pgbp due to lock-in period violation condition. Are you with me? Are you with me? And there is one more thing. The same 8 lakh will be my capital expenditure for my normal business. The same 8 lakh is my capital expenditure for my normal business. On that value, I can claim what? Depreciation under my normal business in accordance with section 32. When I violate that lock-in period 8-year condition, what is going to happen? I can deduct the notional depreciation. The rest of the amount will be deemed to be my income under specified business. And the same deemed income shall be my actual cost in the normal business. I can capitalize it and claim what? Depreciation. Are you all here? Yes. Now, what if I'm selling it outside? What if I'm selling a particular capital asset outside? before 8 years or after 8 years? So friends, when I am selling it outside, the treatment is under section 28. And what is the treatment? The sales value up to the deduction I have claimed under 35AD shall be my income chargeable under section 28. So let's summarize everything. Listen. Say for example, I am a specified business and I claimed deduction under section 35AD. Alright, and I've transferred that asset. This can be divided into two. The transfer of asset can be divided into two. Number one, inter-unit transfer. What is inter-unit transfer? It is transferred from one of my businesses to another business under me. It's not a sale basically. It's only a departmental transfer or a business transfer, I can say. In such scenario, we can split this again into two. Before 8 years, you tell me what is the treatment if I'm transferring it inter-unit before 8 years, then that income, that deduction minus notional depreciation, whatever the balance shall be my deemed income under Pgbp. That's what the example we have learned right now. Yes or no? This example. Yes or no? Now, if I'm selling it before 8 years, then the entire deduction minus notional depreciation, the remaining amount shall be my deemed income. Now, what if I'm transferring it after 8 years? If I'm transferring after 8 years, absolutely no problem. There is no impact according to the income tax department, but there is one thing. When I'm transferring it in the name of new business, in the new business, there is a plant and machinery that will form part of the block with zero value. That will form part of the block of the new business with zero value. Why zero value? Entire 100% is already allowed as a deduction. When I'm transferring it to my normal business, it will form part of the block, plant and machinery, depreciable at 15, if it is a general plant and machinery. But the value will be 0. Are you with me? I have connected actual cost as well as 35AD. Alright, now, if it is an outside transfer, that also I'll split into two. If the transfer value is up to its cost of acquisition, then what is the treatment? Its entire cost is allowed as a deduction in the year of purchase under 35AD. When I'm selling it outside and the sales value is up to the deduction I've claimed earlier, then what should be the treatment? Taxable under section 28. Then, if the transfer value is more than its cost of acquisition, that means I've sold it for a value which is more than its original cost of acquisition, then up to its cost of acquisition shall be what? Taxable under section 28. The excess shall be under capital gains. Because if I'm getting some value which is over and above its original cost of acquisition, that will be always capital gains. The original cost of acquisition, there is no restriction. I can claim that entire cost as a deduction under 35AD. Are you with me? This outside transfer, it is whether it is before 8 years or after 8 years, the treatment is same. Outside transfer, whether it is before 8 years or after 8 years, the treatment is same. 8-year lock-in period is only for the inter-unit transfer. Outside unit transfer, at any time you transfer, the impact is same. Are you with me? So the last thing under this 35AD section is, listen, there is a case law that is called a Seabros Hotels Private Limited, 2018, cited by the Madras High Court. So Seabros Hotel Private Limited, which is cited by the Madras High Court. What happened is, assessee started a hotel, say a 4-star hotel, and applied for what? Star recognition with the tourism department, with the Ministry of Tourism. They applied for the star recognition. Are you with me? This application was pending. With that particular department. In the meanwhile, assessee has filed their returns. By claiming 35AD deduction and claimed 35AD deduction. But the assessing officer denied the deduction. Why? Because not yet certified as a 4-star hotel. Your application is still pending. So assessing officer said, we will not give you what? We will not give you 3580 deduction. First you have to certify yourself as a specified business. Then only we will give you what? Deduction. The assessee said no. We are actually eligible. We have given our application the correct manner. But they are unnecessarily delaying it. It's not because of our problem. There is a delay. We want deduction. They started fighting. The case went to Madras High Court. And the Madras High Court said, it is not on account of assessee there is a delay by the tourism department. Assessee cannot be held responsible. And in the meanwhile, he got approval also. In the meanwhile, during the debate, he got approval also. So, Madras High Court said, it is not on account of assessee. Assessee have followed everything. Assessee have given application. He have the facility. The authority delayed it. So, due to the delay of authority, you cannot make assessee responsible. And he is eligible for deduction under 35AD. I hope it is clear. So, by that I can say, all the theory in relation to 35AD is completely over. Okay friends, now it's time for us to solve some problems in relation to Pgbp. So please take your problem sheet, that is page number 4, and solve question number 2, which is in relation to computation of depreciation. Easy question, okay? Easiest of the question. Take page number 4, question number 2, and give me the answer. It is the easiest of the questions we have. So friends, let's solve the answer together. A newly qualified chartered accountant, Mr. Dawal, commenced practice and has acquired the following assets in his office during 22-23 at a cost shown against each item. Calculate the amount of depreciation that can be claimed from his professional income for assessment year 23-24. Assume that all the assets were purchased by way of account, pay, check. You know the reason behind the assumption, because if you are not purchasing it by way of account, pay, check, or account, pay, cross check, or ECS or prescribed electronic mode, then you cannot treat it as your part of actual cost. So they are telling you to assume that all the assets are purchased by way of account, pay, check. It's an easy question. So we'll solve it quickly. Now computer including computer software. You tell me under which classification it will come. It will be a plant and machinery depreciable at 40% rate. Yes or no? So let's form the block first. Let's let's form the block and solve the answer. So the first item is computer. And how much is the value, friends? 35,000 rupees is the value. And it is put to use and purchased on 27 September and put to use on 1st October. So which date you should consider? Purchase or put to use? Always put to use. So 1st October 2022 to 31st March 2023, if you count, you will get exactly 182 days. Hence, it is more than 180 days and you can claim full amount of depreciation. There is absolutely no problem. Moving on to the second asset is UPS. UPS is also regarded as computer and 8,500 is its actual cost, but it is put to use for less than 180 days. Why? Because 8th October, if you start counting, it will be less than 180 days. So 8,500 is the actual cost of UPS that I will write, and in bracket I will write 180 days less. Then, which is the next asset, friends? It is computer printer, also regarded as computer, and put to use date is on 1st October, which is more than 180 days, and 12,500 is the actual cost. So I will write printer value 12,500. Then, which is the next asset? Books. Books are actually separate block. Books are actually separate block according to the return specified by the department. But when you solve in exam, plant and machinery under 40, categorize it as a single block. In examination, when plant and machinery 40%, if an item is there, you categorize it as a single block, because in all of the suggested answers given by institute, they do the same. Actually, is it correct? The answer is no. It is not correct because there is no formula for creating block. The block is there in the return. We fill the block value according to the return. That's what we normally do. But here, what you can do is you can add it as a plant and machinery depreciable at 40, because book is a subcategory of plant and machinery, and the depreciation rate for book is 40%. Hope you remember the rate chart which we have discussed yesterday. And here the value is 13,000. Whether it is annual publication or not, rate will be always 40%. And the value is 13,000. 1st April 2022, hence more than 180. So 13,000 is the value of books. More than 180 days is the put to use as well. Moving on to the next asset, that is office furniture, which is furniture and fittings depreciable at 10%. The value is 3 lakhs, so that is separate block we have to form. Furniture and fittings depreciable at 10%. So furniture and the value is 3 lakh, which is more than 180 days. Now, moving on. Laptop is also computer, value is 43,000 and put to use for less than 180 days because put to use on 8th October 22. If you start counting, it will be less than 180. So 43,000 is laptop under the first block. Value is 43 and we will write in brackets 180 days less. Now, can you just add and give me the total block before depreciation? Total block value before depreciation in the first case. Second case is 3 lakh. 99,000 is the total value of block before depreciation. Now let's compute depreciation. So normal depreciation. First we need to take computer 35,000 plus printer 12,500 plus book 13,000 will get full rate of depreciation. Yes or no? The rate is 40%. Then for laptop and UPS you will get only half. So 8,500 plus 43,000, you will only get half. That is 20%. Now help me with the depreciation figure. So friends, the total is not 99,000, it is 1,12,000. Is that right? Yes, 1,12,000. So the depreciation figure, it is 34,500. Now after deducting that, how much is the closing WDV? After deducting 34,500 from 1,12,000, what is the closing WDV? 77,500. Now, in the other case, depreciation, it is very simple at 10%, that will be 30,000 and hence the closing WDV will be 2,70,000. And this is the final answer to that particular question. Don't expect this question in exam, okay? It is only for the conceptual understanding I have given this question. Don't ask me about additional depreciation. Chartered accountant is not manufacturer of audit report. He is only a service provider. So there is no additional depreciation at all. Now go to question number 1 and solve it. Take question number 1 and solve it. When you solve question number 1, I want all of you to give me the WDV value as well as the depreciation figure and be very, very careful in dates. When you read question number 1, be very, very careful with the dates. So we'll read the question first. Compute the quantum of depreciation available under section 32 of Income Tax Act 1961 and any other benefit available in respect of the following items of plant and machinery purchased by Siemens Limited, which is engaged in the manufacture of textile fabrics for the year ended 31st March 2023. So from the first paragraph, there is only one takeaway, that is manufacture of textile fabrics. That simply means we can claim what? Additional depreciation on eligible plant and machinery. That is the information that we want. Now, let's move on and discuss the remaining things here. So, new plant and machinery installed on 1st May 2022. It's a new business, right? So, it is under plant and machinery depreciable at 15% category. So, the first asset is under plant and machinery depreciable at 15% category. And tell me how much is the value? It is plant and machinery and the value is 84 crores. The figures are in crores. Now, what is the next asset, friends? It is windmill, which is installed on 18/6/2022. So, windmill means plant and machinery depreciable at 40% rate of tax. So, windmill. Plant and machinery depreciable at 40% rate of tax. It is windmill. And what is the value? 22 crores. Now listen, which all are the next plant and machineries? Items purchased after 30th November 22. That simply means all the remaining items are less than 180 days put to use category. Yes or no? All the remaining items under this list is under less than 180 days category. Now, let's see the first item, that is lorries for transporting goods to sales depots. So, that is amount is 3 crore. So, lorry is a plant and machinery depreciable at 15%. So, we will write lorry. No, lorry for transporting goods to sales depot. It's not a goods transporter. So, depreciation rate is 15%. If you are a goods transporter or then you can claim depreciation at 30%. Otherwise, it will be always 15. So lorry amount is 3 crore. Then, which is the next item, friends? It is forklift truck used inside the factory, that is 4 crore. So we will write forklift truck used inside the factory less than, these items are less than 180 days first of all. Okay, forklift truck, the amount is 4 crore. Again, general plant and machinery depreciable at 15% rate. Then computer installed in office premises 1 crore. So I'll write again less than 180 day category, computer in office. How much is the amount, friends? 1 crore. Then computer in factory is there. So computer in factory, the amount is 2 crore. Then what they are saying is new imported machinery value 12 crore. New imported machinery is there and its value is around 12 crore. New imported plant and machinery, its value is 12 crore. And for that, there are certain adjustments in the question. Listen. Which all are the adjustments in the question, friends? It says, new imported machinery arrived at Chennai port on 30th March 2023. So this 12 crore item arrived at Chennai port on 30th March 2023 and was installed on 3/4/2023. But put to use in which year? Put to use in 2023-24 PY. Yes or no? The put to use happened in only 2023-24 PY. All other items were installed during the year ended 31st March 2023. The company was newly set up during the year. Also compute the WDV for various blocks of assets. Now, what I have done here is I have written till that imported plant and machinery. I have written, categorized everything until that imported plant and machinery. Now you tell me, friends, what to do with that value of imported plant and machinery? That will form part of the block, but you cannot claim depreciation. Because if the import is completed, purchase is completed, you have to capitalize the value, but you are not supposed to claim depreciation. You tell me, what is the point of completion of import? When the goods touch the, or it goes through the customs barrier. That means touches the landmass. Yes or no? That is when the import is completed. So here the question clearly states that the new imported plant and machinery arrived at the port on 30th March 2023. That means it is already received in the port. That means import is completed. Purchase is completed. So what we need to do is, under general plant and machinery, we will write imported plant and machinery 12 crore, but you are not supposed to claim depreciation on this particular value. Your WDV will be high, but on that value you cannot claim depreciation. Are you all here? Now, tell me, friends, how much is the total value of the first block? How much is the total value of the first block before depreciation? 84 plus 3 plus 4 plus 12. 103 crore. How much is the total value of the second block, friends? That is 22 plus 1 plus 2. 25 crore is the value of the second block. Now listen, friends. Let's compute the depreciation first. Let's compute normal depreciation. Normal depreciation. So for normal depreciation, you know that the first asset 84 crore value, you can get full 15% as the depreciation. Yes or no? Then for the 3 crore and 4 crore, you will get 7.5% depreciation. Why? Because it is put to use for less than 180 days. So we can write 3 crore plus 4 crore is subjected to 7.5% depreciation. On 12 crore, you cannot claim any depreciation as well. Now you tell me, how much is the total normal depreciation figure coming? How much is the total normal depreciation? 13.125 crore normal depreciation. Now let's compute the additional depreciation here. So additional depreciation, since he is a manufacturer, you can claim what? Additional depreciation. On the first plant and machinery of value 84 crores, you can claim 20% full additional depreciation. Yes or no? 84 crore into 20%. Plus, on lorry, you cannot claim any additional depreciation because they use that lorry to transport goods to sales depot. So it's a proper road transport vehicle. How about forklift truck? Yes, you can claim depreciation back. Why? Because it is used exclusively inside the factory. Normally, forklift truck will be used inside the factory. We will never use forklift truck to transport containers through the road. Okay, so what you can do is that 4 crore you can claim additional depreciation, but only at 10%. Why? Because it is put to use for less than 180 days. So into 10%. And on imported plant and machinery, you don't get any normal as well as additional. So tell me how much is the total additional depreciation figure coming? 17.20. So after deducting these two, how much is the closing WDV in block 1? 72.675 is the closing WDV of block number 1. Now let's compute the closing WDV of block number 2, friends. So let's compute it together. Listen. So windmill, as you know, first let's compute the normal depreciation. Normal depreciation. For windmill, you can claim what? Full amount of depreciation, that is 22 crore will be subjected to 40% rate of tax. So tell me, plus less than 180, office, computer, 1 crore plus 2 crore into how much? 20%. So how much is the total normal depreciation figure coming? So the total figure is 9.40 crore coming. Now let's compute additional depreciation in block number 2. So additional depreciation in block number 2. So friends, tell me how much is the additional depreciation in block number 2 coming? So let's see. For the windmill, you can claim full additional depreciation, 22 crore into 20%. Now how about the computer in office? No additional depreciation because office appliance it is. How about computer in factory? That you can claim additional depreciation, but only at 10% because it is used for less than 180 days. Now don't say 6 months, it is 180 days. So it is 2 crore into 10%. How much is the total additional depreciation figure coming? 4.60 crore. So after deducting these two, how much will be the closing WDV? 11 crores. And that is the final answer to that particular question. I hope it is also clear. Okay, friends, now take question number 4. That's in page number 5. So go through this question number 4 and give me the answer. That is depreciation in relation to amalgamation. Today morning we have discussed the concept in relation to amalgamation. What all are the things that you have to do? So this question is in relation to that concept. So I want all of you to go through the question and give me the answer by yourself. So question number 4, what they say is, Sai Limited has a block of asset carrying 15% rate of depreciation whose written down value as on 1st April 2022 was 40 lakhs. So Sai Limited is a company. We will draw a small chart for a better understanding. So Sai Limited is a company. They have some opening WDV of plant and machinery depreciable at 15%. And tell me how much is the opening WDV figure? It is 40 lakhs. Now it purchased another second-hand plant and machinery. It purchased another second-hand plant and machinery. And what is the value of the second-hand plant and machinery? 14 lakh 40,000. And when is the purchase date? 1st November 2022 is the purchase date. Now listen and put to use on the same date. Now Sai Limited is got amalgamated with Shriddhi Limited. Shriddhi Limited. Maybe it's an amalgamation by way of absorption. And all the assets of Sai has been taken over by Shriddhi at 60 lakhs. So all the assets of Sai has been taken over by Shriddhi at what value? At 60 lakh rupees. And first of all, let me tell you that 60 lakhs has no relevance in Income Tax Act while computation. Why? Because the transaction or the transfer of capital asset from amalgamating company to amalgamated company is not at all regarded as a transfer. If it is not a transfer, then we don't have to check we don't have to consider the transfer value. Are you all with me? Now, listen. So what is next? Also assume that the plant and machinery were purchased by way of account pay check. Now you are supposed to compute the depreciation that can be claimed for both Sai and Shriddhi. The amalgamation took place on 1st January 2023. So let's compute, friends. Now, for the opening WDV, they are eligible to claim 15% full depreciation. And you tell me how much is the total 15% depreciation figure coming? 6 lakhs is the total depreciation. And this depreciation have to be splitted among Shriddhi and Sai based on the total number of days of use. Yes or no? Now you tell me, From 1st January 2023, how many days Shruti used? For January 31, February 28 and March 31, that will be 90 days. How many days Shruti Sai used? It is 275 days. Out of 365 days, opening asset is used by Sai for 275 and used by Shruti for 90 days. So you have to split the WDV value based on this number of days proportion. So let's compute it together, friends. So here 6 lakhs divided by 365 into 90 days. How much is the proportionate depreciation that can be claimed by Sai? Sorry, Shruti. Tell me, how much is the proportionate depreciation? So the answer is 1,45,945. 145,945. Is that right? Now, let's compute the case of Shruti also. So Sai also 6 lakhs divided by 365 into 275. How much is the proportionate depreciation for Sai? 4,52,055. Now, it's not yet over. Now we have to deal with the second hand plant and machinery. Second hand plant and machinery, the purchase is on November 1st. That means it is used for less than 180 days by both. Alright. So into 7.5% is the depreciation. You tell me how much is 7.5 of 14,40,000? 7.5% of 14,40,000. How much is the figure coming? 1,08,000. Now that 1,08,000 again have to be splitted between Sai and Shruti. But there is a problem. That 1,08,000 he purchased as asset from 1st November onwards. So for November 30 days and December 31 days is the total number of used by Sai. That is 61 days. And Shruti has used it for 90 days. So altogether it is only 151 days. Don't divide it by 365. If an asset is purchased in between, divide it by the number of total days of actual usage by both the parties and divide it by the proportionate days of use. So what to do with this 1,08,000? 1,08,000 divided by 151 into 90 is the proportionate depreciation for Shruti. Tell me how much is the figure coming? 64,371. Now, how about Sai? 1,08,000 divided by 151 into 61 days. Tell me the figure, friends. 629. Now you just help me in totaling the depreciation of Sai first. How much is the total depreciation of Sai? 4,95,684 is the total depreciation by Sai. And tell me how much is the total depreciation of Shruti? So friends, this is not 145, it is 147. Then what is the balance? 147? 945. Is that right? So add these two and tell me the figure. Add these two and tell me the figure. 2,316. So this is the final answer to the question. I hope it is clear. So friends, let's solve another question in relation to Pgbp. So I want you to take question number 10. You cannot call, no, not 10, sorry. Take question number 11. Take question number 11. It's in page number 7. From page number 7, take question number 11. That's a fantastic question. So carefully read the question. It is in relation to section 35AD. Okay. Alright friends, so let's read the question together and compute the answer as well. So please listen. Mr. A commenced operations of business of setting up warehousing facility for storage of food grains, sugar and edible oil on 1st April 2022. So let's write all the businesses they have. So what all are the three businesses? Number one, warehousing facility. It's warehousing. Okay, where's a warehousing facility of storage of food grains. Then storage of sugar. Then edible oil. These are the three businesses. Both are warehousing. All of them are warehousing. Warehousing of these activities. Now, out of this, warehousing of food grains, you tell me whether it is a specified business or a normal business. Specified business, because food grains are always agricultural produce. Yes or no? So, normally food grains are agricultural produce. So, we can say warehousing of food grains is specified business. So, I will call it as SP, specified business. How about sugar? Specified business. How about edible oil? Normal business. Why? Edible oil. Say for example, coconut is the primary produce. Coconut's processed product is coconut oil. Alright, so edible oil means an oil that you can consume. Alright, now this is a normal business. Now let's read the remaining part of the question. He incurred a capital expenditure of 80 lakh, 60 lakh and 50 lakh respectively on purchase of land and building during the period January 22 to March 22. So the first information here is he started his operation on 1st April. Yes or no? He incurred this expenditure from Jan 22 to March 22. That means it is pre-commencement. If it is pre-commencement, what should be the treatment? Nothing. You at the year of commencement, you capitalize it and claim deduction. That's it. Are you all with me? So, how much is the pre-commencement land and building total cost? So, land and building total pre-commencement expenditure is 80 lakhs, then 60 lakhs and 50 lakhs respectively. We are just noting all those information down. Now, listen. Out of that they say, exclusively for the above business and capitalize the same in the books of accounts as on 1st April 2022. Now, the cost of land included in the above figures is 50, 40, 30 respectively. So, what to do with the cost of land? Cost of land is never allowed as a reduction under 35AD, hence you have to remove it. Even if it is a normal business, you cannot claim depreciation on the cost of land. So you need to remove anyways the cost of land from the capitalized value. So land cost. Land cost. How much is the cost of land, friends? 50, 40, 30. 50 lakhs, 40 lakhs, 30 lakhs respectively. So how much is the remaining value? Remaining value shall be 30, 20, 20. Yes or no? Yes or no? Now, moving on. During previous year 22-23, what happens? He incurred capital expenditure of 20, 15 and 10 respectively for extension or reconstruction of the building, purchased and used exclusively for the above business. So, there was some expansion of the building, expansion cost for the building. So, we will write that in the year PY 22-23, expansion cost of building. How much is the expansion cost of building? It is 20, 15 and 10. So 20 lakh, 15 lakh and 10 lakh. So how much is the total capital expenditure? For business 1, it is 50 lakh. Then business 2, it is 35 lakhs. And for business 3, it is 30 lakh. It is the total cost of building. Yes or no? Now, let's continue reading the question. So what next is the profits from the business of setting up warehousing facility for storage of food grains, sugar and edible oil before claiming 35 AD and 32 for assessment year 23-24 is 16 lakh, 15 lakh and 31 lakh respectively. The profit is also given in the question. So we'll write the profits down. So profit from the above business before claiming all the 35 AD as well as depreciation. How much is the profit, friends? 16, 14, 31. So 16 lakh, 14 lakh and 31 lakh. Now let's compute all the other things. So compute income under Pgbp for assessment year 23-24 and the losses to be carried forward assuming Mr. A has fulfilled all the conditions specified for the claim of deduction under 35 AD and wants to claim deduction under 35 AD and has not claimed any deduction under chapter 6A under the heading C deduction in respect of certain incomes and assume in respect of expenditure incurred by the payments are made by account paycheck or use of electronic clearing system. So they are required you to compute the net income taxable under Pgbp or the losses, if any. So let's compute it together. So in the first two cases, you can claim what? 35 AD deduction. So section 35 AD deduction. For the first business, the entire 50 lakhs is allowable as a deduction. For the second business, entire 35 lakhs is allowed as a deduction. For the third business, you cannot claim any 35 AD deduction. Why? Because it's a normal business. And how about depreciation? So depreciation under section 32. For the first two businesses, you cannot claim any depreciation. Why? Because entire cost is already allowed as deduction. How about the third business, friends? For the third business, you can claim what? Depreciation. And the depreciation amount will be 30 lakhs into 10%. And that will be 3 lakhs. So friends, tell me, how much is the loss or profit? In the first case, it is loss. How much is the loss? 34 lakhs is the loss. And second case also it is loss. How much is it? 21 lakh. And how much is the profit in the third case? Profit in the third case is 28 lakh. Now I have a question. These two loss total is 51 lakhs. Sorry, 55 lakhs. Can I claim this 55 lakhs loss from this 28 lakh taxable profit? No. Why? Because specified business losses can set off only with profits from specified business, and hence this 55 lakhs loss have to be carried forward to unlimited subsequent years. This 55 lakhs have to be carried forward to unlimited subsequent years according to the theory mentioned under 73A of Income Tax Act. Is that clear? And that is the final answer to the question. Yes. Okay, friends. So I want you to solve one more problem in relation to this. So please take question number 14. It's in page number 7. Question number 14. It's page number 7. So go through that question and give me the answer. So let's read question number 14 together, friends. ABC Limited is a company having 2 units. Unit A carries on specified business of setting up a warehousing facility for storage of sugar, and in Unit B carries on non-specified business of operating a warehousing facility for storage of edible oil. So there are 2 businesses. Alright, that is Unit A and Unit B under one undertaking. So they say ABC Limited is a company and they have 2 units, that is Unit A, which is specified business, and Unit B, which is a normal business. That's what they say in the question. Now, let's read the remaining part of the question. Unit A commenced its operation on 1st April 2021 and it claimed a deduction of 100 lakhs incurred on purchase of 2 buildings for 50 lakhs each. So Unit A had 2 buildings and the cost of the building was 50 lakhs each. And they claim that entire cost as a deduction as well under 35 AD since they are a specified business. Now, however, in February 2023, Unit A transferred one of its building to Unit B. Examine the tax implication of the transfer in the hands of ABC Limited. So, you are required to compute the tax implication in the hands of Unit A and Unit B. So, let's understand. So, Unit A have purchased 2 buildings and transferred 1 building. So, it is in relation to that transferred building. So, when it is purchased, the year of purchase is 2021-22. They purchased the building having value 50 lakhs. 2 buildings they have purchased, but only 1 building they transferred. So, I am considering only that transferred building. Now, they used it for how many years? 21-22 they used, but in 22-23 February they transferred. So, they violated the lock-in period condition of 8 years in the second year. Yes or no? So, when they violated the lock-in period condition, what should be the treatment in income tax? You charge notional depreciation, thereafter the remaining value have to be treated as what? Deemed income from the business. So, 1 year notional depreciation figure. How much is the notional depreciation figure for building? 10%. So, that will be 5 lakh rupees. You remove it first. Then the remaining 45 lakhs have to be treated as deemed income from your business for Unit A. And the same 45 lakhs have to be treated as actual cost of that particular building in 22-23. And they can claim depreciation at what rate, friends? 10% or 5%? At 10%, because it is not a separate purchase. It is an inter-unit transfer. Assessee himself owns that particular building for more than 180 days. See, it's not a outside purchase. It's an inter-unit transfer. So, full rate of depreciation you can claim. So, 10% that will be 4,50,000. And the remaining, how much will be the closing WD of that building? 40 lakhs, 50,000. 40 lakhs 50,000 will be the closing WDV of that particular building. I hope it is clear. It is a direct question. Is that clear, friends? So for the time being, we are saying tata bye-bye to the questions. Now let's let's discuss some theory in relation to PGBP again. So the next provision that we have to discuss is section 35CCA of Income Tax Act, that is deduction for contribution for rural development. You have contributed for rural development, then that contributed amount is allowed as a deduction under which section? 35CCA. So let's understand which all are the items that are allowable as a deduction. So listen, friends. See, a deduction of the following payments or contribution are allowable. Number one, you have contributed anything to an association or institution having an objective of undertaking programs for rural development which is approved by prescribed authority. That simply means central government. If the central government approved, so you are contributing anything to a central government approved association or institution which does rural development. What do you mean by rural development? Uplifting the people in rural area. If you are donating something to a central government notified rural development fund, then or rural development association, then that amount is allowed as a deduction. To promote these kinds of donation, they say you can donate and claim it as a deduction, whether or not that donation have a business nexus. That simply means that donation does not require any business nexus to claim it as a deduction under 35CCA. Moving on. Second contribution. You are donating anything to an association or institution having its object training of persons for implementing rural development program. Say for example, I am an institution which trains people who actually takes parts in rural development. We call it as Trainers Training Institute. What is Trainers Training Institute? Those who does awareness programs and all to uplift this rural people. That persons have to be trained, right? So if I am an institution or association and my main object is training of persons for implementing rural development program, then all the donations given to this institution is also allowed as a deduction. So I am a training institute and you are giving me a donation. You can claim that donation as a deduction under 35CCA. Are you all with me? Moving on to the third point, that means donation to a rural development fund set up by central government. You are directly donating to a rural development fund which is set up by central government. That is also allowable as a deduction. And finally, you are contributing anything to a national urban poverty eradication fund which is set up and notified by central government. That is also allowable as a deduction. So four types of donations are allowable as a deduction under 35CCA. Friends, you tell me which all are the four types of donations allowable as a deduction. Number one, you are donating anything to an institution which does programs for rural development. Number two, you are donating anything to an institution or association which trainers who does rural development programs. Or you are donating anything to a rural development fund which is notified by central government. Or you are donating anything to a national urban poverty eradication fund which is set up by central government. In all these four cases, whether the donation have a business nexus or not, you can claim that donation as a deduction. Bus. Donate 100, take deduction 100. That's it. How much amount you donated, that donation is allowed as a deduction. For the same donation, don't claim any other deduction in Income Tax Act. Why? Because already we are giving you a deduction under 35CCA. Don't take any other deduction. Once, if you get deduction, that's it. No other further deductions. Moving on with the next provision, that is 35CCC, that is deduction in respect of expenditure incurred on notified agricultural extension projects, which is under section 35CCC. Are you all listening? So listen friends, 35CCA says if you have expended anything for a notified agricultural extension project, you have to expend. This is not a donation. You have to expend something for a notified agricultural extension project. then that expenditure is allowed as a deduction under which section? 35 triple C. Now, first of all, what is this notified agricultural extension project? A project which is approved by the Ministry of Agriculture to train, educate, or to update farmers in India. Either to train or educate or guide or update farmers in India, and the project should be notified and approved by the central government. The Ministry of Agriculture have to approve your program. Are you all with me? If you conduct such a program, then all the cost in relation to that program is allowed as a deduction under 35 triple C, subjected to conditions under 35 triple C. So let's understand which all are the conditions. Number one, for the first condition, what they say is the agricultural extension project shall be considered for notification. It fulfills all the following conditions, namely the project shall be undertaken by the assessee for training, educating, or for guiding farmers. Number two, it should get the approval of Ministry of Agriculture, that is the Government of India, Ministry of Agriculture. And finally, this is the most important condition out of three, that is an expenditure exceeding 25 lakhs is expected to be incurred for the project. This is not a small size project. You should expend more than 25 lakh rupees for the particular project. Then only you will get a deduction under 35 triple C. And friends, there is one more thing. When you incur the 25 lakhs, that cost shouldn't be for purchase of land or purchase of building. What do you mean by the cost shouldn't be for purchase of land and purchase of building? Say for example, I am an assessee. Alright, I have initiated a notified agricultural extension project. I bought 1 acre of land for 2 crores. Then I built a building of 1 crore. Then I conducted a program for 10,000 rupees. Now I am saying 3 crore 10,000 rupees have expended for what? Notified agricultural extension project. I conducted 2 days program. Then said Tata bye bye to the farmers. Then what will happen? It's good. I can use that particular land and building for my business purpose. Yes or no? So department anticipated this and they say, we will not give you deduction for the land and building. Except for land and building, you need to expend 25 lakhs. More than 25 lakhs. Exactly 25 lakhs, no deduction. More than 25 lakhs, then only you will get it as a deduction. Say for example, I have expended 24 lakhs. Will I get any amount as deduction? No. I have expended 25 lakh 10,000 rupees. I'll get that entire 25 10,000 as a deduction under triple C, section 35 triple C. Are you all with me? Yes or no? So these are actually deductions under 35 triple C subjected to the conditions. And friends, listen. The assessee is supposed to maintain separate books of accounts in relation to this project and get it audited by an accountant. An accountant means chartered accountant. Now, if you have claimed a deduction under 35 triple C, you are not supposed to claim any other deduction under any other provisions of Income Tax Act for the same expenditure, because we are already giving you a deduction under 35 triple C. For the same expenditure, don't claim any other deduction. That's what the Act says. I hope it is clear. Now, moving on with the next deduction. These are chota deductions, so we can quickly finish it off. The third one is 35 CCD deduction, that is deduction in respect of expenditure incurred by companies on notified skill development project. So friends, please listen. In this series, we have discussed 35 CCA first, then CCC first. Then we are about to discuss CCD now. But in CCD, there is a restriction. Only company assessees can claim CCD deduction. That too, when they incur some expenditure on notified skill development project. So you have to be a company assessee and you have to expend something for a notified skill development project. So listen. You are a company assessee and you have expended something in notified skill development project in manufacturing sector. Then the amount that you have expended is allowed as a deduction. How much amount you expend for that project, that much amount you can claim as a deduction under 35 CCD, provided you should be a company assessee. Again, here there is no minimum expenditure like 35 triple C. Under section 35 triple C, they say you have to expend minimum more than 25 lakhs. You should say it like that. More than 25 lakhs. But here they say there is no minimum expenditure, but the expenditure should not be in relation to purchase of land or building. You can expend any amount except for land and building, and you can claim it as a deduction under 35 CCD. Here also you should maintain separate books of accounts and get it audited by a chartered accountant. So you need to maintain separate books of account, get it audited by a chartered accountant. So tell me, what is 35 CCD? Company assessees who incur expenditure for notified skill development project on manufacturing sector. In relation to manufacturing sector, that expenditure shouldn't be in relation to land and building. All other expenditure you can claim it as a deduction. Earlier these was weighted deductions. Right now you expend 100, you will get 100. That's it. Earlier there were 150%, 125% and all. Right now you expend 100, take 100 only as a deduction. That's what they say. And moving on to the third set of deduction here, that is 35D, that is amortization of preliminary expenses. So let's understand what is this amortization of preliminary expenses. I hope all of you are listening. So friends, the point is amortization of preliminary expenses. Tell me, what is preliminary expenses? What do you mean by preliminary expenses? So listen friends, amortization of preliminary expenses. Preliminary expenses simply means all those expenses incurred by a person before commencing business. If it is related to scientific research, then it have to be dealt under section 35. If it is a common, normal pre-commencement expenditure, it have to be dealt under 35D. Are you all with me? If it is a common preliminary expenditure, then you have to dealt it under 35D, read with rule number 6AB. So, what rule number 6AB says? This preliminary expenses have to be divided into 3. All the preliminary expenses have to be divided in 3 stages, or you can amortize preliminary expenses in 3 stages. It's not preliminary expenses divided into 3. You can claim this preliminary expenses as a deduction in 3 stages or in 3 steps. Step number 1 is pretty simple. Identify eligible preliminary expenses. So step number 1, what they say is identify eligible preliminary expenses. You need to identify the eligible preliminary expenses. Step number 2, check whether it's within ceiling limit or not. Within ceiling limit or not. So step number 2, they are saying you to check whether all the identified eligible preliminary expenses are within ceiling limit or not. If it is within ceiling limit, then step number 3, they say claim it as a deduction. Claim it as a deduction in 5 equal annual installments. So in 3 steps, you can claim preliminary expenses as a deduction. Which are the 3 steps, friends? Number 1, you identify eligible preliminary expenses. That also means for all the preliminary expenses, you cannot claim amortization. Only for eligible preliminary expenses, you can claim amortization. That is step number 1. Then you need to check whether it is within the ceiling limit. That also means for all eligible preliminary expenses also, you will not get deduction. There is a ceiling limit. That means there is a maximum amount that can be allowed as a deduction. And step number 3, such amount within ceiling limit is allowed as a deduction in 5 equal annual installment from the year of commencement of business onwards. From the year of commencement, divide the total eligible preliminary expenses within the ceiling limit into 5. You have to divide it by 5 and claim it as a annual installment for the next 5 years from the year of commencement of your business. Now listen, the first thing to study here is which all are the eligible preliminary expenses. Let's understand which all are the eligible preliminary expenses. Friends, listen. Eligible preliminary expenses, the first item is preparation of feasibility report. Friends, what do you mean by feasibility report? Say feasibility study simply means whether such a business is feasible or not. It is about the feasibility of a business. Say simple example I'll give you. Listen, say I have invented an engine where I can run a car by making use of water. Okay, I don't require diesel or petrol. That's my dream. Okay, to design such an engine and to pour some tap water and run the car. This was a invention, only in papers. The very next thing I do is what? I will create a prototype. What is called as a prototype? I'll create a model. I'll create a model and I'll put it in a car, then I'll test it. Yes or no? So all these costs, only if it is practically, what do you say, possible only, I will start selling that particular car. Yes or no? So all the expenses to check the practicality can be called as a feasibility study expenses. So the preparation of feasibility report simply means whether a business is practically possible to conduct. All those costs is allowed as a deduction. Number 2, preparation of project report. What is project report? How much should I invest? If I invest this much, how much amount I'll get back? The future cash inflows. Then I'll discount it to the present value to determine IRR. That means the break-even point. Are you all with me? Based on that IRR, I will decide the size of investment that I have to do. We'll call it as a projected financials. So I have to prepare a project report before I start my business. So that is also an eligible preliminary expense. Every person will do a feasibility study. Every person will do a proper project report also. So all those costs is allowed as a eligible preliminary expenses. Next one, conducting market survey or any other survey necessary for the business of assessee. Say in relation to car, even before I start my production, I should decide what kind of car that I should sell. Whether I should sell hatchback, sedan, limousine, SUV, MUV, etc. that I have to decide. Depends upon the market. For that, I should know the preferences of my customers. For that, I should do a very extensive market survey. All those costs is allowed as an eligible preliminary expenses. These are the common costs that a person incur before they start their business. So, conducting market survey or any other survey which is necessary for your business is also an eligible preliminary expense. Moving on, engineering services relating to assessee's business. You require a lot of, what do you say, machines, automations, etc. All those engineering costs is also allowed as an eligible preliminary expense. Then, item number 5, legal charges for drafting any agreement between assessee and any other person for any purpose relating to setting up to conduct the business of assessee. What is legal charges? Say for example, supplier agreement cost, then initial advocate or legal advisory fees. So all the legal charges for drafting agreement between assessee and any other person. Before starting your production, you require raw materials. Yes or no? Say normally a person will sign raw material agreements for timely supply of raw material. So all those legal charges for entering into initial agreements are also a eligible preliminary expenses. Are you all with me? So which all are the 5 items, friends? Repeat with me. Feasibility study, project report, market survey, engineering services, initial charges, legal charges for drafting agreements. These are common for everyone. Now, it's not yet over. The 6th one, 7, 8 and 9 is only applicable for company assessee. So let's understand which is the 6th one. So 6th one is expenses for drafting MOA and AOA of a company. You have expended anything for drafting memorandum of association or articles of association. That expense is also an eligible preliminary expense. Next is printing cost for MOA and AOA. You need to take a printout of MOA and AOA. Even though it is negligible, they say it is an eligible preliminary expense. And point number 8, any fees for registering the company under 1956 Companies Act. It is still 1956. But as a footnote, they say you can read it as 2013. So ultimately, or the company incorporation fees is also allowed as an eligible preliminary expenses. And finally, in connection with issue of public subscription of shares or debentures of a company, being underwriting commission, brokerage, charges for drafting, printing and advertising of prospectus. Say, listen, the company is about to plan a public issue of shares or debentures. So at the time of public issue, a company may normally enter into underwriting agreements. Yes or no? What is underwriting agreement? What do you mean by an underwriter? To achieve minimum subscription, we will appoint certain persons. That appointed person will find subscribers, or they themselves will subscribe for the shares. For that, I have to pay them a commission. That commission is an eligible preliminary expenses if it is in relation to public issue of my shares or debentures, or any brokerage that are paid in relation to public issue of shares or debentures, or drafting, printing and advertising prospectus in relation to public issue of my shares or debentures. What do you mean by prospectus? It's just like a brochure issued by any business. Say, for example, an academy issues brochures, all right, to explain their amenities, their features, etc. Likewise, a company issues prospectus to informate investors that these are our financial figures, these are the statutory figures, these are our businesses, etc., etc. You need to draft, print, and advertise prospectus. What is advertise prospectus? You need to advertise it. Then only the shareholders will be able to know that this company is planning for a public issue. Just like LIC, they had a public issue earlier. Before their public issue, they had an advertisement in TV. If you are a policy holder, you need to update your PAN for increasing your chances to get that public issue and all. There was an advertisement. So all the advertisement cost is also an eligible preliminary expenses. Are you with me? So there are 9 eligible preliminary expenses. So the first thing to do is identify these 9 expenses and total it. Now, what is the second thing to do? You need to check whether it is within the ceiling limit or not. Now the question is, what do you mean by ceiling limit? So for ceiling limit can be split into 2 for non-corporate assessees. For non-corporate assessees. What do you mean by non-corporate assessee? Any assessee other than company assessee. The ceiling limit is 5% of cost of project. Cost of project. What do you mean by cost of project, friends? 5% of cost of project. Tell me what is cost of project. So friends, listen. So let's understand what exactly is the cost of project. So there is a definition for cost of project. Okay. You don't need to by heart this definition and all. Only for the purpose of understanding I am explaining this. Cost of project means, listen, cost of project means expenses incurred before commencement of business. That is the actual cost of fixed asset being land, building, leaseholds, plant, machinery, furniture, fittings, railway sidings, then which are shown in the books of accounts of the assessee on the last day of the previous year in which the business of the assessee commences. Now, so that is the cost of project explanation is all about. Total value of assets you can take. Now friends, if you are a corporate assessee, then what is your ceiling limit? That is point number 2. For corporate assessee, that means for company assessee, the ceiling limit shall be either 5% of cost of project or 5% of capital employed, whichever is higher. Whichever is higher. That's what income tax department say. If you are a company assessee, your ceiling limit shall be either 5% of cost of project or 5% of capital employed, whichever is higher. Are you all with me? So once it is within the ceiling limit, then what is next, friends? You can claim those amount as a deduction, 5 equal annual installments from the year of commencement of business onwards. I hope it is also clear. Now friends, there are a few things in relation to this 35D. There are a few things. First of all, there is a case law. So let's start with the case law. That is called as Berger Paints India Limited, cited in the year 2017 by the Supreme Court. So Berger Paints India Limited, which is cited in the year 2017 by the Supreme Court. So let's understand what is this case. So Berger India, what they did is like, while checking the ceiling limit, since it is a corporate assessee, what is the ceiling limit? Either 5% of the cost of the project or 5% of the capital employed, whichever is higher. So when they computed capital employed, what they did is they added the face value of shares plus premium amount that they collected while issuing shares. So what they did is they added the face value of share plus the premium amount also while computing capital employed. But assessing officer said it is only the face value should form part of the capital employed, not the premium amount. So there was a debate. There was a debate because it was not defined in Income Tax Act. So there was a debate between them. The case went to Supreme Court. And Supreme Court said, when we prepare balance sheet as per Schedule 3, we show capital employed as the face value only. The premium that you collect normally comes under reserves and surplus as securities premium. Yes or no? So the intention of Companies Act is that shareholder funds means only the face value, not the other value. That's why it is an reserves and surplus. That's why it's coming under reserves and surplus as under securities premium according to the Schedule 3. And hence Supreme Court said that while computing capital employed, you should take only the face value, not the premium amount. So this case is in favorable to assessing officer and against assessing. Are you with me? So this is the case, Berger Paints India Limited 2017, cited by the Honorable Supreme Court of India. Now, there are a few more things that you should understand in relation to this. So please listen, friends. Say, the 35D deduction can be claimed in 5 equal annual installments. Yes or no? Say after second installment, there was an amalgamation or a demerger. Then you tell me what should be done. The amalgamated company or resulting company can claim the balance number of installments. Yes or no? The successor can claim the balance number of installments, just like that depreciation case. Alright, so the successor can claim the balance number of installment. That's what the department says. Now listen, there are a few things that you should know. So I'll write a note on this. I want all of you to take a note of this, which we are about to discuss. So note number one. Note number one. Say a company has incurred share issue expenses. A company has incurred share issue expenses. We will split that expenses into two. That is pre-commencement and post-commencement. Pre-commencement and post-commencement. A company has incurred share issue expenses, pre-commencement as well as post-commencement. The pre-commencement share issue expenses are subjected to deduction under section 35D. If it is related to underwriting commission, brokerage, etc., then you can claim it as an eligible preliminary expenses and it is subjected to deduction under 35D. Yes or no? Now the question is, what if it is a post-commencement expenditure? That means you have incurred some expenditure for issuing your shares after commencement. Then what should be the treatment? According to the case law cited by the Supreme Court, according to the decision given by the Supreme Court in the case of Brook Bond India Limited, which is cited by the Supreme Court, what they say is post-commencement share issue expenses are not allowable as deduction under Pgbp. Post-commencement share issue expenses are not allowable as deduction under Pgbp according to Brook Bond India, which is cited by the Supreme Court of India. Are you all here? Now listen, friends. Listen. Share issue expenses includes issue of right shares. It includes any expenses in relation to issue of right shares. If it is post, then it is not allowed as a deduction in the post-commencement period. Because what Supreme Court said is like, when it comes to the post-commencement period, it is just like raising your own capital. It is an expenditure for raising your own capital and not allowed as a deduction because it is not an outside expenditure. For a company, you are raising your own capital. Whatever expenses that you have incurred cannot be treated as an outside proper expenses and not allowable as a deduction. But 35D specifically states that if it is pre-commencement, you can claim it as a deduction. That's why it is allowed as a reduction in the pre-commencement era, not under post-commencement period. Are you with me? Now moving on. Say, next is issue expenses in relation to bonus shares. Expenses in relation to issue of bonus shares. What do you mean by bonus shares, friends? What do you mean by bonus? So friends, bonus shares simply means capitalization of profits. A company, instead of distributing dividends, will convert the reserves into share capital. Are you with me? Now, if there is any expenses in issue in relation to bonus shares, if we split that into pre and post, I will say under pre, not applicable. Why not applicable in pre? You should have profits. Then only you can issue bonus shares. To have profits, you should start your business. Yes or no? So there is no pre-commencement era for bonus shares. What about post-commencement? The Supreme Court said it is allowed as deduction under section 37 of Income Tax Act. So it is in the case of General Insurance Corporation. General Insurance Corporation, which is cited by the Supreme Court. What they say is, since while issuing bonus shares, there is nothing called raising on capital. See, when you issue normal shares, the company raises their own fund. But in bonus shares, company is not getting any additional funds. It is only an administrative procedure. And hence they can claim that entire cost as a deduction under 37. This is cited by the Supreme Court in the case of General Insurance Corporation. So post commencement, bonus share issue expenses are fully allowable. Moving on. Debenture issue expenses. Debenture issue expenses. Pre-commencement. You tell me, what is the treatment of debenture issue expenses in the pre-commencement era? Allowable as a deduction under section 35D, subject to the conditions under 35D. Hope you remember. Public issue in relation to shares and debentures, any cost in relation to underwriting commission, brokerage, drafting, printing and advertising prospectus, both shares as well as debentures. Pre-commencement is according to 35D, it is allowable. Are you with me? How about post? Again, Supreme Court say it is allowable under section 37. Why? Because it is an external debt. Debentures are actually external debt. It is not raising your own fund. It's an external debt and hence it is allowed as a deduction. And the case law's name is Core Healthcare. Core Healthcare Limited, cited by the Supreme Court. Even if it is a convertible debentures, the treatment is same. What is convertible debentures? At the time of issue, it will be debentures. Instead of redeeming it, you can convert it into equity shares. In the case of convertible debentures also, pre-commencement, same treatment. Post-commencement, same treatment. Are you all with me? This has been tested many times. You should quote the name of the case law as well, because that's what the suggested answer says. And even if you don't quote the case law name, you should get marks. But all the suggested answer always suggests that you should quote the case law name. Alright. So these are the things that you should learn under 35D. What was 35D, friends? Listen. Amortization of preliminary expenses. How do you amortize preliminary expenses? In 3 steps. Number 1, identify. Number 2, check whether it is within ceiling limit. Number 3, claim all those deductions in 5 equal annual installments from the year of commencement onwards. I hope this much is clear for you. Alright friends, now let's discuss another section, that is section 35DD. That is amortization of expenses for amalgamation or demerger. Say you have incurred some expenses in relation to amalgamation or demerger, then how do you claim it as a deduction? The company which incurs that expense can claim it as a deduction in 5 equal annual installment. The company normally in amalgamation, amalgamated company incurs the expenses. So amalgamated company can claim it as a deduction in 5 equal annual installment. In demerger, both the demerger company or resulting company can incur that particular expense. What is this expense? Expenses in relation to amalgamation and demerger. They need to settle books of accounts, they need to take permissions, approvals, etc. Are you with me? For all these things, if you incur any expenditure, then that is allowed as a deduction in 5 equal annual installment. Whoever incurs that expenditure can claim it as a deduction in 5 equal annual installment. More than enough. Are you all here? Moving on with the next item, that is amortization of expenditure incurred under voluntary retirement scheme, which is under section 35DDA of income tax. Friends, tell me, what is this voluntary retirement scheme? VRS. What is this VRS payment? What is VRS? Tell me. So, voluntary retirement compensation simply means a compensation which is paid at the time of voluntary retirement. And what is voluntary retirement? That means retiring before the age. Say the retiring age is 60, you can retire before the age itself, and that is called as what? Voluntary retirement. Okay, friends, tell me the VRS, that's what we were discussing. So, VRS means a compensation which is paid at the time of voluntary retirement. And what is voluntary retirement? Retiring before your age is said to be voluntary retirement. And for the employer, this VRS compensation paid to employee is a cost. Yes or no? For the employer, this VRS compensation paid to the employee is a cost. He can claim it as a deduction. But since it is a huge expenditure, what they are saying is you can claim it as a deduction in 5 equal annual installment. You can claim this VRS compensation as a deduction in 5 equal annual installments from which date? From the year you pay the compensation. From the year of incurring that expenditure, you can claim it as a deduction in 5 equal annual installment. And for the employee, it's an income. It is an income and subjected to exemption. It is an income subjected to exemption and assessable under the head salaries. For the employer, it's a cost and allowed as a deduction under 35 DDA. I hope that is also clear. So that is 35 DDA. Now there is another section called 35E. I am completely ignoring 35E because they will never ask 34E. They will never ask 34E. It's actually very niche deduction, that is amortization of expenses for prospecting and development of certain minerals. So you can simply skip that. For academic purpose, you can read that. But the next deduction is the most important out of the deduction, that is section 36, that is other specified deductions. So listen friends, we have 2 more deduction sections in PGBP. Number 1, 36, other specified deduction, and number 2, section 37, general deduction. Are you all here? So friends, 36, that is other specified deductions. Let's start discussing this. So the first deduction under this is what? Insurance premium paid on stock or stores. Say you have paid any insurance premium and you have taken any insurance for your stock or stores, then the premium paid by you is allowed as a deduction. It's a very simple, straightforward deduction. You paid any insurance premium for the insurance of your stock or stores. What is stock? Stock in trade. What is stores? Maybe consumables or other items. So you have taken an insurance, all the premium paid is allowed as a deduction. It is as simple as that. Moving on to the second item under this particular deduction, that is insurance premium of life of cattle paid by a federal milk cooperative society. What do you mean by insurance premium paid on life of cattle by a federal milk cooperative society? If you are a cooperative society who is in the business of dairy, you can take insurance on your life of cattle. If something happens to your cattle, then the insurance company will give you what? Compensation. Say you are a federal milk cooperative society and you have taken insurance on life of cattle, then the premium paid by you is allowed as a deduction under section 36. It is as simple as that. You paid premium on the life of your cattle, then you can claim that premium paid as a deduction. Moving on to the next item, that is premium paid by employer for the health insurance of employees. You paid a premium for the employer for the health insurance of your employees. See, it's also called as group health insurance. Say employer has taken a group health insurance for the benefit of employees. The employer have to suffer a premium. That premium paid by him is allowed as a deduction under section 36. I hope that also is clear. Now, but there is one point here is the mode of payment should be other than cash. You have to make the premium other than cash. If you have paid the premium in cash, you will never get any amount as deduction, even if it is lesser than 10,000. See, all the payment above 10,000 have to be made by way of account pay check or account pay cross check or ECS or prescribed electronic modes as per section 40A3, restriction for the payment. But here what they say is, when you are making a premium for the life or the health of your employees, then even if the single day premium is less than 10,000, you have to make it otherwise than by way of cash. You make a cash payment, you will never get any amount as a deduction here. That's what they say. So these point number 1, point number 2 and point number 3, All these 3 points are in relation to what? Insurance premium. What was point number 1? Insurance premium for your stock or stores. What was point number 2? Insurance premium of life of cattle by a federal milk cooperative society. And what is point number 3? Insurance premium paid by the employer on the health of employee. So all these things you will get it as a deduction. Moving on to the next item, that is bonus or commission paid by employer to the employee. Say you are an employer and you're paying bonus or commission to your employee. Then that bonus or commission paid by you is allowed as a deduction under 36 subsection 1 clause number 2. Listen friends, listen. Here they also say it is subjected to 43B. What do you mean by it is subjected to 43B? Because there is a section in income tax called as 43B, and 43B says certain payments are only allowable as deduction on actual payment. Even if you maintain your books of accounts in mercantile system, if you didn't make the actual payment, then the following items mentioned under 43B will not be allowed as a deduction. One of the items covered under 43B is what? Bonus or commission. And hence we can say bonus or commission is allowed as a deduction under 36, subjected to 43B. What is that? You need to actually make the payment rather than putting a payable entry. Are you with me? So that's why in brackets I've written subjected to 43B. You are an employer and you are making a payment that is bonus or commission to your employee, then that is allowed as a deduction on the basis of actual payment. Now friends, tell me, what do you mean by bonus? Bonus simply means, see the employer, say he's in profit. He will distribute a portion of profits to the employee, maybe on account of a festive, maybe yearly, maybe half yearly, whatever it is. So distribution of a part of profit to the employees is said to be what? Payment of bonus. Are you with me? There is an act called Payment of Bonus Act. It says certain employers have to mandatorily distribute a percentage of their profit to the categorized employees and all. So if the employer is distributing bonus or commission to the employee or giving bonus or commission to the employee, it have to be actually paid to claim it as a deduction under 43B. Now, there is a small case in relation to this. So let's understand what exactly is the case law. So listen here. It is called as Shawson Chemicals and Drugs, or Shawson Chemicals and Drugs, we can say. Shawson Chemicals and Drugs Limited, which is cited by the Supreme Court. So before start discussing this case law, you should know one more section in relation to this. So please listen friends, please listen. Before moving on to the case law, there is a section called 40A9. After explaining 40A9, I will discuss the debate in the case law. Listen, 40A9 is actually a disallowance. So what do you mean by disallowance? So disallowance simply means certain items which is notified by department shall never be allowed as a deduction. So under that they say no deduction shall be allowed in respect of any sum paid by assessee as an employer as a contribution to any fund, trust, company, AOP, BOI, society or other institution for any purpose. That simply means, say, I am your employer. Are you all listening? I am your employer. I am giving you some benefit. I am giving you some benefit. Maybe a kind of bonus or commission or PF, whatever it is. Instead of directly giving it to you or instead of directly giving it to an approved entity, I am transferring this amount to some other entity. Alright, maybe some other entity or some other fund which is not approved. In that case, the entire payment shall be a disallowance. If the employer is paying anything to the employee, he have to either directly make the payment to the employee or to an approved fund. If he makes any transfer or if he makes any payment to any other entity which is not approved, then that entire payment shall be a disallowance. Are you all with me? So, listen. No deduction shall be allowed in respect of any sum paid by assessee as an employer as a contribution to any fund, trust, company, AOP, BOI, society, other institution for any purpose. They indirectly mean if you make a payment to any unapproved entities, companies, trust, fund, etc., then that entire payment shall be always a disallowance. allowance. Now let's come back to the case. So the Shasan Chemicals and Drugs had a problem with their employees. They had a problem with their employees. So they declared bonus. But employees said, we don't want your bonus right now. First you settle the problem. Maybe it's a kind of a wage revision or something. They had a debate or they had a problem, they had a fight, maybe in relation to wage revision. Due to that fight, employees didn't accept what? Bonus. The company declared bonus, but employees didn't accept the bonus. So what the company did is company formed a trust. And kept this bonus in the name of the trust. By appointing trustees and all. Alright. Then their fight got over. In the meanwhile, their fight got over, and ultimately, from this trust, all the employees got the payment. Payment as well. That too before filing return of income for that year. That simply means even before filing the return of income, the problem got solved, and ultimately the payment from the trust has been given to the employees. Everything was fine. But assessing officer came here and activated section 40A9, and he said, initially being an employer, you transferred this bonus to a trust, which is not approved. And hence, this entire payment shall be fully disallowed under 40A9. But employer said, whatever you said is right. Initially, we transferred the payment to a trust. Why? Because we had a problem with the employees. They were not accepting the bonus. That's why we created a trust to keep this amount. And we appointed trustees. And ultimately, all the amount from this trust has been ultimately given to the employees when we settled the issue. But assessing officer said, no. Assessing officer said, you go read 40A9. What 40A9 says is, no deduction shall be allowed in respect of any sum paid by assessee as an employer as any contribution to any fund, trust, company, etc., which is unapproved. You make a payment to this trust, at that moment itself 40A9 will come. Whether ultimately it is paid to your employees or not, 40A9 have to be followed. This is what assessing officer said. And they started debating because both are right. Assessing officer, he said, is right. Initially, you make a payment to this trust. At that moment itself, 40A9 will come to the picture and there will be disallowance. Whether you ultimately make a payment to your employees or not, 40A9 will be there. So they started fighting and the case went to Supreme Court. And Supreme Court here invoked substance over form principle. What is substance over form? What is the real substance here rather than the form? The real substance is ultimately the payment have been given from the employer to the employee through a trust. Yes or no? Ultimately, there is a flow of payment from the employer to the employee through the trust, that too before filing returns also. Return of employer also. And hence Supreme Court said this should be allowed as a deduction in the hands of the employer. 40A9 is not applicable here by invoking substance over form principle. So this case was against assessing officer, or we can say this judgment was in favor of assessing. Is that clear? So ultimately in Shasan Chemicals, what happens is the Supreme Court invoked the concept of substance over form principle, and they said, anyways the payment is there. There is a flow of payment from the employer to the employee, and he should be given with a deduction as well. And hence we can say this is fully deductible in the hands of employer. I hope it is clear. So moving on, friends, with the next deduction, we will complete all the deductions now. So the next deduction is deduction on interest on borrowed capital. What do you mean by deduction for interest on borrowed capital? Very simple. You have taken a loan for your business or profession. If you have taken a loan, then you are supposed to pay what? Interest on that particular loan. Yes or no? So when you pay the interest or when you make the interest payment, that entire interest is allowed as a deduction under section 36, subsection 1, clause 3. That simply means if you have taken a business or a professional loan and there is an interest liability, that entire interest is allowed as a deduction under section 36, subject to one exception. What is that exception? That we have covered under actual cost. You have taken a loan for purchasing a capital asset, maybe a plant and machinery or something. And that plant and machinery requires some period to put to use. those interest, those proportionate interest until that asset is put to use have to be capitalized. The rest you can claim as a deduction under 36. That is the only point that you have to register here. I hope that also was clear. So when you purchase an asset, by taking a loan, the proportionate interest till the asset is put to use have to be capitalized and have to be a part of the actual cost. The rest you can claim it as a deduction under 36. And here also there is a case. There is a case that is called as Reebok India Company, which is cited by the Delhi High Court in the year 2018. So let's understand what is this Reebok India Company case. So listen. So Reebok, what they did is like, say for example, they took a loan of 10 lakhs. This is only a dummy figure, okay? They took a loan of 10 lakhs. These figures are actually dummy. Are you all here? In the real case, it is not 10 lakh. Only for the purpose of understanding the case, I am using a amount. They took a loan of 10 lakhs at 10% interest. At 10% interest. Then what they did is like, out of this 10, they give 4 lakh as a supplier advance. As a supplier advance. What is supplier advance? What do you mean by supplier advance? So they have given an advance to one of their suppliers for purchasing what? Raw materials. So they have given a supplier advance, and this advance was there for 2-3 years. This advance was standing like that for 2-3 years, and there was no interest for this advance. We can say it is an interest-free supplier advance. So we can say it is an interest-free supplier advance. What is interest-free supplier advance? Supplier is not supposed to pay any interest to Reebok. So assessing officer said, you have utilized only 6 lakhs for your business purpose. This 4 lakhs have been given to a third party, that too free of cost. So what assessing officer said is like, out of 10 lakh borrowing, you only utilize how much? 6 lakhs for your business or profession. 4 lakh have been given as what? An advance to a third party supplier, that too without any interest. It's an interest-free advance. So we say that you have only used 6 lakhs, only 10% on 6 lakhs is allowed as a deduction as an interest on borrowed capital. The rest 4 lakh we will not treat as your loan. It has been rerouted to a third party. But assessee said, no sir, supplier is a part of our business. Supplier is a part of my business, and hence I've given this 4 lakh to supplier for procuring some raw material. So that 4 lakh is also utilized by me for my business purpose. This was the contention of assessee. So they started fighting and the case went to Delhi High Court. The Delhi High Court said, assessee is right. What do you mean by supplier? Supplier have to supply raw material, then only you will be able to make your product and sell it. Yes or no? So supplier, you giving an advance to a supplier, that definitely is your business purpose. And hence, on this entire 10 lakh, you can claim 10% interest as a deduction. Here, assessing officer is not supposed to say supplier is not a part of business. Of course, yes, supplier is a part of business and all the advance given to the supplier will be treated as an amount utilized for your business only. Are you with me? So this is what the case, and the case name is Reebok India Private Limited. Now, let's move on. Not Reebok India, not private limited, sorry, Reebok India Company. So it's a public limited company. Let's move on with the next provision, friends. That is discount on zero coupon bond, which is under section 36 subsection 1 clause 3a. So let's understand what is this discount on zero coupon bond. Tell me, what is zero coupon bond? There is no coupon rate of interest. Annually, the company who issues the bond will never pay any interest. Normally, this infrastructure company and all issues zero coupon bond to the investor. Then let me ask you one question. Then why this investor will invest in that particular bond? What is the takeaway of the investor? See, this zero coupon bond will be normally issued at a very high discount. Normally issued at a very high discount. And at the time of maturity, the investor will get a lot of amount back. So we can say the interest in a zero coupon bond is paid by way of a capital appreciation. What do you mean by capital appreciation? See, for example, I'll tell you, say on 1st April 2021, say I'm a company called JK Limited. This JK Limited has issued a zero coupon bond. zero coupon bond having a face value 10 lakh, but the issue price was only 7 lakh. Issue price was only 7 lakh. Now you tell me how much is the discount here? 3 lakhs is the discount. So the investor is supposed to pay only how much? 7 lakh to the company for getting what? This 10 lakhs zero coupon bond. Now say the bond is for 3 years. The bond is for how much? 3 years period. Now the investor, after 3 years, every year the company will not pay any interest on that particular bond. At the end of the third year, the investor can redeem that particular bond and take back how much? 10 lakh from the particular company. Are you with me? So that's what I said. 3 lakh is a capital appreciation of that particular bond. Instead of giving annual interest, the company is giving 3 lakh by way of a capital appreciation. Are you with me? Now friends, what is the total cost of this company? During the period of issue of this zero coupon bond, what is the total cost for this particular JK Limited company? I will say 3 lakh. Why 3 lakh? At the time of issue, they got only 7 lakh. At the time of redemption, they are supposed to pay 10 lakh and hence 3 lakh is their total cost. Yes or no? So the 3 lakh rupees cost is allowed as a deduction under section 36 on pro rata basis. What is pro rata basis? You have to check the period of bond. How many years that bond is for? 3 years. Yes or no? So 3 lakh divided by 3. Every year you can claim 1 lakh as a deduction under section 36. It's claimed on a pro rata basis, normally monthly basis. You have to divide this 3 lakh divided by 36 months and into 12 months. The effect is same. Because I took 1st April 2021 as the example. Normally it have to be divided by the months criteria, divided by 36 and multiplied by 12. That's what you are supposed to say. So discount on zero coupon bond is allowed as a deduction on a pro rata basis during the period of life of that particular bond. Now friends, listen, there is one more point. Listen, say this bond is for 10 years. Then how do you take deduction? 3 lakh divided by 10. Every year you can take 30,000 rupees as a deduction. Every year 30,000 rupees will be your deduction. Now this is the perspective of company. For company it is a cost. And let's think from the perspective of investor. From the perspective of investor, it is a gain. Yes or no? From the perspective of investor, it is a gain. How much is his gain? 3 lakhs. So what department say? Zero coupon bond is a capital asset and transfer of or redemption of zero coupon bond is a transfer also. Zero coupon bond is a capital asset and redemption of zero coupon bond is regarded as the transfer as well. And what will happen ultimately? The full value consideration have to be taken as what? 10 lakh and the cost of acquisition have to be taken as 7 lakh and the remaining 3 lakh shall be what? Capital gains in the hands of the investor. Remaining 3 lakh shall be capital gains in the hands of investor. Are you all here? There are certain explanations in relation to zero coupon bond. How do you bifurcate month and all? Based on days and all, that is actually not at all required for our exam. That's why I intentionally skipped that topic. Are you with me? For the time being, understand, divided by the number of months and multiplied by the number of months in a year. Or we can do things like this also, because in my example, it was 1st April 2021. So a complete year I've used. So there won't be any difference in the answer. Normally what you do is, you need to apportion it on the basis of months. That too, while counting the days, there are certain explanations that are actually completely not required for our exam. So please don't waste your time on those things. Are you here? So the point is very simple. Discount on zero coupon bond is claimed as a deduction on a pro rata basis by the company. And the same amount will be taxable in the hands of the investor, under which head? Capital gains. Is that clear? Okay friends, so let's move on with the next deduction under 36, that is contribution towards RPF and superannuation fund. What is RPF? Recognized Provident Fund, and to superannuation fund, if the employer is contributing any sum, then how to claim it as a deduction? That's what we are about to discuss. So friends, listen, listen, in the case of a recognized provident fund, how exactly it works? Say for example, there's an employer and there is an employee. Alright, this employer, both the employer and employee have to contribute to this provident fund. Are you with me? What is basically provident fund? It is a kind of a saving scheme. It is actually a saving scheme which is actually initiated by both the employer as well as employee. Both will contribute and there will be interest element. At the retirement time, the employer can withdraw a lump sum amount for his post-retirement life. Now listen friends, say for example this employer is paying an employee 1 lakh rupees as salary. 1 lakh rupees as salary every month. And the employer will contribute 10,000 rupees to PF, Provident Fund, from his own pocket, out of pocket we can say. And from this employee's salary also, he will deduct same amount, 10,000. And he will pay only how much? 90,000 as salary every month to the employee. And he will deposit that 10,000 also to the RPF account. So every month the employer will deposit how much? 20,000. 10,000 from his own pocket and 10,000 deduction from the employee's salary. Normally employer contribution and employee contribution is the same. Unless otherwise there is something. Both the employer and employee contributes the same amount to the provident fund. Are you with me? Now listen, this employer contribution is actually his cost. This employer contribution is actually his cost. And for that cost he will get a deduction. That's what we are about to discuss. So listen. So what they are saying is any sum paid by employer towards a recognized provident fund or to an approved superannuation fund is allowed as a deduction and it is subjected to 43B. What do you mean by it is subjected to 43B? The employer have to actually make the payment. Employer have to actually make the payment to the respective provident fund account. Otherwise, he will never get it as a deduction. The employer contribution have to be actually paid from the employer to that particular respective fund. Then only he will get it as a deduction. Otherwise, he will never get it as a deduction. So listen, what was 36 subsection 1 clause 4 friends? It is very simple. You are being an employer contributing something to a recognized provident fund on account of your employee from your own pocket. That portion is allowed as a deduction. There are 4 types of provident funds. Number 1, recognized provident fund. Number 2, statutory provident fund. Number 3, unrecognized provident fund. Number 4, public provident fund. If the employer is contributing something to unrecognized provident fund, never allowed as deduction. That will be a disallowance. Are you with me? If the employer is contributing anything to an unrecognized provident fund, that will be a straight away disallowance. Next is statutory provident fund. If the employer is contributing anything to a statutory provident fund, that is allowed as a deduction under section 37. Because in the first day itself, I've told you, 30 to 36 is specific. What is specific? What all you can claim as a deduction have been specially notified. Under 36 subsection 1 clause 4, they only say contribution to RPF. That means recognized provident fund. If the employer is contributing something to SPF, statutory provident fund, then it is allowed as a deduction under section 37, not under 36. Now, employers will never contribute to PPF. What is PPF? Public Provident Fund. Employers will never contribute anything to PPF and hence you don't have to think about employers' contribution to PPF. So the moral of the story is if the employer is contributing to RPF 36, SPF 37, URPF no deduction, PPF not applicable. Are you with me? Yes. So moving on with the next item, that is employer's contribution to the account of employee under pension scheme referred under 80 CCD. So listen, just like PF, the employer has to contribute to NPS account. That is called as National Pension Scheme account. What is National Pension Scheme? So NPS means National Pension Scheme. Both the employer as well as employee have to contribute amount to the NPS, and this NPS will take care about the pension after retirement. Once the employee is retired, you will get pension from the NPS account. Now friends, when the employer during the course of employment of employee, he have to contribute something to the NPS. That is his cost. And for that cost, he should be given with a deduction. That's what we are about to discuss. So listen, if you are an employer and you are contributing to NPS for the benefit of your employee, you are an employer and you are contributing anything to the NPS for the benefit of your employee, it is allowed as a deduction for the employer under section 36. But there is a ceiling limit. The maximum deduction under 36 shall be 10% of your basic salary plus DA forms part of retirement benefit. The maximum deduction for the employer shall be basic plus DA forms part of retirement benefit of the employee. What is basic? Basic means basic salary. What is DA? DNS allowance. What do you mean by DA forms part of retirement benefits? Those DA which is considered by employer to compute retirement benefit of employee. Those DA which is considered by, what is basically DNS allowance? So DA means it's an allowance given by the employer to employee to meet the cost of living of employee. And if that DA considered by the employer to compute the retirement benefit of employee, then we will call it as what? DA forms part of retirement benefit. So basic plus DA forms part of retirement benefit. You take the total of these two, then 10% of these two shall be the maximum deduction under 36 for the employer. If he contributes more than this 10%, then excess shall be disallowed again under 40A9. So there are two categories of disallowances under 40A9. Number one, you are paying anything in the status of employer to an unapproved fund. Number two, you are paying more than 10% of basic plus DA to what? To the NPS account. Then that excess shall be disallowed under 40A9. I hope that also is clear. So this is all about 36 subsection 1 clause 4A. Now it's time for us to solve a problem in relation to this. So friends, please take question number 15. Please take question number 15. It's in page number 8. Page number 8, question number 15. Go through this question and give me the answer. So I hope you have completed that particular question. So friends, yes, listen. So let's do it together. Listen. What they are saying is, X Limited contributes 20% of the basic salary to the account of each employee under a pension scheme referred under 80 CCD. DNS allowance is 40% of basic salary and it forms part of the pay of the employees. Compute the amount of deduction allowable under 36 subsection 1 clause 4A if the basic salary of the employees aggregates to 10 lakh. Would disallowance under 40A9 be attracted, and if so, to what extent? So let's understand how much is the basic salary of in this question. How much is the basic salary in this question? It is 10 lakhs. And how much is the DA? 40% of basic salary. That will become 4 lakhs. Yes or no? They say the entire DA forms part of the retirement benefit. So indirectly what they said, it forms part of the pay of the employees. It forms part of the pay means it is an official DA, forms part of the retirement benefit. Now listen, how much is basic plus DA? 14 lakhs. How much is 10% of basic plus CA? 1 lakh 40,000. Yes or no? So this is the maximum deduction. Now let's understand how much is the actual contribution. Actual contribution is 20% of basic salary in this question. So 20% of 10 lakh will be 2 lakh rupees. And out of this 2 lakh, the maximum deduction is 1 lakh 40. The remaining 60,000 shall be a disallowance under section 40A9. This is the deduction under section 36, and 60,000 shall be a disallowance under 40A9. It's a pretty straightforward question. We don't require much explanation for this. I hope it is clear. So moving on with the next deduction. So that is contribution towards approved gratuity fund, which is under section 36 subsection 1 clause 5. So let's understand what is this contribution towards approved gratuity fund. Listen, Accrued gratuity fund contribution simply means, what do you mean by gratuity basically? What do you mean by gratuity, friends? Tell me. Gratuity simply means a gratuitous amount paid by the employer to the employee at the time of retirement or at the time of resignation. That's what we can say. Now, when the employer normally have to pay this lump sum amount from his own pocket to the employee, or instead he have an alternative. What he can do is, he can maintain an accrued gratuity fund. He can contribute to that accrued gratuity fund during the period of employment. At the time of retirement, that fund will make the gratuity payment to the employee. Are you with me? It is also an alternative. So if that employer is maintaining such an accrued gratuity fund, then he needs to contribute something to that accrued gratuity fund every year. So that contribution is from his own pocket and it is allowed as a deduction under section 36. So that's what we are about to discuss. Any sum paid by employer's contribution towards accrued gratuity fund created by him exclusively for the benefit of his employees under a irrevocable trust is allowed as a deduction. However, it is subjected to the provisions of 43B. What is 43B again? You need to actually make the payment to that accrued gratuity fund to claim it as a deduction. Otherwise, you will never get it as a deduction. Are you all with me? So, the point is very simple. If the employer is maintaining an accrued gratuity fund for the benefit of employee and employer gives a contribution to that particular accrued gratuity fund, then that contribution is allowed as a deduction under section 36 subjected to 43B. I hope that also is clear. Moving on to the next deduction under 36, that is employees' contribution towards staff welfare scheme. So I want all of you to go through this particular provision and you should tell me what exactly is this provision. So go through this provision and tell me, friends. Yes. So listen, the point is very simple. See, we will take the example of PF itself. All right. Provident fund itself. Earlier I've told you, to the provident fund there will be employer contribution and employee contribution. Yes or no? And the employee contribution is not paid by the employee directly to the fund. Instead, the employer deducts that contribution from the monthly salary paid to the employee. Hope you remember the example which I've drawn earlier. So this was the example, not this. This was the example. So employer from his pocket will contribute 10,000 plus he will deduct another 10,000 from employee's monthly salary. When he deduct that 10,000 from the employee's monthly salary, that deduction will be treated as employer's income, which is under section 224 clause 10. This is the first thing that they say. When an employer deducts employees' benefits such as PF, ESI, etc., etc., at the time of deduction, that will be treated as his income. Whose income? Employer's income. Then, to claim it as a deduction under section 36, the employer is supposed to make the payment to the respective fund on or before due date under the respective act. What is this respective act? In the case of PF, in accordance with the PF Act, that means the next month, 15th. In case of ESI, it should be in accordance with the ESI Act. Are you all with me? So whatever is the respective payment, the respective act's due date, the employer should remit it to the respective fund. Then only you will get it as a deduction. So they say you take it as income and you claim it as deduction. Why they are saying all these things? To correctly deduct the portion and make the payment on time, income tax department say you must deduct it. At the time of deduction, it's your income. And when you remit it, you claim it as a expense also. There is no impact for you. But you have to do this responsibility on time. That is the point. Are you with me? Now, let's understand it in a detailed manner, friends. Listen. So what they say is, any sum received by an employer from his employee towards maybe PF or any superannuation fund or any other fund set up under the provisions of ESI or any other fund for the welfare of such employees, like labor welfare funds or something, then is treated as income of the employer under 224(10), and subsequently when such sum is credited by the employer to the employee's account in the relevant fund On or before due date, you need to underline this. On or before due date of crediting such contribution prescribed under relevant act. So underline the relevant act also. What is this relevant act? In case of PF, PF Act. ESI, ESI Act. Whatever the relevant act is. Now, it is not the due date here doesn't mean due date of filing return. Normally when we say due date, in income tax, normally it is due date of filing return, but it is not like that. Here they say due date accordance with the relevant act. It's very strict. Alright. Yes. So you can claim it as a deduction as well. And there are actually two case laws. This is not actually required because CBDT have clarified the relevant act. Earlier, there was a case called Gujarat State Road Transport Corporation. It says relevant due date means due date according to the relevant act. And there was another case called Kitcha Sugar Mills, which is cited by the Uttarakhand High Court. And in Kitcha Sugar Mills, they say the relevant due date can be also read as due date under Income Tax Act. Alright, that was not right. So CBDT has clarified that relevant due date means in accordance with the relevant act, not the due date in accordance with the Income Tax Act. That simply means if it is PF, you need to remit it before the PF Act's due date. If it is ESI, you need to remit the payment before the ESI Act's due date. Are you with me? It is not in accordance with the return filing due date. That's what they say. So this case law is actually not that important for our examination purpose. So let's move on with the next deduction. I hope you guys are listening and you guys are with me. So friends, what if you have missed the due date and you have subsequently made the payment? Nothing will happen. It will be your income forever. It will be your income forever. You missed the due date. You made it a payment after that. Nothing. You will never get it as a deduction. You will never get it as a deduction. Are you all with me? Then don't think that it is actually good for the employer. He can keep the payment. It is not like that. In income tax, you will never get it as a deduction. In PF and ESI Act, there will be interest penalty and other things will come. Income tax department say, you miss the due date, you will never get it as deduction. That doesn't mean you miss the due date, you don't have to pay. You have to make the payment, otherwise you have to face the consequences in accordance with the relevant act. Listen, now let's move on to the next point, that is allowance in respect of dead or useless animals. So let's understand what is this allowance in respect of dead or useless animals. Again, it's a very simple point. So listen, say you are using a particular animal for your business. Say you are using an animal for your business. Alright. And that animal's cost, say you are using elephant for your business. And that elephant's cost, you purchased an elephant for 50 lakhs. You purchased an elephant for 50 lakhs. Are you with me? That is definitely a capital expenditure. But the point is, can you claim depreciation on that 50 lakhs? No, because you cannot call an elephant as any of the specified category assets, which is mentioned under 32. So hence, for claiming depreciation, it have to be a specified asset under 32. So you cannot claim depreciation. So what department say? You are using a live animal for your business, it is okay. When the animal become useless or when the animal dies, if you are getting something back from his sale of carcasses, that means sale of remainings. Say for example, your elephant died and you sold its tusk. Alright, the elephant died and you sold its tusk. Forget about its legality. Whether it is legal or illegal, it's not a matter of income tax department. You sold its tusk and you got how much? 10 lakh back. So department say you can claim your net cost is 40 lakhs. That net cost is allowed as a deduction in the year in which the elephant dies or elephant become useless. So at the time of purchase, you will never get it as a deduction. When the elephant in the subsequent year become useless or die, you are selling something on account of its remainings and you are getting some amount back. Net cost you take. That net cost is allowed as a deduction under 36. Are you with me? So they say the quantum of difference between the actual cost of the animal, in our example it was 50 lakh to the SSA, and the amount realized, if any, in respect of carcasses or sale of animals is allowed as a deduction. That means from the remainings you got 10 lakh. So the net cost of 40 lakhs is allowed as a deduction. In which year, friends? In the year in which either elephant dies or it become useless. Are you with me? Yes. So that is deduction for what? Dead or useless animals. Next is again a small deduction, that is bad debts. We have already discussed about bad debts. What is bad debt? What do you mean by bad debts? So friends, you tell me what is bad debts? So normally, when you make a credit sale, you will show that portion of credit sale as a part of your income. And subsequently, you understood that that person is not going to make you the payment. Then you will write off that particular payment from your books of accounts, and that is called as what? Bad debts written off. And departments say bad debts written off is allowed as a deduction. There is absolutely no problem. You can claim the bad debts written off as a deduction. There is no problem. But there is one point. You need to actually write off that portion from your books of accounts. Instead of writing off, you put a provision for bad and doubtful debts. Can you claim it as a deduction? The answer is no. Instead of writing off bad debts, if you put a provision for bad and doubtful debts, you will never get it as a deduction. You need to actually write off that particular bad debts rather than putting a provision. So, writing off bad debts is definitely allowed as a deduction. Now, friends, let me ask you one doubt. If you got that bad debts back, that means recovery of bad debts, then it have to be treated as your deemed income. Hope you remember, we have discussed that point. You got a recovery. Already you have written it off in your books and you claimed it as a deduction. Thereafter, that entire amount you got recovered. Then that recovered amount shall be your deemed income. But there is one problem. I'll tell you it as an example. So please listen. Say for example, everybody please be very attentive. Say for example, I had a credit sale. Of rupees 10 lakh. Then afterwards I understood that this person is not going to make me the payment. So I have written off this entire 10 lakhs in my books of accounts. But assessing officer told me that after conducting an inquiry told me that you will get back 3 lakh. You will get how much back? 3 lakh back. So I will allow you only 7 lakh as bad debt. Are you with me? So we can say there is a disallowance. I've claimed 10 lakhs as bad debt, but he disallowed how much? 3 lakh. And how much will be the net bad debts claimed as deduction? 7 lakh is the net bad debt I claimed as deduction. Are you with me? 3 lakh was disallowed by assessing officer. All these events happened in the year 2022-23. Now listen, in 2024-25, that debtor came to me and he paid me 1 lakh rupees. That debtor came to me and he paid me how much? 1 lakh rupees as a full and final settlement. What do you mean by full and final settlement? He will not give me anything more. He told me that I don't have money. I only have this 1 lakh with me. So you take that 1 lakh. Alright, that is the only amount that I can give you in my situation. So I said, okay. Now you tell me in 24-25, when I get this 1 lakh back, what should be the treatment of this 1 lakh? When I get this 1 lakh back in 24-25, what should be the treatment according to the income tax provision? You tell me. Say, in this example, assessing officer disallowed 3 lakh rupees on an expectation that you will get 3 lakhs from that particular debtor. Yes or no? So 10 lakhs was your total debt amount. You got only, you were expecting to receive 3 lakhs. So 7 lakhs is only allowed as a deduction. So after this, what is your expectation at the end of 22-23? You will get 3 lakh back. So there is a debtor of 3 lakh remaining. Yes or no? But you got only 1 lakh. That too a full and final settlement. That means you will not get the remaining 2. So that remaining 2 is allowed as a deduction. Deduction under section 36. That remaining 2 is allowed as a deduction in under section 36 in the year 24-25. For this 1 lakh, there is no treatment. Why? The entire 10 lakhs at the time of credit sale is shown as an income. Out of that, your contention was you will get nothing. But assessing officer said you will get 3 lakh back. You only got 1 lakh back. So that remaining 2 again can be claimed as a deduction. Or we can say it in like this also. 10 lakh was the total amount recoverable. You got only 1 lakh back. So your total loss is 9 lakh. You claim deduction only for 7 lakh. You can claim the remaining 2 lakh as well as a deduction. Are you with me? So we were discussing about the bad debts and its recoveries. I hope that too is clear for you. Now friends, I've already told you, if you create a provision for bad debt, then that provision is never allowed as a deduction under section 36. But for certain people, they can claim a deduction for provision of bad and doubtful debts. For certain people, say for example, like bank, then foreign banks, NBFCs, etc., they are given with a chance to create provision and to claim it as a deduction. And that's what we are about to discuss. That is provision for bad and doubtful debts in case of specified banks, which is under 36 subsection 1 clause 7a. So let's understand what exactly is this. Say if you are a scheduled bank or a non-scheduled bank or a cooperative bank, other than a primary agricultural credit society or a primary cooperative agricultural and rural development bank, you don't have to study this part. Okay, if you want, you can. This other than is actually not that important, but you should know a scheduled bank, non-scheduled bank, cooperative bank. You can create a provision and claim a deduction. You can create a provision and claim a deduction. But there is a maximum limit that you can claim as a deduction, that is, the maximum amount shall be an amount not exceeding 8.5% of their total income. You compute their total income, maximum provision shall be 8.5% of their total income. Now the question is, what is this total income? Normally, what is total income? Gross total income, you claim chapter 6A deduction. The rest, the remaining figure that you get is called as what? Total income. Here they define total income computed before making any deduction under this clause and chapter 6A deduction. What do you mean by that? Total income computed before making any deduction under this clause. What is this clause? 36 subsection 1 clause 7a. Why? For computing how much you can claim as a deduction, we need total income. Yes or no? We don't have this 36 deduction right now. So what they say is, you compute everything. You compute everything except this clause. Then you what? Compute your gross total income by adding the 5 heads, clubbing, set off, etc. You compute your gross total income. That gross total income's 8.5% is the maximum deduction under 36 subsection 1 clause 7a. So instead of that, they say you compute total income before taking 36 as well as chapter 6a deduction. That also means from gross total income, except you claim this deduction, or after claiming all other deductions, you take that figure, took 8.5% as the maximum limit for this particular deduction. Is that clear, friends? So you take 8.5% of this figure as the maximum deduction. Now, if you are a rural branch of banks specified above, what do you mean by rural branch? Rural branch of banks specified above. Say for example, there is a bank called, say, Federal Bank. Federal Bank. This Federal Bank has many branches in South India. Yes or no? They have many branches in South. The assessee is the one and only one Federal Bank. While computing the total income, the Federal Bank has to accumulate all the profit figures of all different branches. And on their gross total income, they can claim 8.5% as a provision. But if they have rural branches, along with this 8.5, they can claim 10% of their aggregate average advance made by the rural branch as an extra provision. If Federal Bank has what? Rural branches, along with the 8.5% of gross total income, they can claim an additional provision of what? 10% of aggregate average advances made by the rural branch. What do you mean by aggregate average advance? What do you mean by aggregate average advance? For a bank, advance means what? Loan. For a bank, advance means what? Loan given to the customers. So you take the aggregate average advance, which is computed as per prescribed manner. That manner we don't have to study. Which you compute the aggregate average advance. On that advance, you take 10% as what? The maximum deduction under 36 for rural branches alone. So friends, listen. Say Federal Bank has 2 rural branches. Then first you compute the total income of Federal Bank. Gross total income of Federal Bank just before this deduction. You claim 8.5%. Plus, you take the aggregate average advances of the 2 branches. Then you take another 10%. Every year, every bank can charge up to this without any other restriction. So everybody will claim this. Every bank will claim this particular reduction every year because it is a provision. What do you mean by provision? You have incurred a liability. It can be fairly estimated also, but it is not realized. It is about to come. You know that it will come. Are you with me? You have incurred a liability. You know that it will come in future. Right now it is not there. So you are transferring some amount to meet that future liability, which is already there. May or may not means contingent. May or may not means contingent. Normally for contingent liability, we don't create provisions. We probably give a footnote in the balance sheet. There may be one more liability in the future that is called as contingent liability. Are you with me? So be very careful with the terms, okay? Now, so the point is, friends, here what they say is, if you are a scheduled bank or a non-scheduled bank or a cooperative bank, then GTI 8.5%. If you have rural branch along with that, additional provision. How much? 10% of aggregate average advance. Now the question is, what do you mean by rural branch? Your branch is situated in a place where population is less than or equal to 10,000 as per the last preceding census. The last preceding census was in 2011. Thereafter, there was no census. It was supposed to be held on 2021, but due to Corona, we are not able to conduct another census. Okay, yes. So the point is, if you have rural branch, you can create an additional provision as well. Now friends, say you are a foreign bank or a public financial institution or a state financial corporation or a state industrial investment corporation or an NBFC, then the provision shall be 5% of the total income. And what is total income? The same definition. Total income computed before making any deduction under this section and chapter 6A deduction. So friends, listen, we can split this provision into two: for scheduled bank, non-scheduled bank, and for cooperative bank. 8.5% of their total income, plus if they have rural branch, additional 10% of their aggregate average advances. Category 2, foreign bank, then SFC, State Financial Corporation, State Industrial Investment Corporation, and NBFCs, instead of 8.5, it is 5% of their GTI, just before claiming this particular deduction. So every specified entity which is listed here in this table will claim this provision every year. And there is one more thing. Listen, every year I will claim this provision. Say this year I have claimed a provision of 10 lakh and my actual bad debt is 11 lakh. This year I have claimed a provision of how much? 10 lakh and my actual bad debt is 11 lakh. Now you tell me how much is the deduction for bad debt? 1 lakh only will be the deduction for bad debt. Why? I created a provision for 10 lakh and I will claim it as a deduction also. Actual bad debt is 11. So my bad debt extra is 1. That 10 lakh provision is for the bad debt. That 10 lakh provision which I created and claimed as a deduction is for the bad debt. If my actual bad debt is over and above the provision only, I can claim it as a deduction. If my actual bad debt is less than provision, then don't take any deduction because already provision is allowed as a deduction for the specified entities. Is that clear? Is that clear? Because the examiner will definitely trick you with these kinds of things. Are you all with me? So let's solve a problem in relation to this, friends. So please take question number 16 and solve it by yourself. Go through this question number 16, take 2 minutes and try to solve the answer. So what they are saying is, listen. So the following are the particulars in respect of a scheduled bank incorporated in India and provision for bad and doubtful debts under 36 subsection 1 clause 7a up to assessment year 22-23 means what? Up to previous year 2021-22 you have already created a provision up to how much? 100 lakh rupees. Gross total income for assessment year 23-24 before deduction under 36 subsection 1 clause 7a. That means before claiming current year deduction for provision, the gross total income figure is 800 lakhs. Are you with me? Then aggregate average advances made by rural branches of that bank is also given 300 lakhs. Bad debts written off for the first time. What do you mean by for the first time? For the past, they didn't have any bad debts. They only create provision. This is the first time that they have come up with a bad debt scenario. In the books of accounts, in respect of urban advances only, during the PY, 22-23. If the first time bad debt is how much? 210 lakhs. Compute the deduction allowable under 36 subsection 1 clause 7. That is how much bad debt can be claimed as a deduction this year. That is the question. Are you with me? So let's compute. The first thing that you have to do is how much is the provision amount till past year or till PY 2021-22. The total amount of provision. How much is that? Total amount of provision which is already allowed as deduction as per this question is how much? 100 lakhs. Yes or no? And now tell me, the first thing that this company will do is create a current year provision. So let's create current year provision. So current year provision. So current year provision, being a scheduled bank, how much is the current year provision? First you find out the gross total income of that particular bank before claiming deduction for current year provision. That is already given in the question, that is 800 lakh. You can claim 8.5% as the current year provision first. You tell me how much is 8.5% of 800 lakhs? 68 lakh. Now you tell me current year provision, since he have rural branches, he can take an extra provision for that also. And the aggregate average advance is also given in the question, that is 300 lakhs. You can claim 10% of that. How much is 10% of 300 lakhs? 30 lakhs. So you tell me how much is the current year provision? He can create 98 lakhs as a provision and claim it as a deduction. Are you all with me? Now, how much is the total provision till 22-23 year end? How much is the total provision till 22-23 year end? 198 lakh. Now you tell me how much is the actual bad debt? Bad debt, that too for the first time. That too for the first time in 22-23. That is 210. Anyways, out of the 210, 198 will be allowed as a deduction for provision for bad debt. Yes or no? So how much is the balance amount? The balance bad debt figure will be 12 lakhs. And that 12 lakhs is allowed as a deduction for actual bad debts. Hope you remember my example. If you have already created a provision and claimed it as a deduction, then the actual bad debt have to be over and above your total provision to claim it as a deduction for bad debts. Are you with me? So here what assessee did is, he created provision till 21-22, it was 100 lakh. He will create a current year provision anyways, that is 98 lakh. And total provision that he created till 22-23 is 198 lakh. And the current year actual bad debt for the first time is 210 lakh. And the actual bad debt is over and above the provision till year end. And so the excess amount only can be claimed as a deduction for bad debts. I hope that is also clear. Is that clear? Okay friends, so let's continue the other deductions under 36. So yes, moving on with the next deduction, that is deduction in respect of special reserve. This is not at all an important one, but only for the sake of explaining, I am completely covering this as well. Deduction in respect of special reserve, which is under 36 subsection 1 clause 8. So listen, deduction is allowed in respect of any special reserve created and maintained by a specified entity in respect of reserve created from eligible business. So three things you have to know. Number one, what is special reserve? Number two, who is specified entity and what is this eligible business? If you are a specified entity that does eligible business, then you can create a special reserve and you can claim deduction. Repeat with me. If you are a specified entity who is in eligible business, you can create a special reserve and claim a deduction. Now, first of all, let's understand how much is allowed as deduction. The deduction shall be least of the following. The reduction shall be what? Least of the following. Limit number one, amount transferred to reserve account during the previous year. Just like the amount that you deposited in the reserve during the year is the first limit. Amount deposited in the reserve. Point number one. Or 20% of the profits derived from specified business of providing long-term finance. So friends, the eligible business means what? Long-term finance. From that, you compute the profits. On that profits, you claim 20% as the second limit. And the third one is twice the amount of paid up capital paid up share capital and general reserve less aggregate amount carried to special reserve account. What do you mean by that? You take twice the value of your paid up share capital and general reserve, then you deduct it by the total amount in the reserve. That is limit number 3. You take these 3 amounts, compare these 3 and pick the lower figure. That lower figure will be your deduction under 36 subsection 1 clause 8. Now there are a few more clarifications required in this. Who all are specified entity and what all are the eligible business? You don't have to by heart all these things, okay? Only for information I am telling you. So number 1, a financial corporation specified in section 4A of Companies Act 1956, or a financial corporation which is a public company or a banking company or a cooperative bank which is in the business of providing long-term finance for industrial or agricultural development or development of infrastructure facility in India or development of housing in India. Second category, HFC, that is a housing finance company in the business of providing long-term finance for the construction or purchase of residential house in India. And the third one is any other financial corporation, including a public company, in the business of providing long-term finance for the development of infrastructure facility in India. You create a special reserve, then you will get a deduction. And what all are the deductions? What all are the limits? Lowest of the following. Which all are the limits, friends? Number 1, amount transferred to the reserve. Number 2, 20% of the profits. Number 3, twice the amount of share capital and general reserve deducted by the amount carried in the reserve till past year. So that 3 amounts you compute, whichever is lower shall be the deduction. And there is one more thing. If you withdraw any money from this reserve in future, entire withdrawal shall be your deemed income irrespective of its purpose of utilization according to section 41 subsection 4A. That simply means this is not a permanent deduction. This is only a deferment of taxation. What do you mean by deferment of taxation? In the year in which you deposit, you will get a deduction. When you withdraw the amount, that amount is a deemed income under 41 subsection 4A. So technically it is not a deduction. It is basically what? Create reserve and take deduction. You can defer your taxation. Ultimately, when you withdraw amount from the reserve, you need to pay taxes for that particular amount. That's what the department says. And the deduction is under 36 subsection 1 clause 8. Again, friends, you don't have to study the clause numbers and all. But you should know whether it is a part of section 36 or not. The clause numbers are not that important, but it is better to study the section numbers. Moving on with the next one. Next one is important. Expenditure on promotion of family planning among employees. So listen, friends, if you are a company assessee, only you can take this particular deduction. So this deduction is applicable only for whom, friends? Company assessees who expend something to promote family planning among their employees. You tell me, what is family planning? So, to control the population, if you are being an employer, you are taking an initiative to conduct some programs or to expend something among your employees, then you can claim that cost as a deduction. So, listen, friends, it is for company assessees who incur any expenditure to promote what? Promote family planning among employees. Alright, now listen, this can be divided into 2, friends. If you are incurring any revenue nature expenses, then you can claim it as a deduction in that year itself. If you are incurring anything related to capital nature, then it is allowed as a deduction in 5 equal annual installment. So you are incurring anything which is in nature of capital, you can claim it as a deduction in 5 equal annual installment. That's what the department says. Are you with me? What is this capital and what is this revenue? Say for example, an employer being a company assessee installing a machinery to dispense medicines or pills for the employees. The employee with an employee card, if they swipe, they will get free pills. Alright, if he installs such a machinery in the premises, then that is a capital expenditure. To fill medicines, he need to spend, that is a revenue expenditure. So the capital expenditure, he can divide it into 5 equal installment and claim as a deduction. The revenue to fill the medicines, all the expenditure you can claim in that year itself. Are you with me? But for claiming this deduction, you have to be a company assessee and you should incur some expenditure to promote family planning among your employees. I hope it is clear. Now friends, if there is any unabsorbed capital portion family planning expenses, then that can be carried forward to unlimited subsequent years, similar to unabsorbed depreciation. The treatment is actually similar to what? Unabsorbed depreciation. If you have any unabsorbed capital portion of family planning expenditure, you can carry forward to unlimited subsequent years. The treatment is actually similar to what? Similar to our unabsorbed depreciation. I hope that also is clear. Now, let's move on, friends. Moving on to the next deduction, that is deduction for expenditure incurred by entities established under any central, state or provincial act which is under 36 subsection 1 clause 12. Again, it is not at all an important deduction, but let's cover that too. Any revenue expenditure not applicable capital expenditures. That means any revenue expenditure incurred by a corporation or a body corporate by whatever name called, if it is constituted or established by central government or any provincial act. Such corporation or a body is notified by central government in the official gazette for this purpose, and the expenditure is incurred for the object and purpose authorized by the act under which it is constituted and established. Accordingly, the central government has notified Oil Industry Development Board for the purpose of deduction under 36 subsection 1 clause 2. Simply, it means if you are a corporation or a corporate established by state, center or any other provincial act in India, you have incurred something for the notified activity under the respective act. What is the respective act? The act under which you are formed. You have expended something in accordance with that particular act. Whatever expenditure that you have incurred, whether it is related to your object or not, you can claim it as a deduction under income tax while computing your income. Are you with me? If you are a statutory body, just like created under any state or center or any provincial act, and you have expended something in relation to that respective act, that amount irrespective of its nature, except capital expenditures. Capital expenditure you need to capitalize and claim depreciation. All the revenue expenditure you can claim it as a deduction under 36 subsection 1 clause 12. Is that clear, friends? Again, it is not relevant for us for our examination purpose. Moving on to the next item is deduction for contribution by a public financial institution to credit guarantee fund trust for small industries. Again, not required for our exam, but still provides for a deduction of any sum paid by a public financial institution by way of a contribution to such credit guarantee fund trust for small industries notified by central government. You are a public financial institution and you are giving some amount to a credit guarantee fund trust which is applicable for small industries, which is notified by CG. You can claim it as a deduction. What is this credit guarantee fund, friends? For small scale businesses, even without collaterals, these public financial institutions give what? Give loans. They provide this credit guarantee fund provides what? A guarantee. And for that, there is a payment for this public financial institution. They will provide the guarantee. If there is any default, this credit guarantee fund trust will give a smaller portion of amount. To uplift the small industries, it is actually notified by central government. So all the payment given by this public financial institution to this credit guarantee fund is allowed as a deduction. Again, not relevant for us. Moving on to the next deduction, that is deduction for security transaction tax paid, which is relevant for us. Deduction for STT. Tell me what is this STT, security transaction tax? So if you are a person who are actually buying or selling a listed security or a share, you need to pay security transaction tax directly to the government. It's also a direct tax. Are you with me? So the point is, can you claim the STT paid by you as a deduction under 36? The answer is very simple. If your business income is on account of transfer, that means purchase or sale of securities, then you can claim the STT paid as a deduction. If your business income is from purchase and sale of securities, then you can claim STT paid as a deduction, otherwise not. For others, you cannot claim STT paid as a deduction. Say for example, I'm a practicing chartered accountant. I've purchased some securities, some listed securities for the purpose of investment. At the time of purchase, I need to suffer what? STT. Can I claim it as a deduction under section 36? No. Basically, that purchase and sale of share will come under capital gains only. Under capital gains, you cannot claim STT as a cost. Section 48 clearly restricts that. While computing capital gains, nobody is supposed to claim STT as a deduction. And hence, STT can be claimed only as deduction for those persons whose main business is buying and selling securities. Moving on. Next is deduction for commodity transaction tax. What is CTT? Commodity transaction tax. When you buy and sell commodities through a recognized stock exchange, you need to suffer CTT, which is similar to STT. Now the question is, can you claim the CTT as a deduction? Answer is pretty simple. If your business income is from purchase and sale of security, you can claim all the CTT as a deduction, otherwise not. It's as simple as that, STT and CTT. Now, moving on to the next deduction. These two are actually required, okay? These two deductions, STT and CTT, is actually required. Next is actually not required, but still, amount of expenditure incurred by a cooperative society for the purchase of sugar cane at a price fixed by the government, allowable as deduction. Say, for example, amount of expenditure incurred by you are a cooperative society and you are purchasing a sugar cane at a price fixed by the government. That entire purchase cost is allowed as a deduction, again not required. So moving on, that is mark to market loss, which is under 36 subsection 1 clause 8. So for this, is this important? Again, not important, but let me tell you what exactly is this mark to market loss. Listen, how do you value your inventories? How do you value your inventories in accountancy? Normally, the principle that we follow is either at the cost or market value, whichever is lower. Yes or no? ICDS 2, that is Income Computation Disclosure Standard 2, also says the same. If you are inventory, you have to value your inventory at cost or realizable value, whichever is less. So every year you need to revalue your inventories. When you are revaluing your inventories, you will incur some expenses, some losses. That loss is allowed as a deduction. That is called as marked to market loss. When you revalue, if there is any loss that you incur, you can claim it as a deduction in accordance with ICDS. I hope it is also clear. What is ICDS? Income Computation Disclosure Standards. Whatever loss that comes in relation to ICDS, you can claim it as a deduction. One of the examples is ICDS 2, valuation of inventories. So these all are the items under section 36. Now we are about to start the next and the last deduction section, that is section 37, which is also called as what? Residuary expenses. So let's understand what exactly is this residuary expenses. I hope all of you are listening. So listen friends, residuary expenses means from section 30 to 36 everything was specific. Everything was specific. Section 37 says if you have incurred any other expenditure which is not covered under 30 to 36 and the expenditure is solely for your business purpose, then subjected to conditions under 37, you can claim it as a deduction. You have incurred any expenditure for your business or profession which is not covered under 30 to 36, but it is for the purpose of your business or profession, then you can claim it as a deduction under 37, subjected to conditions mentioned under 37. So first of all, let's understand which all are the conditions under 37. For claiming a particular expenditure as a deduction, you need to satisfy all the 8 conditions listed here. That's the first requirement. For claiming a particular expenditure as a deduction, you need to satisfy all the conditions mentioned here. So let's start with the conditions first. Condition number 1. The expenditure should not be of nature described in section 30 to 36. What do you mean by should not be of nature? Should not be. If it is covered under 30 to 36, you go and claim deduction in the respective section. Why you are coming to 37? Not possible. If an expenditure is covered under 30 to 36, you will not get it as a deduction under 37. That is the first thing that you should know. Point number 2, it should not have been incurred by the assessee it should have been incurred by the assessee in the accounting year. The current year expenses, you can claim it as a deduction. Point number 3, it should be in respect of business carried on by the assessee, the profits of which are being computed and assessed. So the profits, see, this that all the deduction under section 37 is always business specific. Say for example, you have two businesses, one specified business and one normal business. For all expenses of normal business, you can claim it as a deduction under normal business. Specified business expenses, deduction have to be claimed under specified business. Don't interchange. If you have two normal businesses, then also you are not supposed to interchange. But even if you interchange, there is no problem practically. But in examination, if you have multiple businesses, when you compute 37 deduction, you need to be very careful with it should be business specific. Now, moving on. It must have been incurred after the business was set up. Pre-commencement expenses are not supposed to be claimed as a deduction under 37. Why? Because you have a separate section called 35D for claiming your pre-commencement expenses. So pre-commencement expenses are not supposed to be claimed as a deduction under 37. Moving on, it should not be in nature of any personal expenses of the assessee. Your personal expenses are not supposed to be covered under section 37. Your personal expenses are not your business expenses, hence you are not supposed to claim. Moving on, it should have been laid out or expended wholly and exclusively for the purpose of such business. What do you mean by that? The business exclusivity is a mandatory factor. Say for example, I require shirt, I require clothes to take classes. Can I say that this clothes is a business expenditure? No. These clothes are there by me always, not when I take classes. When I go out, if I am removing this clothes, then it is right. Are you all with me? Say for example, to take classes, I need to have food. So I'm saying that I'm having food only for my profession. No, having food is for me. All right, profession is after that. So those expenditures which are exclusively incurred for your business only is allowed as a deduction. Otherwise, what will say? I will say, I require a home to sleep. Only after getting proper sleep, I will be able to take classes. So the residential house which I own is a professional capital asset. Can I say things like that? No. If an expenditure is exclusively incurred for your business, then that is allowed as a deduction. Otherwise, it is not. Again, it should not be in the nature of capital expenditure. If it is a capital expenditure, you tell me what should be the treatment? Capitalize and claim depreciation. If it is a scientific research capital expenditure, you claim it as a deduction under 35. If you are a specified business, you can claim it as a deduction under 35AD. I hope you are with me. Don't come and take it as a deduction under 37. And finally, the expenditure should not have been incurred by the assessee for any purpose which is an offense or is prohibited by law. Say for example, I'm a goods transporting agent. One of my client told me that I have to deliver some goods urgently from Chennai to Coimbatore within 4 hours. So I've overspeeded and all the traffic cameras. Is there any traffic camera here? In Kerala, there are a lot of traffic cameras. Likewise, here all the traffic police came to me and they fined me. So that fine is actually a business expenditure basically, because one of the demands from my client was to deliver it on time. That's why I overspeeded. But it is a penalty due to violation of law. Hence, I can never claim it as a deduction. So, if an expenditure is in relation to any offense or which is prohibited by law, then that particular expenditure is never allowed as a deduction under 37. So, these are the 8 conditions. If you satisfy the 8 conditions, you can claim an expenditure as a deduction. Now, can you tell me a few items that can be claimed as a deduction under 37? So examples for 37 deductions are salary, power and fuel, printing and stationery, then food allowances, miscellaneous expenses, everything will come under section 37. Now, listen, there are a few things that you should know in relation to 37. Let's discuss each and every point under 37. Listen, the first thing is, if an employer is paying any premium on keyman insurance policy, then that entire premium paid is allowed as a deduction under 37. Are you with me? If the employer is suffering any key man insurance policy premium, that is fully allowed as a deduction under 37. In relation to that, in case of a firm, premium paid by the firm on key man insurance policy of a partner also is an admissible deduction under 37. A partner, say for example, a partnership firm is taking a key man insurance policy on the life of partner. Both the partner and partnership firm are same actually. But the partnership firm, in the eyes of Income Tax Act, is a separate person and the partner is another separate person. And hence, if the partnership firm is taking a human insurance policy on the life of partner also, the premium paid is an allowable deduction under 37. Moving on. Next is, hope you remember, any expenditure which is an offense or is prohibited by law is never allowed as a deduction. In relation to that, department has issued certain explanations and clarifications. Let's understand which all are the explanations that they have inserted in line with that point number 8. So, first explanation, I will explain it by way of an example. Listen, say for example, I am a pharma company. I am a pharma company and I am giving freebies or gifts to doctors. I am giving freebies or gifts to doctors. What do you mean by freebies or gifts? Not samples. Medicine samples are not freebies or gifts. Say for example, if a doctor prescribed this particular pharma company's medicine and he achieves a target, this pharma company will give him a TV or a washing machine or a fridge or a foreign travel, like that. These are called as freebies. Free samples are not freebies. Free samples will be given to test the quality of that particular product. That is permissible. You with me? So, if the pharma company is giving gifts or freebies to the doctors, to the practicing doctors, it is totally opposed to the public policy. But it is not prohibited by any act in India. The pharma companies who are actually giving freebies to the doctors is not prohibited by any act in India, but it is opposed to public policy and it opposed to the code of ethics of IMA. Indian Medical Association clearly states that no doctor is supposed to accept any freebies from any pharma companies. So if the pharma company is giving any freebies, it is actually a cost to the pharma company. Yes or no? It is actually a cost to the pharma company, but this payment is against the code of ethical standards issued by Indian Medical Association, and hence the pharma company cannot claim this cost as a deduction. So department say if any payment is against any professional code of conduct or ethical standards in India, that payment is not allowed as a deduction under 37. Are you with me? If any payment is in violation of any code of ethics or ethical standards in India of any professional body, then that particular payment is never allowed as a deduction to the person who makes the payment. Are you with me? This is under 37. This is to protect the public policy. The explanation, the first explanation which I was saying is what? The pharma company, if they are giving freebies to doctors, then that is against the ethical standards of a particular IMA, and hence it is not allowed as a deduction for the pharma company. Then, next point in relation to that is, say listen, when you have violated a law and there is a payment for that, like a penalty or a fees for violation of law, you cannot claim it as a deduction. Say you have violated a foreign law and you paid a penalty in the foreign country, can you claim it as a deduction in India? Again, the answer is no, because the department say law means both the Indian law and foreign law. You have violated any Indian law or foreign law, if for that you have paid any fees or a penalty, that amount cannot be claimed as a deduction. Are you with me? Yes, point number 3, say you have, even before penalizing, you paid a compounding fee. You paid a compounding fee to settle a case. Say for example, there is a prosecution was about to start against you. Or example I will give you, say you have violated municipal law. You have violated what? Municipal law. You built a building by violating municipal law. You didn't get the completion certificate. The municipality told you to pay a amount as a compounding fee to get what? To get the license. You paid that particular compounding fee. That compounding fee is in the nature of a penalty and hence it is also not allowed as a deduction. So 3 things. Any payment which is against the ethical standards or code of conduct of a professional body in India, not allowed as a deduction. Number 2, violation, payment for a violation of foreign law is also not allowed as a deduction in India. Point number 3, any compounding fee paid by you is also not allowed as a deduction. Are you all with me? Along with that, I want to add one more point. Say for example, there is a thing called contractual penalty. What do you mean by contractual penalty? Say you have entered a contract with some other person and you have violated some provisions of that particular contract. You paid a penalty to that particular person. Can you claim that penalty as a deduction? The answer is yes. Contractual penalties are not in relation to violation of any law. It is not violation of Contract Act. Contractual penalty simply means your payment will be comparatively high if you violate these. conditions. So contractual penalties are actually not penal in nature, and hence it is fully allowed as a deduction. Are you with me? Next is in relation to GST. Can you claim GST as a deduction in income tax? GST paid depends upon the factor that whether you claim input tax credit or not. If you are taking input tax credit, then GST paid is never allowed as a deduction. Why? Because it is not your cost. You are recovering it from the GST collected from your customer. Yes or no? So those persons who are taking input tax credit, GST paid is never a deduction. And for those others who are not taking input tax credit, GST paid is definitely your cost. That simply means if you are routing GST through your P&L, then it is a cost. Routing GST through your P&L when you are not taking input tax credit. If you are taking input tax credit, GST paid by you will become an asset. Yes or no? Basic accounting, it will become your asset as a current asset. Then it is not your cost. Then another thing, how about GST interest liability? So you paid some GST interest. Can you claim it as a deduction? The answer is yes. GST interest is not a penalty. It is compensatory in nature for the delayed payment, and hence GST interest paid by a person is allowed as a deduction. I hope you guys are noting it down, okay? GST interest paid by a person is allowed as a deduction. Next, how about late filing fee? Can you claim late filing fee as a deduction? The answer is no. Late filing fee, even though it is called as a fee, it is in nature of a penalty, and hence you cannot claim it as a deduction. Are you all listening? Now, how about income tax paid? Can you claim it as a deduction? No, it is a specific disallowance. Income tax paid, its interest, surcharge, cess, its penalty, etc. shall be fully disallowed. Another thing, say I taken a loan to pay my income tax liability. I've taken a loan to pay my income tax liability. Can I claim interest of that particular loan as a deduction? Again, no. The department say no. Even payment of income tax is not a deduction. I've taken a loan for paying an income tax liability. That loan's interest is also not deductible. Are you guys listening? Moving on to the next one. How about CSR expenditure? Can you claim CSR expenditure as a deduction? CSR expenditure, corporate social responsibility expenditure. The income tax department say no. You cannot claim any CSR expenditure as a deduction under section 37. Why? Because it is a company's obligation, not a income generating expenditure. And hence, all the CSR expenditure suffered by a person is never allowed as a deduction. Then, moving on. Can you claim a political party donation as a deduction? Can you claim a political party donation as a business expenditure? Not deduction, business expenditure. Do you have to pay donations to the political party in India for carrying out your business? The answer is no. So the point is, if you are giving any donation to a political party, that donated amount is not your business expenditure, but you can claim it as a deduction under 80GGB if you are a corporate assessee, or 80GGC if you are a non-corporate assessee, subjected to one condition, that the payment should be in any mode other than cash. It's a chapter 6A deduction. So every assessee can claim what? Chapter 6A deduction if you have given any political party or a contribution to an electoral trust also. What is electoral trust? Say for example, if you are, it is just an institution to fund political parties. Say for example, a charitable trust does what? They will find the poor people and they will help the poor people. Likewise, there is a thing called an electoral trust, and you can give donation to the electoral trust. They in turn will give donations to the needed political party in India. Are you all with me? So if you are donating anything to electoral trust also, you can claim it as a deduction. So if you have given any donation to a political party or electoral trust, then it is allowed as a deduction under 80GGB or GGC, not under section 37. Likewise, if a company or an assessee has given any advertisement in a political party magazine or brochure or tract or a pamphlet, then that also will be considered as a political party donation. If you have given any advertisement in a political party magazine or a brochure or a tract or the notice, etc., that will not be treated as your business promotion expenditure. That will be treated as a political party contribution. And hence, what will be the treatment? That will be disallowed under section 37, and you can claim it as a deduction under 80 GGB or GGC. Company SC GGB, other SC GGC. Are you all here? Now, moving on to the next point, friends. Say, for example, you are a production company. You are a production company and you have abandoned a particular feature film, just like Marudu Nayagam. Alright, say I'm a production company. I was the one produced Marudu Nayagam, and what I've did is like, I've completely abandoned that particular movie. Marudu Nayagam is a movie. Okay, those who don't know about that movie, it's a movie. So I'm a production company and I've started shooting a movie. Thereafter, I completely abandoned that particular project. I can claim that entire cost as a deduction from my production business. All the abandoned movie cost, I can claim it as a normal business expenditure under section 37. All the actors payment, all the production cost, etc. can be claimed as a deduction under 37 while computing my profits. Then, next point, there is a CBDT clarificatory note in relation to that. Listen, the CBDT clarified that the cost of construction on development of infrastructure facility being road or highways under BOT projects may be amortized and claimed as allowable business expenditure. However, the whole of the cost incurred in creation of the infrastructure facility of a road or highway is amortized evenly over the period of concessionary agreement after excluding the time taken for creation of such facility. What do you mean by this? BOT projects, friends. Have you heard about BOT projects? So BOT means built on toll. That simply means, I'll tell you one thing. Say, I have expended 100 crore rupees to build a flyover. Are you all listening? I built a big flyover. Expended how much, friends? 100 crore rupees. And government told me I can collect toll for how many years? 10 years. Government told me I can collect toll for how many years? 10 years. Then this 100 crore expenditure is not my capital expenditure. It is capital nature, but I cannot capitalize it. Why? I cannot capitalize it and I cannot claim depreciation. Why? Because that flyover is not owned by me. I have to hand it over to the government. Yes or no? I only have a right to collect toll. So that entire 100 crore, what I'm supposed to do is, I need to amortize it over the period of concessionary agreement under section 37. So 100 crore for 10 years means every year I can claim 10 crore as my cost under 37. I cannot capitalize it as a part of my capital asset. Why? Because I'm not the owner of that particular flyover. Due to that expenditure, I only have a right to collect a toll from the persons who are using that particular flyover. So what department say? All the infrastructure cost incurred by me can be claimed as a deduction throughout the period of the concessionary agreement. If it is for 100 years, then 100 crore divided by 100. If it is for 30 years, 100 by 30. Likewise. I hope it is clear. And the deduction is allowable under section 37 itself. So friends, now it's time for us to discuss some case laws in relation to section 37. The first case law is Orion Ceramics and Industries Limited, which is cited in 2013 by the Delhi High Court. What Orion Ceramics and Industries, what they did is like, they put some glow signboards. What do you mean by glow signboards? Those boards which are painted in fluorescent color and all. Those you can see at streets. It is just like a name board which is painted in fluorescent colors for a better visibility. So the SSC have put some glow signboards for promoting their business, and he have incurred some expenditure for this. Assessing officer told SSC that these expenditures are capital in nature since the amount of expenditure was huge. AO told SSC that it is in capital nature and hence you cannot claim it as a deduction under 37. But SSC said no. SSC said no, I will claim it under section 37, and this was the debate whether it can be treated as a revenue expenditure and claim it under 37 or whether it should be a capital expenditure. The Delhi High Court said this glow sign boards have a life. Every year you need to repaint it for getting its maximum effect because that glow paint will automatically fade away. Yes or no, due to the climatic changes and all, it will get faded. So, and hence, if you want to get 100% out of this glow signboard, you need to repaint it, not repay, repaint it. And hence they say it is an yearly expenditure and you can treat it as a revenue nature expenditure and claim a deduction under 37. That was the case Orion Ceramics and Industries Limited, cited by the Delhi High Court in the year 2013. I hope it is clear. Is that clear? So moving on to the next case law, friends, that is Priya Village Roadshows. Hope you heard about this particular company. It is called as PVR. Priya Village Roadshows. So what PVR did is like, they want to convert their existing theater into a multiplex complex. They have plans to convert their conventional theater into a multiplex complex. So what they did is like, they have conducted a technical viability study or a feasibility study, etc. or a tech or a feasibility study based on conversion of a theater into multiplex. Then they completely abandoned that particular project. They thought of dropping that particular idea. They dropped that particular idea and they claimed this entirely technical or a feasibility study cost as a deduction from their normal business. And the department say it is huge in nature. That technical study that amount was very high, and department say it is not allowable as a deduction under 37. And ultimately Delhi High Court said, if they have conducted a technical study and they have incurred an expenditure to convert a theater into multiplex, if the theater came into existence, then it is in capital nature, because that expenditure has to be incurred for bringing in a new asset. If that project is completely abandoned, then you can claim that entire as a revenue nature cost under 37, because capital expenditure means an expenditure incurred for getting an enduring benefit, or to bringing in an asset, or to expand the value of an asset, or to increase the life of an asset, or to increase the volume of an asset. If the asset itself is not coming and that expenditure in relation to your existing business, then you can claim it as a deduction under section 37. Are you with me? So what they said is like, since the new theater is not came into existence, you can claim all the technical viability study as a expenditure from your existing business, because your existing business is theater business. It is in line with the activity and hence you can claim it as a deduction under 37. I hope that is also clear. Moving on to the next case, it is Hindustan Zinc Limited, which is cited in the year 2010 by the Rajasthan High Court. It is actually a fantastic case law. So let's understand what is this Hindustan Zinc Limited. So Assasi had a smelter plant. What do you mean by smelter plant? A smelter plant means where it is like you, process iron ore. You heat the iron to make it as iron ore and all. So it requires a lot of water to cool that smelter plant. They require a lot of water to cool their smelter plant. Are you all listening? So, since the case is in Rajasthan, the Assasi also will be in Rajasthan. So, maybe he had a problem with water. So, what it is like, there was a dam. There was a dam nearby which is owned by the state government. So, what he did is like, he incurred some expenditure to renovate the dam. The dam was an old dam which was not at all working. Alright, this Assasi expended something to renovate the dam. So there was some expenditure to renovate dam. And they made a request to the state government that since we have expended something to renovate the dam, you please give us some water from dam. We expended everything. We made that dam working condition. State government can make use of the dam either to, give water or to generate electricity or whatever it is. You give us some water since we have expended something on it. State government agreed that. And the Assasi claimed this entire renovation expenditure as a deduction under 37. Assessing officer said, no, you cannot claim this as a deduction under 37. Why? Because it's a capital nature expenditure. You have expended the dam. And hence there is what? The life of the dam went up. There is more life, useful life for the dam after the renovation expenses. So it cannot be claimed as a deduction under section 37. But Rajasthan High Court said the dam is not owned by what? The Assasi. Assasi expended something for the dam. In return, he got water. It is just like giving money and purchasing water, and hence he can claim that entire renovation expenditure as a deduction under 37. Assessing officer simply said there is an increase in useful life of an asset, but that asset is not under the control of assessee, and hence it is just like giving money and buying water, and you can claim it as a deduction under 37. Are you all with me? The next case is called as EJ forgings. So ECHJAY, you can call it any name, EJ forgings. EJ Forgings Limited, which is cited in the year 2010 by the Bombay High Court. So EJ Forgings was a company, and what the company did is like the company's director's son, he was studying abroad. Director's son was studying abroad, and the company claimed that entire abroad cost of study as an expenditure under section 37. It was director's son. So the entire cost of that son's studies claimed as a deduction under 37, and assessing officer said not possible. Assessee said no. Director's son is one of our trainees. He is in under training period. So he went to overseas and now he is under training over there. So we are the one who sponsored the training. He will come back and work in the company. That's what said the assessee said. But the case went to Bombay High Court, and Bombay High Court asked, is there any other trainees appointed by the company? Then assessee said no. Okay, fine. Is there any examination or an interview conducted to appoint a trainee? No. Then how do you select the trainee? The trainee was director's son. They simply selected director's son as a trainee and sponsored his abroad education cost. This is in the nature of a personal expense. The company cannot simply say that it is a training expenditure of one of our employees. If it is a normal trainee, then there would have been some criteria to appoint the trainee. Only on account of director, since he was director's son, that's why he have been appointed as a trainee here, and it is pure in personal nature and not deductible under section 37. I hope that also is clear. Moving on to the next case here is Shanti Bhushan. Shanti Bhushan. It's cited in 2011 by the Delhi High Court. This is a fantastic case law. So the assessee was a lawyer. He had some problems with his heart. Alright. So he undergone an open heart surgery. And he claimed that entire cost of open heart surgery as a deduction under section 37, stating it as a current repair of his what? Stating it as a business professional expenditure. His contention was, after that particular open heart surgery, I am about to attend more cases. He was a lawyer, so I'm about to take more cases. So my professional income went up. So this open heart surgery is a business expenditure. That was the contention of assessing. Then department say, no, we will not allow you as a deduction under 37. Then assessee also said one more thing. Then we will do one thing. Then I'll treat this heart as a plant and machinery, and I will claim it as a deduction under 31, because under 31 we have studied current repairs in relation to plant and machinery is allowed as a deduction under 31. So Shanti Bhushan said, I will treat it as a plant and machinery and I will claim it as a deduction under 31. He was an advocate, that's why. Otherwise the court would have definitely rejected his contention. But the court accepted the contention and the case was there. I'm not saying court accepted his view. The court has taken a hearing, accepted the hearing. So during the hearing, the court asked two things. You are saying you should get it as a deduction under 37. For getting a particular expenditure under 37, there is one criteria. The expenditure should be business exclusive expenditure. You are using your heart only when you are in court? No. You are using heart every time. So you cannot claim it as a deduction under 37. That is gone. Now the second contention is you want to treat your heart as a plant and machinery. Yes or no? Then prepare a balance sheet and you put your brain, kidney, your liver, lungs, heart, etc. as your assets. Then you value it. How do you value your heart? It is impossible. You cannot value your internal organs and put it in your professional balance sheet. It is impossible. So hence you cannot call all these things as your plant and machinery, and hence that contention is also rejected. It is a pure personal expenditure, not allowable as a deduction under section 37. I hope it is clear. Then there is one more case law that is called as Neelavati and others. Neelavati and others. 2010 Karnataka High Court. So what happened in this case is like Neelavati was running a theatre. There was a lot of goons in the theatre. Goons means gundas in the theatre. Those who buy tickets in black and they used to sell it and all. It is an old case, 2010 case. At that time, this Book My Show and all is not there. So people used to come. When they come there for taking tickets, most of the tickets are owned by the gundas and they will sell it for black. So this was totally disturbing her theatre business. So, and there was policemen also. Policemen also used to come and collect hafta. Hafta means, what do you say, kind of bribe. So what she did is like, she paid bribe to both the gundas and policemen and she claimed all the bribe as an expenditure under section 37 as her business expenditure. Assessing officer said, this is bribe. You cannot claim it as your business expenditure. But she said, no. It is not like that. In order to run my business, this expenditure was mandatory. That's why I've claimed it as a deduction. The case went to Karnataka High Court and the Karnataka High Court said, bribe is totally illegal. First, I am going to take case against you for giving bribe. Thereafter, we will talk about deduction. Alright, so the Karnataka High Court completely rejected her contention and it is not a allowable expenditure because giving bribe in India is totally illegal. If an expenditure is illegal, you cannot claim it as a deduction. If your income is illegal, it will be fully taxable. If an expenditure is illegal, you cannot claim it as deduction. Are you with me? Expenditure means, if an expenditure illegal means, if it is a nature of any penalty or fees for violating a law. That's what I said. I hope that also is clear. So these are the case laws that you have to consider while going through section 37. I hope all the cases are clear for you. Alright friends, so by that I can say all the deductions from section 30 to 37 is completely over. Now we are about to start disallowances. You tell me, what do you mean by disallowances? Those expenditures or payouts which are not allowed as deduction are called as what? Disallowances. So friends, let's understand which all are the disallowances. So the first disallowance which we have to study, I'll give you some flowcharts. So I want all of you to take note of these flowcharts. So the first disallowance is disallowance under section 40A1. Disallowance under section 40A1. We can write disallowance for default in TDS if payee is non-resident. If payee is what? Non-resident. In brackets you can write except salary. Except salary. So what Act says is, if you are making a payment which is allowable as a deduction under 30 to 37, but the payee is a non-resident and you have defaulted in deducting TDS, that is tax deducted at source, then what will happen? That entire payment given by you shall be a disallowance in accordance with 40A1. And you can divide or you can split this disallowance into two. You can split this disallowance into what? Two. Let's understand which all are the two splits under this. So except salary, yeah, you can split this into two. Split number one, we can say, if on account of, we can write due to default in deducting TDS in relevant PY. If there is a default in deducting TDS in relevant PY, 100% of cost shall be disallowed. Don't write due to. If default, right? If default in deducting TDS in relevant PY, 100% of the cost shall be disallowed. What do you mean by this? What do you mean by default in deducting TDS, then 100% of the cost shall be disallowed? Say, basically what is TDS? I'll give you a small glimpse of TDS. I know that you all know TDS, but only for the conceptual understanding I'm telling you this. Say for example, there is a company called JK
Limited, and JK Limited has accepted a service of a non-resident, and I've promised to pay him rupees 10 lakh. And while making the payment, JK Limited has to deduct TDS from this particular payment. Say the rate of TDS is 10%. Only for the example purpose, say the rate of TDS is how much? 10%. So JK Limited, while making this payment, have to deduct 10%. That is rupees 1 lakh from this 10 lakhs. And only 9 lakh is supposed to be given to this non-resident. And 1 lakh JK Limited have to give it as a payment to the central government by calling it as what? TDS. And thereafter JK Limited have to file a TDS return. JK Limited have to file a TDS return stating PAN number of this non-resident. If he does not have PAN, it is fine. Whether he has PAN, I need to what? Give his PAN number. If he does not have PAN, then his name, his other IDs, etc., his address, email ID, etc., I have to give. Now listen, after this particular non-resident, this 10 lakh is fully taxable in the hands of this non-resident in India, then only I am supposed to deduct what? TDS. I am deducting TDS for the tax payment of that non-resident in India. Now listen, this non-resident in the year end, when he files his return, his total income should be how much? 10 lakh. But he received only how much? 9 lakh. But he should show his income as how much? 10 lakh. And his tax liability will be 1 lakh 17,000. 10 lakh you put into slab, you will get 1 lakh 17,000 in the old slab rate. 1 lakh 12,500 plus 4% as cess will be 1 lakh 17,000. 1 lakh 17,000 will be the tax liability. From that you can deduct that 1 lakh as what? TDS. And the rest 17,000 he is supposed to make as payment. This is how the structure of TDS is all about. So the JK Limited is called as what? Deductor. Here non-resident is called as what? Payee. Are you all with me? I know that you know all these things, but only for the sake of clarity I have said this. Now listen, if JK Limited failed to deduct TDS, this 10 lakh is actually a cost for JK Limited. Yes or no? I have made this payment to that non-resident and that 10 lakh is a cost for JK Limited. JK Limited cannot claim it as a deduction. If there is a default in deducting TDS in the relevant previous year, then that entire expenditure shall be a disallowance in the hands of JK Limited in that previous year. And again friends, this is a temporary disallowance. What is temporary disallowance? Say for example, in previous year 22-23, in the year 22-23, I defaulted in deducting TDS. Defaulted in deducting TDS. But I deducted it subsequently. I deducted it on say 5th May 2023 and I made the payment. And I paid it to central government. So I deducted it afterwards, after the PY. I deducted it and made the payment to central government. Then what will happen? In 22-23, this 10 lakh is fully disallowed. In 22-23, this 10 lakh is fully disallowed. But in 23-24, I can claim that entire 10 lakh as a deduction. That's why I said it's a temporary disallowance. If there is a default, there will be disallowance. Once you rectify the default, you can claim it as a deduction. Are you with me? Are you with me? So if there is a default, there will be a disallowance, and once it is rectified, you can claim the same as a deduction afterwards. Now there is one more point. That is point number 2. That is after deduction. After deduction, defaulted in payment on or before due date of filing return of income, then also 100% of cost shall be disallowed. What do you mean by this? What do you mean by this, friends? Say, simply it means what? In the example, JK Limited has deducted the TDS. But didn't make the payment to the central government. He kept the TDS amount with himself. In such a scenario, if during the PY, if you have deducted TDS, then you need to make payment on or before due date of filing JK's return.
If you have made the payment on or before due date of filing JK's return, then I can claim it as a deduction. Even after the due date, I haven't made the payment, then only it will be a disallowance. Are you with me? Say for example, on 31st March 2023, I have deducted TDS. My return filing due date is say 31st October 2023. I've made the payment on 30th October 2023. Absolutely no problem. I can claim it as a deduction. What section 40A1 says, you deducted it in the relevant PY. If you miss to deduct in relevant PY, at that moment itself, there will be disallowance. Are you with me? You missed to deduct TDS in the relevant PY. You deducted it after the PY. Then definitely in the relevant PY, there will be a disallowance. Hope you remember the first scenario. You deducted it on 5th May 2023. That means in 22-23, you missed deduction. 22-23, it will be disallowed. In 23-24, you can claim it as a deduction. Once you deducted it, then you have time to make the payment up to the due date of filing your return. That's what the department says. Are you all with me? You have deducted TDS, then you have time to file your returns up to the due date of filing your return. If you haven't paid it even after due date, then what will happen? Entire cost shall be disallowed. Again, this is also a temporary disallowance. Why? Say for example, I paid it on 15th December. 15th December 2023, I made the payment. Then I can claim it as a deduction in the year 23-24. Are you with me? Then I can claim it as a deduction in the year 23-24. So 40A1A have to be very careful. You have to be very careful. During the PY itself, I have to deduct. Once I deducted, I have time to make the payment up to my return filing due date. Both are temporary disallowances. Are you all with me? Hope it is clear. Now there is one more thing. If this non-resident, in the example, say the non-resident provided this service overseas. This non-resident provided me the service overseas. Are you all with me? Non-resident provided me a service overseas and I made the payment in overseas. Do we have to pay taxes in India? Do he have to pay taxes for this 10 lakh in India? The answer is no. Then I don't have to deduct TDS. If the payee is not supposed to pay taxes in India, then the deductor is not supposed to deduct TDS. Are you with me? In one examination, they had given an adjustment like this. A non-resident provided a service overseas, received payment overseas. But while making the payment, the company forgot to deduct TDS. 99% of the students have written the answer as disallowance will be there. If the non-resident provided the service overseas, received the payment also overseas, for him, he is not supposed to pay any taxes in India. In such case, TDS is actually not required. When the deductor misses TDS, there is no disallowance because the payee should have a tax liability in India for 40A1 to come into the picture. Are you with me? You have to be very careful because the examiner will definitely trick you with all these points. I hope it is clear. So this is actually a case law called as Maruti Suzuki India Limited 2018. If the payee is not required to pay taxes in India, then TDS is also actually not required. The deductor have no liability in deducting TDS. If the payee has tax liability only, we need to think about what? TDS. It's a case law called Maruti Suzuki India Limited 2018 cited by the Delhi High Court. I hope it is clear. Now, there can be one or two scenarios. I will explain the scenario. Listen. Say in the same example of JK Limited and non-resident, I forgot to deduct TDS. And I've made entire 10 lakh to non-resident. Are you all with me? I forgot to deduct TDS and I paid this entire 10 lakh in 22-23. Then what will happen? This entire 10 lakh shall be a disallowance in the year 22-23. Yes or no? So on 30th October 2023, I came to realize that I missed the TDS. On 30th October 2023, I came to realize that I missed the TDS. So I called non-resident. To remit back rupees 1 lakh. Say the rate is 10%. I called the non-resident to remit back rupees 1 lakh. But what happened is non-resident have already filed his return.
showing 10 lakhs as his income and paid the entire 1,17,000 rupees as what? Taxes in India. He already paid his tax liability in India. Now there is a genuine problem. Now after this, that non-resident is not going to make me a payment of 1 lakh again. Why? He already paid his tax liability as a self-assessment tax. Yes or no? Even after this, if I call him, he will never give me that 1 lakh rupees again. Are you with me? Or what he can do is, he can give me that 1 lakh, then he is supposed to revise his return and get the refund of 1 lakh. It's a headache. He will never give me that 1 lakh back. Yes or no? That's the one thing that's going to happen practically. So in such scenarios, there will be a permanent disallowance for me. That 10 lakh will be permanently disallowed. Otherwise, I have to suffer 1 lakh from my hand. If I suffer that 1 lakh from my hand, it will be an extra credit for the non-resident payee. Yes or no? So it's a deadlock. In such scenario, what JK can do is, JK can collect a copy of return. Collect a copy of return plus tax payment challan. Tax payment challan plus a CA certificate stating that entire 10 lakhs have been correctly included in the return and the payee has correctly paid all the taxes. 3 things: copy of the return, tax payment challan, and a chartered accountant certificate stating that the payee non-resident has incorporated entire 10 lakhs in his return and paid all the taxes. If I can collect all these 3 things, then what I can do? I can claim it as a deduction in 23-24. Department will presume that all the default have been correctly rectified. Are you with me? But there is also a problem. In 22-23, there will be disallowance. Why? Because I missed the deduction. In 23-24, I can claim it as a deduction. Are you with me? If there is a default in deducting TDS and the payee have correctly paid all the taxes by showing all the income in his return, then the deductor may ask for the copy of the return plus tax payment challan plus a CA certificate and submit it to the department for taking that disallowed amount as a deduction subsequent year. Are you with me? So these are the things that are under 40A1. 40A1 will be there if your payee is non-resident, and 40A1 will be there for all payment except salary. For salary, there is a separate section. For salary, for disallowance, there is a separate section that we will cover later. I hope this much is clear. So moving on, friends, the next one is 40A1A. It is actually similar to 40A1. That is disallowance under section 40A1A. Disallowance under section 40A1A. It is similar to 40A1. It is similar to 40A1. So what I am doing is I am rewriting all these things here itself. So 40A1A. Disallowance for default in TDS if the payee is resident. Resident. Here it includes salary. Including salary. You can write including salary. Again, this also can be split into 2. Number 1, if default in deducting TDS in the relevant PY, instead of 100%, how much will be the disallowance? 30% of the payment shall be disallowed. After deduction, if there is a default in making the payment on or before due date of filing return, in that case also, instead of 100%, 30% of the cost shall be disallowed. Say for example, JK Limited while paying 10 lakhs to the resident payee, if there is a miss in TDS, entire 10 lakh is not disallowed. 30% of 10 lakhs is only disallowed. That will be effectively 3 lakh rupees. Are you all with me? So effectively 3 lakh will be the disallowance. And friends, this is also a temporary disallowance. Why temporary disallowance? Once subsequently, if the TDS has been correctly rectified, then you can claim all the disallowed amount as a deduction afterwards. Otherwise, not. I hope it is clear. It's actually similar to 40A1. All the points there in the 40A1 is there in the 40A1A, subjected to 3 differences. Difference number 1, payee here is resident. Difference number 2, disallowance here is 30%. Difference number 3, it includes salary. 40A1 excludes salary. I hope it is clear. Apart from that, everything is same. Every other points are ditto same in 40A1 and 40A1A. Are you with me? Okay friends, so
In the last session, we have discussed about the disallowances, especially 40A1 and 40A1A. So we were discussing about 40A1 and 40A1A, that is in relation to default in relation to TDS. Now it's time for us to discuss the next disallowance, that is 40A1B, which is in relation to default in equalization levy. So friends, listen. Expenses incurred by assessee towards specified services shall be disallowed if equalization levy has not been deducted and paid under section 40A1B of income tax. So please listen friends, there are certain circumstances where just like TDS, the person who makes the payment have to deduct certain amount, and that amount is called as equalization levy. Are you all listening? If the person similar to deductor in TDS defaulted in deducting equalization levy, then what will happen? The payment made by him shall be fully disallowed. Likewise, if after deducting equalization levy, if there is a failure in making payment to the central government, in that scenario also there will be what? Disallowance. So friends, listen. According to the Finance Act 2016, there are certain circumstances where a person, while making payment for certain specified services, have to deduct equalization levy. Deduct equalization levy from the payment of pay. And this deducted portion of equalization levy have to be paid to the credit of central government, similar to TDS. If there is any default in deducting equalization levy, or after deducting equalization levy there is a default in making the payment, then the 100% the payment shall be fully disallowed in the hands of the person who makes the payment, just like deductor. Are you all with me? Now the question is, what is equalization levy? There is a separate chapter called equalization levy. In the chapter, we will study all the circumstances where levy have to be deducted. For the time being, it's similar to TDS, where certain payments are required to be made on certain specified services. The person who makes the payment is supposed to deduct equalization levy and pay to the credit of central government. Scheme is similar to TDS. If there is a default, 100% of the amount is fully disallowed. I hope it is clear. Now, it is also again a temporary disallowance. Why it is a temporary disallowance? Because moving on, in subsequent years, if you correctly deducted the amount and make the payment to the central government, you can claim that amount as a deduction. If there is a default, there will be disallowance. Once you have rectified the default, there won't be any disallowance. I hope it is clear. So the point is, it is in relation to equalization levy. Now moving on to the next disallowance, that is 40 clause number A, subclause number 2. What they say is income tax not deductible. So that simply means all the income tax, surcharge, cess, interest under 234A. What is interest under 234A? That is, if there is a tax payable as well as a delay in filing return, then you need to pay interest under 234A for the pending tax liability at 1% per month or part thereof. Then 234B. If there is a default in paying advance tax, at least by 31st March of the previous year, you haven't paid advance tax up to 90% of your tax liability, then you need to pay interest at 1% on the difference amount till you actually make the payment, 1% per month or part thereof. What is 234C? If there is a default in paying advance tax in 4 installments, first installment is on 15th June, you should pay 15%. Second installment is on 15th September, you should pay 45%. Third installment is on 15th December, you should pay 75%. And the fourth installment is technically on 15th March, but you can make the payment before 31st March also. And the payment installment is 100%. For default, there is a 1% per month or part thereof as interest. So all those interest and penalty under income tax, all those things are fully disallowed. So the point is, Indian income tax, surcharge, cess, interest, penalty, whatever it is shall be fully disallowed. Now,
taxes or rates paid outside India, which is eligible for tax relief under 90, 90A and 91. That simply means you have suffered a foreign tax liability. The question is, can you claim it as a deduction here? The answer is, you can claim a relief under section 90 or 90A under 91. 90 and 90A are called as bilateral reliefs, and 91 is called as unilateral reliefs that we will cover under the chapter DTAA. For the time being, it is just a relief, just like a marginal relief. It is just a relief for the taxes that you've suffered overseas. If you have claimed that relief, then the taxes paid overseas is not your cost, and hence no deduction. You cannot claim that also as a deduction. Now, next point that you need to know is again another disallowance, that is disallowances for state government undertaking, which is covered under section 40A2B. So let's understand what is this 40A2B. Listen, any amount paid by way of royalty, license fee, service fee, privilege fee, service charge, etc., which is levied exclusively on any amount apportioned directly or indirectly from a state government undertaking by the state government. That simply means, friends, if the state government undertaking, what do you mean by state government undertaking? An entity under state government makes a payment to the corresponding state government in the name of, say, either royalty or license fee or service fee or privilege fee or service charge. All the payments made by the state government undertaking to the corresponding state government shall be fully disallowed. You cannot claim it as a deduction. It is only a simple point, and again not at all an important point. So all the service fee, royalty, etc. paid by a state government undertaking to the corresponding state government shall be fully disallowed. I hope that too is clear. So moving on with the next disallowance, friends, that is disallowances for salary payable. Hope you remember, under section 40A1, we have written if the payee is a non-resident, I clearly said it is excluding salary. Now listen, say when you are making a salary payment, to a non-resident employee, either without TDS or after deducting TDS, there is a default in making payment. Either without TDS or after deducting TDS, there is a default in making the payment. In such scenario, that entire salary shall be disallowed in the hands of the employer. So you are an employer, you are paying salary to your non-resident employee, either without deducting TDS or after deducting TDS, there is a default in making the payment on or before due date of filing your return. Then that entire salary amount shall be fully disallowed, and the speciality is it is a permanent disallowance, not a temporary disallowance. What do you mean by permanent disallowance? Once you miss TDS, that entire salary shall be fully disallowed. Whether in future you have correctly deducted or paid doesn't matter. That's why they have kept salary to a non-resident as a separate section rather than under 40A1. They have kept it as a separate section and calling it as 40 clause number A subclause number 3. What they say is any sum which is chargeable under the head salaries if payable outside India or to a non-resident, and if tax has not been paid thereon nor deducted therefrom according to chapter 17B, 100% of that salary shall be fully disallowed. If you missed it, then what will happen? Disallowance forever. Subsequently, you rectified it or not, doesn't matter. Disallowance will be there. It is not a temporary disallowance. It is a permanent disallowance compared to the other provision. I hope that too is clear. So moving on, friends. Next is any payment to a provident fund, which is under section 40A subclause number 4. So any contribution to provident fund or a fund established for the benefit of employees of an assessee, unless the assessee has made effective arrangements to make sure that the tax has been deducted at source from any payments made from the fund which are chargeable to tax under the head salaries. Say for example, if being an employer, you are making a contribution to a respective fund for the benefit of your employee, then it is allowed as a deduction under section 36. Yes or no? Are you all listening? Then from the respective fund, when the provident fund matures, there is a payment flow from the respective fund to the employee. At that time, if TDS is required to be deducted, this employer have to make sure that all the satisfactory arrangements are
there in the respective fund. That means while appointing trustee for that fund, employer have to make sure that all the adequate arrangements for deducting TDS at the time of payment from the fund to the employees is there. Otherwise, what will happen? The employer at the time of depositing this particular fund on behalf of employee will never get it as a deduction. Are you with me? And there is one more thing. If an employer is maintaining an approved provident fund under LIC or any other recognized institution, then automatically there will be provisions for deducting TDS and all. He is not supposed to ensure anything. But say for example, if group like Tata or Reliance, if they maintain their own provident fund and get it recognized, then it is under the control of employer. Then the employer have to make sure that all the trustees of the provident fund, that there is an adequate provision for deducting TDS when there is a payment flow from the fund to the respective employee at the time of his retirement or at the time of withdrawing the amount. Now, again, not an important provision, but it is there in the Income Tax Act. Now, moving on to the next point is, tax paid on perquisites on the behalf of employees is not deductible under section 40, clause number A, subclause number 5. Listen, when the employer gives perquisites to the employee, value of perquisites is taxable in the hands of employee. Yes or no? When an employer is giving a perquisite to the employee, that value of perquisite is taxable as salary in the hands of employees. The employee is supposed to pay taxes for that particular perquisites along with the salary income. But there is an option. Employer can afford that what? Taxes on perquisite. Because perquisite is normally non-monetary. Alright, there is no requirement that perquisite have to be monetary. It is non-monetary. So if employer is giving a huge non-monetary perquisite to the employee, then employee is supposed to pay taxes for that non-monetary perquisite from his cash salary. It will be a burden for the employee. Are you all with me? In such scenario, employer have an option to suffer the taxes on perquisite. If employer is paying taxes on the perquisite, then it is a cost for him, but he cannot claim it as a deduction because it's an obligation. It is not your cost. It is an obligation of your employee taken over by you, suo moto, not voluntarily, and hence you cannot claim that particular tax paid on perquisite as an expenditure, and you cannot claim it as a deduction. Whether to take it or not is your wish. If you yourself are taking that responsibility of taxing perquisite, then that is your cost, of course, no doubt. But it is your employee's obligation, and it is not allowed as a deduction in your hands. That's what the department says. I hope that too is clear. Now, the same perquisite is thereafter is exempted in the hands of employee. Why the same perquisite is exempted thereafter in the hands of employee? Already employer paid all the taxes for the perquisite value. That perquisite value again need not be a taxable perquisite in the hands of employee, because employer has suffered all the taxes. Are you with me? So this point is very simple. Employer is suffering the taxes on perquisite. That tax that he suffered is not deductible. And that perquisite is afterwards fully exempted in the hands of employees. That's it. Moving on. Next is actually a disallowance, but we will study it as a deduction. Section 40B is actually a disallowance, but we will study it as what? A deduction. So let's understand what exactly is 40B. So I want all of you to write notes in relation to 40B. Alright. So please write section 40B. Deduction for partnership firm. We will write it as a deduction. Deduction for partnership firm. Section 40B, that is deduction for partnership firm. Deduction for partnership firm, including LLP, okay? Including LLP. Including LLP. You can split this deduction into two. You can split this deduction. Actually, it is a disallowance, but we are about to learn it as a deduction. I will tell you the reason also after explaining this. So we can split this deduction into two. Number one, interest on capital paid by partnership firm to partners. And number two, it is remuneration. Remuneration paid by partnership firm to working partners. Remuneration paid by
partnership firm to working partners. Listen. So there are actually 2 points, that is interest on capital paid by the partnership firm to its partners and what? Remuneration paid by partnership firm to its working partners. Both are deductible. So let's understand what is the ceiling limit for this interest on capital paid by partners to paid by the partnership firm to partners. This partnership firm here includes what? LLP as well. So let's understand what exactly is the first deduction. So listen, what Act says is, if a partnership firm is paying interest on capital to partners, then it is allowed as a deduction subjected to a ceiling limit, and the ceiling limit shall be maximum 12% on capital. The maximum deduction shall be 12% on capital. That's what the Act says. If a partnership firm is paying interest on capital to the partners, maximum deduction shall be 12% on the capital. That 12% is simple interest. There is nothing called compounding and all. It should be simple interest. And one more thing, if your actual interest is less than 12%, then only actual will be deductible. Maximum deduction is 12%. If your actual is more than 12, then the maximum deduction shall be 12%. Now, the second one is remuneration paid by a partnership firm to its working partners shall be allowed as a deduction, again subjected to maximum. There is some ceiling limits that say, in case of loss, in case of book profit, up to 3 lakhs, or in case of loss, in case of book loss, the maximum deduction shall be 90% of such book profit, 90% of such book profit, or rupees 1,50,000, whichever is higher. This is the first limit. Then on the balance book profit, if any, then 60% on balance. This is the theory that they say. I'll give you an example for understanding this theory. For the time being, let's learn how much is the maximum deduction for remuneration paid by a partnership firm to its working partners. They say, in case of book profit up to rupees 3 lakh, or in the case of loss, maximum deduction for remuneration shall be how much? Either 90% of such book profit or 1,50,000, whichever is higher. For the balance book profit, if any, on that balance you claim 60%. For example, say my book profit is 10 lakh. My book profit is how much? 10 lakh. I'm a partnership firm and book profit is 10 lakh. What is the maximum amount I can claim as a deduction under 40B for remuneration paid to my working partners? Department say, up to the first 3 lakh book profit. Up to the first 3 lakh book profit, 90% of either 3 lakh or rupees 1.50 lakhs, whichever is higher. How much is 90% of 3 lakh? 2,70,000 or 1,50,000, whichever is higher. You tell me what is the figure then? 2,70,000 itself, 2.70 lakhs. Is there any balance book profit? Yes, 7 lakh is the balance book profit. On that 7 lakh balance book profit, you apply 60%. How much is 60% on 7 lakh? 4,20,000. So altogether total, how much is my maximum deduction? 6,90,000 is the maximum amount deductible under 40B, which is paid as remuneration, not to a single partner. In all the partners, it is a total amount that a partnership firm can give us a remuneration to all of its partners in a year. Are you with me? It is not per month or not to a partner. It is a total amount payable by a partnership firm, all of its working partners in a year. That is the maximum amount. One more thing is there. Say the actual remuneration is only 5 lakh. Then you can claim only that 5 lakh as a deduction. If actuals are more, then maximum deduction shall be up to that ceiling limit. I hope it is clear. Now the question is, what is this book profit? What is this book profit? That is a question that we have to answer. Book profit. So book profit means, friends, profit which is computed as per Pgbp just before adjusting 40B remuneration. We can write it like this. Book profit means profit computed as per Pgbp, profit computed as per Pgbp before adjusting remuneration paid to working partners and brought forward business loss. So book profit simply means a profit which is computed as per PGBP. It's not P&L profit, okay? Book profit doesn't mean your P&L profit. Book profit simply means you compute all the profits according to the PGBP provision just before adjusting remuneration. That means it is after adjusting interest on capital. You need to apply interest on capital as well and all other deductions, considering all the disallowances plus. Then you compute the book profit. Then that book profit is called as what? That is the criteria for determining the maximum deduction under 40B. And listen, you are not supposed to adjust brought forward business loss as well. I hope it is clear. Are you all listening? Yes or no? Now there are a few things in relation to this. First of all, let me tell you, listen. There are two explanations in relation to this 40B. I'll give that explanations. Alright friends, so please listen. Say for example, I'm a partner. We are a partnership firm. Okay, we all are a partnership firm. I'm one of the partners. I'm giving this partnership firm a loan. Are you all here? Alright, I'm giving a partnership firm a loan. And the partnership firm is about to give me interest on loan. That interest, will it count as an interest on capital? Answer is yes. Interest on capital includes both the capital as well as the loan given by the partners. Otherwise, no partner will give what? Capital. Every partner will give what? Loan. To come out of that ceiling limit. Yes or no? So, the partner's loan also will be considered as a partner capital. Are you with me? Hence, that also will come under the ceiling limit of 12%. I hope it is clear. Now listen, not yet over. Say for example, there is a partnership firm called ABC and Co. ABC and Co is a partnership firm. A is an HUF. Alright. So this is a HUF. Normally the name of HUF will be the name of Karta. Name of Karta as a, then HUF they will add. Alright. That is how they used to name. Now Mr. A is the Karta of this particular HUF. So this A is what? HUF, and Mr. A is the Karta of this particular HUF. I will call it as K, Karta. This Karta comes for the partners meeting and all. So this Karta is a representative partner. Representative partner. What is representative partner? Mr. Karta's name is Mr. A. Mr. A in his personal capacity is not a partner. Mr. A is representing the HUF. Whoever is the Karta tomorrow, that person will come tomorrow as a partner of that HUF. Are you with me? We call it as ex officio. Being a Karta in that HUF, you are a partner here. Are you with me? Now listen. This partnership firm has some financial problems. So they took a personal loan from Mr. A. And who is Mr. A? Representative partner as well as Karta of HUF. So this partnership firm took a personal loan from Mr. A. This loan will not be regarded as a capital from partner because Mr. A is not a partner in his personal capacity. He is a representative partner and given a personal loan. And that loan will not come under the purview of 40B. Say the partnership firm is paying an interest of 15%. Absolutely no problem. They can claim that entire 15% as a deduction. Are you with me? If a person is a representative partner and he gives a loan in his personal capacity, then that particular loan interest will not come under the purview of 40B. I hope it is clear. Now, point number 2, explanation number 2 is, say for example, there is another partnership firm called PQR and Co. There's a partnership firm called PQR and Co. And say, listen, this partnership firm required some urgent money. Mr. P's friend is very rich. So they took a loan from this friend. They took a loan from this friend. But this friend was very rich and very busy. So he left India. He left India and told that partnership firm to pay interest to Mr. P. To pay interest to Mr. P. Who was P? P is a partner. Mr. Friend is P's friend. P has given a loan to the partnership firm. Thereafter, P left India. After that, Mr. P said, that friend has given a loan to the partnership firm, and the friend told PQR that give the interest to my friend. Thereafter, I will collect it from him. Now listen, this partnership firm is paying interest to one of its partners. Yes or no? In this example, this partnership firm is paying interest to one of his partners. But that partner is collecting that interest in a representative capacity. Yes or no? The partner is collecting that interest only in a representative capacity. What is this representative capacity? On behalf of his friend, this partner is collecting interest. And this also will not come under the purview of 40B. If it is a loan from Mr. P partner, and if the interest is paid to Mr. P, then it will come under the purview of 40B. Here what happens? Friend has given a loan, and friend told Mr. P to collect interest from your firm. In that case, this interest, even though paid to a partner, will not come under the purview of 40B because the partner is collecting interest in a representative capacity. I hope that too is clear. So these are the two explanations under 40B. These explanations are very, very important. Okay. So friends, let's solve some problems in relation to this. So please take question number 18, which is in page number 8. Take question number 18, which is page number 8, and go through this question. Go through this question. This question, there is some remaining portion here also, okay? You have to read the rest of the portions also. It comes in the next page. So read this as well. So friends, section 40B, I have told you it's actually disallowance. How it is a disallowance? See, whatever over and above 12% interest, disallowance. Whatever over and above that remuneration limit is a disallowance. That's what the section says. So we learned it as a deduction. Up to 12% deduction, up to that limit in remuneration is deduction. But in Income Tax Act, if you read, over and above 12% is a disallowance. And over and above the ceiling limit of remuneration shall be a disallowance. That's what they say under 40B. We learned that just the reverse. Alright friends, so let's solve it together. So the question says, listen, Ravo and Jane, a partnership firm consisting of two partners, reports a net profit of 7 lakh before deduction of the following items. So let's note down that net profit first, that is rupees 7 lakh, that too before deducting the following items. Number one, salary of 20,000 each per month payable to two working partners of the firm as authorized by the deed of partnership. So, first of all, listen friends, partnership firm has paid a salary to the working partner. Before claiming it as a deduction, you need to check whether it is within the ceiling limit or not. To check whether it is within the ceiling limit or not, you require what? Book profit. To compute book profit, you are not supposed to adjust that particular salary. So, for the time being, I am ignoring that particular salary. What is the second item? Depreciation on plant and machinery under section 32, which is computed 1,50,000. Can we deduct that 1,50,000 from this net profit? The answer is yes, because they say this net profit is before adjusting the following items. So depreciation I can definitely deduct. The amount is 1,50,000. Then what is next? The next point, it says interest on capital at 15% per annum as per the deed of partnership firm, and the amount of capital eligible for interest is 5 lakh. So the interest that they normally pay is 15%. Can we claim that entire 15% as a deduction? No. We can only claim up to 12% as a deduction on 5 lakh. Yes or no? So tell me how much is 12% on 5 lakh? 5 lakh into 12% is the interest as per 40B. It is 60,000. Yes or no? The actual interest that they pay is 15. But you cannot that entire 15 as a deduction. You can claim only up to 12% as a deduction. And now, what is next? They say compute the book profit under section 40B. It is under processing. You tell me how much is the book profit figure coming? 4 lakh 90,000 is the book profit figure coming.
Now let's compute the ceiling limit as well. For the first 1,50,000, for the first 3 lakh, how do you compute the ceiling limit? For the first 3 lakh of book profit, it is either rupees 1,50,000 or 90% of 3 lakh, that is 2,70,000, whichever is high. That will be 2,70,000. For the balance book profit, how much is the balance? 1,90,000 is the balance into 60%. And how much will be that figure? 1,14,000. So total remuneration that is allowable as deduction shall be 3,84,000. Now before moving on, we need to check how much is the actual remuneration paid. Actual remuneration is 20,000 each per month to 2 working partners. So let's compute the actual remuneration, friends. That is 20,000 into 2 working partners into 12 months. How much is the actual remuneration coming? 4,80,000. Hence, you can claim only 3,84,000 as a deduction. Because they have paid excess over and above the ceiling limit prescribed under 40B. They can only claim up to 3,84,000 rupees. I hope it is clear. Are you all here? Super. Now, I want you to solve one more problem in relation to, not in relation to this 40B. It is a general problem under Pgbp. So, go take question number 17. It's in page number 8. And give me the answer. It's in page number 8. And give me the answer. Alright, listen. So, ISEC Limited is a company engaged in the business of biotechnology. And the net profit of the company for the financial year ended 31st March 2023 is 35,25,890 after debiting the following items. So, all the items mentioned here have been already debited to the net profit. And let's write the net profit here, friends. So, tell me how much is the net profit? Net profit figure 35,25,890. Net profit is 35,25,890. Now let's go through each and every debited items under that particular question. So the first item that they say is purchase price of raw material used for the purpose of in-house scientific research and development. So the first of all, it's a raw material purchase price for in-house scientific research. It is allowed as a deduction. It is including GST of 1,80,000, which ITC is not admissible. Input tax credit cannot be claimed. That simply means if you cannot claim input tax credit, then that GST will form part of your cost. Entire cost you can debit. Since it is already debited your statement of P&L accounts and no further adjustment required. Are you with me? So no adjustment required, only and not required. It is fully deductible and it is already deducted. Moving on. The purchase price of asset used for in-house research and development. You purchase the land. You cannot claim the cost of land as a deduction. Then you purchase building. As you know, if you are a scientific research, if you are in the business of, if you are in any business and you are doing some scientific research, that to in-house scientific research, entire capital expenditure is allowed as a reduction under section 35. Hope you remember. But except for land. For building you can claim, there is absolutely no problem. But for land, you cannot. So what you are supposed to do is entire 5 lakh have to be added back to the profits because it is already debited. So purchase cost of land. The amount is 5 lakhs. 5 lakhs have to be added back to the profits. Is that clear? So what you can do is, you can add back the cost of land. Cost of building is allowed as a deduction under section 35. Now, moving on to the next item, friends. That is expenditure incurred on notified agricultural extension project. It is fully allowable as deduction, provided excluding land and building expenditure, you have to expend minimum more than 25 lakhs. It is already expended, already debited to the statement of P&L account, hence no further adjustment required. Moving on. Expenditure on notified skill development project. For that, you need to check whether you are a company SC or not. In the question itself, they have given that you are a company SC, and hence you can claim it as a deduction. But expenditure on notified skill development project, there is a purchase of land and training expenditure is there. Purchase of land cannot be claimed as a deduction under 35 CCD. Hope you remember. So that cost you need to add back. So purchase of land again. Amount is 40 lakhs.
Moving on with the next item, that is expenditure incurred on advertisement in souvenir published by political party. If you are an assessee and you put an advertisement in political party magazine, souvenir publish, or any other tract, pamphlet, etc., then what will happen? It will be treated as a proper. It will be treated as a political party donation. Hence, you cannot claim it as a deduction under 35, but you can claim it as a deduction under chapter 6A. To be very precise, 80 GGB being a company SC. But in this question, you are supposed to compute only Pgbp, profits or gains from business or profession. Hence, it is a disallowance. Are you with me? So, we need to add back 75,000. So, political party donation. 75,000 rupees. Moving on. Expenditure incurred on issue of right shares. It is post commencement. Why it is post commencement? We commenced this business, that's why you have a profit, okay? Yes or no? It's a post commencement share issue expenses fully disallowed, not allowed as a deduction. Hope you remember, right? Yesterday under 35D we have already discussed this particular point. So this right share expenditures is fully disallowed and hence you need to add it back. So right share expenses, the amount is 80,000. Then next one. Expenditure incurred on issue of debentures, fully allowed as a deduction and it is already debited to the statement of P&L account as well. Yes or no? It is fully allowed as a deduction and it is already debited to the statement of P&L account as well and hence no further adjustment required. Penalty paid under GST Act, fully disallowed, 35,000. So GST penalty, 35,000 fully disallowed. Then moving on to the next item is penalty paid for breach of contract with a customer, fully allowed as a deduction. Contractual penalties are fully allowed as deduction. Hope you remember we have discussed that particular point as well. So no further adjustment required since it is already debited to the statement of P&L account. You don't need to do any further adjustment. Moving on. Interest paid on loan taken from a bank for payment of advance income tax. You took a loan for payment of advance tax. Can you claim that loan's interest as a deduction? No. In the morning, today morning itself I have told you. So this 60,000 is fully disallowed. So interest on loan, we can write 60,000 again have to be added back to the profits. Moving on to the next one, provision for loss of subsidiary. If you put a provision, normally it is not allowed as a deduction and 85,000 also have to be added back. That too provision for the loss of subsidiary. Okay, it's anyways it is disallowed, 85,000. So you tell me how much is the net profit after adding back all these things. So the answer is 83 lakh 60,890 is the net profit as per Pgbp. I hope it is clear. Alright friends, so there are a few more things in relation to section 40B. Let's complete the other things. So moving on to the next disallowance which we have to discuss is 40BA. That is 40BA is applicable for association of persons or body of individuals. Say you are an association of person or body of individual and you are paying any interest to your partner on, not partner, on member on their capital, or you are paying any remuneration to your member, both are fully disallowed. If you are an AOP or an BOI and you are paying what? Either interest on capital to your member or you are paying remuneration to your working member, both are fully disallowed. Only partnership firms in India can claim what? Both interest on capital as well as remuneration paid to its working partners as a deduction, not for others. For AOP and BOI, if they pay any interest or any remuneration to their members, it is fully disallowed. Are you all with me? Now, while computing the disallowance, one thing that you have to be careful is there is an explanation. The interest is paid by an AOP or a BOI to a member who has paid interest to AOP or BOI. The amount of interest to be disallowed under BA shall be limited to the net amount of interest paid by AOP or BOI to the partner. That simply means not to the partner, to the member. So make a correction and write it as member, okay? Member. If there is drawings
taken by the member from an AOP or BOI, then the member have to pay an interest to AOP or BOI. Yes or no? Say in certain AOPs and BOI, there are interest on drawings. What do you mean by drawings? What do you mean by drawings? Say for example, a member can draw an amount from a particular AOP or BOI. If that AOP or BOI is charging an interest on drawings and they are also paying interest on capital, if it is excess, then you need to net off, and the net off amount is only disallowed in their hands. Again, not an important point. Again, hope you remember that representative capacity, personal capacity thing. Say you are a representative member. You are not a member in personal capacity. You are a representative member and given a loan in personal capacity, then it is not under the purview of 40BA. It should not be disallowed. Are you all with me? Hope you remember under 40B we have learned that representative capacity concept. You are a representative partner and given a loan under given a personal loan to the partnership firm, then the partnership firm, while paying interest, does not does not check or does not have to follow section 40B. Likewise, you are a member of an AOP or BOI. You are a representative member and you have given a loan to that particular AOP or BOI in a personal capacity while paying interest to the member. That is not disallowed under 40BA because it will not come under the purview of 40BA. Likewise, the same repetition is there. Both the explanations under 40B which we have discussed is repeating again under 40BA as well. I hope that is clear for you. So these are the things under section 40B. Hope it is clear. Alright friends, so moving on to the next disallowance, that is under section 40A2, which is called as payment to relatives in excess of requirement. We call it as excess payment given to relatives also. Now listen, we'll take the example of Focus Kannan, FK. Alright, say FK running a particular company and FK's wife is the chief accountant in that particular company. FK's wife is the chief accountant in that particular company, but she have a speciality. She don't know anything about the basics of accounting, but she is drawing a salary of around 1 lakh per month. Alright, so her special skill is she don't know anything about accountancy, but she is the chief accountant and she's drawing a salary of how much, friends? 1 lakh rupees as the salary. And now a normal in the market for a fresher accountant who is not experienced, for a fresher accountant, say the salary is 25,000 per month. This is the normal amount. We'll say at the market value or market salary. Alright, assessing officer came to know about this, and now assessing officer will say Focus Kannan's wife is the accountant of Focus Kannan's own company, yes or no, FK's own company. That's why she was about to draw a salary of how much? 1 lakh. So this is excessive and unreasonable to the extent of 75,000. What is the 75,000? Normal salary for such an accountant in the market is only 25,000. You have given excessive salary to your relative, and hence that excess portion shall be a disallowance under section 40A2. If you are giving excess salary to your relatives, then that excess portion which is determined by the department shall be disallowance in the hands of assessees. Are you with me? So two things you have to consider. Number one, it should be excessive, and the payment shall be given to either your associates or to your relatives. So if you are giving excessive payments to either your associates or to your relatives, then the excess portion shall be fully disallowed in your hands, which is the discretionary power of assessing officer. But in examination, they will definitely specify about the excess. Are you all with me? Now under this portion, you need to study who all are our relatives and related parties. So let's understand who all are the relatives and related parties. These are the list of relatives and related parties. Say for example, if assessee is an individual, if FK is an individual, then who all are the related persons? Number one, all his relatives are a related person. Who all are the relatives of an individual? Let's understand who all are the relatives of an individual. Listen, number one, spouse. Spouse means the partner, not professional partner, life partner. Then brother, sister, lineal ascendant or descendant of that individual. What do you mean by ascendant or descendant? That means father, grandfather or son, grandson. Both maternal and paternal is fine. Mother, grandmother, that's also your relative. So, your spouse, brother, sister, lineal ascendant or lineal descendant, these are the list of relatives. Are you all with me? So, if an individual gives something which is more than the market value to any of these persons, then the assessing officer have the power to recompute that particular figure, disallow that excess portion in the hands of individuals. I hope it is clear. Now, it's not yet over. For an individual, there is one more related person. That means a person in whose business or profession the individual have a substantial interest. Say for example, this is FK. FK have 20% or more stake in a particular company or a partnership firm. 20% or more stake. We'll call it as substantial interest. What is a stake? What do you mean by 20% or more stake? What do you mean by the word stake? Stake means in a company, it is in the form of share capital, holding equity shares. If it is in the partnership firm, it is in the ratio of PSR, profit sharing ratio. Are you with me? Now, if FK have substantial interest in a particular entity, then that entity is also a related person of FK. We are thinking from the perspective of an individual. I hope it is clear. So, relatives as well as the individual in an entity where that individual have a substantial interest. Both are individuals, related persons. If you are giving some excessive amount to any of these persons, that excess portion shall be fully disallowed under section 40A2. I hope it is clear. Moving on. For a company, if FK is FK Limited, then he is a company. For a company, who all are the related persons? Number one, director of the company or any relative of the director. So, you are FK Limited as a company and all the directors of that particular company are separate individuals. Yes or no? So, directors are what? Related persons. If you are giving something which is more than the market value to directors, that also will be disallowed under 40A2. Or directors' relatives are also what? Related person. Now, you need to think from the perspective of companies. Now, a person in whose business or profession the company or any of its directors or its relatives have substantial interest. Either the company themselves has substantial interest in another entity, or the company's directors have substantial interest in another entity, or the director's relative have substantial interest in another entity. In all these scenarios, that other entity shall be a relative of or related person of company. We cannot say relative of company because company is not a natural person, hence it does not have relatives, but it have related persons. Are you with me? So, this is the second list for a company. And now moving on to the third one for a firm. Say, assessee is a firm, then any partner of the firm or relatives of the firms are fully related persons. If you are a partner of the firm or relative of the partner, then you are a related person. Then, a person in whose business or profession the firm or any of its partners or relative of such partners has substantial interest. It's actually similar to that company related person. For a company, all the directors are related persons. Directors, relatives are related person. The company or director or director's relative, if have substantial interest in an entity, that is also a related person. Likewise, if in the case of a partnership firm, partners, relatives, or the partners or its relative or the partnership firm itself have a substantial interest in another entity, both the cases are what? Related persons. Moving on, if you are an AOP, that means association of persons, any member of association or relative of member. And the second one, a person in whose business that AOP or any of its member or relative of the member have substantial interest. Actually similar it is. Are you all listening? These points are actually similar. Then HUF, a member of HUF or relative of such HUF. A person in whose business HUF or member or relative of such member have substantial interest. So these are actually similar. And let's understand the final scenario. That means you are any assessee. What do you mean by any assessee? Say you are an individual or HUF or AOP or BOI or AJP or local authority or a company or LLP or partnership firm. You can be anyone, not the others. You can be any assessee, common related person items. That's what we are about to discuss. The common items. You are individual, HUF, AOP, BI, etc., etc. Any person you are. And what happens is,
an individual who has substantial interest in the business or profession of the assessee or relative of such individual. Say, any individual has substantial interest in the business of this assessee. There is one individual who has substantial interest in the business of what? Assessee. Then this particular individual is a related person of that particular assessee. Say for example, assessee is a partnership firm. And in that partnership firm, there is an individual who holds how much? 20% or more stake. Then we can say that particular individual is always our relative, or his relatives are related person. The next one, a company which has substantial interest in the business or profession of assessee or a director of such company or relatives of such director. This is just the vice versa case. If a company, are you all listening? If a company has substantial interest in an entity, then from the perspective of company, we can say that entity is a relative of company. In the perspective of that entity, company is also a related person. Are you all listening? Listen. In the last, say, we will take this case. Say company have substantial interest in any entity. In this table, we have discussed from the perspective of company. For a company, this entity is what? Related person. And for this entity, this company is also a related person. That's what this table is all about. It's vice versa. Rather than saying vice versa, they have explained it specifically. Now, a firm, AOP, BOI, etc., which has a substantial interest in the business or profession of the assessee or partner member of such firm, AOP, BOI, etc., or the relatives has a substantial interest. Again, vice versa case. Then, a company, one of whose director has a substantial interest in the business or profession of the assessee or a directors of such company or relatives of the director. Or a firm, AOP or HUF, one of its partners or members has substantial interest in the business or profession of the assessee or any partner or member of such firm, AOP, HUF or a relative of such person. That simply means vice versa in all the above scenarios. From the perspective of others also, these persons are what? Related persons. Are you all listening? There are a few things that you should know. So, the point is, friends, this 48.2, they normally ask questions from 48.2. So, you should know whether the other party is a related person or not. Otherwise, what will happen? Certain questions we won't be able to give a clear picture whether it is an excessive payment disallowed under 48.2 or not. They will say third party. If you are giving an excessive payment to a third party which is not a related person, is it disallowed under 48.2? Say if you are giving an excessive payment to a third party which is not your related person, then can you say that that excessive portion is disallowance under 48.2? Tell me. The answer is no. The reason is 48.2 is specifically clear. You give something more than normal to a related person or a relative, then only 48.2 will come into the picture, otherwise not. I hope it is clear. Now, moving on to the next scenario, friends. So, moving on to the next disallowance, let's understand what exactly is the next disallowance. And there is a small case law in relation to this that is called as Great City Manufacturing Co., which is cited by the Allahabad High Court. It's a simple case. Listen. Say there was a partnership firm. And it has given remuneration to its working partners. It is given what? Remuneration to working partners. And yesterday we studied, if we are giving a remuneration that have to be within the ceiling limit, which is specified under 40 BF income tax. Hope you remember. If you are giving a remuneration to a particular working partner, then that remuneration have to be within the ceiling limit. And the ceiling limit also we learned. Up to, based on the book profit, we compute the ceiling limit. This remuneration given by the partnership firm to the working partner was within the ceiling limit. There was absolutely no problem. It was within ceiling limit. But what happened is, when the assessing officer had an, assessment on his books of accounts or analysis of the books of accounts, he came to know that the partnership firm paid working partner salary. That salary is 2 or 3 times of what the other salaries. Say for example, there are certain other employees. You take the total of the other employees' salary and you take the remuneration given to the partnership firm. The total of other employees is half the remuneration paid to the partners. So assessing officer said this is what? Unreasonable. This is unreasonable because a partner is one of the related person of partnership firm and it is totally unreasonable. It is excessive. And what was the basis for determining whether it is excessive or not?
They took the other salary. Other salary was just the half or 1/3 of the salary paid to the partner. And hence, assessing officer said this partnership firm is paying excessive salary to its partners. But this partnership firm said, no sir, we have paid whatever it is specified in 40B within that limit. So we should get it as a deduction. So the case went to Allahabad High Court. Allahabad High Court said, if the payment given to the partner is within 40B limits, then assessing officer is not supposed to invoke 40A2 because 40B is very specific. If you are giving remuneration to working partner within that limit, that entire remuneration should be given as what? A deduction. Then it shall not be disallowed under 40A2. This is called a specific versus general. What is specific versus general? 40B is specific. You give a remuneration, take it as a deduction within the ceiling limit. In such a scenario, you need not bring 40A2 into the picture. And hence, partnership firm has given deduction for the remuneration paid to its working partners. This is the case of Great City Manufacturing Company, which is cited by the Allahabad High Court in the year 2013. Now, let's move on, friends. Let's move on with the other disallowances, that is consequences of paying exceeding 10,000 otherwise than by account, paycheck or demand draft, etc., which is 40A3 and 40A3A. This section is a very common and familiar section. So listen, if you are, say there is a deduction, there is an expenditure which is deductible under section 30 to 37. Are you all with me? What all are the deductions from 30 to 37? We have discussed a lot of deductions from 30 to 37. A payment is a deductible expenditure under section 30 to 37. But income tax department say, when you are making a payment in a single day, which is more than 10,000. Listen, when you are making that payment and in a single day payment exceeds how much? 10,000 rupees, then the method of payment should be either account pay cross check or account pay bank draft or electronic clearing system or through prescribed electronic modes. If you are making a payment in any other mode, then that amount paid shall be fully disallowed. So listen friends, if you are making a payment which is more than 10,000 in a day, then the method of payment have to be either account pay crossed check or account pay bank draft or electronic clearing system or prescribed electronic modes. And you are making a payment in any method other than this, then the payment made by you shall be fully disallowed under 40A3. Are you with me? Now, that's what the department say. So, account pay check, you know what is account pay check, account pay bank draft, ECS and prescribed electronic modes, because we have already discussed such scenario under actual cost determination itself. Now, and there is one more thing in relation to this, that is called as 40A3A. So let's understand what is this 40A3A. Are you all listening? Are you all listening? So 40A3A, what it says is, so say for example, I am following mercantile system of accounting. Mercantile system of accounting. Alright. So what I did is like in 2021-22, there was some, printing and stationery charges payable. Printing and stationery charges payable, and the amount was 40,000. Amount was 40,000. The payment was actually due, but I haven't made the payment, but I claim it as a deduction. Since I follow mercantile system of accounting, it is possible for me to claim a deduction for such items. Yes or no? Now, after this, what happened is, say in 2022-23, at the time of making payment, what I did is I paid cash 40,000 in a day to settle that particular expenditure. In a single short payment of 40,000 rupees have been given. Are you all with me? Now, the point is in 22-23 I have violated 40A3. Yes or no? But you cannot say that it is a expenditure disallowed under 40A3 in 22-23. Why? Because I have already claimed it as a deduction in 21-22. In 22-23 only I made the payment. When I made the payment in 22-23, I violated the provisions of 40A3. In such scenario, what should be done? Department say, in such scenario, in 22-23, you treat this 40,000 as your deemed income. Because already in 21-22, you claimed it as a deduction. Alright, so in 22-23, if you have violated the provisions of 40A3, then it will come under 40A3A. Last year already you claimed it as a deduction. This year, while making payment which is more than 10,000, you paid it either by way of, not by way of account pay check or account pay bank draft or ECS or prescribed electronic mode. And hence, you treat that equivalent amount as your redeemed income this year. I hope it is clear. This is 40A3A. Now friends, it is not yet over. There is one more thing. If your payee is a goods transporting agent. What do you mean by payee? What do you mean by payee? So, payee means the person to whom you are making the payment. If that person is a GTA, goods transporting agent, then up to 35,000 rupees you can make payment in any method. There is absolutely no problem. The limit is 35,000 instead of 10,000. If your pay is a goods transporting agent, then the limit is 35,000 instead of 10,000 under 40A3. I hope that also is clear. Now, moving on. So these are the two things that you should know in 40A3 and 40A3A. Now friends, there is one important thing. There are certain exceptions to this 40A3 which are under Rule 6DD of Income Tax Act. There are certain exceptions to the concept 40A3 which is under Rule 6DD of Income Tax Rules 1962, and the point is you should know all the exception situations under 40A3 which is covered under Rule 6DD. So without wasting time, let's discuss each and every exceptions of 40A3. So let's understand the exceptions. So in the following scenarios, 40A3 is not applicable. That simply means what? Method of payment is irrelevant even though single day payment is more than 10,000. Are you all with me? In the following scenarios, method of payment is irrelevant even though you are paying more than 10,000 in a single day. So, scenario number one, where the payment is made to, that means if your payee is Reserve Bank of India or any other banking company, or State Bank of India of any of its subsidiaries, or any cooperative bank or a land mortgage bank, or any primary agricultural credit society or a primary credit society or life insurance corporation of India. So if you are making payment to any of these entities, that means if your payee is any of these, then method of payment is irrelevant. You can make any amount in cash in a single day without thinking about 40A3 because it is covered as an exception to Rule 6DD. Exception to 40A3 covered under Rule 6DD. Are you with me? So that is the first point that you should know. Point number two, if the payment is made to whom? If the payment is made to government. So if you are making a payment to government and under the rules framed by it, such payment is required to be made in a legal tender. What do you mean by required to be made in a legal tender? Can you give me an example for a legal tender? So friends, the point is legal tender simply means your currency, any legal tender. The currency that you have is a legal tender. So if you are making a payment to the government by way of a legal tender, then that is also covered under Rule 6DD. 40A3 is not applicable over there. Moving on to the third scenario, friends. So where the payment is made by letter of credit arrangements through a bank. We call it as payment by way of bank guarantees. What do you mean by bank guarantee payment or letter of credit arrangement payment? Tell me, friends. Say for example, bank guarantee simply means what? Say I am an exporter from India and you are an foreigner, my buyer. Are you with me? I am an exporter in India and you are my foreign buyer. And I am exporting something to you. I am exporting something to you and you are supposed to make me the payment. I am telling you, you make advance payment. But you say, no, you don't believe me. So you told me that you give the product first. Then only I'll make the payment. So there is always a problem because the buyers and sellers are not actually meeting. So in such a scenario, the bank will come into play. The buyer's bank will give a guarantee to the seller's bank, stating that if the buyer is not making the payment, the bank itself will make the payment through bank guarantees or letter of credits. So if you are making a payment, it is a bank payment first of all, and hence it is covered as a exception to 40A3. So you are making a payment by letter of credit arrangements through a brand, so through a bank, then that is also covered under Rule 6DD. Moving on, a mail or a telegraphic transfer through a bank. You can do direct RTGS, direct transfer. We call it as TT transfer, telegraphic transfer. So you can directly transfer money from your bank account by visiting the branch. But nowadays nobody does that, because if you have a mobile and you have internet connection, you can download the banking app and you can do a RTGS or IMPS from your mobile app itself. So nobody does that. But it is covered as a exception to exceptions to section 40A3. Moving on, a book adjustment from any account in a bank to any other account in that or any other bank. If you go to a bank, you can fill that yellow slip or white slip, whatever it is, and you can transfer money from that bank's branch from one account to another account. Yes or no? So that is also a payment which is not covered under 40A3 methods. That is, it is not account pay check, it is not account pay bank draft, it is not ECS, it is not prescribed electronic modes, but it is a payment through bank, and hence it is covered as a exception to 40A3. And moving on, bill of exchange made payable only to a bank. If you are giving a payment by way of a bill of exchange which can be only encashed through a bank, that is also a item covered under 6DD. Point number 4, where payment is made by way of adjustment against amount of liability incurred by the payee for any goods supply or services rendered by the assessee to such payee. It's actually a very simple point. Listen, I am supposed to give you 1 lakh rupees. You are also supposed to give me 1 lakh rupees, or you have supplied goods of worth 1 lakh rupees. I am supposed to give you how much? 1 lakh. You have supplied goods worth 1 lakh. Do I have to pay you 1 lakh and take that 1 lakh from you? Or do you have to pay me 1 lakh and take that 1 lakh from me? Not required. We can mutually cross off our liability. Yes or no? So instead of payment, you have supplied services or goods to the person. That is also a discharge of payment. That is covered under Rule 6DD. Why? Because there is no actual flow of money. There is actual no flow of money, and hence they say it is also covered as an exception to 40A3. The main objective of 40A3 is to restrict money transactions, because department is not in a position to monitor all the money transactions. So they say all these things are covered under 6DD as an exception to exception to section 40A3. This is the most important of this lot. That is where the payment is made for the purchase of agricultural or forest produce, or produce of animal husbandry, or dairy or poultry farming, or fish products, or products of horticulture or apiculture, to the cultivator, grower, producer of such article, produce or products. So what do you mean by this? Say for example, I am a company and my raw material is, say, fish pickle. Alright, what is my raw material? Fish pickle. Not raw material, fish pickle is my product. Okay, fish pickle is my product. You tell me what will be my raw material? Obviously fish. If I am buying fish directly from the fisherman and I am making a payment in cash, absolutely no problem. So what department say? If you are buying agricultural or forest produce or produce of animal husbandry, dairy, poultry, fish products, horticulture, apiculture, directly from the cultivator, grower, producer, etc., then method of payment is irrelevant. Say I am a pharma company and forest honey is my main raw material. I am buying honey directly from a person who collects honey. I can make the payment in any method. So agriculture produce, forest produce, whatever the forest produce. Then what do you mean by produce of animal husbandry? Meat, skin, hides, etc. Dairy means milk. Poultry means chicken, eggs related items. Then fish or fish products, fish products, under that squid, shrimp, crab, etc. will come. All the marine products will come. Then what is horticulture? Flower. What is apiculture? Honey. These are the products. But I have to buy it from the direct producer, cultivator, grower, etc. If I am buying fish directly from the fisherman, covered under 6DD. When I am buying fish from a broker, hawker, middleman, etc., not covered under 6DD, 40A3 is applicable. Are you with me? If I am buying fish from a middleman, broker, hawker, or a shop, etc., then it is covered under rule, is not covered under rule 6DD. From the original producer, I have to buy products. I hope it is clear. Moving on to item number 6, that is where the payment is made for purchase of products manufactured or processed without aid of power in a cottage industry to the producer of such products. So, if you are in the business of a cottage industry, say you are buying something from a cottage industry, and this cottage industry is manufacturing their products without aid of power. That means they are using that mechanical machines for their productions. And I'm buying something from that particular cottage industry, and I'm about to make a payment to that cottage industry. Then I can make the payment in any method. Absolutely no problem. Are you all with me? So moving on to the next point, friends. So if you are purchasing anything from a cottage industry where the cottage industry manufactures products without aid of power, then you can make the payment to the cottage industry in any method. Absolutely no problem. Moving on to the 7th point, friends, where the payment is made in a village or a town on which the date of the payment is not served by any bank to a person who ordinarily resides or is carrying on any business or profession or vocation in such village or town. That simply means your supplier is residing in a place where there is no banking facility. In a rural area where there is no banking facility, then you can make the payment in what? Any method. But your supplier have to normally reside in that particular place. Are you with me? Your supplier is in Chennai, but every time when you make payment, you go to a rural area and make the cash payment. That is not possible. Your supplier's place of residence should be that place where there is no banking facility or the time of payment. You might have heard one more point. You're making a payment in a day where bank is holiday or bank is on strike. It is not there right now. It is not there right now because even if the bank is on strike, you can take your app, put the numbers, click the pin, and you can transfer the amount. So it is not required that the bank have to function in a particular day to transfer the amount. So that bank strike, bank holiday point is not there in 6DD right now. It has been scrapped. Are you with me? You can check with the Rule 6DD in Income Tax Act from the website itself. It has been omitted. It has been omitted. It is not there in the Income Tax Act right now. Now, let's continue, friends. Point number 8. Where any payment is made to an employee of SSC or hire of any such employee in connection with the retirement, retrenchment, resignation, discharge, death of such employee on account of gratuity, retrenchment compensation, similar terminal benefit, aggregate of such payment payable to the employee or his hire does not exceed 50,000 rupees. It's actually a very simple point. Listen, you are my employees and today you are retiring. I have to give you a retirement compensation, either by way of gratuity, provident fund, whatever it is. So while making that retirement compensation, I can pay up to 50,000 rupees in any method, in any mode. Say my employee is either retiring or he's dead. So that I have to make the payment to his legal hire. In that case also I can make a payment up to 50,000 in any mode. It is not per year, per event. To an employee maximum in aggregate, I can pay up to 50,000. If the payment is more than 50, then I have to make the payment by either account pay check or account pay bank draft or ECS or prescribed electronic mode. Are you with me? If on account of death, retirement, etc. of an employee, when I'm making a payment as an employer, I can make up to rupees 50,000 in any method. Absolutely no problem. Moving on to point number 9. Where the payment is made by an assessee by way of salary to his employee after deducting income tax from salary in accordance with the provisions of section 192 of the Act. And when such employee is temporarily posted for a continuous period of 15 days or more in a place other than his normal place of duty or on a ship and does not maintain any account in any bank at such place or a ship. So friends, listen, it's actually a simple point again. So the point is, say for example, you are my employees working in my Chennai branch. Are you all listening? You are my employees working where? Chennai branch. I have sent you to my Jammu and Kashmir branch. I have a branch in Jammu and Kashmir. I am sending you to Jammu and Kashmir. It's a temporary posting. What is temporary posting? After finishing the job, you can come back to the Chennai branch itself. It's a temporary posting for more than 15 days. Say I have deputed you over there for 3 months. I have deputed you in my Chennai branch for how many months? 3 months. It's a temporary posting. So in Jammu and Kashmir, you don't have a bank account. In Jammu and Kashmir, you don't have a bank account. In such scenario, I can make the payment. I can give the salary payment to you in any mode, but there is one condition. I have to deduct TDS correctly while making the salary payment. Are you with me? So if a person is posting his employee for more than 15 continuous days, that's a temporary posting. And while paying the salary, he can pay the salary in any mode after deducting TDS, provided your employee should not have a bank account in that place where he has been temporarily posted. Are you with me? So if I am posting you in a place which is not your normal place of duty for more than 15 days, and that is a temporary posting, and you don't have a bank account over there, then while making salary, I can pay the salary in any mode, but the only point is I have to deduct TDS. Or I'm posting you in a ship. I'm posting you in a ship like this for more than 15 days, and you don't have any bank account over there. At that moment, in certain ships, there are banking facilities. In luxury cruise liners and all, there are banking facilities. But the ship which I am posting you should not have any banking facility. Not banking facility, you should not have an account over there. It can have a banking facility. You should not have an account over there. Then also I can pay you the salary in any mode. Either in a place which is not your normal place of duty, or in a ship if I am posting you for more than 15 days, I can pay you the salary in any mode. The only point is I have to deduct what? TDS. Plus, you should not have a bank account in that temporary place as well. Are you with me? Are you with me? Moving on to the last 2 points, that is point number 10, where the payment is made by a person to his agent who is required to make the payment in cash for goods and services on behalf of such person. That simply means I'm a principal and you're my agents. I'm giving you money to distribute to different persons. In my books of accounts, the entry is I have given you cash more than 10,000. Absolutely no problem. But in your books of accounts, when you make payment, your single day payment if exceeds 10,000, it have to be either the prescribed modes. Are you with me? So when the principal is giving cash to agent, that is not covered under 40A3. He can pay the payment in any mode. Absolutely no problem. But the agent, when he subsequently makes any payment on behalf of principal, then the method of payment should be either account pay check or account pay bank draft or ECS or prescribed electronic mode. Now, moving on to the last point, where the payment is made by an authorized dealer or money changer against purchase of foreign currency or a traveler's check in his normal course of his business. What do you mean by that? Say, I'm a money exchanger. I have to buy dollars by paying Indian rupees. Yes or no? I have to buy dollar from a foreigner by paying what? Indian rupees. I'm telling to that foreigner, I'll give you account pay check. You open a bank account in India, then you encash this particular account pay check from that particular bank account, because that's what section 40A3 says. Can I say things like that? No. Then my business will not happen. So department say, if I'm a money exchanger and I'm buying foreign currencies or traveler's check by paying Indian rupees, absolutely no problem. It is covered under rule 6DD. You will not have to think about 40A3. So these are the 11 scenarios where there is an exception to the section 40A3 or 40A3A. I hope all the points are clear. So I want you to go through each and every points. So now let's move on to the next point in relation to this. So friends, listen. So they are saying a few notes in relation to this. Number one, the provisions of section 40A3 are applicable only in computing income under IFRS and under Pgbp. Under IFRS also this is coming, but not as section 40A3, as a disallowance under IFRS. Under section 58, there is a disallowance similar to 40A3. That's why I've written 40A3 will be applicable only in Pgbp and IFRS. Now, next is where goods are purchased against cash, whether the payment is made prior to the delivery of goods or after the delivery of goods. If payment is in cash, then the same is covered under 40A3. Irrespective of the time of payment, for a goods, you have given an advance in cash, disallowed. You have given a payment after purchase of goods, disallowed. If it is more than 10,000 and you haven't followed the methods and it is not covered under 6DD as well, then only it will be disallowed. Otherwise, you can claim it as a deduction. Now, moving on to the next disallowance that we have to study, that is 40A7 disallowance for provision of gratuity. It's actually very simple disallowance. That means if you have put a provision for your gratuity liability, then that provision shall be fully disallowed. What do you mean by putting provision for gratuity? What is gratuity basically? It is a gratuitous sum paid by the employer to the employee. If the employer knows, normally all the employees knows that all the employees will retire someday. Yes or no? So he is putting a provision for that future liability. Can I claim that provision as a deduction? The answer is no. I cannot claim that provision as a deduction. If I have put any provision for gratuity, that will be always a disallowance. But actual payment of gratuity is allowed as a deduction. Or I'm maintaining a recognized gratuity fund and every year I'm paying an amount to that particular gratuity fund. That is also allowed as a deduction under 36. Hope you remember. Employer is paying something into an approved gratuity fund is allowed as a deduction under 36. Alright. That is definitely deductible. Or actual payment of gratuity from the employer to the employee is also deductible. But simply putting a provision, you cannot take deduction for gratuity. Are you with me? Moving on to the next one is 40A9, which we have already covered. What is 40A9? Two things are covered. If you are in the status of an employer and making a payment to the, if you are making a payment on the behalf of or the benefit of employee to any fund, trust, company, etc., then payment shall be fully disallowed. If it is an approved fund, then it is allowed as a deduction. If it is an unapproved fund, then it will be fully disallowed. And one more thing is there. You are making a payment to NPS, which is more than 10% of basic salary plus DA, which forms over the retirement benefit of the employee. Then that excess is disallowed under 40A9. I hope you remember. We have computed a problem also. Are you all with me? Moving on. So these are the disallowances under 40A9, which we have already covered. Now, next is mark to market loss or expected loss, which is under 40A subsection 13. Only mark to market losses specifically permitted under ICDS would be allowable as a deduction under 36. Other mark to market losses which would not be allowed as a deduction under section 40A subsection 3. See, mark to market loss, I've given you an example also for ICDS. When you revalue ICDS every year end, that loss you are suffering is a mark to market loss which is allowed as a deduction under ICDS, specifically under ICDS 2. Only those mark to market losses which are allowed as a deduction as per ICDS is allowed as a deduction under 36. All others are fully disallowed under 40A subsection 13. You cannot simply claim a deduction by calling it as a revaluation or mark to market losses. Say for example, you are simply revaluing your investments and you are saying it's a mark to market loss. Can you claim that loss as a deduction? No, that is not permitted under ICDS. If a mark to market loss is permissible under ICDS, you can claim it as a deduction, otherwise not. Moving on, again the next provision is actually not required. Special provision for deduction in case of prospecting mineral oil, section 42 is not required. Moving on with the next one is 43A, that is changes in the rate of exchange of currency. So friends, listen. This is not very important, but I'll explain this provision as well. So please listen, friends. Changes in case of exchange of currency. So let's understand what exactly is this. Alright friends, so let's understand what exactly is this changes in rate of exchange of currency under 43A. Listen. Say what they are saying is, I'll draw a flow chart here for 43A. That is better. Say for example, I am an assessee and I'm buying a foreign asset. I am buying a foreign asset. I'm buying a foreign asset either on credit or I've taken a foreign loan. What do you mean by either on credit? That means at the time of purchase, I haven't made the payment, or I have made a payment by taking a foreign loan. So friends, listen, either on credit or by taking a foreign loan, I purchase a foreign asset. Now what happens is, at the time of purchase,
the foreign assets value was $10,000. $10,000 and the currency conversion was 70 rupee per dollar. At the time of purchase, say it is in 2020-21, the purchase value was how much? $10,000 and the currency conversion at that time was 70 rupee per dollar. Then in my books of accounts, I will show this $10,000 into 70 rupee per dollar, and how much will be the sum? 7 lakhs. I'll show 7 lakh rupees as my actual cost of that asset in the year of purchase. And I will claim depreciation also. Say it's a plant and machinery depreciable at 15%. So how much is 15% on 7 lakh, friends? How much is 15% on 7 lakh? Say it is a plant and machinery depreciable at 15. 1 lakh, 5,000 I will claim as a depreciation as well. So how much is the closing WDV? 5,95,000 is the closing WDV. Say in year 2, that means in the year 21-22, what happened is I made the payment. I've made the payment of $10,000, but at that time there was a problem. At that time, the currency conversion was 80 rupee per dollar. The currency conversion was how much? 80 rupee per dollar. So due to that, how much is my actual repayment? It is 8 lakh. My actual repayment is 8 lakh. Due to that 10 rupee increment in the currency conversion, my actual cost is 8 lakh right now. But I have only capitalized 7 lakh. Yes or no? So there is an additional cost of 1 lakh. What to do with that additional cost? Department simply say under 43A, that additional cost can be adjusted with the WDV value. If it is a cost, then what I need to do is, I need to add that 1 lakh with this 5,95,000. And I should show 6,95,000 as the opening WDV in the year 2. And I'm supposed to compute depreciation at 15% on this 6,95,000. If it is reverse, then what should be done? Reverse means what? Say instead of 80 rupees, say it is 60 rupees per dollar. 60 rupees per dollar. Then I've saved rupees 1 lakh. Then I saved rupees 1 lakh. Then I have to deduct that 1 lakh from the opening WDV, and I should show the rest only as the WDV under 43A. And this is applicable only when I purchase a foreign asset either on credit or by taking a foreign loan. I purchased an Indian asset, then there won't be any foreign currency fluctuation asset. I purchased a foreign asset by taking a loan from an Indian bank. There is no foreign currency fluctuations effect because the Indian bank will make the payment to my buyer at that moment itself. Then my repayment will be to the Indian bank. Then there will be no impact of any foreign currency. Are you with me? So 43A states about this thing. You need to adjust that amount with the WDV value. If it is an extra cost, additional cost, you add it with the WDV value. If it is a savings, you deduct it from the WDV value. I hope that also is clear. Are you with me? Now friends, let's move on with the next thing, that is 43B. So let's understand what is 43B. Certain deductions to be made only on actual payment basis. So friends, listen. First of all, I'll tell you 43B is applicable only for those assessees who follow mercantile system of accounting. Why? If you follow cash system of accounting, then all your expenses will be based on actual payment basis. Are you with me? If you follow cash system of accounting, then all of your expenses will be based on your actual payments. So 43B is applicable only for those persons who follow mercantile system of accounting because they used to put a payable entry and used to take deduction for that. But departments say, even if you follow mercantile system and you put a payable entry for the following items which we are about to discuss, if you want to take a deduction, you need to actually make the payment. Bus. So let's understand which all are the items that comes under 43B. So listen. So the first point is, these items that are covered under 43B have to be paid on or before due date of filing your return. It is not mandatory that you need to make the payment in the relevant PY itself. You have time till you file your returns. And again, it is a temporary disallowance. What do you mean by temporary disallowance? If you fail to make a payment on or before filing your return, there will be disallowance. Afterwards, you make the payment, then in the next year, you can claim it as a deduction. It is just like the TDS provision. If there is a default, there will be disallowance. Once it is rectified, you can claim it as a deduction. Are you with me? So if there is a default in making the payment,
on or before due date of filing your return, then there will be disallowance. After the due date, if you actually make the payment, thereafter you can claim it as a deduction. So let's understand which all are the items covered under 43B. Item number 1, they say any sum payable by way of a tax, duty, cess or a fees by whatever name called under any law for the time being in force. Best example, GST. Say I am not taking input tax credit, then the GST is my cost, but I need to actually make the payment to claim it as a deduction. Or municipal taxes for a building which is used for my business or profession, allowable as a deduction under section 30. Hope you remember. Rates and taxes for a building which is used for my business or profession is allowed as a deduction under section 30. But if I want to claim it as a deduction, I need to actually make the payment. Whatever cess, duty, fee, etc., which is allowable as a deduction from 30 to 37 is allowed only on the basis of actual payment basis. This 43B does not have an independent existence. You have to read 43B along with 30 to 37. Why? Only those items which are deductible under 30 to 37, those items on actual payment basis, you can claim it as a deduction. Say for example, income tax is not at all deductible. Can you say that income tax have actually made the payment and it is allowed as a deduction under 43B? No. If an expenditure is allowable as a deduction under 30 to 37, then that deduction is based on actual payment basis. Are you with me? Moving on. 43B is a supporting section, not a major deduction section. So, point number B, any sum payable by assessee as an employer by way of contribution to provident fund, superannuation fund, gratuity fund. Hope you remember under 36 I've told you, subjected to 43B. Listen, if employers on contribution to the provident fund, gratuity fund or any superannuation fund is allowed as a deduction on the basis of 43B, that is basis of actual payment. If the employer contribution is not actually paid by the employer, it is not allowed as a deduction according to 43B. And what for the employee contribution, what will happen? 43B is not applicable for employee contribution. Employee contribution, when you deduct, it will become your income. Then you need to make the payment on or before the due date of the relevant act. Under 36, we have covered it. Hope you remember. This 43B point is only for employer out-of-pocket contribution. I hope it is clear. Moving on. Next is bonus or commission payable by an employer to his employees. That also we have already covered. When the employer is paying any bonus or a commission to the employee, it is allowed as a deduction only on actual payment basis. Then point number D, E and F we will combine together and we will discuss. Point number D, E and F and combining together. So listen, point number D, E and F, three of them are related to what? Interest payment. So let's understand what is D, what is E and what is F. Listen, say interest on loan. Interest on loan from point number D, what they say is from a public financial institution or a state financial corporation or a state industrial investment corporation. Say I have taken a loan either from a public financial institution, say for example LIC, or a state financial corporation. There are Tamil Nadu State Financial Corporation, Kerala State Financial Corporation, Karnataka State Financial Corporation are there. Then State Industrial Investment Corporation. I have taken a loan for my business purpose. Then the interest on loan is allowed as a deduction under 36, but only on actual payment basis. If I want to claim that, interest as a deduction, then I need to make the actual payment, otherwise not. Then point number D, what they say is, I've taken a loan, not D, sorry, F. Point number F, what they say is, there is E in between, okay. Point number E, what they say is, if I've taken a loan from a deposit taking NBFC, that is non-banking finance corporate, or non-deposit taking systematically important NBFC. So the point number E, what they say is, either I have taken a loan from a deposit taking non-banking finance company or a systematically important non-deposit taking non-banking
finance company, then both the cases, the interest have to be actually paid to claim it as a deduction. What is this deposit taking and non-deposit taking NBFCs? There are different classifications for NBFCs. Are you all with me? Say like factors, asset restoration companies, deposit taking NBFC, non-deposit taking systematically important NBFCs. Deposit taking NBFC means those NBFCs which accept and deposits. Non-deposit taking NBFC, that is systematically important, means that NBFC that have a net earned funds which is more than certain prescribed limits. In my memory, it is 500 crores. If they have net earned funds, just like a, what do you say, net worth of a company. Net earned funds means their own earned funds, just like net worth, similar to net worth of a company. If they have net earned funds, if I'm not wrong, it is 500 crores. More than 500 crores, then they will be considered as what? A systematically important non-deposit taking NBFC. You have taken a loan from any of these two NBFCs, then it is allowed as a deduction only on actual payment basis. And if you have taken a loan from any other NBFC, then what will happen? Is it covered under 43B? No, it is not covered under 43B. And point number F. So point number F, what they say is, you have taken a loan from a scheduled bank. You have taken a loan from a scheduled bank or a cooperative bank. Or a cooperative bank. In the cooperative bank, there are giving some exceptions also, other than agricultural, primary agricultural credit society or a primary cooperative agriculture land and rural development bank. That you can ignore. If I have taken a loan from scheduled bank or a cooperative bank. What is scheduled bank? A bank which is scheduled by Reserve Bank of India, like SBI, Federal Bank, then South Indian Bank, then Punjab National Bank, like that. A bank which is scheduled as per the list notified by Reserve Bank of India. Or a cooperative bank. That means a cooperative society in the banking business or a cooperative bank. Then all these three cases, you have taken a loan for your business or professional purpose. You can claim it as a deduction only on the basis of actual payment. You make an actual payment, you will get it as deduction. Otherwise, don't even think about deduction. Are you with me? So D, E and F is similar. The only difference is the place where you take the loan. D it says PFI, SFC, SIIC. E says NBFCs. F says scheduled bank or cooperative banks. Now, let's move on to the point number G. Point number G, what they say is, any sum paid by assessee as an employer in lieu of earned leave of his employee. You tell me what is earned leave? Earned leave. Leave encashment. It is called as leave encashment. Say for example, I can take 30 days of leave in every year. I haven't taken any leaves. That simply means I've worked for an additional 30 days. Yes or no? My eligible leave was 30 days in a year. I have worked for all the working days. I haven't taken any leave. That simply means I have worked for an additional 30 days. I could have taken leave, but I've worked for additional 30 days. I should get 1 month's extra salary. That 1 month's extra salary is called as what? Leave encashment. If employer is paying leave encashment to the employee, it is employer's cost. And it is allowed as a deduction only on actual payment basis. And finally, point number H. Any sum payable by assessee to the Indian Railway for the use of railway assets. That simply means, say I'm using any goods train for my transporting goods and all. Then my traveling cost is payable to Indian Railways. In such scenarios, I need to actually make the payment. Are you with me? To support Indian Railway, they have brought in such a point. So these are the different items covered under 43B. Now, what is 43B? All those items which are covered under 43B, you have to actually make the payment to claim it as a deduction under 43B. By merely putting a payable entry, you cannot claim deductions for these items. And when should be the payment? Either in between the previous year or before due date of filing your return. If you are not filing it, if you are not paying it even before due date of filing your return, then what will happen? In the relevant previous year, it will be a disallowance. In the next year, you can claim it as a deduction. Provided you have to actually make the payment in the next year. In the next year also, you are not paying. Then, again disallowance. So, whenever you actually make the payment, that year you can claim it as a deduction. Now, there are a few instances that we have to discuss here. Listen. So, let's discuss that few instances. Listen. Payment means actual payment. Say for example, say you have taken a loan from me.
Are you all listening? You have taken a loan from me. I'm the manager of the bank. I'm the manager of a scheduled bank, and you have taken a loan from me. And the interest liability payable by you is say 10 lakhs. The interest liability payable by you is say how much? 10 lakhs. Forget about its principal. The interest liability that you are supposed to pay is 10 lakhs. So I called you and asked you for immediate payment. But you told me that, sir, I don't have money right now. So what I did is like I've restructured that interest payment. What do you mean by restructuring that interest payment? I have closed that entire interest payable and I've treated it as a new loan. I've treated it as what? A new loan which is repayable in 10 installments. Which is repayable in how many installments? 10 installments. Are you with me? That entire interest liability I've closed. Then I've treated it as a new loan and I've converted it as a new loan which is payable in 10 installments, and you made a payment of 2 installments. You made a payment of how many installments? 2 installments. The first thing to notice, right now I have closed all the interest liability. This cannot be treated as an actual payment of interest. This is not an actual payment of interest. When I pay that new loan, I've told you that you have paid me 2 installments. Yes or no? So what is the proportionate interest that you actually paid? 2 lakhs. How it become 2 lakhs? 10 lakh have been divided into 10 installments. Out of that, you paid 2 installments. And how much will be the amount? 2 lakhs. This 2 lakhs is the proportionate interest that you have paid. And this 2 lakhs is the deductible amount under 43B. Just by converting that interest into a new loan cannot be treated as what? Actual payment under 43B. It is only conversion of your interest liability into a new loan. Now you have to make the new loan. You have to make the payment for the new loan. Then only you can claim it as a expenditure. Are you with me? Point number 2. Instead of converting into a new loan, say what you said is like, sir, I don't have money, but my company is issuing debentures. So the company is about to give me 10 lakhs worth of debentures. I'm the bank. Instead of giving me money, you have given me what? Debentures of 10 lakhs. You have given me debentures of how much? 10 lakhs. Are you with me? Can you treat it as an actual payment? No. It is also a conversion. By simply converting that interest into a new loan or by just giving debentures, you cannot call it as an actual payment. You need to actually make the payment. At the maturity time, when you redeem the amount, when you redeem the debenture and pay me the amount, you can claim that 10 lakh as an expenditure. Till that time, it will be disallowance. Are you all with me? Initially, basically, it is an interest, right? Interest payable on a business loan. That interest is a business expenditure. It will not be allowed as a deduction unless otherwise you actually make the payment. Conversion of that interest into a new loan or conversion of that interest into debentures will not be regarded as an actual payment. You need to actually make the payment. That's what explanation to section 43B states about. Are you all with me? Now there is one more thing which is actually not related to 43B because most of the provisions are over. Now I need to tell you some further explanations in relation to Pgbp. Listen. Say for example, listen. Say for example, I am running a business called JK Limited. I sold some commodities to my customers. I sold something to my customers and collected GST. And collected what? GST. Say 10 lakh rupees is the GST that I've collected. Are you all with me? 10 lakh rupees is the GST that I collected from my customers. Now, I need to make this 10 lakh payment to the central government. Yes or no? Or state government, whatever it is. I paid it to the government. Then they will distribute it to the state government. Initially, the payment is going to the center. Then center will allocate the proportionate share of the state. It is like that. So, I given the payment to the central government. Then I filed a case. In the High Court, stating that this GST rate is excessive. Now, the High Court decided that this entire 10 lakh has to be refunded to the JK Limited. The High Court decided entire 10 lakh have to be refunded to the JK Limited, to the businessman. So, the state government or central government, whoever it is, have refunded that entire 10 lakh. They refunded the entire 10 lakh. Now, is this 10 lakh my money? Is this 10 lakh my money? No, I need to distribute it to my customers. Yes or no? If I am not distributing this 10 lakh to my customers, then this will be regarded as a deemed income. Deemed income. If I am not distributing this 10 lakhs to my customers, then according to the provisions of income tax, this will be regarded as my deemed income. Say for example, in 22-23, I got this refund from government and I haven't distributed this particular amount to my customers in 22-23, then this entire 10 lakh will be my deemed income. I have made the actual distribution in 23-24. I've actually made the payment to the customers in 23-24. Then I can claim it as a deduction in 23-24. In 22-23, that means the year of refund, that will become my deemed income. Afterwards, if I am actually distributing it to my customers, then I can claim it as my deduction as well. I hope it is clear. Are you with me? Yes. So these are the things that you should know. So friends, now let's solve a problem in relation to 43B. I want all of you to take question number 19. That's in page number 9. Page number 9. Question number 19. Just go through this question and give me the answer. Okay friends, now let's solve the answer. It's an easy question. So let's understand what exactly is the requirement. Hari, an individual, carried on the business of purchase and sale of agricultural commodities like paddy, wheat, etc. He borrowed loans from Andhra Pradesh State Financial Corporation, that is APSFC, and Indian Bank has not paid any interest as detailed hereunder. So they have given the list of interest. Andhra Pradesh State Financial Corporation, the interest was for 21-22 and 22-23, total amount was 15 lakh. So Indian Bank, the interest is in relation to 22-23 and the total interest amount is 30 lakh. Both APSFC and Indian Bank were restructuring the loan facilities of Hari during 22-23, converted the above interest payable by Hari to them as a loan repayable in 60 installments. So they converted this into a loan which is repayable in 60 installments. Now, during the year ended 31st March 2023, Hari paid 5 installments to APSFC and 3 installments to Indian Bank. Now let's compute. He claimed the entire 45 lakhs as an expenditure while computing the income from the business of purchase and sale of agricultural commodities. Discuss whether his claim is valid. If not, what is the amount of interest, if any, allowable? So let's compute the allowable deduction. He cannot claim that 45 lakhs straight away as a deduction. That is the first point. How much is allowable deduction? Very simple. First one, the total amount was 15 lakhs. So 15 lakh divided by 60 installment into how many installment he paid? 5 installment he paid. So you tell me how much is the figure coming? 1 lakh? 1,25,000. Then point number 2, 30 lakhs. That loan also have been converted into 60 installment. Into how many installments he paid? 3 installments. You tell me how much is the figure coming? 1,50,000. So the total will be 2,75,000 is the actual deduction, not the entire 45 lakhs. That should be the final answer. I hope it is clear. So friends, let's finish off the other remaining administrative provisions in Pgbp. Okay friends, so let's deal with 43CA now. So let's understand what exactly is section 43CA. That is stamp duty value of land and building to be taken as the full value consideration. So let's understand what exactly is this 43CA. So let's understand which all are the provisions remaining. That is 43CA. That simply means, friends, listen. Say for example, you are an assessee and you are keeping land or building or land and building as your stock in trade. Now tell me, what will be your business? If you are keeping land or building or land and building as your stock in trade, your business will be real estate, or you are a developer. Yes or no? And you are selling it for a value which is less than stamp duty value. That simply means your sale value is less and stamp duty value is more. Your stamp duty value is more and sale value is less. Then the department will say, while computing profits under Pgbp, you need to take the stamp duty value as the deemed sales value according to the 43CA. Are you all with me? So if you are in the business of, if you are keeping land or building or land and building as your stock in trade and you are selling it for a value which is less than stamp duty value, that means SDV is high, actual consideration is low. In such scenario, SDV, stamp duty value itself have to be considered as the sales value for the purpose of computing your profits. Now there is a threshold that they mention. The stamp duty value have to be more than 110% of actual consideration. What do you mean by 110% of actual consideration? I'll give you an example for this. Listen, say for example, I've sold a particular land. I've sold a particular land which is held as my stock in trade, and the stamp duty value of this particular land is 1 crore 20 lakhs. And the actual consideration was only how much? 1 crore. So here we can say SDV is high compared to the actual consideration, but you need to check one more thing. What is the 110% of actual consideration? You tell me, what is 110% of actual consideration? The figure will be 1 crore 10 lakh. If the figure is 1 crore 10 lakh, then you can see that your SDV is more than this 1 crore 10 lakh. In such scenario only 43 CA will be come into the picture. Instead of this, say for example, instead of this, your stamp duty value is 1 crore 5 lakhs. Your stamp duty value is how much? 1 crore 5 lakh. In that case also stamp duty value is high. Yes or no? But it is not more than 110% of your actual consideration, and hence in such scenario 43 CA will not be there. You can take this 1 crore itself as the sales value. So friends, the point is pretty simple. When you are transferring a land or a building which is held as your stock in trade for a value which is less than stamp duty value, and the stamp duty value is more than 110% of actual consideration, then you should take the stamp duty value itself as the sales consideration for the purpose of computing Pgbp. I hope it is clear. Now friends, let's move on. And departments say there are a few more things to consider. Say for example, in such sale of immovable properties, there can be two dates. That means date of agreement and date of registration. What do you mean by date of agreement and date of registration? Date of agreement means you have entered into an agreement to buy a particular or to sell a particular land or a building. And the registration will happen afterwards. What is registration? For transferring a property in India, according to the Transfer of Properties Act, according to section 55, what you need to do is, you need to get registered that particular sale in the sub-registrar or the main registrar office. Are you with me? Then only it will be considered as a proper sale. Now listen. So what happened is, say for example, JK is a property developer. And I'm planning to sell a land for 1 crore. Alright, its stamp duty value as on date of agreement. Date of agreement simply means my buyer has entered into an agreement with me. In the date of agreement, the stamp duty value was 1 crore 20 lakhs. It was 1 crore 20 lakhs. And date of registration was after 6 months. And the stamp duty value went up. And it became 1 crore 30 lakhs. It became how much, friends? 1 crore 30 lakhs. In such scenario, what should be the SDV that you should consider for 43 CA section or 43 CA computation? If there are two stamp duty values, one on date of agreement and one on date of registration, one thing you have to check, that is whether JK has received an advance from the buyer by way of either account pay check or account pay bank draft or prescribed electronic modes or electronic clearing system. If I have received, the amount of advance is irrelevant. 100 rupees is fine. 1 rupee is fine. But the method is relevant. If I have received an advance, either by way of account pay check or account pay bank draft or ECS or prescribed electronic modes, then department say, I can take the stamp duty value as on date of agreement. If there is no advance or the advance is in any other method, then I need to take the date of registration's SDV for the purpose of 43 CA. Are you all with me? The point is very simple. So when I'm selling a particular land or a building or a landed building for a value which is less than SDV, and there are two SDVs, one in date of agreement and one on date of registration, I need to check whether I have received an advance on the date of agreement or before that, either by way of account pay check or account pay bank draft or ECS or prescribed electronic modes. If yes, then SDV as on date of agreement have to be considered. If no, SDV as on date of registration have to be considered. I hope it is clear. So everything is here. Now, listen, it's not yet over. So listen friends, if assessee claims that SDV is more than the fair market value of the property and SDV has not been disputed in any appeal, then assessing officer may refer the case to a valuation officer. What do you mean by SDV is less than FMV? Say for example, I have a property. Are you all listening? I have a property. Its stamp duty value is 1 crore 50 lakh. Its stamp duty value is how much? 1 crore 50 lakh. But a flood occurred in my property or near to my property or in that particular locality. Due to that, nobody wants my property. Nobody wants my property. So I'm forced to sell it for 80 lakhs. I forced it to sell it for how much? 80 lakhs. Here I am totally what? Helpless. Because nobody will be there. If I put a value of 1 crore 50 lakh or above that, nobody will come and buy. So I'm forced to sell it for how much? 80 lakhs. And the assessing officer, I've showed 80 lakhs only in the return. And the assessing officer said, this is very high. Sorry, this is not possible because stamp duty value is high and your actual consideration is less. So we cannot accept it. And my contention is, sir, my FFB is what? Very less. Fair market value of that property right now is very less. It is only 80 lakh. So do something. In such scenario, assessing officer may refer a case to whom? To valuation officer, provided I haven't disputed it in any court. If I'm disputing it in any court, then the court will decide what exactly is the FMV. If I'm not disputing it in any court, then AO may refer the case to whom? Valuation officer. We call it as DVO, District Valuation Officer. What DVO will do is, DVO will value and will give a valuation report. And if the value determined by VO, VO means whom? Valuation officer, okay. Value determined by VO exceeds SDV, then SDV may be considered. What happened? Valuation officer have given a value of 1 crore 80 lakhs. 1 crore how much? 80 lakhs. Then assessing officer will consider only 1 crore 50, that SDV. Are you with me? And if the valuation officer says a lesser value than SDV, then the value so adopted shall be considered. Say the valuation officer say assessee is right. The property's value is only 80 lakhs. Then assessing officer will consider only 80 lakhs. Or valuation officer say the property's value is 1 crore. Then that 1 crore will be considered. Are you with me? If the valuation officer reports give a higher value, then stamp duty value is the maximum curse. If he gives a lower value, then that value will be considered by the department for the rest of the computation. Are you all here? All right. So this is what 43 CA is all about. I hope it is clear. So moving on to the next provision, that is pure administrative provisions that we have to discuss. That is, who all are required to maintain books of accounts according to the provisions of income tax. That's what we are about to discuss. Maintenance of books of accounts is the provision. So compulsory maintenance of books of accounts. First of all, if you are a notified professional, which is mentioned under section 44AA of Income Tax Act, who all are notified professionals? It is there. Medical professionals, legal professionals, engineering professionals, architectural professionals, accountancy, technical consultancy, interior decoration, CBDT notified professionals, and the CBDT have notified profession of film artist, company secretary, IT, etc. If you are in this list of notified professionals, then how about the maintenance of books of accounts? That's what the flowchart says. So let's understand. All notified professionals are required to maintain the following BOA. What is BOA? Books of accounts. So which all are the books of accounts that they have to maintain? Everyone have to maintain such books of accounts and other documents as may enable the AO to compute his total income. That means the minimum things. The minimal things that will aid AO to compute your books of accounts. say for example, all your professional receipts, incomes receipt and your expenses bills, you have to maintain. Don't say, I have nothing, sir. You are not supposed to say like that. You have to maintain the minimum things. Maybe in a structured format or not, you have to maintain the minimum things to help AO to compute the total income. Now, so as per rule 6F, if notified persons have maintained prescribed books of accounts, if any of the following conditions are satisfied. So if any of the following conditions are satisfied, they have to maintain prescribed books of accounts. What is prescribed books of accounts? That is notified by the income tax department. There are certain books of accounts notified by the income tax department. Let's understand which all are the items. So listen, in case where of a new profession and gross receipts are likely to exceed 1,50,000 in the first year. You are a notified professional and your gross proceeds are likely to exceed. What is this likely to exceed? It may go beyond 1,50,000. What is this 1,50,000? Gross receipts. Then you have to maintain prescribed books of accounts in the first year itself. Or in case of an existing profession, gross receipts exceeds how much? 1,50,000 in all three preceding the previous years. What do you mean by three preceding previous years? Relevant PY, whether you have to maintain prescribed books of accounts is based on the past 3 years total gross receipts. If it exceeds 1,50,000, gross receipts exceeds 1,50,000 in all 3 years. What is all 3 years? For the past 3 years, in all three, in each year, it have exceeded 1,50,000 gross receipts. Then you have to maintain books of accounts. Again, friends, let me tell you one thing. Maintenance of books of accounts, that simply means what? Department mandates books of accounts. Everybody have to maintain books of accounts. Are you with me? Whether it is mandated by department or not. That's what 44A states. If you are not in the limit, that doesn't mean that you have to maintain nothing. Everybody has to maintain what? Books of accounts. Whether department wants to check the books of accounts or whether department mandates books of accounts. That's what the limit says. Are you with me? Everyone have to maintain books of accounts. That is the common terminology. Everybody should have a record of their transactions. Moving on. Then let's understand the maintenance of books of accounts of other persons. So let's understand if income or turnover or sales or gross receipts exceeds prescribed limits, that is section 44AA subsection 2, then have to maintain books of accounts and other documents as may enable AO to compute total income. So let's understand. Say you are an individual or HUF carrying on a business or profession. Business or profession here means other than notified professions. Are you with me? We are about to discuss the case of other persons. Other persons means what? Those who are in the business or those who are doing some other profession apart from notified profession. Are you all here? So, if you are an individual or HUF, then how to maintain books of accounts? So, in the case of an existing business or a profession, the income from existing business or profession, if exceeds 2,50,000 or total sales or turnover or gross receipts exceeds 25 lakh in any of 3 years immediately preceding the accounting year. So listen, you are an individual or HUF, either doing a business or in the profession other than notified profession, whether you have to maintain books of accounts or not. If you are an existing business, what is existing business? Not a new one. You are already doing business. In the existing business, whether department mandates you to maintain books of accounts or not is based on 2 criteria. Either your income in the past 3 years have to be more than 2,50,000 or your gross receipts in the past 3 years have to be more than 25 lakhs. Any of this is satisfied, then this year you have to mandatorily maintain all the books of accounts prescribed by the department. Are you all with me? Are you all listening? So, if you are a new business, that means a newly set up business or a profession, then your income in the first year either exceeds 2,50,000 or total sales or turnover or gross receipts in the first year exceeds more than 25 lakhs. Here also it is or. What is or? Either income or
gross receipts or turnover, whatever it is. So in that case, from first year onwards, you have to maintain the books of accounts. I hope it is clear. So these are the criteria for whom? For individuals and HUFs who are carrying on either a business or any other profession other than notified profession. Are you all listening? So moving on with the next one, friends. Person other than individual or HUF. Say you are a partnership firm, LLP, BOI, AOP, etc. Then when to maintain books of accounts? Let's understand. Say you are an existing business or profession, then income instead of 2,50,000, it is 1,20,000 in the past 3 years, in all past 3 years. Then, or total turnover instead of 25 lakhs, it is 10 lakhs in any of the 3 years. Sorry, not all, it is any, okay. When it comes to other assessees, it is any of the 3 years immediately preceding the accounting year. Are you all with me? Are you all here? So the point is very simple. If you are a person other than individual or HUF, then you are in the existing business. Then in past 3 years, out of that 3, in any, if your income exceeded 1,20,000, what is income? Your profit. Or your total turnover exceeded how much? 10 lakh in any of the past 3 years, then this year you have to mandatorily maintain books of accounts. Then, if you are a new business or profession, then income in the first year is likely to exceed 1,20,000 or total sales turnover in the first year likely to exceed how much? 10 lakhs. In such criteria, in such scenario, you have to mandatorily maintain books of accounts. We are discussing about other persons other than individuals and HUF. I hope that also is clear. And moving on to the books of accounts, again there are certain other persons also. So you are a person covered under 44 AE, 44 BB, 44 triple B, and you are showing lower income compared to these sections. 44 AE is presumptive taxation for goods transporters. 44 BB is presumptive taxation for mineral explorers. That will be covered in NR taxation. 44 triple B is presumptive taxation for foreign company engaged in the business of turnkey power projects. Will be covered in NR taxation. So all these scenarios are presumptive taxation. So in these 3 presumptive taxation, if you are showing a lower income compared to the income mentioned in the respective presumptive taxation, you have to mandatorily maintain books of accounts. Are you with me? So if you are a person covered under 44 AE, goods transporter, 44 BB, mineral explorer, 44 BB, that is a foreign company engaged in the business of turnkey power project, and you are showing a lower profit than the presumptive profits, then you have to maintain books of accounts and get it audited by a chartered accountant. It is also there. Are you all listening? So these are the factors that they say. And where the provisions of 44 AD subsection 4 are applicable. That means what is 44 AD? Presumptive taxation for a normal business person. Moving on with the next point is 44 AD, that is presumptive taxation for normal businesses. That is, in case where an assessee not eligible to claim the benefit of provisions of 44 AD subsection 1 for 5 assessment years subsequent to the assessment year relevant to the PY in which the profit has not been declared in accordance with the provisions of 44 AD subsection 1 and his income exceeds basic exemption limit. This we will cover under 44 AD itself. Say we can call it as a special circumstance under 44 AD. Are you with me? If you are covered under a special circumstance under 44 AD, you need to maintain your books of accounts. What is the special circumstance? That we will cover under 44 AD. Now, listen. So these all are the case of maintenance of what? Books of accounts in Income Tax Act. Moving on with the scenario of tax audit. So, section 44AB, that is audit of accounts of certain persons carrying on business or profession. If you come satisfy any of these conditions mentioned under, you need to mandatorily carry out a tax audit and you need to submit a audit report under 3CA or 3CB, and there is an annexure that is 3CD. 3CA is for assessees whom has audit under any other provision. Say for example company have audit under company law as well as audit under income tax act. Then 3CA, or LLP which has an audit, which has undergone an audit under LLP Act, 3CA.
If you have audit only under Income Tax Act, then 3CD. The annexure is common, 3CD. Now, who all are supposed to carry out tax audit? That's what we are about to discuss. Number one, if total sales in business exceeds how much? Exceeds 1 crore. Then you need to mandatorily carry out a tax audit. Listen, if your total turnover from your business exceeds how much, friends? 1 crore rupees, you need to mandatorily carry out what? Tax audit. But there is a point. For certain SSEs, instead of 1 crore, the limit is 10 crore. For certain SSEs, instead of 1 crore, the limit is how much? 10 crore. For whom? The turnover limit will become 10 crore instead of 1 crore if both the conditions are satisfied. What are the conditions? Number one, total cash receipts is less than or equal to 5% of receipts. Plus, both of the conditions have to be satisfied. Plus, total cash payments less than or equal to 5% of the total payments. What is that? Out of your receipts and payments, the cash receipts and payments should be less than or equal to 5%. That means 95% of the receipts as well as the payment have to be in any mode other than cash. Maybe by account paycheck or account pay bank draft ECS or any other prescribed modes. Are you with me? In that case, you are showing everything in a perfect manner because that's why you are using this digital payments and all. So your turnover limit is 10 crore. We believe you. We believe you. So your turnover limit is how much? 10 crore. Are you with me? Those who have more cash transactions, we don't believe you. We only believe an independent chartered accountant. That's why we are advising you to carry out a tax audit and bring his audit report because we completely rely on the auditor. And moving on with the next point, if you are a professional, then your gross receipts exceeds how much, friends? 50 lakhs, then you have to mandatorily carry out tax audit. If you are a professional and your gross receipts exceeds 50 lakhs, mandatory tax audit. Moving on to the third point, in case of an SSE covered under 44AE, that is presumptive taxation for goods transporters, and claims a lower profit, he need to maintain books of accounts under 44AA and he need to carry out a tax audit under 44AB. If you are a goods transporter and showing a lower profit compared to 44AE, then you need to maintain books of accounts and carry out a tax audit under 44AB irrespective of your turnover limit. Then point number 4, notified professionals covered under 44ADA claims lower profit. If you are a notified professionals covered under 44ADA, that is presumptive taxation for notified professionals, and you are claiming a lower profit, again you have to maintain books of accounts and carry out what? Tax audit. Maintain books of accounts and you have to carry out tax audit. That's what department say. And point number 5, assessee is covered under 44AD, that special scenario for a presumptive taxation that we will cover under 44AD. In that case, you need to maintain books of accounts under 44AA and get it audited by accountant in 44AB. Now, and finally, 44AB will not apply if assessee declares a profit under 44AD and his turnover from sales exceeds how much? 2 crore. See, for a person, his normal criteria is 1 crore turnover. Yes or no? If your turnover is more than 1 crore and you are opting for 44AD, then there is no requirement of tax audit. What is 44AD? Presumptive taxation under 44AD. Your turnover is more than 1 crore, but you opted for 44AD. You don't have to carry out any tax audit. That's actually a note. So friends, moving on. Assessee being non-resident covered under 44BB and BBB are also, if they are showing a lower profit, have to maintain books of accounts and carry out a tax audit. What is 44BB? Presumptive taxation for mineral explorers. 44BBB, presumptive taxation for foreign company who does turnkey power project, again will be covered under NR taxation, non-resident taxation. They also have to mandatorily maintain books of accounts and carry out a tax audit. Now there are a few notes. For the purpose of the above cash receipts or payment, as the case may be, by a check drawn on a bank or by a bank draft which is not account pay shall be treated as cash receipts or payment. This is actually an explanation inserted under 44AB. Say for example, I have told you that the turnover limit is 10 crore instead of 1 crore if the aggregate cash receipts and payments is less than or equal to 5%. In the act, they use the word cash receipt. Instead of cash, my client has given me a cash check. That also have to be treated as a cash receipt. If my client is giving me a cash check, that also will be treated as a cash receipt. If they are giving a check, then it have to be an account pay crossed check. That's what they say. For the purpose of the above cash receipts or payments, which is the above cash receipts or payments? This one. Above cash receipts or payments, as the case may be, by a check drawn on a bank or by a bank draft which is not account pay shall be treated as a cash receipt or cash payment. That means cash check or symbol cross check also will be treated as a cash receipt. A symbol cross check is not done enough. It have to be an account pay cross check. Are you with me? It have to be an account pay cross check or crossing. Symbol crossing is again not enough. Then, note number 2. The audit report furnished may be revised. You can revise the audit report furnished. But if there is any payment by such person after furnishing of report which necessitates recalculation of disallowance under 40 or 40B, and the said revised audit report has to be furnished before the end of the relevant assessment year for which the report pertains. Because there is a problem in filing audit report. What is the time limit for filing audit report? That is the next point. Time limit for filing audit report is 1 month prior to the due date of furnishing return. What is 1 month prior to the due date of furnishing return? Please listen. Your due date of furnishing return for a audit assessee is 31st October of AY. You need to submit audit report on 30th September of AY, 1 month before. Are you with me? Say for example, on 30th September, please be attentive, okay? This is very simple. On 30th September of assessment year, I haven't made a bonus payment to my employee. The bonus payment was pending. So you know 43B will come and there will be a disallowance. So at the time of audit, I might have disallowed 43B in the audit report. Are you with me? After the 30th September, my client paid that bonus to whom? To the employee. Because 43B says you have to make the payment on or before due date of filing return. So between the 30th September and 31st October, you have time to make the bonus payment. So he paid it. And now what happens is 43B is not required because that bonus is allowed as a deduction. But in audit report, what I did is like on accordance with the 43B, I have disallowed it. So I can revise it. By what time? Maximum time. It should be before end of relevant assessment year. If it necessitates. Only due to section 40. The TDS also is there. Deducted. Then after the payment time is on or before due date of filing or return under section 40A1 and 40A1A. Hope you remember. Only due to section 40 and 43B, if there is a mistake, if there is a change, I can rectify it. Not on account of other reasons. That's what the Act says. Are you with me? So the last point here is penal provision under 271B, that is if assessee fails to get books of accounts audited under 44AB, penalty shall be lower of 0.5% of the total turnover or gross receipts or rupees 1,50,000. Lower of these two. That means maximum penalty is 1,50,000 or 0.5% of the total turnover, whichever is lower. That's it. So these are the things that we have to cover under 44A, tax audit. I hope it is clear. So the next thing that we have to study is special provision for computing Pgbp on presumptive basis. That is called as presumptive taxation. So let's understand what exactly is presumptive taxation under 44AD. So listen. So what department say is, first of all, you should be an eligible assessee to claim the benefit of presumptive scheme under 44AD. Who all are eligible assessee? Listen. Eligible assessee means you have to be either a resident individual or a resident HUF and a resident partnership firm, but excluding LLP. You can be an individual or an HUF or you can be a partnership firm, but excluding LLP, and you have to be a resident. This is the eligibility. And you should not claim 10AA exemption or you should not avail chapter 6A C heading deduction. If you have claimed 10AA or chapter 6A C heading deduction, you are not eligible to claim 44AD. you are ineligible. Are you with me? You shouldn't claim either 10AA or Chapter 6A C heading deduction and Chapter 6A C heading deduction. Plus, in any business except agency business. If you are in agency business, you are not eligible for 44 AD. You are in commission and brokerage business, you are not eligible for 44 AD. You are in eligible business under 44 AE, then again you are not eligible for 44 AD. What is 44 AE eligible business? Goods transporting agent. We call it as GTA. Goods transporting agent owning 10 vehicles or less are the eligible assessees under 44 AE. You shouldn't be that assessee also. Plus, your turnover should be or gross receipt should be less than or equal to 2 crore in the relevant financial year. If all the conditions are satisfied, we can say that you are eligible for presumptive scheme under 44 AD. Are you all listening? So 3 things, or we can say 4 things. Number 1, individual, HUF or partnership firm excluding LLP who is a resident. Don't claim 10AA or Chapter 6A C heading deduction. Your turnover should be less than or equal to 2 crore in the relevant previous year. Your business should be in any business. You should be in any business except agency, commission and brokerage and goods transporting. Then you are eligible under 44 AD. And what is 44 AD? It says eligible assessee declaring profit under, 44 AD it says your presumptive income shall be 8% of the total turnover, minimum 8%. Say for example, your turnover is 1 crore 80 lakh. Your turnover is exactly 2 crore. It is easy then. Exactly 2 crore. Are you eligible? The answer is yes, because less than equal to is there. Less than or equal to is more than enough to satisfy the condition. So exact 2 crore also you are eligible. Now, if your total turnover is 2 crore, then how much should be your profits? You should declare 8% of 2 crore. How much is 8% on 2 crore? You should declare at least 16 lakhs as your profit. They say minimum. That also means you can declare 20 lakhs. But it is not mandatory. Minimum 8% is more than enough. If you want to declare more, you can do that. You are welcome. That's what the department says. Now, department also says one more thing. However, the presumptive income, the presumptive rate will become 6% if the your receipts are by way of an account pay check or account pay bank draft or ECS or through prescribed electronic mode, and it have to be received on or before due date of filing return. Say for example, out of this 2 crore, 1 crore 40 lakh you have received through account pay check. Account pay check. And the remaining 60 lakhs you have received in cash. Then on this 1 crore 40 lakhs, you can claim 6%. And on 60 lakh, you have to claim 8%. Not claim, you have to show 8%. So if your receipts, that too on or before due date of filing return, you have to receive that amount on or before due date of filing your return by way of either account pay check or account pay bank draft or ECS or through prescribed electronic mode, then you can show 6% instead of 8%. I hope that too is clear. Now listen, if assessee covered under 44 AD and then not required to maintain books of accounts and no audit required. So if you are covered under 44 AD, then it's not necessary that you have to maintain your books of accounts and there is no requirement of any audit as well. Now, note number 2, all the deductions from section 30 to 38 shall be deemed to have been claimed. What do you mean by that? That simply means you are showing only 16 lakhs. If 2 crore is your total turnover and 8% is the rate that you apply, then your profit will be 16 lakh. From this profit, again, you are not supposed to claim any deductions from section 30 to 37. That's what they say. All the expenses have been deemed to have been applied. You cannot claim any of the deductions from 30 to 37, 30 to 38. 38 is the proportionate. Proportionate means if you claim, say for example, you are using a particular machinery partly for personal purpose and partly for official purpose, then that proportion. That's what section 38 is all about. We have discussed that under 32 itself. Hope you remember. Now, in case of a firm, salary and interest paid to partners again is not deductible. For a partnership firm, they can claim a deduction under 40B. Hope you remember. 12% as the interest on capital and ceiling limit for remuneration paid to working partners. Again, you cannot claim that. If you are an eligible partnership firm opted for 44AD, from that profits, no more deduction under 40B as well. Now, the eligible assessee opting for 44AD is required to pay advance tax by 15th March of a financial year. This is important because you may get a MCQ question from this. Say for example, for a normal assessee, he need to pay advance tax in 4 installments. 15%, 45%, then 75%, 100% on 15th of June, 15th of September, 15th of December, and 31st of March. Instead of that, you can pay all your advance tax in a single shot by which date? By 15th of your March or 31st of your March. Single shot is more than enough. And one more note is there. WDV of the asset of the eligible assessee shall be deemed to have been calculated as if you have claimed all the depreciation for each year covered. That also means if you are opting for 44AD, you have to maintain a depreciation schedule. What is depreciation schedule? Every year you are supposed to depreciate the value and you are supposed to maintain the WDV value, but you cannot claim the depreciation from the presumptive income. Why? Because all the 30 to 38 deductions have been deemed to have been claimed. But you need to maintain a depreciation schedule. Every year covered under 44AD, you need to depreciate the value of your capital assets. Maybe after 10 years or 12 years, you are opting for the normal provision. On the 12th year, how much is the WDV value? On that value, you can claim what? Further depreciation. Every year, you need to depreciate the depreciation schedule or the capital assets. That's what they say. And now, this is the special one. We have skipped 44AA. Under that, there is a special scenario we have discussed. That's what we are about to discuss. Listen, if eligible assessee declaring profit under the scheme opts out from the scheme in any of the 5 consecutive PY, then he shall not be eligible to opt this scheme again for the next 5 subsequent PY. Friends, listen. First of all, whether 44AD is mandatory? No. 44AD is not mandatory. If you want, you can opt it. If you are an eligible assessee, satisfies all the conditions, you can opt it. Nobody is mandating you to opt for 44AD. That is the first thing to know. Number 2, you opted 44AD. And for the next 5 years, if you are opting out from 44AD, what is opting out? Year 1, I've opted for 44AD. Year 2, I'm opting what? Normal provision. I can. Alright, there is nobody restricting you that you have to continuously opt for 44AD. Year 2, I'm opting out from 44AD. Then for the next 5 years, I cannot opt 44AD. Are you with me? So listen, if an eligible assessee declaring profits under this scheme opts out from the scheme in any of 5 consecutive years, then he shall not be eligible to opt this scheme again for next 5 subsequent years. That means year 1, 44AD. Year 2, I've opted for normal. Then for the next 5 years means year 3, 4, 5, 6, 7. I cannot opt 44AD. Are you with me? I think it is 5. 1, 2, 3, 4, 5. Yes. For the next 5 years, I cannot opt 44AD. Is that clear? Now, in the above cases, assessee is required to maintain books of accounts and carry out tax audit. That means in the next 5 assessment years, I have to mandatorily, or from year 2 onwards, I have to mandatorily maintain what? Books of accounts and carry out tax audit. I'm opting and opted out. Then from year 2, maintain books of accounts and audit. Year 3, 4, 5, 6, 7, maintain books of accounts, carry out tax audit. What about year 8? Depends upon the turnover. Depends upon the turnover. I can decide whether I have to carry out tax audit or not. If the turnover is less than 1 crore, or if the turnover is less than 10 crore, depends upon the receipts and payments. If I'm not required to do tax audit, don't do it. But in year 2, 3, 4, 5, 6, 7, mandatory books of accounts and mandatory tax audit. If I'm opting it out, are you with me? I hope it is crystal clear. There is nothing, no confusing point should be there. It is pretty much straightforward point. Now, this is all about 44AD presumptive scheme. Are you all listening? So moving on, friends, with the next presumptive scheme, that is 44ADA, presumptive taxation scheme for assessees engaged in eligible profession. Who all are eligible profession, friends? medical, legal, architectural, etc., which we have covered under 44AA. Hope you remember this box. This box over here, this is the list of what? Notified professionals. Let's read it again. Which all are the notified professionals? Number 1, legal. Number 2, medical, engineering, architectural, accountancy, technical consultancy, interior decoration, CBT notified professions. Which all are the notified ones? Film artist, company secretary, information technology. You tell me chartered accountant whether is notified or not, or cost accountant whether he is notified or not. Yes, notified. He comes under the accounting. Where is accounting? Yeah, this is the accountancy. He will come under this particular bracket. Are you with me? Now, if you are a notified professional, then you are eligible for 44ADA presumptive scheme, subjected to satisfaction under conditions mentioned under 44ADA. Let's understand which all are the conditions. So, friends, listen. So, first of all, you should be an eligible assessee. Let's understand who exactly is the eligible assessee. Listen. So, friends, that is all about 44ADA. That's what we are about to discuss. So, listen, eligible assessee. Who all are eligible assessee? Gross total receipts. Or your gross receipts or total receipts should be less than or equal to how much? 50 lakhs. The first thing is your gross receipts or total receipts should be less than or equal to 50 lakhs. Then you should be a notified professional under 44AA of Income Tax Act, and plus you should be a resident individual or a resident partnership firm excluding LLP. So listen, friends, for claiming 44ADA, either you have to be a resident individual or a resident partnership firm, but excluding LLP, plus you should be a notified profession, plus your gross total income should be less than or equal to 50 lakhs. If all these things are there, then you are an eligible assessee for 44ADA. Now, the first thing is your presumptive income shall be 50% of your gross receipts. Say for example, my total receipts is 40 lakh. Then the profit shall be 20 lakhs. 50% of the total gross receipts is the minimum presumptive income. If you think that you want to show 25 lakhs, then you are most welcome. You can show more than that. It is okay. But you are not supposed to show a lower amount. Now, if assessee opted for 44ADA, then not required to maintain books of accounts and tax audit is actually not required. And not number 2, all the deductions from 30 to 38 have been deemed to have been claimed. All the deductions from 30 to 37 have been deemed to have been, 30 to 38 have been deemed to have been claimed. Why? Because afterwards you cannot take any other deduction. And then, in case of a firm, salary and interest paid to the partner is not deductible. If you are a partnership firm opting for 44ADA, you cannot claim that interest on capital as well as salary paid to your working partners as a deduction. Then, the eligible assessee is required to pay 100% advance tax by 15th of March of the financial year. It is similar to 44AD. Are you all listening? It is similar to 44AD. You pay all the advance tax in a single shot by 15th of March. Again, friends, this 15th of March also can be read as 31st of March. That is there in the advance tax portion. Now, note number 5. WDV of the asset of the eligible assessee shall be deemed to have been calculated as if he have claimed all the depreciation for each year covered under 44ADA. That simply means if you are covered under 44ADA, what you need to do is every year you need to maintain the depreciation schedule and you need to remove the corresponding depreciation and maintain the correct WDV value every year. And friends, you are an eligible assessee under 44ADA, but not opting for 44ADA mandatory books of accounts plus mandatory tax audit. Both 44AA you have to follow and 44AB you have to follow. You are an eligible assessee and you are not opting for 44AB, then you have to maintain books of accounts and carry out tax audit. That's what department say. Now, that's all about 44ADA. Now, we are about to discuss 44AE. So, friends, moving on with the next one, that is 44AE, that is special provisions for computing profits and gains of business of plying and hiring or leasing goods carriages. So, if you are in the business of plying, hiring or leasing goods carriages, then 44AE is applicable for you, or we can say goods transporting agents, GTA.
Now listen. So there are certain conditions for this. Income is computed per vehicle. It is not a percentage of your turnover. 44 AD and ADA was a percentage of your turnover or gross receipts. Yes or no? But when it comes to 44 AE, the presumptive income is computed based on per vehicle. And assessee should own less than or equal to 10 goods vehicle. If you own more than 10 goods vehicle, you are not eligible for 44 AE. So 44 AE eligibility is based on the number of vehicles that you own in a year. Say for example, today evening I had 10 goods vehicles. Are you with me? Today I have 10 goods vehicles. Today evening I bought one more vehicle. And tomorrow morning I sold another vehicle. So today evening, how many vehicles I have? 11. I'm not eligible. So at any point of time in a PY, if number of vehicles is more than 10, you are not eligible. Are you with me? At any point of time in a PY, if you have more than 10 goods vehicle, you are not eligible. Say today evening I sold one of my old vehicles and tomorrow morning I bought one. Then today evening, after selling that vehicle, my count is 9. Tomorrow morning I bought another one, it is 10. Are you with me? So it is like that. In exams it is that strict, but in practical and all, it's okay. Okay, yes. So the business should be leasing goods carriages. So this is the criteria or characteristics for an eligible assessee. Listen, the ownership of vehicles is very important. You should own less than or equal to how many? 10 goods vehicles. Plus your income is computed per vehicle. Plus your business should be goods transporting. Now let's understand how to claim this presumptive income. In case of heavy goods vehicles, then 1000 rupees per ton into gross vehicle weight into number of vehicles into number of months or part thereof. This is how you compute. What do you mean by heavy goods vehicles? If your goods vehicle have a capacity of more than 12 tons or 12,000 kilograms. If your vehicle's net tonnage capacity is more than how much? 12 tons or more than 12,000 kilograms. Both are same. 1 ton equal to 1000 kilograms. If it is more than exactly 12, it is not heavy. More than 12, it is heavy. Now, if it is heavy goods vehicle, then how do you compute the presumptive income? Rupees 1000 per ton into number or the gross vehicle weight. We can call it as vehicle weight into number of vehicles into number of months of ownership or part of a month. What do you mean by part of a month? 1 day have to be counted as a single month. So friends, listen, if it is a heavy vehicle, then how do you compute presumptive income? Rupees 1000 per ton into total vehicle weight into number of vehicles you have into number of months you've owned or part thereof. Now, if it is not a heavy vehicle, then how do you compute? In other vehicles, then 7,500 per vehicle, not per ton. 7,500 per vehicle. Now you tell me which is other than heavy. Have a net vehicle capacity, not tonnage capacity of 12,000 kilograms or less, or 12 tons or less. This you have to by heart. Now listen, 7,500 per vehicle into number of goods vehicles into number of months or part thereof based on the ownership. Are you with me? Now, here there is a speciality. Here Act say all the deductions from section 30 to 38 have been deemed to have been claimed, but if you are a assessee eligible under 44 AE, from the presumptive income, you can deduct what? You can deduct the interest on capital as well as remuneration that you pay to your partners. If the assessee is a partnership firm, from the presumptive profit, you can claim 40B deduction again. Are you with me? But 44 AD and ADA says you cannot claim 40B again. But 44 AE is super clear. You can claim 40B again from the presumptive income. That is the only extra deduction under Pgbp. Are you all listening? That is the only extra deduction under Pgbp. You can claim 40B. Now, again, assessee opted for 44 ADA. This should be 44 AE. Okay, this should be 44 AE. Assessee opted for 44AE, then not required to maintain books of accounts and tax audit is also not required. Then deduction from 30 to 38 shall be deemed to have been claimed. Eligible assessee has to pay advance tax in 4 installments. Under 44 AD and AD it was different. You can pay your advance tax in a single installment 100% on by 15th March. Here you have to follow all the 15%, 45%, 75%, 100% installments. Now, WDV of the asset, that depreciation schedule you have to maintain. And finally, in respect of a tractor or a road roller, profit shall be at the rate of 1000 per ton of unladen weight basis. If your vehicle is a tractor or a road roller, then again you have to consider it as a heavy vehicle because it does not have a tonnage weight capacity. Does road roller have a tonnage weight capacity? No. What is tonnage weight capacity? Loading capacity. It's not the weight of the vehicle. You don't have to weigh the vehicle. It's the weight holding capacity. Are you with me? How do you find out weight holding capacity? You go check its registration certificate. We call it as RC. It will be notified over there. Are you with me? So this is how you compute 44AE. Now let's solve the question in relation to this. So please take your question sheet, friends. So please take question number 21. It's in page number 9. Page number 9, question number 21. Read the question and give me the answer. Alright friends, so let's solve it together. It's an actually easy, very easy question. So Mr. X commenced the building of operating goods vehicle, business of operating goods vehicle on 1st April 22. He purchased the following vehicles during 22-23. Compute his income under 44AE for assessment year 23-24. Gross vehicle weight in kilograms, 7,000. So you tell me whether it is heavy or other than heavy. Other than heavy. OTH means other than heavy. Then how do you compute presumptive income? 7,500 per vehicle into how many vehicles? 2 vehicles into how many months? 12 months. Tell me the figure. 1,80,000. Then next is also other than heavy. So 7,500 into how many vehicles? 1 vehicle into how many months? Only 1 month. So the figure will be 7,500 itself. Then next is 10,000 kilograms. That is other than heavy. 7,500 per vehicle into how many vehicles we have? 3 vehicles, right? Into how many months? From July onwards we have 9 months. Tell me the figure. 2,02,500. Then again next is also other than heavy. 7,500 per vehicle into how many vehicles we have? 1 vehicle into how many months? On 3 months, because it is on 2nd January. Part of day, even 1 day will be counted as 1 month. So 3 months. How much will be the sum? 22,500. Now, how about the other one? Next one, it is heavy vehicles. Yes or no? It's a heavy vehicle and hence 1,000 per ton into 15 tons into how many vehicles? 2 vehicles into how many months? 8 months. Tell me the figure. Then the next one is also heavy vehicle. That is 1,000 per ton into how many tons? 15 tons into how many vehicles? 1 vehicle into how many months? 2 months. February we have only 5 days, but you have to treat it as a single month. So 2 months, 30,000. Now you tell me the total figure. 6,82,500 will be the total sum. I hope it is clear. Now friends, listen. Would your answer change if the goods vehicles purchased in April 22 were put to use only in July 22? The answer is no. There is no change. Why? Because it is based on the ownership, not on the basis of put to use. You own a vehicle, you need to compute this presumptive income, whether you actually put to use it or not. Based on ownership, we need to compute the presumptive income under 44AE. I hope it is clear. Now I can say all the theory in relation to Pgbp is over. Everything we have covered and we have problems remaining that we will cover. Okay friends, now let's finish off the problems in Pgbp. So I want all of you to take page number 9, question number 22 in Pgbp and try to solve the answer by yourself. So when you read the question friends,
be very, very careful with the dates. Okay. So the question is there in the next page also. So I want you to read the entire question. Okay. You flip the page. There is remaining part in the next page as well. So question number 22. All right, friends. So let's do it together. So the trading and loss account of Dumbledore Trading Private Limited, having a business of agricultural produce, consume item and other products for the year ended 31st March 2023 is as under. So they have given a trading P&L account. Opening stock is there, purchase, freight, then sales is there, closing stock is there. Then bonus to staff, rent of premises, advertisement, bad debts, interest on loan, depreciation, GST demand, miscellaneous expenses, net profit for the year. Then gross profit is there, income tax refund is there, warehousing charges are also there. Now, the one and only one information for the time being I require is what? Net profit as per P&L account. So what I'm doing is, so first of all, I'm writing the head's name, that is Pgbp. Anyways, Pgbp income is there because he has some business activity. So I will write the head name Pgbp and we will write net profit as per P&L account. P&L account. How much is a net profit as per P&L account, friends? It is 33,90,000 is the net profit as per P&L account. 33,90,000 is the net profit. Now, let's go back to the question and read the additional adjustment. So this is the way that you have to solve a question in your examination. First, go and pick the net profit figure, then finish all the additional adjustments. After finishing all the additional adjustment, you should have a quick overview of the P&L and trading account to check for the other adjustments, if any, there. Now, we'll start with the first adjustment, that is, there was a survey under 133A on the business premises on 31st March 2023. What do you mean by survey? The department officials will come to your office premises and they will collect information from your premises itself. They will verify your books of accounts and they will collect information. Hope you have heard about a survey in the premises of BBC. I think 2 or 3 months before, there was a survey conducted by the department in the premises of BBC, India, and they collected information against BBC. So such process they usually does. So there is always a difference between survey and search. They will come, take your books of accounts, they will seize your assets, that is search. Survey means they will come and verify your books of accounts and they will go by collecting information, that's it. Now, on business premises on 31st March 2023, in which it was revealed that the value of closing stock as on 31st March 2022. What is the relevant PY in the question? What is the relevant previous year in the question? It is 2022-23 is the relevant PY in the question. Yes or no? When they say closing stock as on 31st March 2022, that means opening stock in the year 2022-23. The opening stock should be 8,75,000. But what is the opening stock value in the books of accounts? It is only 375. It should be 875. It should be 875. That simply means you have to increase 5 lakhs as opening stock. When there is an increase in the opening stock, then what will happen to your profits? Your profit will go down. Yes or no? Because opening stock is a debit item. If you increase opening stock, your profit will come down. So only adjust that effect of increase in opening stock in the net profit. That's it. You don't have to restate P&L account and all. It is totally based off type. Don't go and restate the P&L account. Just do the effective adjustment to the net profit. That is more than enough. So 5 lakhs you have to deduct it from the net profit. So less opening stock adjustment, that is 5 lakh. You have to deduct from the net profit. Then it's not yet over. What they are saying is the next point, as there is an omission of 75,000 was made on 13/3/2023 was not recorded in the books of accounts. So they omitted to record a sale. If they omitted to record a sale, that simply means you have to increase the profit because sale is a credit item. That 75,000 have to be increased to the net profit as an adjustment. Yes or no? So what you need to do is adjust sales value, sales omitted. And how much is the amount? 75,000 have to be added to the net profit. Now, moving on to the next adjustment, what they are saying is the value of closing stock after considering these facts
and on the basis of inventory prepared by the department as on 31st March 2023 worked out at 12,50,000. So the closing stock value should be 1250. Now you tell me what is the closing stock that they disclosed? It is 450 only. It should be 1250. Now how much should be increased? 8 lakh should be increased. If there is an increase in the closing stock, then there will be an increase in the net profit as well. Why? Because closing stock is a credit item. So what you need to do is you need to add 8 lakhs as closing stock adjustment. 8 lakh to your net profit to increase the effect of profit. So these are the three adjustments in relation to the first additional adjustment. I hope it is clear. Is that clear, friends? Moving on. So point number 2, it says income tax refund includes an amount of 4570 of interest allowed thereon. So let's go back to the P&L account, and there is a thing called income tax refund. First of all, this income tax refund is not at all a Pgbp item. What is income tax refund? Excess tax paid given back by the department is said to be what? Income tax refund. That refunded amount of income tax is not your income. But if there is interest on income tax refund, that portion only is your income. So there are two adjustments required. Number one, you remove the effect of 20,000 from the net profit. Are you with me? You need to remove the effect of 20,000 from the net profit and add the interest element as an item under IFOS. So what you need to do is we need to deduct IT refund full 20,000 from Pgbp, and we'll start a new head that is IFOS. You can write it under, okay. To bring everything under one page, I'm writing it parallelly. So interest on IT refund. How much is the interest on IT refund, friends? How much is the interest on IT refund? 4570 is the interest on IT refund. That is your income, which is accessible under income from other sources. Are you all with me? Moving on with the next one, that is bonus to staff includes an amount of 7,500 paid in the month of December 2022, which was provided in the books on 31st March 2022. That means past year. Yes or no? 31st March 2022 means which financial year, friends? Or which previous year? 2021-22 there was a bonus which is paid in December 2022. That simply means in 21-22 it would have been disallowed under 43B. Last year it would have been disallowed under 43B. Since you actually made the payment in December 2022, that means what is the due date for filing return for the year 21-22? What is the due date for filing return for the year 21-22? 31st October 2022. So this bonus is paid after the due date. Hence there will be a disallowance in the year 21-22. Since it is paid in between 22-23, you can claim it as a deduction. But bonus to staff includes this 7,500. That's what they say. That simply means in this bonus to staff, they have accidentally added that 7,500 to your P&L. It is already debited. Now you tell me what should be the adjustment? No adjustment required since it is already debited to the statement of P&L account. No further adjustment required. Is that clear? There is actually an accounting error here, but that's not our headache. They are required, they want us to compute the income from Pgbp. That's it. We don't have to rectify their accounts and all. Are you with me? All right. Now, moving on. So what is the adjustment? No adjustment required. It is disallowed in 21-22. Since it is paid in December 2022, you can claim it as a deduction in 22-23. But it is already debited to the statement of P&L account and hence no further adjustment required. But you need to write this note. If you skip the note, then department will say, institute will say, you have skipped that particular adjustment. You need to write a note for this. If you skip that note, or if you didn't write a note, they will say, you haven't read that particular adjustment. Are you with me? There will be a loss of mark. Now, moving on to the next one. Rent of premises includes an amount of 5,500 incurred on repairs. The assessee was under no obligation to incur such expenses as per the rent agreement. So, assessee don't have to incur expenditure on the rented premises, but he incurred. If he incurred, he can claim it as a deduction. Whether he should be incurred as per rental agreement or not, the section 30 say you have a building, you use it for your business, you have incurred some expenditure.
then you can claim it as a deduction. Whether you have to incur that expenditure according to your rental agreement is not at all a factor. If you incur that expenditure, you can claim it as a deduction, irrespective of whether it is provided in the rental agreement or not. Are you with me? So since it is already again debited to the statement of pre-rental account, because rent of premises includes that amount. That's what they say. Since it is already debited to the statement of pre-rental account, again no further adjustment required. But you need to write a note, irrespective of whether the person have to incur that expenditure as per rental agreement. If he incurred it, he can claim it as a deduction. It is already debited to the statement of pre-rental account and hence no further adjustment required. That should be your note. Moving on. Next is advertisement expenses include an amount of 2,500 paid for advertisement published in souvenir issued by political party. So if you have given an advertisement in any political party magazine, brochure, tract, pamphlet or their souvenir, etc., then what will happen? That will be treated as a political party contribution and it will not be allowed as a deduction under 37, but you can claim it as a deduction under 80 GGB. Since the assessee is a company assessee, it will be under 80 GGB on a condition that the payment should be made in any mode other than cash. Section 80 GGB says when you are making a political party contribution, your method of payment should be any mode other than cash. So the question also says the payment is made by way of an account pay check, and hence this should be a disallowance under Pgbp, but you can claim it as a deduction under 80 GGB because the question asks you to compute the total income. Yes or no? So you need to take the 80 GGB deduction as well for computing the total income. I hope you guys are listening. So what you can do here is we can add back that amount 2,500 from the net profit. So adding back political party magazine advertisement 2,500 you need to add back. Then you can claim it as a deduction under chapter 6A. So I am leaving some space here and chapter 6A deduction. Chapter 6A deduction under which section, friends? Under 80 GGB, political party contribution. The amount is 2,500. There is no limit for political party contribution deduction. How much ever you want to pay, you pay and claim it as deduction. Are you with me? So moving on with the next deduction, friends, or next adjustment, friends. Miscellaneous expenses include amount of 15,000 paid towards penalty for non-fulfillment of delivery conditions of a contract of sale for a reason beyond control. It's a contractual penalty. Yes or no? And hence it is allowed as a deduction. It is already there as a part of the miscellaneous expenses. It is already there as a part of the miscellaneous expenses and hence no further adjustment required. Are you all with me? Moving on. Next is amount of 1 lakh paid to wife of director who is working as a junior lawyer for taking an opinion on a disputed matter. The junior advocate of High Court normally charges only 25,000 for the same opinion. You paid something which is more than the market value to your relative, spouse, wife. Yes or no? How much is the unreasonable amount? 75,000, because normally a junior advocate charges only 25,000. Since it is your wife, she might have pulled your collar and she might have charged how much? 1 lakh. And how much is the excess? 75,000 is the excess, and that full 75,000 is a disallowance under 40A2. So what we can do is excessive payments to relatives, disallowance under section 40A2, 75,000 rupees. You need to add back to the profit because it is already debited to the statement of P&L account under miscellaneous expenses. So let's come back to the point, friends. So we have added back 75,000 under 40A2 since it is an excessive payments to your related persons. Now point number C, amount of 1 lakh paid to electoral trust by check under miscellaneous expenditure. You need to add it back from the miscellaneous expenditure and you can claim it as a deduction under 80 GGB. Hope you remember, under 80 GGB I've told you, both donation to the political party as well as electoral trust is allowed as a deduction under 80 GGB. So what you can do is, you need to add this donation
to electoral trust and the amount is 1 lakh. You need to add it back under Pgbp and you need to deduct it under 80 GGB. So electoral trust contribution. How much is the amount, friends? 1 lakh. Again, that payment also should be made in any mode other than cash. So they say by check and hence it is fully deductible. Moving on with the next item, that is GST demand paid includes an amount of 5,300 charged as penalty for delay in filing of returns. It is also called as late fee. Can you claim GST late fee as a deduction? It's penal in nature and is never allowed as deduction. So 5,300 you need to add back to the net profits. So GST penalty 5,300 you need to add back. Then there is something else, and 12,750 towards interest for delay in deposit of tax. Interest is compensatory in nature and hence GST interest is allowed as a deduction, but GST penalty is violative. It's for the violation that you have done of the in relation to the act and hence it is not allowed as a deduction. GST interest always allowed as a deduction and it is there in the GST demand paid. It is already debited to the statement of P&L account and hence no further adjustment required, only a notice required. Moving on. The company had made an investment of 25 lakhs on construction of warehouse in rural area for the purpose of storage of agricultural produce. Warehouse for storing agricultural produce is what type of business? Specified business mentioned under 35AD. Yes or no? So what to be done? You need to treat it as a separate business. You are not supposed to mix it up everything. You have a normal business and a specified business. You have to maintain separate computation and separate books for that. So what you need to do is, this 25 lakhs is what? An investment for building. That means it is deductible under 35AD. That is number one. This was made available for use from 15 September 2022 and income from this activity is credited in the P&L account under warehousing charges. So you go to the P&L account and you can see warehousing charges of 15 lakh. So this is from that particular business. So what you need to do is, you need to reduce this 15 lakh from the normal business income and add it as a specified business income. From that specified business income, you are supposed to deduct 35AD deduction. Are you with me? So the correct treatment is, first of all, let's less this warehousing charges. Warehousing charges, the amount is 15 lakh. You need to reduce it here. Then you need to consider it as a separate business item. That is income from specified business. How much is the income, friends? 15 lakhs. Then you can claim deduction under section 35AD, that is for building construction. And how much is the deduction? 25 lakhs. That is the investment that you have done for building. It is fully allowed as a deduction. And there is loss from specified business. There is loss from specified business. Now the question is, can you claim this loss from specified business as the, can you claim this loss as a deduction from your normal business profit? Can you set it off? Not possible. So what you need to do is, you need to carry forward this loss to subsequent years. You need to carry forward this particular loss to the subsequent years because you cannot claim specified business loss with a normal business profit. Specified business loss can be set off only with specified business profit. I hope it is clear. Moving on with the next adjustment, friends. What all are the other adjustments pending? Depreciation under income tax works out at 65,000. So now let's check the P&L account whether we have claimed any depreciation. Have we claimed any depreciation? Yes. We have claimed some excess depreciation. Depreciation as per Income Tax Act is only how much? 65,000. Now you tell me how much is the excess that we have claimed. 6,500 have to be added back to the P&L account. Why? Because your actual depreciation is only 65. You have claimed around 71,500. You need to add back the excess depreciation. So adding back excess depreciation 6,500. Then what else you have? I think it is the last adjustment. Interest on loan includes an amount of 80,000 on which tax was not deductible. If the tax is not deductible, then you tell me what should be the adjustment. Then if the payee is a resident, then it is 30% disallowance. If the payee is non-resident, 100% disallowance. Are they saying something about the payee? They are silent about payee. Hence, what should be the assumption? If they are not specifying anything about the residential status, then all the persons here are residents. If they are non-resident, they will clearly mention that. Otherwise, all the persons in a story will be always residents. So what we can do here is 40A 1A disallowance will come. So disallowance under section 40A 1A, 30% of 80,000. How much is 30% of 80,000? 24,000 have to be added back as a disallowance. Then compute the income chargeable to tax for assessment year 23-24 or Dumbledore Private Limited, ignoring the math, and support your answer with working notes. Okay, fine. Now let's have a look at the trading account first. Opening stock is there, we have already adjusted. Purchases is there, freight and cartage is there, no problem. Sales is there, closing stock already adjusted. Then anything else pending? Let's look at the P&L account. Bonus to staff, rent of premises, advertisement, no problem. Bad debts is there, interest on loan we have adjusted, depreciation, GST demand, miscellaneous expense we have adjusted, net profit is there, gross profit, income tax refund, warehousing charges. So there is nothing more to adjust. There is nothing more, but always have a cross verification. When we complete with all the additional adjustment, always do a cross verification of your P&L account, because there might be something which we have missed. So now it's time for us to compute everything together. First, friends, be very careful. Just help me in computing the normal business profits. Just help me in computing the normal business profits. So profit from, we can write normal business. How much will be the profit? 24 lakh 58,300. So 24 lakh 58,300. Don't adjust this 10 lakh with this 24 lakh. Don't do this, because we have already carried forwarded this particular loss to the next year. And we have one more income that is under IFOS, that is 4570. Friends, now tell me how much is the gross total income? Gross total income by adding this 24 lakh 58,300 plus 4570. Add these two and tell me how much is the gross total income. Add these two and tell me. 24 lakh 62,870. Then you deduct 2,500 and 1 lakh as the chapter 6A deduction and tell me the total income. How much is total income? 23 lakh 60,370. That is the final answer to the question. I hope it is clear. So friends, now I want you to take the next question, that is question number 23. So take question number 23, it's in page number 11, and try to solve the answer. Be very careful with the adjustments. Okay, yes. So friends, let's read question number 23. That is, Ganga Limited is engaged in the business of manufacturing fertilizers since 1st April 2009. So the first point is whether it is a specified business or not. The answer is no. Because for a fertilizer business to become specified business, what is the date of commencement recommended by department? 1st April 2011. It started before 1st April 2011. Hence, we cannot say that it is a specified business. But there is one problem. Do we have to really by heart the dates? No. There is a hint in this question itself. If you can go down, then they have clearly stated that normal depreciation allowable as per income tax rules 1962 is 62 lakhs. That simply means what? This business is claiming normal depreciation. If they can claim normal depreciation, then they will be what? They won't be specified business, because if they are claiming normal, if they have claimed 35 AD deduction, then they cannot claim normal depreciation. That is the hint from the question itself. Are you with me? Are you with me? Moving on. So friends, let's go to read the question. Its statement of profit and loss account shows a net profit of 350 lakhs. So we will note down that particular figure first. So net profit as per P and L account. How much is the figure, friends? 350 lakhs. So I will write everything in lakhs. Now, for the year ended 31st March 2023, after debiting and crediting the following items. So friends, all the following items have been either debited or credited. Let's go to the first question. First adjustment. Depreciation provided in accounts as per SLM basis, that is 50 lakhs. So what to do with that? Add back, because you cannot claim depreciation on SLM basis. So the better way to do this is to add back. Alright, so what you can do is depreciation as per SLM basis. How much is it? 50 lakhs. Then you can deduct the depreciation as per normal IT rule. And how much is the depreciation as per normal IT rule? It is there. 62 lakhs. Or rather, what you can do is you can deduct that extra 12 lakhs by stating it as an adjustment. That is also fine. I've written it like this, that you want, you can write in the other way also. Alright, now moving on to the next item. The opening stock and closing stock for the year were 200 lakhs and 255 lakhs respectively. They were overvalued by 10%. What do you mean by that? This opening stock is overvalued by 10%. Don't take 200 into 10%. That 200 itself is an overvalued figure. Yes. So how do you find out the correct figure, or what is the overvalued figure? See, this 200 figure is after that overvaluation. Yes or no? Read that again. Opening and closing stock for the year were 200 lakhs and 255 lakhs respectively, and they were overvalued by how much? 10%. Now what you need to do is, this 200 is an overvalued figure, and hence 200 lakhs divided by 110% is already overvalued. Into 10% is the overvalued figure. How much will be the 10% of that? Help me with the figure. 18.1818 will come, right? So we will write 18.18. So that is the overvalued figure. So you need to reduce 18.18. If you reduce opening stock, then what will happen to your profit? Profit will go up. Yes or no? If you reduce opening stock, your profit will go up. So what you need to do is, you need to add opening stock adjustment, and it is 18.18. I hope it is clear. It's not yet over. Closing stock is also there. How much is the closing stock figure? 255 lakh. That is also overvalued figure. Yes or no? So how do you find out the overvalued figure? 255 divided by 110% into 10%. You tell me how much is the overvalued figure? 23.18. Closing stock is also overvalued. So you need to bring down closing stock. When you bring down closing stock, your profit will go down or come down. Are you with me? So what we need to do is less closing stock adjustment. That is 23.18. Or you can take the differential and you can adjust that 5 lakhs. That is also fine. That is also fine. You will get full marks. If you do it in differential also, you will get full marks. I have taken everything separately and computed for a better understanding. Okay, you can do it in a differential manner also, absolutely no problem. Now, moving on to the next one. That is fees of 1 lakh paid to independent director for attending board meeting without deduction of tax at source under 194J. 30% of the sum shall be disallowed. Are you with me? Because 194J deals with TDS when you make a payment to a resident director. Now, how much is the disallowance? 30% of the sum shall be disallowance, and the section shall be section 40A 1A. 30% means 0.30, because we have written everything in lakhs. Are you with me? Don't write 30, okay? It is 0.3 because we have converted everything into lakhs. So you need to add back 0.3. Then, what is next, friends? 9 lakh contribution to National Laboratory approved under 35(2AA). If you contribute anything to National Laboratory under 35(2AA), 100% of the donation is allowed as a deduction. Since it is already debited to your statement of P&L account, no further adjustment required. Only write a note. It is fully deductible and already
deducted and hence no further adjustment required. Now, moving on to the next item, that is GST of 2,10,000 pertains to 22-23 was paid on 27/12/2023. Now listen, but there is one point missing, whether they are claiming input tax credit or not. It is not given in the question. So what to do? Not assumption. It is charged to P&L. See, that's what they said. All the following items have been debited or credited to the statement of P&L. It is charged to P&L. That simply means they are not eligible for ITC. Yes or no? If they would have claimed ITC, they would have never charged it to P&L account. So it is not an assumption. From the circumstances itself, it's clear that they are not charging or claiming input tax credit. Are you all with me? So if you take the other assumption, then it will go wrong. You have to be very careful. Now listen. Since it is a tax, you need to make the payment on or before filing your due date of return. And you have made the payment on December, which is after every due date. There are actually 3 due dates in income tax. For individuals and non-audit case, 31st July. For audit case, 31st October. For a TP audit, transfer pricing audit, there is 30th November. This December 27 is after all due dates. And hence what you need to say is, according to 43B, this 2,10,000 shall be fully disallowed in 22-23. The same can be allowed as a deduction in 23-24. We are computing 22-23's profit. So we need to add it back. So adding back 43B, GST paid after due date. How much is the amount, friends? It is 2,10,000. So you need to add it back to your profits. I hope that much is clear. Now moving on with the next adjustment, what they say is the company has also purchased goods of 63 lakh from Messrs. Jamuna Limited, in which directors have substantial interest. So our company, our directors have substantial interest in another company called Jamuna Limited, and we purchased something from Jamuna Limited for 63 lakh, where the FMB was only 58 lakh. Is there any problem? Yes. In the morning we have covered 48 too. If our directors have substantial interest in another company, then that other company is our related person. And if you are making any payment which is more than the market value, then that excess shall be disallowed under 40A2. Are you with me? How much is the excess in this question? 5 lakhs. So what you need to do is adding back 40A2, excess portion 5 lakhs. Now, what is next? The company has made cash payments for purchases and expenditures as below. So they have given some cash payments. So friends, listen, the company has made cash payments for purchase and expenditures as below. That is on 10/5/2022, 8 lakh due to strike by bank staff. Fully disallowed. Whether the bank is on strike or not, your method of payment have to be account pay, check, account pay, bank draft, TCS or prescribed electronic modes. Otherwise 40A3 will come into the picture. I think today morning itself I have told you. Rule 60D clause number J, it has been omitted from income tax rules. Now, what you need to do is 40A3, because we have a lot of items. I am writing it here. Then we will total everything and disallow in the main computation sheet. So it is 8 lakhs. Then next, 17/8/2022, 5 lakhs. It is due to cash demanded by supplier. Then what to do? Every supplier will demand for cash only. Okay, you are not supposed to make the payment. It also have to be disallowed. Again 5 lakhs disallowed, 40A3. Then cash payment made to transport operator for hiring lorry are as follows. You paid 40,000 on 6/6/2022. Again disallowed, 0.40. Then you paid 35,000 on 3/7/22. Not disallowed. Up to 35 you can claim as a deduction. For that there is no disallowance. Then 52,000 again disallowed. So you tell me how much is the total disallowance under 40A3? 13.92. 13.92 is the total disallowance under 40A3. In exam you need to write a separate working note for this. Okay. Yeah. So again add back 40A3, that is 13.92 lakhs. Then friends, what is next? What they say is the company has incurred legal expenses of 5 lakh and 4 lakh for issue of bonus shares.
Bonus shares 5 lakh, allowable. Yes or no? Now, right shares 4 lakh, not allowable. Brook Bond India. Hope you remember under 35D. If you are incurring any right share issue expenses after commencement, that is never allowed as a deduction. So, not allowed as deduction under 37. So, add back. Not allowed as deduction under section 37 due to Brook Bond India. It is not a disallowance, okay? You must say it is not allowable as a deduction. For disallowance to come in, it should be a deduction under 30 to 37. This is not at all a deduction. And what is the, figure? 4 lakhs. You need to add back. Then, what are the other points in relation to this, friends? Let's move on to the other point, friends. That is, donation paid to registered political party by way of a check 17 lakh. What to do? Add back from the main computation and claim it as a deduction under chapter 6A. 80 GGB. So, add back PP contribution. What is PP? Political party. 17 lakhs. You need to add back from here and claim it as a deduction under chapter 6A deduction under section 80 GGB 17 lakhs. I hope that too is clear. Then moving on to the next one, normal depreciation we have already adjusted. A debt of 4 lakh was claimed as bad in the previous year 17-18 and a sum of 2 lakh was recovered during 22-23. The effect of recovery of bad debt was not given in the books of accounts. So you tell me what should be the adjustment? It's a normal bad debt recovery. You need to add it as your income, not deduct. Add it as your income. Recovery of bad debt is your income here. So you need to add it as your income under 41 deemed income. So we will write again add under section 41 recovery of bad debt. How much is the amount? 2 lakh. That's what you have recovered. I think that's it. Compute the total income and tax liability of the company for 23-24 AY by integrating, analyzing and applying the relevant provisions of income tax law and decided case laws. Give brief reasons for the treatment of each item and ignore MAT provision. I'll tell you what is MAT when we cover assessment of company. MAT is called as minimum alternative taxes. For the time being, just ignore that sentence. Assume the rate applicable to Ganga Limited for previous year 22-23 is 30%. They've already stated that. Assume the rate applicable for Ganga Limited is already 30% given in the question. Don't take any other assumptions. And now let's compute the income under Pgbp first. So can you just help me in this computation? How much is the income under Pgbp coming? 3 crore 77 lakh 82 32. This is before chapter 6A or after chapter 6A? I want before chapter 6A. 3 crore 77 32 32. Now from that you need to deduct 17 lakh. So how much is after deduction of 17 lakh? 3 crore 60 lakh 32,000. That is 3 point, it will be 360.32 because we have written everything in lakhs. Yes or no? That is the total income. Now friends, listen. When you compute tax liability, you have to write the figures in full. When you compute tax liability, you have to write the figures in full. Up to total income, it's okay. Up to total income, it's in lakhs, no problem. But when you compute the tax liability, don't take any chances. Because income tax department only allows a round of provision. That is plus or minus 10. Under that bracket of 10, only it should come. Apart from that, if there is a change in answer, they may reduce your marks. That's what I'm saying. Don't take any chances. In the examination, always when you compute the tax liability, you write the figures in full. This is not to take any chances. Yes. Now, so 3 crore 60 lakh 32,000. Up to total income, you can write 0.32 and all. But when it comes to the tax computation, always convert it to full figures. Now tell me, how much is the basic tax? 30%, 1 crore, 8 lakh, 9,600. Now how much is surcharge coming? Since the total income is more than 1 crore,
Surcharge is 7%. Okay, surcharge is 7%. So, listen friends, 7% on 1 crore 8 lakh 9,600, tell me, how much is the figure coming? 672. So, adding basic tax plus surcharge, how much is the figure? 1 crore 15 lakh 66,272. Then 4% health and education cess. How much is 4%? 651. So adding everything together, how much will be the final tax liability? 20 lakh 28,923 can be taken as 920. That is fine. So that is the final tax liability. Round off into the multiple of 10. It can be written as 920.
To purchase recorded lectures and textbooks, visit our website www.cajoscurian.com.